DocuSign stood up tall on Friday's trading. It was up almost 4%. At the same time, the Nasdaq was down 2.55% and the S&P was down 1.73%. Why did DocuSign go up while the rest of the market was going down? Well, DocuSign is underappreciated. It's a small cap. It's also a software company, and software companies have been left behind by investors going to semiconductor stocks and chasing the AI hyped stocks. And I'd like to go through my analysis of DocuSign. I'm a stockholder. I'll share with you why I continue to buy shares in DocuSign. Why I think it's a good investment for me. DocuSign over year to date, it's up 3.81%, which isn't a whole lot considering that the Nasdaq and the S&P are up much higher. Over the past year, it's looking a little better at 17.88%. But I happen to think this one's going to be going up. DocuSign is underappreciated. If we look at their fundamentals look really good. First, it is a small cap at $12 billion market cap, and the revenue is almost $3 billion. It's a software company, so that's an industry I really like. The PE this year is 12.54, which is not a very high PE. And analysts say it's a hold and that it's almost barely priced. Now, when I look at their financials, the trailing 12 months, they're growing the revenue by 7.7%, which is very good. The company really grew during COVID years when their digital capture software became very, very popular. DocuSign is the leader in digital signature capture, and they are beginning to expand into other product lines within the whole contract management process. Now, their top line revenue looks great. They're very profitable. Their gross margins look great, by the way. Gross margin on this revenue of $2.8 billion is almost $2.3 billion. So the margin is excellent. Their balance sheet is very good. They have cash and short-term securities of $938 million. And they have total debt of $135 million. So they could just write a check to pay off all debt. That's a very good balance sheet. That means the company is lower risk. It means they have a lower likelihood of going bankrupt and having issues related to how much debt they have. When we look at cash flows, the situation continues to look good. They operate really good cash flow from operations, and they don't have a whole lot of CapEx. So their free cash flow is $919 million in the trailing 12 months, which is a very good cash flow rate. I use cash flow and earnings per share to value companies, and that's what I'll do next. When I look at the cash flows that I just showed you, I'm going to use that as my starting point, but I'm going to grow it by a tiny bit, which is 5%, and just have a good conservative growth rate on the free cash flow forecast. And after year 4, I'm going to grow it by a little more conservative rate of 4%. So all the cash flows I expect from the company in the future are in this line. This is the forecast. They have a very good balance sheet. So I'm going to use a discount rate of 8.5%. And it gives me an intrinsic value, which is a net present value of all those cash flows discounted by 8.5% of $20.7 billion. I add cash and take away debt to get to an equity value of what I think the entire company is worth. The market cap's 11.6 billion, so far lower than their intrinsic value. So it provides a very attractive 78% discount if you look at the free cash flows of DocuSign. The earnings per share, I would agree with analysts that say that their earnings per share reveals about a 6% discount. But I put more weight in the free cash flow valuation, and I get a blended discount of 54. DocuSign is an acquisition target. A larger software company can buy this company, get these cash flows, and get that revenue growth as well. So I happen to think that they continue to be a good acquisition target. They were almost taken over by a private equity group in the late 2023 timeframe, which caused the stock to really rally. So it goes to show that this is a good acquisition target for investors. I think the DocuSign business is attractive and desirable. I like companies that have strong moats, barriers of entry, and have market leadership. And DocuSign, although their products are very narrow, they are the dominant leader in digital capture. So I like that they have, I think, a commanding lead in that industry. They have very good margins. They continue to grow their business. It'd be nice to see them expand into other products and continue to be a very well appreciated company within these companies that use DocuSign. So what am I going to do with DocuSign? I showed that they have a really attractive discount. It's a good business to own. I like software companies. So I'm going to continue to buy shares of DocuSign. It was good to see that the market did appreciate them on a very down day. And I think that the next couple of months, the stock may rally well because it's been recognized by some investors who decided to buy on Friday. So I'll continue to buy shares on pullbacks and expand my investment in DocuSign. So that's my video on DocuSign. Just remember, I'm an individual investor, just sharing my experience with you. I'm not recommending you buy, hold, or sell DocuSign. I'm just sharing my experience. Please make your investing decisions independent of this video. Thanks a lot for watching. Good luck with your investments in 2024.
This was a pretty substantial session where the markets just were dropping big time, and it started at the beginning of the week or toward the end of the month of August. And if you look at the end of August to this point, the Nasdaq's dropped 5.73%. That's a huge drop in 1 week. I don't think we've had this bad of a week since 2022. And 2022, actually, 2022, and that was a bad week. Semiconductor hasn't seen a week this bad since 2020 when we had COVID. So it was a pretty bad situation. Having said that, as prices fall, it's kind of emotionally, it's kind of like mixed emotions, right? You look at your portfolio and you're like, hey, it's not fun to see the value of my portfolio go down. At the same time, intellectually, I know I'm buying stocks at a discount. So buying into Amazon, something I'm driving towards having a substantial position in Amazon. Well, the stock market made it easier in buying in that company because it lowered the price quite a bit. So generally, the stock market just really went down. When we look at the VIX, and VIX is the volatility index to measure of volatility. I'm going to go out a year because I think it gives us a sense of when was the last time there was this much fear in the market. And the last time we had this much fear was looks like we exceed or close to exceeding where we were toward the end of 2023. And we did have a pretty good correction toward the end of 2023. It was a good year, all of 2023. We had a pretty good correction. And we've seen a lot of volatility over the last 6 weeks. So it just kind of goes to show that, if you have a market that has seen good gains, right? Because from the end of 22 up to now, the Nasdaq's still up 59%, even though it sold off this week. You're seeing investors kind of take some money off the table. Hey, they've made money on a stock. Hey, take it off the table, recognize that gain, and move forward. I totally get that. So there's a lot of concerns that stocks are priced high. The other story that is, I think it has a lot of merit is, are we going to have a recession? And I would say that, the answer is probably, but the recession isn't going to be too bad. It's not going to be one of these horrible recessions. Like the subprime mortgage meltdown was very difficult, especially for real estate related industries. I mean, it was pretty bad. There was a lot of layoffs. It was a lot of carnage, and there was a lot of collateral damage in financial services. But other industries fared a little better. They didn't go down as bad. And I think the recession that's coming doesn't have any like big catalyst that's going to drive it down. It's just generally a couple of things are coming to a head. One, I think stock prices are expensive, and that's maybe my personal feeling, but if you look at, over the last 5 years, they're up 106%. That may not look all that crazy, but if you look at, the gains that we were accustomed to 20 years ago, they're down here. And you look at these gains and it's like, holy smokes, man, it's a pretty vertical increase. So I would say that, okay, first, stock prices are a little high. Second, I think there was a lot of stimulus money being pumped into the economy 3 years ago to get through COVID. So that way we didn't have people that were unemployed or businesses that had to send their employees home. They wouldn't have we wouldn't have a depression basically. And all that stimulus money kind of went into the economy. The consumer is 70% of the economy. And I think now that we don't have any stimulus money, but we have to compare to those years, it's going to be tougher for businesses to compare to 2022, 2021. I think it's going to be harder for them to grow. That's another factor. Interest rates are lower. So I think a couple of things are coming to a head. I think we're going to get into it in a recession. So let me catch up to some comments here. Looks like Choffman, how do you think the election will affect the recession? I don't know that. So I think the election most definitely is going to bring more emotion to the market. Like if this candidate, gets elected, then policy is going to affect, gains in taxes in this way, or maybe this candidate might help, businesses better, stability of government and so forth. So most definitely I'd be, probably misjudging it if I didn't think there was going to be some effect. There is going to be an effect over the next 2 months. So now how it's going to affect the recession, I don't know. I don't know that either candidate is going to affect how the next recession is going to be handled. I think in general, the recessions are going to kind of take care of themselves because the businesses in the United States basically start to grow. They create products and services that their markets need. So all those things are probably going to help, make this recession probably a pretty easy one or not too bad. That's my expectation. But I'm talking about recession as it relates to stocks. And I think that stocks we definitely had a really bad week, right? Down, the NASDAQ being down more than 5.5%. I could see us going down, 15 to 20% in the next couple months. I know that the week was tough. We'll see what next week does. I have to imagine that there has to be some type of relief rally. There has to be some buy activity because some stocks are really, really beat up. Let's take a look at a couple stocks, and please suggest any stocks you want me to drill into. I'd be glad to go where you guys want to go. But if you look at here's some gainers, but let's look at some losers. Nothing that I can highlight there, but a stock that we covered yesterday in the general stonks session was Broadcom. And look at that correction. 10% one day. And if you look at this stock, it had really run up. The whole AI data center build out has really pumped up the stock. And I'm not arguing that AI is not interesting. I think it's very interesting. But what Broadcom revealed that shouldn't have been a surprise to everybody is they're not growing 47% organically. They acquired a business, VMware, and that's what created the big growth. But if you read their earnings, they clearly specify that, hey, we had 4% organic growth, only 4%. So the whole story of AI is going to make the data center just expand very quickly, and Broadcom's going to benefit from it. Well, 4% ain't nothing. That's keeping up with inflation. So once investors got their head around that, that's what caused 10% down. And I've believed that Broadcom had been discounted. And I see the comment, Choffman, on NVIDIA. I'm going to move to NVIDIA next. But let me open up my valuation schedule here and go to Broadcom, which is now priced. What's their now price? 137 even. So I have to update that. So when we look at Broadcom, they had a 10% down day. Did I get that right? 137. Yeah. All right, and maybe I can close this guy partially. All right, so now that they came down to 137, they're not priced at a premium like I had before. And I covered this stock on my morning stream, but they're still substantially overpriced. They're priced at a premium of 37%. Now, what we're seeing is that this stock had run up to such a high price that it's going to be interesting to see, what is the chart going to look like for Broadcom? Is it going to, go up, go down at the same velocity that it went up? So it went up quite quickly over, let's call it, it went up over the course of a year and a month. It went up 175%. So if you're like, okay, it went up really fast and they have 4% organic growth. It's like, why did it go up 175% if you're growing 4% organic growth? Well, it matched that type trajectory to the downside. And FYI, there's a saying in stocks, you go up taking the escalator over time, you go down taking the elevator. So we may see like a really bad pull. I mean, we're already seeing a pretty bad pullback, but we may see an even worse pullback where you see, Broadcom lose a lot of value fast. If we look at Broadcom, okay, so the next question that was asked was, let's look at NVIDIA. So NVIDIA today went down 4%, but it's been going down a lot. NVIDIA is a stock that I've covered a few times, and over the last, I'm going to call it 2.5 weeks, it's down 21%. That's a substantial correction on NVIDIA. How is this, stock going to behave? It's gone parabolic. Okay. Now there's another parabolic stock that is out there, and that's a super microcomputer, which just took off like a rocket ship. And it went parabolic, but it's ending very, very painfully for investors. Look at that chart. Woo, went up and then it came back down. I don't know that NVIDIA is going to do that, because I think NVIDIA does have greater value than super micro, but you can see that super micro over about 2 months went up almost 300% for a hardware company. Hardware companies are not that valuable. And since March 13th to now, it's down 67%. So it's getting crushed, and I don't know that it's going to stop. The downward momentum on super micro, it's got a lot of radiation. It's just undesirable. Why would you own super micro? At what point is it going to go up? I don't see what's going to stop the downside. And that's what becomes super painful to these companies. I'm going to show one more example that goes back in the history books, but I think it applies here. Going back in the history books, we're going to look at Cisco. They were such a great company and an important company for the internet, the build out of the internet. They went parabolic. They had the best technology of the day, and the market just priced the stock way too high, and it just collapsed. And it took a long time for it to begin to rise, and it's never risen to the level it was before. This is a real company that had the best technology to build the internet. The internet is truly an industrial revolution. I don't care what the NVIDIA CEO says. AI could be interesting. It's not an industrial revolution yet. Show me more evidence of that and I'll believe it. But if you look at where Cisco went from its high to its low, 87%. Meanwhile, it was growing its business, it was profitable. Just the downside pressure and energy and momentum took this stock, and just destroyed the price of the company. And it was very hard to see the stock rally because everybody was getting burned on Cisco. They didn't want to touch it. So I think that's where Supermicro is going. I don't know where NVIDIA is going to go. NVIDIA is up here. It was up here. Now it's collapsing. I happen to think that NVIDIA is overpriced. I've done a valuation on NVIDIA. I'll show where I think the stock is priced. I think each share of NVIDIA, and I give them a very optimistic valuation. It's worth, each share is worth $75 per share based on free cash flows and earnings per share. So it would need to come down another $27. But what I'm saying is that once you see these parabolic stocks start to go down, the momentum really pushes past their valuation. Again, I don't know if that's going to happen in NVIDIA, but as it keeps getting slammed, I could tell you big money managers, these big money managers they're handling money for wealthy people. They're going to be exiting this stock and staying out of it because it's burning them with their investors, and they can't lose investors. Or they can, but they don't want to lose investors. They don't want to lose the confidence of their customers, their clients. So, if you see this down energy, it's down a couple, like 0.42% in after hours. This could become a really interesting situation where we see NVIDIA continue to go down. That's going to be super interesting. Now, we've needed this, and the reason for it is this is abnormal. It's wrong. It's artificial. It's, you give me the word. I get when a company has a great technology. I get that. But for it to go up, fivefold in what is 2 years, actually a year and a half, you just cannot explain it with rational fundamentals, rational valuations. It's a pretty bad situation, and we'll see where it ends, man. I'm shorting NVIDIA. I think I'm up like 12% right now. I'm going to get out if it gets to 30, and I'm shorting Broadcom. I'm up about the same amount on Broadcom. I'm probably going to get out of that when it gets to like 20, a gain of 20%. And kind of, I shorted Supermicro, walked away with a good gain. I shorted CrowdStrike, and I'll kind of cash in and kind of, I learned something along the way, which was, hey, I saw this and began to really put a thesis out there. And then I put some capital out there, not a ton of capital. I mean, it's not like I put $1 million and, oh man, I made this amount of money. I put enough capital out there where, if this thing went the other way and it ended up causing a 30% loss, it was a couple of grand that I lost, and I paid the market for that lesson. Instead, it's going in the direction that I thought it was going to go. But really, the next week or two on NVIDIA, it's going to tell us the momentum and it's going to tell us the direction. And this is going to become potentially a very, very painful situation for stockholders. We'll see. We will see what happens. And the market is very, very interesting. But not only NVIDIA is losing money. Let's take a look at, so CRM's the next symbol. It's, I guess it's Booz Trader. 1 second, give me 1 minute. Let me just catch up on comments. And we're going to go to CRM. Yeah. Avgo and NVIDIA have been kind of correlated. Now, I would say that NVIDIA intrinsically is more valuable than Broadcom. Why? NVIDIA controls the intellectual property of graphical processing units, which is the best technology to use in high performance computing, which is what is in real big demand. So you cannot build large language models without NVIDIA. It would just take too long. NVIDIA is in control of what's the highest desirable, most profitable, highest value technology, period. Broadcom is nowhere near at that level. Broadcom is competing against their competitors. They do have intellectual property that's unique, but nowhere near as valuable. They could be substituted with other products. So Broadcom and NVIDIA are not at the same level of value. That's why I shorted Broadcom. And FYI, I was a stockholder of Broadcom as recent as late 2023. I've known a Broadcom for a long time, so I'm very, very familiar with the company. But I have to agree that the patterns are the same, but they're different companies. I would put that out there. So Goldens, they have doubled amount now for buybacks. Yeah, so NVIDIA buybacks. So when you're in a growth pattern, right? Like you're growing, like NVIDIA's growing their revenues quite substantially. And let me get to the NVIDIA chart, or the fundamental, excuse me. And I've talked about this on, like I did a long video on NVIDIA. And this is why NVIDIA went parabolic, is the growth, and that they're growing, and they're becoming a really substantial company, 96 billion. Now they are cyclical, but when you look at the month over month growth rate, that's where the growth rates really slow down. And it's expected, just based on their guidance, that their growth rate is really kind of being cut in half each quarter. At a certain point within a couple quarters, they're going to be growing like 15, 20%. And that's going to be like, wait, that's not very high growth at all. Exactly. And that's what investors are getting, their heads around. They're doing buybacks. Now, if you're in high growth mode, you don't do buybacks. You keep the cash because you want to create more capacity to sell more GPUs. So I actually think their buybacks is a negative story. It's a negative aspect. It's like they see that they're not going to have the demand. They're not going to need that capital to buy inventory, to, buy all the materials that are needed in order to fulfill, demand that's going to come in 2025. So I actually see that as a, tipping of the cards that NVIDIA, is saying, hey, I'm going to buy back shares because we don't need that capital because I think our demand is going to drop in 2025. That's a complete speculation on my behalf, but I'm an investor and I get to speculate and I get to invest the way that I want. But I'm glad you pointed that out. I think that's Goldens. Thanks for showing up. So let's look at CRM. So CRM is Salesforce. What have they been doing? I know that they did their earnings and they had good earnings, and I think they went down when they announced, but then they rallied the next day. Yeah, here we go. So let's look at the monthly. Yeah, they announced. When did they announce? Let's see. So they announced on August 28th. So on August 28th, yeah, I thought their earnings were pretty good, but now they sold off. They've sold off 5.77. So something that I've noticed is software companies have not been getting a lot of love from the stock market. And traditionally, it's a great place for value. Microsoft's a software company. Software companies are very, very profitable. They have great margins. They have sticky businesses. They provide great free cash flow. But Salesforce has been kind of left off to the side along with Adobe and other software companies like DocuSign, and as another example. And I would say it's because a lot of the attention's with the semiconductor industry and the hyperscalers like Amazon, AWS, and so forth. So that type of attention, and the investors have been routing their capital toward those hyperscalers. But I think it's a really good place to find value. I'm buying into a number of software companies because I believe that they're being priced a very good price ratio. If you look at their fundamentals and the cash they provide, these are good companies. Let's look at Salesforce real quick. Growth, and this is organic growth of 10%. I just showed you that Broadcom who's supposed to be in this data center build out and everything's the craze around AI, is only growing at 4% organically. These guys are growing at 10. So that's very good on a very substantial number. Okay, good job. Good job, Salesforce. And when you look at their free cash flow for the trailing 12 months, $11.4 billion of free cash flow. It's very good cash. I would value Salesforce at around $240 billion, maybe a little better than that. And you can see that you're getting a small discount just based on my back of the napkin kind of calculation. If I take 11.4 times 20, it ends up giving me about 230. I could probably get up to 240, 250 because Salesforce does have a good balance sheet if I recall correctly. Analysts like the stock. It's discounted by 25%. They primarily look at earnings per share when they value a company. I look at both and I put more weight in the free cash flow valuation method that I use. And these guys here, a lot of analysts cover it, 34 analysts. I mean, this is a very well covered stock. And on average, they're saying, hey, they're going to be really doing well. So CRM is not a bad idea, man. It's not a bad idea at all, especially when you have these markets that are correcting, everything gets sold off. It's like the whole store. It doesn't matter if certain stocks have a lot of value. They're doing well. They're growing their businesses, like in the case of Salesforce by 10%. Doesn't matter. It's being sold off. That's an opportunity. That's an opportunity for somebody who believes in Salesforce to buy shares at a discount. So it leads me to let's talk about our friends over at Google Alphabet. So Google Alphabet's down 4% today, and it's just a stock that I can say 100 good things about Google Alphabet. And you can see this over the last month, it's really come down. And I'm buying shares of Google Alphabet because I believe over the course of time, Google keeps getting stronger and better. They have the Google search business keeps growing, getting more profitable, being a better company. And the YouTube business is now the number one streaming platform around the world. It's even bigger than Netflix. So number one, their Waymo business is really exciting for self-driving robotaxis. You have their cloud business, which is growing faster than AWS or Microsoft Azure. It's just a loaded company. Their AI business is really, really something. It's super valuable. It's got a pretty good grasp on the future. It's going to compete against ChatGPT and the other major AI companies. Having said that, as we look at a market that is correcting and just bringing down stock prices, Google is a better company than they were 4 years ago. Their YouTube business is bigger. Their search business is bigger. Their cloud business is bigger. Their self-driving car business is really taken off. So over time, and more specifically, if you look at since July 1st, which would make it a month and two months and call it a week or two, they've dropped quite a bit. And let me try to grab that and give you a number. So from July 1st, or from here to here, they've dropped 7%. But in that time, Google hasn't gotten 7% worse. I would argue that they've actually gotten better. Over time, they're getting better and better and stronger. So as the market corrects and it starts really bringing down the prices of everyone's stock, it provides an opportunity to buy shares at a discount. And I'm looking at Google. This is high. I'm looking at CRM. I'm looking at the wrong stock. Sorry about that, people. Man, sorry about that. So from July 1st, here we go. This looks a little better to here. So Google Alphabet's down 20.75% in the last 2 months and a week. So again, my rationale is, well, did Google lose 20% of their cloud revenues? No, they actually grew. Okay, did they lose 20% of the YouTube viewership? No, it's still number one. And their search business, no, it's still freaking dominant. So the market's just really selling off a company just because, you know what, for a million reasons. But the reality is, I believe that this is an opportunity. I'm a believer in the Google business, so I'm gonna keep buying shares. That's the opportunity. When you look at companies, and Meta is the perfect example, right? And the same company, the market will abuse. It'll say, okay, we get you, Meta. You're number one in 2021, but we lost, confidence in you. The whole market sold off, and Meta was sold off by 76%. And the business was still growing. They had their problems. The metaverse didn't work, but it was sold off by 76%. So much that it lowered the price so much that once it began to really lift and get to its true value based on cash flows and earnings per share, it just launched and it's up 451%. And I would say this growth is really, I would say, sustainable, and you can rationalize this growth because they are a larger company. Their cash flows have expanded. A lot of good things have happened. But this is the lesson, is when the market gets really going in one direction or another, especially to the downside, you can find the next meta. We just have to pay attention. And it's really hard to time investments, right? So what I did is I bought through this whole range, okay? And I continue to buy shares of Meta. So I didn't time it perfectly, but I could tell you that I bought shares around the time when they were down in the 80s. So that's the lesson of these corrections and these crashes. We were down more than 5% in 1 week. At that rate, we'll be down 20% in the month of September. I don't think that's going to happen. We should have some rallies to the upside. We should have some flat days. Maybe we make it through September only being down 8 to 10%. But I think this fear is going to linger into the month of October. And maybe the month of October and September collectively will be down, 10 to 20%. That's the kind of correction I expect, because there are some stories that are real, like the economy is probably going to go into recession. We have an election. We have these things that are going to drive more fear. And that fear is going to cause investors to sell off and maybe say, hey, I just want to sell stocks. This is too ugly for me to see. I want to sell my positions and just go away. Okay, that's fine. That's not the investor I am. When everybody's selling and stock prices go down, I'm looking to buy. I'm looking to establish positions and try to buy in these zones so I could then see those dollars that I invested just rocket up when the market realizes, hey, that company's awesome. I think the stock price ought to be higher. So that's the lesson we could take away. All right, so let's keep rocking here. Keep the comments coming. What other stock do you want to look at? We went over Broadcom. I wanted to take a peek at DocuSign, because DocuSign, believe it or not, was up 4%. Holy smokes. On a day when stocks got crushed, DocuSign stood up tall at 4%. There's good reasons for it. This is a software company. We talked about Salesforce a few minutes ago, and I talked about how Salesforce has a healthy business. Well, DocuSign's right there with Salesforce. DocuSign, you probably are aware, they do digital capture software. They're the dominant player in that space. And when we look at their fundamentals, you see that the company is growing 7.7% organically. Again, back to Broadcom. I'm going to keep beating them up, man, because that stock price certainly deserves it. 4% organic growth, and they were just shooting up, parabolically on their stock price. These guys are growing at 7.7% organically, very well. They also have great profit margins. You look at their gross. Hey, everybody. Welcome to the live stream, and welcome to the new football season for the NFL. It should be a really interesting season. We'll see how it goes. I'm in Los Angeles, so as you guys may know, in Los Angeles, we didn't have a team for a long time, so I'm not quite sure who to root for. Depending on the week, I root for the Chargers or the Rams or the Raiders, which all have a connection to LA. And we'll see how things play out. It looks like in the early going, some games that we have out there, Steelers, Falcons, what are going to be the big games? The Raiders, Chargers is going to be huge. That's going to be huge. And man, I wonder if the Browns can beat the Cowboys. Looks like in the chat we've got some Saints fans. Who can dislike the Saints, man? Saints are a good team, good town, good time. Thanks for joining, guys, on YouTube. Earthbound Misfit, it's been a while, man. Sorry I haven't been streaming on YouTube. I've been focused on Stonks, but now I'm streaming to both Stonks and YouTube. Android PC gameplay. Do you think SoFi will do well after the rate cut? We look at SoFi and we've looked at it a few times. I'm going to look at it again for you. The conclusions that I've made in the past were I like Robinhood more, and I like other alternatives more. I think SoFi has a business that's going to take a lot to get it to a profitable state, to get it to where I think it needs to be in order for it to be a really valuable company. But let's take a look at it. Maybe something's changed. And good to see you, Android PC. Till the end. Hey, what's up, man? Good to see you. I was wondering if you're following the Bitcoin miners. I am to some extent. And man, the whole crypto universe is really, really having a tough time. Bitcoin prices are down substantially, and that is not fun for cryptocurrency investors like myself. Most of my money's in real estate, number one category, number two stocks, number three is bonds, and number four is crypto. So Nice, very smart guy wants to look at Nice. Man, you guys showed up ready to play. YouTube's making it happen. Very nice. We'll take a look at that. And let's get into it, man. So I'm just going to follow what you guys want to do, man. We can talk about that massive correction we had last week, but, let's not dwell on the past. This week might be better. So let's start talking about some new, fresh stocks. Looks like we're going to look at SoFi, Nice, and maybe a couple Bitcoin miners. So I know that Marathon is a Bitcoin miner. We'll look at that, and BTT. All right, so SoFi. SoFi has a pretty ambitious business plan, right? And that is admirable, but their stock is not doing well. It's way down here. So every time this comes up, because SoFi comes up, and maybe it's because in the year to date, there's been a lot up and down, right? So you get really teased by these really nice runs. It goes up 20%. You're like, oh man, I missed a move on SoFi. And then next thing you know, it goes down 24%. You're like, oh, why the hell did I buy this stock? That's what I would be saying. I don't know in the stock. Up 23. It's like, man, if this was a roller coaster at Six Flags, this would be a crowd favorite. This would be right up there, man. This might be a really good roller coaster design. Up 27, and we're on our way down. So, man, if you want intensity, if you want action, this is a stock for you, ladies and gentlemen. Now let's compare that to Hood, which is my preference, and I think they resemble each other. But you notice the big difference: up 53, down 27 over the 1 year, and actually year to date. The 1 year, it's the same story. So Robinhood, I started buying Robinhood back here. It really did well. Why do I like Robinhood? So it's one thing, like I think SoFi is trying to go after retail banking, and they're one of thousands of competitors that have tried to do that. And not to be a naysayer about the company, but it's just not very profitable to run banks and operations that resemble a bank. Robinhood, on the other hand, is like, hey, we're going to have to go after brokerages, and we're going to go after the next generation of investor, these smart, next generation from hell. My son, right, he started investing at a really young age. I'm not going to say what age because he used my name, but it was a while ago, and he's 20. And he's totally a stock investor, crypto investor. He's 20. He's on the way, man. And there's a lot of people that are really informed. It's the golden age of investing. You have a lot of good information. You have resources like myself and other channels, communities that you can be a part of. Robinhood is the user experience is for the next generation. The community and the culture of that company, it's next gen. I'm 56. I was the previous gen. So it's just a reality. And it's really working. They're growing their customer base. They're growing their fees. They're just growing. So I like Robinhood more than SoFi. Why does SoFi, why is the price so down? And I think the question you were asking is it going to rally? And I think my opening remarks kind of are going to be telling of my conclusion. So the revenue growth it's there, right? You got good revenue growth. Now, are you doing it profitably? And the answer is no. The good news is they're losing less money, but they're still losing money. So they're losing money. they're like a bank, so I can't value them like I typically do, like based on cash flows and so forth. You would just need to do that because banks, you want to do it on book value. And I think we can get to book value. When we look at their earnings per share, there's 13 analysts that cover the stock, and they're on average, they say it's discounted. So 28%. There's a optimistic person at $14 a share. Pessimistic is $3 a share. They're not profitable. So it's like, they're supposed to turn a profit this year. If they turn that profit, they're probably going to rally. So, and then they're supposed to grow it substantially next year and the year after. So that looks interesting here. If you think they're going to pull this off, it's probably going to rally, right? But that's all on you. I'm not a buyer of SoFi. It's not the type of business I want. They're competing for low margin financial services, and Robinhood's creating a bank, but it's kind of there. It's just a side business. Their primary business is brokerage, and they're into crypto. They're into a variety of things that make a lot of sense to their community. So that's my opinion on SoFi. It's not a positive one. It's just an opinion, and I've maintained my consistent, opinion on Robinhood and SoFi. And just a reminder, I'm just an investor, share my experience and opinions on stocks. I hope you find it interesting, but it's not financial advice. Any stock I talk about, it's not a recommendation to buy it, hold it, sell it, short it, do anything with it. So, all right. So we're going to look at NICE a little later. Very smart guy. All right. The IQ of this stream just got a little higher. So much insider selling in HIMS. HIMS has been impressive with their growth, but it's interesting you're picking that out. So the Family Guy, what's up, man? What do you think of DLTR and DG? Will end up like WBA. Stock took a big hit. Let me take a look at those, man. You got like 3 symbols going on there. So I'll put them together, do some analysis, see what's going on. See what is going on with those stocks. Mike, the dividend investor guy. How are you, sir? You own SoFi and Hood. I'm up on both, but doing better in SoFi. Interesting. You know how to buy stocks, sir. You bought them when it was low. It's been up and down using volatility in your favor. Very nice move, Mike. And you'll be adding more shares if it goes down to 650. Interesting. I hope you're right. I hope you make a ton of money. And there's thousands of stocks to pick from, guys. You can only buy a limited number. You can't manage that many. Just because I don't own it or don't like it doesn't mean it's not a great stock, and you could probably make a ton of money. So good luck. Yeah, I hope it's a profitable year for them. I've got PNNT and EIC on the list. Let's go there next because I had noted those on my list of action items here. So let's get into it. So PNNT. So these guys are Pennant Park Investment Corporation, a business development company, is a private equity fund specializing in direct and mezzanine investments in middle market companies. Okay. Small companies are kind of unappreciated, undervalued, in my opinion. Okay. So these guys are like private equity. All right. Asset management looks good. They pay a big dividend. Okay. And we're going to take a look at that dividend, see the history, see if it goes up and down. Stock's done okay, although it's only up 9%. So over the 1 year, it's up 7%. It has had a pretty strong pullback recently. What's up with that pullback? Why did it pull back? So this pullback, stock went down 12%, but what stock hasn't, right? Over the last couple months, it's been a pretty tough market. So they're right there with most other companies, especially these small caps. I think small caps, you can find value. I'm not sure they're going to rally really fast, but I think you can definitely find discounted companies if you look at small cap. So let me take a look. So PennantPark, all right. When we look at their financials, it looks like they were growing nicely, but this growth is, it probably means they acquired another company because the companies they own are probably passing through a lot of their profits. That's what they're collecting, is profits from all these companies. So if they buy a new company, there's more profit to be had. So that's kind of their business. Quarterly, looks like the revenue did go down substantially in the most recent quarter. I wonder why. What's going on with that? I think there's some homework to be done here. This is an interesting idea. It's financial. It's in the financial sector, but these guys are buying small companies. I think they're owning small companies when they're really discounted. So I'm like, there's probably a lot of value there. I would study their balance sheet's probably going to be a little wonky, but let's take a look, because this is not like a traditional company like a Google or a manufacturing company. These guys attract investments from usually wealthy people or pensions and so forth. Then they work that money and try to make a very good return for investors. And that dividend really shows up. And these guys so they have 59 million in cash. So net debt, 757 million. I'm not sure if that's a lot or a little. And you can't really use EBITDA because they're not really producing EBITDA. They're getting all net income from these companies, and that's what they're showing up on their financial. So let's take a look at that dividend. So the dividend is 13.85. Look at the history. So they paid 80 cents for 4 consecutive quarters. It used to be 70 cents. Used to be 21. Used to be 20. Wow, they really raised it in 2023. Now, it did go down in 2016. It went from 28 cents to 18 cents per share. But since then, or actually, it went down again in 2019 in 2020, excuse me. Now, this, I give them a pass. Oh, COVID, pandemic. Do you want to be giving out all your cash? No. We need to figure out how bad this pandemic's going to be. And then the pandemic was bad. And ever since then, they have been raising their dividends. So it looks good. I think I'm seeing good stuff. I'm seeing that the dividend has been raised since COVID. That's a good thing. The dividend's really high. This is interesting. I'm not ready to pull a trigger on something like this, but I'm ready to, kind of look at these financials and look at this company a little further, because there's pieces to it that I sense are really valuable, but I just got to make sure this company is solid. And the website's having a couple bad pages. Smart credit, smart relationships. So they give out credit to the middle market. So as a mid-sized company needs working capital, they go to this company. That's a good proposition. I like it. There is, one potential risk factor is we're probably going to go into a light recession. Is that going to stress some of these smaller companies? Likely, yeah. So I would say do your homework on this one. I think it has a lot of interesting aspects to it. I'm putting a little gold star next to it so I can take it offline and kind of dig into it. But you've got something here. It's kind of like that big dividend. Okay, I'm not an investor pure on dividends. Uh, I have great companies that don't pay dividends or pay a tiny dividend. They're great companies and their appreciation is awesome. That's what I want. I want appreciation. If they pay a dividend, that's nice too. Like 3M, I picked it up. I have a dividend yield of 6% when I was buying the shares. I'll take it. And the stock's up nicely. So I'll take it. But that one looks good. Let's take a look at EIC. So EIC. So Eagle Point Income Company, close-ended fund. Okay. It's up about 8%. Not bad. The market's was doing great up until last week. And really, the last 6 weeks have been down and up and down for the stock market. Okay, so that's Eagle Point Income. So Eagle Point Income Company manages capital on behalf of institutional high net worth and retail investors through private funds, separately managed accounts, publicly listed close-ended vehicles. They provide CLO securities. Okay. So another financial services company. So their stock's doing okay. Big dividend. You brought 2 big dividend payers. And these guys are, let's see here. So the dividend rate, they paid 20 cents a share. They moved it up in 23. Before that, it was 16. They moved it up. 14, 12. Okay, looks good. Here, for a short while, they kind of suspended the dividend or lowered it a little bit. But it looks like it's a strong company if they keep paying that dividend. I would check out their, this is a company worth taking a look at. I can't give you a clear opinion because they're very different companies. Like my tool set is, take a company that produces traditionally cash flow. I can even do banks, but these guys are different. They're taking high net worth capital, investing it. Interesting proposition. Both PNNT and EIC are interesting. They just need a lot of homework. And the one word of caution I would put out there is if I'm kind of pausing and going, whoa, these guys are different. I think a lot of investors would feel that way. So I don't know that you're sitting on a multi-bagger here. If you like the dividend and it works for you, I think if you buy it at the right levels, and it sounds like, Mike, you know how to buy stock, you'll be in good shape on that one. But I'm not going to, I can't form a solid opinion on it. I would just say I see a lot of interesting things. I do see a couple concerns. One being the economy. If it has a recession, both these companies are going to be affected negatively. And then second is their stock isn't going to be super popular. It's never going to appreciate super fast like a Meta or another company like that because it's hard to get your head around their business. It's not really a business. It's a company that owns parts of other businesses. So it's hard to put your head around it. I'm pausing. I think a lot of investors would do the same. But good ideas, man. Thanks for bringing those. Good luck with them. I hope you find what you're looking for there. All right. So I'm going to get to Fun and Disney, which were a request on some comments on my channel. So I noted them. Before I do so, let me catch up on comments. So we're going to look at NICE at the end of the year. So CEO is leaving NICE at the end of the year. Interesting. Okay, well, let's take a look at that. What are your thoughts on Brookfield, BN? Take a look. See what's going on. Siri. So Siri, I think I looked at it, and I think it rewarded investors recently that I think the stock price had gotten so low, it just jumped up. So we'll take a look at it. All right, that's 7 cents and 8 cents. I'm not sure where that goes, Mike, but thanks for putting that. Yeah, you're welcome. Good ideas. It's just not one where I could clearly understand, their financials and then kind of get to rough cut what I think about them. So thanks for bringing that. All right. Android PC gameplay. What a reverse market crash referred to. It keeps reverse market crash. That it's going to rebound very quickly. I know that was I know the correction we saw in the month of August, it was impressive how fast the market came back. I guess I'm gonna have to go to the 6 month. You see how like the market went down 13% very quickly. And then it said, all right, enough of that. We're going to go up very quickly. So it was impressive how fast we made up a lot of those losses. So maybe that's what you're referring to. But I think that one thing that I would say is leading me to believe that we're in this for a couple months, if not throughout the 2024 year, is from the previous high, it didn't even come close to the previous high. So we might be establishing a new trend line to the downside, and investors are scared. Investors are looking at this situation saying, hey man, stock prices are high. Okay. Maybe not everybody agrees with that statement, but stock prices, in my opinion, are high. And you have some concerns. You have an economy that might go into recession. You have unemployment, may creep up. You have an election this year. You have some things that are concerning investors. So with that in mind, I think we're not going to continue to go up on this trajectory where it's like, oh, cool. We have some adversities. We have some ups and downs, but this chart looks pretty darn good. I think we're going to have a little bit of sideways action, kind of like this over here, but we'll see how it plays out. All right. So Siri, go with Warren Pumpit treatment. Not sure what that means. Okay. And then Brad Rowland, thank you so much for attending. How did your Georgia Bulldogs do? Let's take a look. How did the Bulldogs do? I love college football and I love the NFL. So Georgia's ranked number 1, I believe. And then we'll get to your stock request there. So I think Georgia's 48-3. And if Georgia is been very, very good the last 10 years. I'm way out in California, but man, they've done well. So nice. 48-3 against Tennessee Tech. Start that SEC regular schedule. That's a tough conference, but it really brings out great teams. All right. If I can get HNST around $3, I'm going to grab and hold long term. I think the stock will be well over $10 in less than 3 years, but I want a little more leverage with this economy. Let's take a look. HNST. So The Honest Company. Okay, this is that actress. I forgot her name, but she's like a very likable actress or actor. So they manufacture diapers, personal care products they don't have as many toxic ingredients to them, and that was the whole idea behind it. Is I think she became a mom and she became very well aware that, hey, some of the products we buy, they have chemicals that could be harmful, especially over a long period of time of using them. So the market cap, and they're here in Southern California. I believe they're in Santa Monica. Yeah, they make Wholesome Products. Yeah, I believe they're in Santa Monica. I've driven past their headquarters. Okay, so so we know what they do. They're kind of a premium consumer product goods company. It's not a bad idea going into recession, right? They're a buy with a 15% discount. Looks like they don't have a dividend, but market cap $400 million company, tiny. Revenues 355. So with consumer packaged goods companies or consumer product goods companies like this, it's good to look at, the gross profit. Now, I would kind of compare this one, and I'll do that real quick, compared to one of the giants like Procter and Gamble. Let me open that guy up. Procter and Gamble is massive, right? And when we look at Procter and Gamble, like these guys are 412 billion. The Honest Company, 413 million. Is that 100 times larger? No, it might be larger, like 1,000 times larger. So as we look at these guys and we look at their profitability, they're doing 84 billion in revenue, and their gross profit is almost 50%. You see that? Gross profit. And right here, cost of revenue, that's the actual product. If you sold a bottle of shampoo, it's for the plastic bottle, it's for the liquid inside, it's all the manufacturing costs go into that cost of revenue. The Honest Company, they have 355 and 230. So their margins are smaller than Procter and Gamble. So their manufacturing capacity is probably not optimal. And they're just not as profitable as Procter and Gamble. That would be an item of caution for me. It's like, wait, you're a lot smaller and you're less efficient. It's showing up because they're losing money. Now that's pre-income. This is all GAAP related. So we're going to look at cash flow next and see if they cash flow. They do cash flow. So at 18 million, and they're growing at 6%, looking at the quarterly, 10% is good growth. Okay. So if I look at 18 million times 20, 360 million is where I would kind of say it's going to be around that much. And right now they're selling the whole company for more than 360 million. So they're, in my book, based on cash flow, they would actually be priced at a premium. So let me open up my intrinsic value calculator. It takes a little while because it's a big file. So give me a second here. I'll get it going. Once it opens up, we'll take a look at the intrinsic value of the Honest Company. Now, I get what they're trying to do, which is, hey, we want to be like the wholesome brand. We want to be the brand that moms really want to buy. I get that. But I think it had like and they have an actress with a lot of star power. So she could get a lot of like free marketing. But I just wish their margins would be higher. That way they'd be like, yeah, it's a premium company. They get to charge more, but it's not showing up. Now looking at their earnings per share, let's look at the valuation, looking at earnings per share. 5 analysts cover it. That's not bad. It's a tiny company, but you see that star power of that actress. So the most optimistic analyst says it could go up to $6.50. On average, $4.65, and then the low is $4, which isn't totally bad, right? It could go down 33%, or it could go up 50, 60%. Now, it's expected that they're going to lose a little bit of money this year. They're going to lose a little bit of money next year, and then they're going to make a little money in 2026. So not a ton of value, like on on the surface, this would probably be a company that I would probably not invest in unless you feel like, hey, they're going to start to rally. There should be some. There should be something going on that's going to help them rally. If you have a different perspective on it, like, hey, there's going to be a catalyst that's going to help them. I mean, they've done a good move in the last 3 months, 62%. Wow, it's a very good move. And toward the end of 2023, look at that tear, up 325% because they were trading, at $1.16, $1.10. So you could have picked up the stock and quickly, four-bagged the investment. Phenomenal. So I think this is what's catching a lot of attention. I'm not seeing a ton of value. This isn't in my lane. First, I don't like companies that have low margins like this. I think the Honest Company has hard competition with these guys, right? Procter & Gamble. They do have a differentiator in the marketplace, which is we do more organic and wholesome products. Get that. But it's going to be hard to compete against these guys, especially in a recession where maybe a Procter & Gamble has a product that's less expensive and the consumer's like, hey, I'm not going to buy the Honest brand because I'm on a tight budget. So I got to buy the least expensive product that I can get my hands on. All right. So let's look at the calculator really quick. And I don't have a lot of companies like the Honest Company. So I'm just going to jump in and just use I can use DocuSign as an example. All right, so this is the Honest Company. So this is a risky company. They were down to $1 a share. I mean, that's pretty low. So I'm going to go with 11 because they're low stock price. They're a small company. They have huge, gigantic competitors. There's a lot of risk in this company. Cash flow growth. I'm going to go with 10% in the first couple years because I think they are headed in that direction, it being profitable. They just got to develop better scale because that scale is really like terrible. And then 18% would be the starting point, and I'm going to add the growth to that number. So it gets us to a valuation of like 300 million. And I don't know that they had more cash than debt. Let's take a look. So we had cash flow of 18 million. On cash, they have $36.59 million of cash. Total debt, 25 million. Very good. Very good. That means they have about 36 versus 26. Okay, that's good. No debt. So the best I can do is that number, and I think these guys were like 405 million in market cap. 402 million in market cap, and shares outstanding 100 million. So it's the equity value is 313, market cap is 400 million in the market, so it's overpriced. Each share is worth $3.13, but they're priced at $4.02. So there's about a 22% premium on the Honest Company. And this kind of company, with it being small, and it almost got delisted completely, right? Because it almost reached $1. I would want a big discount, like 50, 75%, even 100%. Because there's a lot of small companies that you can find that are going to provide just a stronger offer to an investor. This one, it's got a lot of risk. It's already achieved a lot of its upside, right? It really did go up nicely. I'm glad to see that. I hate to see a business go down. But this one here, it's just it's got a lot of risk to it and not a lot of potential upside. I think based on their forecast for their free cash flow, earnings per share, they're not going to set any records, right? They're just going to barely become profitable. So is that going to excite investors going from 375 to 415? I don't know. I think I see this one's a pass for me. And there's way too many red flags and not enough like potential. Hey, I could double my money. I could quadruple my money in the next couple of years. But that's how I see it, man. Good luck with it. Hopefully you found that interesting. And it looks like Mike is up to date on scores with Georgia. Very good. So Buffett's been buying Siri, huh? We have to look at Siri. All right. And Buffett bought Occidental. I'm sorry, he bought Chubb. Wait, which stock did he buy recently that went down? Not Chubb. I forgot the stock that was revealed that he started to buy into and it went down. Jessica Alba, that's the actress. Yeah, she's nice. I like when she comes out in movies. She usually has like a positive persona. A very smart guy. Looks like it could be similar to Carter's. Yeah, in a way, because I think Carter's does baby clothes and stuff, right? So Ulta, yeah. Don't ask me about makeup, and I guess don't ask Warren Buffett about makeup. And if we can make money on makeup, Ulta, I pump the brakes on because they have a lot of competition. I mean, the beauty category, there's competitors in Europe, there's competitors everywhere. And Ulta does have a different kind of model, but it is an expensive model. It's a retail model. We got to really rent out really expensive real estate and then operate it. So if you look at their financials, let's look at Ulta. That one's an interesting one. We'll do it toward the end because I know some people are waiting for me to talk about the companies they're interested in. So I think the next one we're going to touch is nice. Looks like I'm caught up on comments. Let me make sure I'm looking at all comments. Looks like I am. Yep, looks like I'm current. And we're going to look at nice. So what does NICE do? NICE, together with its subs, provides cloud platforms for AI-driven digital business solutions worldwide. It offers CX1, a cloud-native open platform, Enlighten, an AI engine for the customer engagement market. Now, this is one of the markets that AI is going to really change. The whole service, right? I have a new PC. I'm streaming from a new PC, and part of the new PC, one of the key pieces of software that I run is not running right on this PC. So I reached out to the software developer and put a chat in there. Hey, I need help. This is the issue that I'm having. And it came back to me and said, we'll get back to you in the next 12 hours. I'm like, whoa, okay, thanks. So hopefully sometime late tonight, they're probably going to get back to me. So that's an experience that's not very positive, but with AI, maybe the AI app would have looked and said, oh, your issues like these 5 issues. Have you tried this? But it didn't. All right. So we know what they're doing. It's a software company. I like software companies. This isn't a brand new space, $10 billion market cap. They're $2.5 billion in revenue. They are profitable. Now, I'll check something out later that I'm going to talk about. PE isn't bad. This isn't bad. Okay, good. It's a strong buy, 69%. So what am I missing? They're AI, and it seems like they got it together. And recently, they've fallen off a cliff, 39%. No, that's not a cliff. They fell out of bed. It hurt, but it's not a hospital visit. Okay, so that's interesting. So the slide started in late March. Up until now, it's been selling off. Okay. Now, one thing that I'm going to look at very quickly is there's companies that are kind of rebranding themselves like, hey, we're an AI company. But for the last 25 years, we've been something else, or we've been something that has kind of a bridge to AI. Well, I can understand why companies do that. It's kind of like the earnings calls. CEOs are talking about AI like to a fault, and they say it so many times. Well, companies are actually saying, oh, we're an AI company. So what I'm going to look at is, for how many years have these guys really been an AI company? And to do that, it's going to be a little hard to do it through their financials. But like in 2019, they were already at 1.5 million. They were growing. They were profitable. So they've been doing technologies for the call center. So I'll give them that. And they are now rebranding themselves as an AI company. Okay. All right. I get that. Okay. Looking at them, they are growing their revenue. That's good. I'd want to do some homework on it and make sure that they didn't go through acquisition. If it's organic growth, that's very good growth, especially since it's accelerating a bit. If you look at the quarterly, we're growing in a quarter at 8.4% up to 14. It's very good. Okay. And then gross profits there. Okay. Let's look at cash flow. We look at cash flow. We got 163 million of free cash there, 243 the year before, 174. Okay, looks good. So I'd probably value this at like 3.2 billion and maybe 5 billion, and they're at 10 billion. So I think investors, when you really do your homework behind these companies, they didn't call themselves an AI company like 5 years ago. It probably started around 2021. They're like, oh yeah, we're an AI company, because that's all the craze. So investors are smart. They'll do their homework. I would double check that. It's my assumption. I could be wrong, but I'm willing to bet that that's the case. And they're just a good growing software company, but they're not gigantic. I mean, that's not a bad rate. That's not a bad price on a software company. Let's look at their balance sheet, make sure it's not full of problems. So they have 1.5 billion of cash. That's a lot of cash for a company their size. And debt's only 457. So they have more than $1 billion to spare. Very strong balance sheet. So strong balance sheet, pretty good growth. The market's been really lowering the price of the stock. This would be worth following and seeing if they continue to grow and they become really relevant, because they may be acquired. If they're a quality company, they may get acquired. It looks interesting. I still think it's overpriced. I'd probably price it around 5 billion or so, maybe 7 billion. But who knows? Maybe in a couple of quarters or a year, this may be a really, really good investment. For now, they're just, it's the stock's overpriced, and we're looking at a market that's really reducing the price on AI related stocks. So it's not an automatic, oh, if you call yourself AI, you're going to be worth a lot of money. So that's how I see that one. Thanks for asking. I appreciate you asking about that stock. So, all right. So let me catch up on comments. So we're going to talk about Ulta later. So you like ELF over over Ulta. Okay, we'll look at those two together. Till the end. Okay. All right, cool. All right, so we looked at NICE. I think we wanted to look at the miners, right? So we got Marathon. And crypto has just been, man, it's been going down. So Bitcoin's down to $54 a coin. Man, that is not good. Over the last, over the last month and a half, it's down 21%, and it's down 25% from its 2024 high. So that puts a lot of pressure on the Bitcoin miners. And this is following the price of Bitcoin because that's what how they get paid. So as they earn those coins, that's what their income is all about. It's a $4 billion value company. It does produce a fair amount of revenue. It is profitable. Okay. Cash flow. So this is negative, but I'm going to look a little closer because the sometimes, like, generally accepted accounting principles are these principles that accountants must follow, and they must present financials according to those principles. They've been around for a long time, like 60, 80 years, and they change very slowly. Crypto is totally new. So sometimes they ask a company to take crypto out of the statement of cash flows. And I'm like, wait, it's as good as cash for me. So I would actually include it, but they're like, no, you got to exclude it. And it doesn't show it here, but here we have net income, depreciation, you add it back. That's fine. Stock-based comp. So this is probably where it's at. So it's probably going to be in their actual income statement, financials, because that site that I use, it kind of aggregates information, and sometimes it puts multiple things into a category, and then I don't have the clarity. So okay, so we're at the statement of cash flows. It's super small, so I'm going to make it bigger. Okay, statement of cash flows. And what I'm looking for is, so change in fair value of digital assets. Well, obviously this is the next quarter that ends, this is going to be a positive number because the fair value is going to go down. And in this case here, the fair value was going up. So they decrement it from this number. Okay. So here it is. So revenues from digital asset production, and the GAAP says you have to remove that. But that's like saying, for me, it's the same as cash. So I would actually add that back. So there would be positive, what would be $77 million cash flow. The other thing is about the same. So that's what I do with these miners, is because GAAP says you have to remove that. But I'm like, hey, you can take Bitcoin and cash it out today, 24/7. So it's as good as cash for me. And I would actually add that back, and it actually have free cash flow from operations of roughly 77 million. And then we'd compare that with their plant, property, and equipment. So they actually did 50 million of free cash in that quarter. Okay. And that's for 6 months. So if I double that, it's 100 million of free cash for the year. And I get to that number because I looked at their financials. 100 million. These guys are kind of in a growth industry. If I multiply that times 20, I get to 2 billion, and they're priced at 4 billion. So I'm not liking the valuation. This is a risky endeavor, right? They're a miner, so a lot of things can go wrong. And I don't think this is a good buy for me. It's been going up and down based on, crypto prices. And if we stay on this downward trend, crypto is going to keep getting hammered. I've owned Bitcoin since 2018. So it was nice. It went up and then it came down. I mean, it was pretty low, especially in 2020. You could have gotten a coin for $5,000 and then saw that coin really explode in value. But you could see that we came down in 22, down to 16. So we can come down, to $30,000 a coin, $25,000 a coin. And that's going to affect Marathon. So that's where the miners are at. All right. So let me do a quick break here and catch up on some scores. I don't want to fall behind on scores with the NFL. So it looks like Steelers are beating the Falcons. And is that new quarterback under the helm? So Kirk Cousins is now with the Falcons. He's a good guy. I like Kirk Cousins. Cardinals beating the Bills. And I'm not sure where that game is being played, but Titans getting it done. Patriots over the Bengals. Jaguars up on the Dolphins. Saints. We got somebody on the live stream that was rooting for the Saints. Look at that. 20-0. Somebody showed up to play. I'm so glad that David Carr, is it Derek or David? Because I thought he got a raw deal with Las Vegas. And it's good to see these guys do well. I hope he has a great season. Hell, go deep into the playoffs, win the Super Bowl. That'd be awesome. And he went to a small school. He went to Fresno State here in California. And Fresno State's kind of a smaller school that isn't afraid to play anybody. And it's really cool to see him succeed. Awesome. All right. Then the Vikings over the Giants. All right. All right. Back to our stocks. Back to making money. All right. So, okay, so let me catch up on. So Brad, I've been watching BT Digital. Yeah, so let's take a look at that one. That's another miner, and that I'm invested in BTBT, but let's take a look. So, and then Mike, got to run. Yeah, thanks, Mike. Thanks for showing up. Thanks for being so active, man. Love seeing your messages on Discord, on my videos, on live stream. Thanks for bringing it today. And then, by the way, not David. Guy, not David. Okay, cool. Okay, cool. All right, let's take a look at BTBT. And the thing that I like about BTBT is that they went from being just a miner to being a hyperscaler, providing their GPU capacity for AI-related build-outs of large language models. And they have a couple flagship customers, so that really made the company a little more diversified. And I thought that was really good. Now, the price of Bitcoin still really affects them because most of their revenue still come from mining Bitcoin, being a participant in the whole blockchain and earning those coins. It's rallying in the after hours. That's good. In the 1 year, it's up, but boy, it's really come down. and they really went up after their earnings. I have the company. I already have a value on BTBT, so 247. So BTBT, see, I have a high discount rate on the company. So the stock price 372 and 247. So I think that they're nicely discounted, especially if you look at their earnings per share. But I really trust this number more. I'm going to continue to buy. I'm nibbling these high risk companies. I don't jump in head first. I maybe buy $300 or $500 to get started, and then I literally buy $100 at a time. And as I get more confident, I'll increase my dollar cost average amount. But I just don't like jumping in head first. If it's like Amazon, I'm jumping in head first and trying to build out a nice position at Amazon. We all know what Amazon is. So I bought $3,000 Amazon on Friday, bought $1,000 on Thursday, bought $1,000 on Wednesday, I bought $2,000 on Tuesday. So I invested $7,000 in Amazon. I'm in an accelerating buy pattern on Amazon because I think it's discounted and it's one of the obvious winners for the next 5 to 10 years. But these guys, it's a really unknown little company. If they make it, this could be a multi-bagger, wonderful, but I wouldn't be surprised if I lose half my money. It's like, that's just the risk. And that's why I only go with small amounts on these higher risk. If you're a younger investor, maybe you want to play with a little more risk. I totally understand that. I also have risky investments, but I like making money consistently. And, I've learned my lesson on having too much risk in my portfolio. And I've also been rewarded for having a lot of risk in my portfolio. So having said that, that's how I approach it. So, all right. So crypto is down. All right, guys. So I'm going to need a quick break. I'm going to put the stream just on a quick hold. I'm going to take a bio break. I'm going to play a little bit. I'm going to play the read recording on DocuSign. And I will be back in maybe about 10 minutes. And if you want to hold tight, that'd be great. And I'll be back. So see you in a bit.
DocuSign stood up tall on Friday's trading. It was up almost 4%. At the same time, the NASDAQ was down 2.55% and the S&P was down 1.73%. Why did DocuSign go up while the rest of the market was going down? Well, DocuSign is underappreciated. It's a small cap. It's also a software company. And software companies have been left behind by investors going to semiconductor stocks and chasing the AI hyped stocks. And I'd like to go through my analysis of DocuSign. I'm a stockholder. And I'll share with you why I continue to buy shares in DocuSign, why I think it's a good investment for me. DocuSign over year to date, it's up 3.81%, which isn't a whole lot considering that the NASDAQ and the S&P are up much higher. Over the past year, it's looking a little better at 17.88%. But I happen to think this one's going to be going up. DocuSign is underappreciated. If we look at their fundamentals look really good. First, it is a small cap at $12 billion market cap, and the revenue is almost $3 billion. It's a software company, so that's an industry I really like. The PE this year is 12.54, which is not a very high PE. And analysts say it's a hold and that it's almost fairly priced. Now, when I look at their financials, the trailing 12 months, they're growing the revenue by 7.7%, which is very good. The company really grew during COVID years when their digital capture software became very, very popular. DocuSign is the leader in digital signature capture, and they are beginning to expand into other product lines within the whole contract management process. Now, their top line revenue looks great. They're very profitable. Their gross margins look great, by the way. Gross margin on this revenue of $2.8 billion is almost $2.3 billion. So the margin is excellent. Their balance sheet is very good. They have cash and short-term securities of $938 million. And they have total debt of $135 million. So they could just write a check to pay off all debt. That's a very good balance sheet. That means the company is lower risk. It means they have a lower likelihood of going bankrupt and having issues related to how much debt they have. When we look at cash flows, the situation continues to look good. They operate really good cash flow from operations, and they don't have a whole lot of CapEx. So their free cash flow is $919 million in the trailing 12 months, which is a very good cash flow rate. I use cash flow and earnings per share to value companies, and that's what I'll do next. When I look at the cash flows that I just showed you, I'm going to use that as my starting point, but I'm going to grow it by a tiny bit, which is 5%, and just have a good conservative growth rate on the free cash flow forecast. And after year 4, I'm going to grow it by a little more conservative rate of 4%. So all the cash flows I expect from the company in the future are in this line. This is the forecast. They have a very good balance sheet. So I'm going to use a discount rate of 8.5%. And it gives me an intrinsic value, which is a net present value of all those cash flows, discounted by 8.5% of $20.7 billion. I add cash and take away debt to get to an equity value of what I think the entire company is worth. The market cap's 11.6 billion, so far lower than their intrinsic value. So it provides a very attractive 78% discount if you look at the free cash flows of DocuSign. The earnings per share, I would agree with analysts that say that their earnings per share reveals about a 6% discount. But I put more weight in the free cash flow valuation, and I get a blended discount of 54. DocuSign is an acquisition target. A larger software company can buy this company, get these cash flows, and get that revenue growth as well. So I happen to think that they continue to be a good acquisition target. They were almost taken over by a private equity group in the late 2023 timeframe, which caused the stock to really rally. So it goes to show that this is a good acquisition target for investors. I think the DocuSign business is attractive and desirable. I like companies that have strong moats, barriers of entry, and have market leadership. And DocuSign, although their products are very narrow, they are the dominant leader in digital capture. So I like that they have, I think, a commanding lead in that industry. They have very good margins. They continue to grow their business. It'd be nice to see them expand into other products and continue to be a very well appreciated company within these companies that use DocuSign. So what am I going to do with DocuSign? Well, I showed that they have a really attractive discount. It's a good business to own. I like software companies. So I'm going to continue to buy shares of DocuSign. It was good to see that the market did appreciate them on a very down day. And I think that the next couple of months, the stock may rally well because it's been recognized by some investors who decided to buy on Friday. So I'll continue to buy shares on pullbacks and expand my investment in DocuSign. So that's my video on DocuSign. Just remember, I'm an individual investor, just sharing my experience with you. I'm not recommending you buy, hold, or sell DocuSign. I'm just sharing my experience. Please make your investing decisions independent of this video. Thanks a lot for watching. Good luck with your investments in 2024. All right, so let's keep going. Do a quick check on the scores and keep doing some analysis. Still got a string of companies we want to look at. Let's see where the scores are at. And 1 second. Steelers on top. Cardinals on top. Titans. Man,
think the Bears switched out their quarterback, right? Texans, that was an exciting team last year. Jaguars, man, what happened to the Dolphins? You're supposed to have a really, really powerful offense, but it's not happening today. Saints, man, just running away with it. Interesting. Very good. So in the afternoon games, we got the Raiders against the Chargers. We got, I forgot the head coach's name for the Chargers now. Then we got Broncos Seahawks. All right. Should be a really good day. All right. Cool. All right. Back to making some money on stocks. Let's talk about HIMS. Let's check out the comments real quick. See what's going on. So Impulsive Hamwich. Thoughts on Baidu, THCY, IQ. All right, cool. Let's take a look at those. We got a string of symbols ahead of this one, but we'll take a look at these. So Baidu, TCEHY, and IQ. All right, cool. Let's take a look at those. That's there, and we got stocks. Okay, so we're going to pick up where we left off, and that was with HIMS. So HIMS has really good growth. Last time we looked at that stock, it showed really good growth. What's the stock been doing? So it's been really coming down 45% in 3 months. That's a pretty good haircut. And for the year, it's still doing really well. Really good winner. If you saw it coming and you bought it in 2023, you are doing well. So these guys, they do have kind of a unique proposition of, they call it telehealth, where they're providing access to medical professionals to then get some type of treatment or maybe a condition you have. So that is interesting. They have $2.96 billion market cap. Revenue is $1 billion. And net income of $18 million. Okay. All right. Growth is just really good. They've gone from being less than 100 million to over $1 billion. That's very, very impressive. Their gross profit's okay. It's very, very high gross profit. Very good. That looks good. Free cash flow of 100 million. So high growth, free cash flow. I would say this is going to be worth $3 billion to $5 billion based on free cash flow. And here it is. It's come down to, let me double check their balance sheet. So their cash is 227 and their debt. How much is debt? Total debt? No debt. So these guys this is getting interesting because it's come down to this level. It's probably going to keep going down, especially if we have more negative, weeks. What's good about a dropping stock market is it provides great opportunity for an investor, because companies like this with that downward momentum may take it well below its true value, and then you can pick it up for a really good price. So Could you make an argument that this would be a good investment today? Probably. But if it goes down another 10, 20, 30%, it's probably going to become really enticing. So this one here would be a good one to watch and take a look at, because back of the napkin, if I take their free cash flow at 100 million, multiply that times 30, because they're a high growth company, very high growth. I mean, you get to 3 billion. But what if they grow even faster, especially their cash flows? If we look at their cash flows, let's see how quickly they've grown cash. So you see their operating cash flow, they were like negative. Then all of a sudden, boom. Okay, we've hit our scale. We've hit that operating capacity to be able to generate really good free cash. So cash, we may come look at the company in a year and this is 300 million. And then it'd be like, whoa, this thing's worth 10 billion, $20 billion. So this one here looks pretty decent. I'm gonna look closer at HIMSS. I might do a video on it on my channel, because again, it's dropping. It's dropping. I think investors in today's market, right? Last week, there was a lot of fear. So let's take a look at the fear index. I like looking at the fear index. So right in the middle of it, man. Good, solid fear. Investors are fearful. They're, oh man, I'm selling my stock. I'm selling my Broadcom stock. I'm selling all these different stocks. And I get it. But fear is my friend, because when there's a lot of fear, stocks get really discounted. I'm good with that. I'm totally good with really good companies like an Amazon, like a Qualcomm, like an Uber, getting sold off and giving me a very good price. HIMSS, this downward action has a lot of momentum, and I could see it falling to $10 a share. And then, man, it'd just be a little hard to resist that one. So I'm going to put a little star, do some more analysis, and put it on my watch list. So not ready yet. Still, I would leave it in the oven. It's not just cooked just enough, especially if we have a couple of down weeks or it takes a couple months to get out of this correction. This one might start looking really good because they do have profitability, great growth, cash flow, no debt. I mean, they're doing a lot of things right. All right, so somebody asked for the combo. Well, let's talk about Siri, because Warren Buffett's buying Siri. All right, so Siri, I think, man, look at that. Why is Warren Buffett buying this? It's kind of gone sideways. Then it cratered. And it cratered some more. Huh. All right. Man, look at that. Just in the year, it's down. At one point, it went from January to June and it went down 53%. Man. So what gives? So so here's Siri. So $10 billion company. They have a fair amount of revenue. They have good net income, really low PE, really nice dividend. I mean, this is a Warren Buffett special right here. Established business, underappreciated. He thinks it generates a lot of free cash, and he wants to come in and get it at a really good price. So when we look at free cash, 1.8 billion, you're getting, and look at that consistency of operating cash on the company. CapEx is a little high, but it's still very good free cash flow. So at 1.2 billion of free cash flow, and what's their growth rate? So pretty much flat. They kind of went up a bit and they came down. If we look at the annual, yeah, it's pretty flat. Okay. So 1.2 billion in free cash. Yeah, I'm not seeing it. Here's why I would not invest in this company is this space here, unless the one game changer for me, and I'll get to it in a second, is so Siri, I believe, does like broadcasting of programs and so forth. So they're replacing traditional radio stations with satellite radio. Okay. But we're kind of going past that. I mean, I'm on my phone all the time on Spotify, or I listen to YouTube on my phone. I don't listen to radio very often anymore. So they're going after a market space that's kind of dying. And I opened up another spreadsheet that I like to use. So if you guys have seen my videos or live streams, right, we have so many choices to pick from on stocks. We could pick new generation communication services companies like Meta, Netflix, Google, which owns YouTube. Then there's Sirius. Okay. Now, these guys are definitely not in the green. They're kind of straddling the gray with some red. Why? Digital signals are replacing traditional radio. I mean, who listens to radio? I go on YouTube, I go on Spotify. Spotify now does like books, so I can listen to books on the road. I can get to specifically the content I want, which includes like just listening to it in my car. Having said that, the one game changer would be, hey, we're switching our business model to be a satellite provider of broadband. And then it'd be like, okay, all right, now we're talking. How are you going to do it? And where are you going to have it? Because you have a lot of remote places that have very poor broadband service, and this might be a way to do it. But I'm not seeing it. Let's take a look at their website just to make sure that I'm not missing that. But this is a Warren Buffett special. He likes these old industries. He owns like See's Candy. And See's Candy, I got nothing against candy. Got nothing against See's Candy. But, man, that's a boring company. And they're a retailer. It's like there's so many things that I don't like about See's Candy, but they own the whole company. So he knows what he's doing. I'm going to stay in my lane. He can do whatever he wants. So subscriptions. So it's all entertainment. Yeah. Yeah, this doesn't float my boat. I don't like the industry. Yeah, they're not doing broadband. That would have been the one game changer. But it's not going to change the game for me. I don't like Sirius. I put them here, which means they're partially in the red. Eventually, they're going to be here. And it's like, I don't want businesses in the red. Businesses in the red have a lot of competition. They're in contracting industries. The amount of addressable market continues to get smaller, and they have to compete with a lot of people for the remaining share. Meanwhile, everybody's on their smartphone. Pretty soon, we're going to have, I'm sure, earpieces that are, picking up a digital signal, if not augmented reality with glasses. I mean, these guys they were trying to replace a paradigm that we were at, and they were doing so, but then this new paradigm showed up and replaced them and the previous paradigm. So that's where I'm at with Sirius. So good luck to Mr. Buffett. He's a genius, and I'm sure he's going to do just fine. All right, so the next one I'm going to look at is DLTR. And let me make sure I'm not neglecting comments. Looks like I'm okay. All right. So next one is Okay, DLTR is a company that I did invest in. I got out of it, and then the stock went up. No, that's Dollar Tree. Is that right? DLTR. I thought you were going to go digital. the REIT that has data centers. So, man, Dollar Tree, pain and suffering. Oof. Not good, man. This is pretty much not a good situation. So Dollar Tree is here. It's a retailer. I don't like retail. It has very little margins, has a lot of competition. It's like everything that I don't want in a company that I want to own. So out of the gates, like, okay, well, it's not a company that I would really want to invest in. It's down. Has it been discounted at this point? Well, let's take a look. Now, as you invest, everybody gets to invest the way they want. I can tell you that my preferred approach is to find quality. Quality is always going to give you a rate of return that's going to be very good. And when I say quality, it could be a little unknown company with quality fundamentals, with a quality product, with quality. So I'm not saying it has to be, a top 10 brand in the world, but always look for quality. If you see a business struggling, it may be for a reason. Their company isn't competitive. Their industry is contracting, collapsing, and I don't want my capital going there. I don't want my capital in an economy, in an industry that is contracting, soon to be completely derailed. And that's the case of Dollar Tree. Their primary competitor was 99 Cent Store. They're bankrupt. So I looked at Dollar Tree and I couldn't make sense of their valuation because they're a $14 billion value company, and that's after these decrements to their stock price. Their forward PE is 11, but their current PE is not available because they're losing money. Let's look at their cash flow, and then we're going to look at their debt. Cash flow wise, free cash flow is 464. Okay. At best, I can give these guys a $4.6 billion valuation, and they're at 14. Okay. It's like we're just not in the same universe here. When we look at cash, 570, how much debt? Almost 11 billion in debt. Okay. And so call it, they have $10 billion of debt. If we look at their EBITDA, it would take them about 4.5 years to pay their debt. And that's very risky for a very low margin company, business. Look at their revenue. It's growing a little bit. That's good. That is good. They're growing. In the quarterly, I think they didn't grow much, but annually, that's pretty good. That's like what Target and the big retailers are growing. Now their margins, their gross profit on 31 billion, is it looks like they're probably about 30% gross margins. So it's a very tight business, right? Very tight margins. Compared to other businesses like software companies, they're at like 80%, 90% in some cases. Like Meta, they're like 85%. They make so much freaking profit. So this is a business that just is not desirable to me. I try to value it and I'm like, I'm not going to buy this stock. But what are people seeing that they would say, hey, I'm going to buy this stock versus, an exciting industry? We get to pick. We are the investors. It's our money that goes into these investments. And we get to pick within these 11 sectors anywhere we want to go. It's like, hey, I'm going to give you an airline ticket anywhere you want to go in the world. You're probably going to pick like, oh man, New York City, Paris, France, Tokyo, Japan. You're going to be like Marquee City. Cool. You're not going to be like, oh yeah, I want to go to Bakersfield, California. I love Bakersfield. Nothing against it. You're not going to say Bakersfield, California. You're going to say one of these big cities. So as you pick the industries you invest in and the sectors you invest in, why not go after the ones that have had consistent high rates of return? Not necessarily buying the name brand stocks that, oh, everybody's into the Magnificent Seven. No, I'm not saying that. But if you see technology just kicking butt and taking names, maybe find the next technology company that is going to be one of those big giant companies at some point. So we get to pick where our investments are. And I always try to pick somewhere where there's just going to be great value add for me, great returns. And I'm going to learn something that's even going to be more important going down the road. So that's where I'm talking about quality into industries that are going to probably do quite much better than other industries over the next 10 years. They give me a higher likelihood of doubling my money in the next 5 years, as opposed to the toughest industries being like utilities is tough. Look at their rate of return over 5 years. You're just barely increasing the value of your investment there by 20% over 5 years. So keep that in mind. That's what I think about when I'm investing is, okay, do I want to be in that industry? Do I like that company? Is Dollar Tree going to be worth more in 5 years? I don't know. Are they going to be around in 5 years? That might be a question. And if you have that question on the table, look out. It's going to be a tough one for me to value at their current price. And I'm nowhere near ever being an investor in that company. So DG. So guys, Dollar General. You guys are taking me down the road of places I don't want to be on. But we're going there, man. We're going down this road. We're going to check out Dollar General. Dude, God, pain and suffering. 48%. So I just said all the things that I said about DLTR. I think we're good with Dollar General, right? We're going down the same road. These are just not categories that, if I spent the next 5 years being the best investor I can in this industry, it'd be in a big way a lot of wasted time, because in 5 years, this industry is like being replaced by Amazon and Temu and all these other choices that consumers have. So I'd rather figure out, like Uber, Amazon with their Waymo. This robo-taxi thing is going to be something. And I own Uber, I own Alphabet, and I've been watching it for like 10 years because I've known of Waymo for 10 years. And it's kind of beginning to kind of come together. That's exciting. That's fun. It's in it, Alphabet's worth $2 trillion. Uber is worth $100 million on its way up. That's where I want to spend my time, man. So I'm an Uber stockholder. I'm happy with my return. These guys are going places. This could be the next $1 trillion company. It might take 10 years, but Uber has got something really good, very well run company. Their network is so powerful and valuable. So that's where I want to spend the next 5 years, is figuring out, how do I find the next Alphabet? How do I find the next Meta? How do I find the next Uber? How do I find the next Robinhood? How do I find the next, wave of these companies? How do I find undervalued companies like Zim that make total sense to me? And companies like that. So enough of that. WBA. So WBA, is that Walgreens? Yeah. So Walgreens has had a horrible, horrible time. And they've always carried more debt, and they paid a high dividend, I think, to attract investors. But man, was that a trap, huh? Because, yeah, you're making 11% dividend, but you just lost 67% of your money this year alone. I don't care how high the dividend is. That's a big loser. So retail, I thought that Walgreens and CVS would have a greater ability to sustain their businesses and actually go up in price if you look at their shares. But I was wrong. I was wrong on CVS, which is their biggest competitor in the US. Look at this growth. Pretty good. Now, they're losing money. But how's their cash flow? So negative cash. Yeah, these guys need to turn things around. They went from being a cash flow generator at 4 billion. Now they're like at negative cash. Man, a lot of problems there. CVS is far better than Walgreens. And I just sold my CVS position. I just got tired of waiting, man. At a certain point, I just got to admit defeat. And I'm glad I did so because I sold it and then the market just crumbled, right? So I had more cash to work with. But you look at CVS, it's a solid business. The fundamentals, I could show you that this thing is discounted, but the market just doesn't care. It treats them like retailers and undesirables because they're tied to healthcare. So both CVS and, Walgreens are just companies that I don't get how the market hates them so much, but they hate them. And they've been kind of losers. This one's been a loser for me. And I think Walgreens has disappointed their investors. So, all right. We're getting out of retail. Yes. Moving on. Hopefully BN is not a retailer. So Brookfield Corporation. What do these guys do? All right. So I think I'm good on comments. So Impulsive Hamwich. I heard something about Siri acquiring different companies which are part of Buffett's interest. Okay, maybe. Mr. N. Kiter. TDG. Yeah, we'll take a look at TDG. So what is Brookfield Corporation? Look at that chart. Oh, yeah, that is nice. Very nice. Very nice chart. Upward slope, some volatility. This is a gentleman's graph, if I may say. And we'll take a look at their fundamentals, see if there's some real meat behind that image there. So these guys do alternative asset manager, real estate investment trust. Okay. So they do renewable power, joint venture capital. Okay. So Brookfield, they pay a dividend, but a small one. They're fairly priced according to analysts. I don't like utilities. I think I said that 10 times. This is asset management, alternative asset manager, and REIT. Focus on real estate. Okay. Well, they say like several things here. It's kind of hard to figure out, what are you? Are you a utility? You're a power generator? Do you just lease land? So they're growing their business. They probably grew through some acquisitions here, and now it's kind of a stable business. Look at cash flow. Negative cash, bad. They had some positive cash back here, but this is bad. Okay. So why is there operating cash flows nice and high? Well, it came down. And then, so this is why I don't like utility companies. Look how much they have to put back into their business. Trailing 12 months, they've had to put $10 billion back into the company in the form of, hey, you got to maintain all this power generation. And yeah, it costs money. But they had to put $10 billion back into the business in the last 12 months, and they're a $70 billion market cap. So they had to put upwards of 13% of their market cap in capital back into the business. That's a lot. And it ended up being negative cash. I can't give you a value on this because it has negative cash, and it's just anybody's guess. Are they going to be eventually a $5 billion free cash flow company? Well, it's going to take years. Can't give you a value on it. And their stock is gone up. Part of it is that, you have the AI, data center build out is supposed to cause an increase of demand for power. So the power companies are going to be in a position where they're going to have more customers, sell electricity at higher rates, especially to commercial accounts, which I believe are not regulated like they are regulated for consumer accounts. So that makes sense. But when you look at these power generators and data center companies and so forth, I'm not seeing high growth. So the story makes sense, but the facts don't line up with the story. It's like, well, then you should be growing your revenue by 20, 30% every year, but they're not. So I can't give you a value on free cash flow. Based on the forecast, there's 7 analysts covering this stock, and they're saying that the earnings per share for 24 is going to be $3.75. It's going to grow nicely next year and then by 5% in 2026. So at a reasonable PE, it values, it pretty much is fairly priced based on earnings per share. This is a pass for me. There's just too many things that are probably going to bring this stock down. And you can see that not too long ago, it came down pretty good. So not a good one for me. Ulta. Warren Buffett's cosmetic company. So this one did pop when Warren Buffett it was reported that he started buying into it. This also is a Warren Buffett special, which is old industry. They look like they can come back and probably give him a good rate of return. He buys the company, it pops, which is cool. But let's take a look at the 1 month. And it's holding its return out, right? But overall, the business is down, right? 35%. And this was a darling. But at the end of the day, this is a retailer. It's a retailer of premium cosmetics where their value add is they have a lot of consultants that will help mostly ladies with their makeup, which I can understand is probably appreciated. But like my wife buys stuff online. She knows what she likes, and it's both for convenience as well as, mainly convenience, because who wants to run out to the store when you already know what you need? She orders it, comes in, Amazon, done. Now, Ulta has to compete with that. So I think that's going to be a hard thing to go after, right? Ulta against Amazon, that's not a fair fight. Amazon's going to win every battle with every retailer. So that's the biggest concern I would have there is, Ultra's probably going to be a steady state, zero growth company at some point. Let's take a look at where their revenue's at. So their revenue is growing in the trailing 12 months, but the most recent quarter, flat. Okay. So I think they're going to they're going to stay flat. I don't see them growing very much. They have a lot of competition. They have 100 competitors in every market. And that is not an exaggeration. You have department stores. You have CVS, Walgreens, they sell cosmetics. You have Amazon. You name it. You got beauty consultants that come to your house like Mary Kay and all kinds of different independent beauty product companies. It's like, man, the competition is fierce in that industry. So, okay, so it's going to be flat sales. Cash flow wise, they are doing $104 million of cash. But you see how I don't like seeing like up and down. It makes it hard to predict. You're like, okay, are you going to be 800? Are you going to be 28? Are you going to be 68? or are you going to be 100 million in free cash flow? It's very hard to predict that. So using, if you average that out, maybe we get to 200 million, and it'd still be risky to take that number because you don't know if the next 2 years are going to be negative cash. So at 200 million times, if they're flat, so that I think they're worth like, believe it or not, I think they're worth like 2 billion, 4 billion tops. And they're priced at 17 billion in market cap. So Mr. Buffett is a genius. He's probably seen something there that he liked. There's somebody on his staff probably said, hey, we should buy this company. He did his homework, presented it to the investing committee, and they said, yeah, let's buy some shares of Ulta. But I don't see it. I think this one's going to keep losing. Fundamentally, again, where's Ulta in my desirability? They're here. Okay. I'm not saying they're here, but they're here. They're not special. But you know who is? Amazon. And Amazon's completely like stealing everybody's customers, because once somebody knows I like this product and I can get it on Amazon the second, third, fourth, fifth time. So the first time maybe you got it at Ulta and you're like, okay, I know the product, I know the brand, I know the tone I want. I'll get it online because it's convenient. I could just order it there. It arrives to my home. Good to go. So that's where I'm at with Ulta. I surprised Mr. Buffett bought it. Looks like somebody liked Elf, which was one of their competitors. And beauty is not a category or an industry or that I'm into. Man, look at that growth. Looks really good. So Elf has better growth, way better growth. Looks like, but they are smaller, but they have better growth, and that's an interesting company. They are a $7 billion company, and they're doing 1.1 billion in revenue. Looking at their free cash flow, they don't cash flow very well. I mean, the best I can do here is like not even get close to it. I can maybe get us to 1 billion, but nowhere near this valuation, because it's only $40 million of free cash. That's not very much. I'd get to like maybe $1.5 billion with a high growth rate, maybe 2 billion, but this one's not even close for me. All right, so Brad wants to look at ALRM. ALRM. Alarm.com Holdings. Alarm.com Holdings provides various Internet of Things and solutions for residential, multifamily, small business, and enterprise commercial markets in North America and internationally. The company operates two segments, Alarm.com and other offers solutions to control and monitor security systems. Okay. So $2.7 billion company, revenue of 905 million. PE is 27. Analysts think it's discounted by 26%. So if we look at where the stock has been, wow, what a ride. So investors were riding high, and then things turned, and now they're got a pretty good haircut. Okay. And more recently, in the last month and a half, they're down 23%. That's a very good haircut. Okay. So alarm.com. Understand their space. It's like products for your home. Keep it secured. Got it. Look at their financials. They're growing. Their growth isn't very high, and they're a little company. So when we look at the quarterly, yeah, it's consistent growth. So it's a slow grower. It would be nice to see them grow faster because they're small. Right now, they're quite small there. And that might be why their stock's really declining, is investors were unimpressed with this growth rate. Free cash, it is nice that they're growing it from 27 million up to 166. See how that has somewhat of an upward trajectory, right? Not perfectly, but somewhat. It's much higher than it was before, and now it's 166. So these guys are slow growers. I'm going to say 15. 166 times 15 would be about 2.4 billion, and they're a $2.7 billion company. So they're priced at a small premium. And looking at, let me look at what other analysts say, and then I've got a different point that I'll make on that company. So earnings per share is a good number, 211. It's going to grow by 5% in 2 years, over the course of 2 years. Okay. So yeah, I could probably get to 2.4 billion. They have 1 billion of cash and 1 billion of debt, so pretty much even. Yeah, so I'd be there. But where I was going to go was the company is competing against some big players, right? So, like at our home, we have Google cameras. I think they acquired Nest. And these guys are here, and they have competitors like Google. Amazon has, they bought Ring, and I think they kept the brand, but Amazon is in that space. Who else is in that space? So I'm just pointing out that they have some really big competitors, and it's a space that is pretty fragmented. It would be nice to see them grow faster, because if they're growing faster, that means their product is really desirable. It's like, hey, I'm not going to buy the Google product because the alarm product is way better. So it sells at, at 50% growth rate. But they're not showing that. So maybe their product is similar to Google's, but at the end of the day, the Google brand or the Amazon brand is going to be more powerful, more valuable to the customer, the consumer. So this one here would be a pass for me. I'd be probably wanting it to be discounted far more than it is today. And that's where I sit on alarm.com. Thanks for asking. That's a good one. And I think from a live stream perspective, I have covered the most stocks ever. So thanks for all the questions, guys. I'm going to get to the comments, but first I need to check in on some NFL scores. Oh, Falcons are coming back. Kirk Cousins, TD, but 1 interception. All right. Bills, nice. Josh Allen getting his squad back to even in the third quarter. And then we've got the Bears are on the board, but it looks like they got plenty of work to do against the Titans. Patriots are dominating the Bengals. Joe Cool is losing. What's going on, Joe Cool? This guy was in the Super Bowl. Was it 3 years ago? So what happened? Texans showing up. Colts are behind by 8 points. The Jags, man, showing up. Miami got to catch up. And then the Saints are dominating. Vikings, 21-6. So who's the quarterback for the Vikings? Darnold, huh? This guy was with the Jets. I think he was like a high draft pick, USC graduate. And it looks like he's gotten a second chance. He's having a very good game. Hopefully he has a good season. All right. Interesting. All right. Let's keep rolling. Okay. Baidu. Wait, let me check on comments really quick. Cyan Ken, what's up, man? I've been away from YouTube a little bit, and I'm seeing some friendly names that have been coming to my live streams for a while, and I appreciate you guys showing up. Cyan Ken, Google, most discounted Mag 7 right now. Agree. Tariq Hill got arrested and released an hour before the game. Oh, man. So he was warmed up. And the video's all, oh, man. What happened? That guy's so talented. He's like, I think he's one of the fastest players. They call him the cheetah, right? So, all right. Well, hopefully the guy's in not too much trouble and nobody got hurt. All right. So I think we're caught up on messages. Thanks so much, guys, for hanging out on a Sunday, talking stocks and a little football. Okay, so we're moving to Baidu. And this is Chinese stocks. They don't get valued up to their intrinsic value. Like if you took a company that's headquartered in the US with the same numbers, fundamentally, same revenues, same profits, same cash flow, same growth rates, same everything, put them in China, half off. It's like, oh man, when are Chinese stocks going to be priced at least at their intrinsic value? Because I own Baba. It's not doing all that great. I think it's discounted. I think it's a really good company and it's in a very powerful position. But the stock market just doesn't increase the price of Baba. So, oh well, I could think it all day long, but the stock market doesn't agree with me. Baidu, let me remind myself what these guys do, because sometimes I get these companies, confused. And these guys, Baidu engages in the provision of internet search services in China. It operates through two segments, Baidu Core and IQIWYI. So they're a little like Alphabet, Google / Meta, right? Okay. All right. $28 billion. See how low price that is? That's nothing, man. Alphabet, Google is 2 trillion. And then Meta is 1 point whatever trillion. These guys are way down here. Okay. Look at the PE, 10. Oh my God. Discounted by 70. I agree. If you look at the fundamentals, I totally agree. But the market's like, yeah, if it's located in China, we're not buying it. It's like, oh man. It's down 50% from 21. They had a big peak. Look at that, 339. Wow. So these guys here, the fundamentals are going to look good. Let's look at their growth rate. So revenue growth isn't all that exciting. It's good, but it's not exciting. I think Meta grew far faster and they're massive. Meta is my biggest stock. So we look at these guys are $149 billion and they're growing at 24%. That's a mic drop. These guys are smaller, not growing as fast. And this is on the Chinese currency. You multiply that times 0.14. So 0.14 of this is going to be about 11 billion in revenue. So they're 11 billion. Meta is 149 billion. They're growing at 3 and Meta is growing at 24. No, the difference being these guys are primarily servicing China and surrounding countries. I like having one stock, Baba, in China, just to kind of cover all my bases. It's going to have one stock out there. But it has been a waiting game for me. The rest of it, let's take a look at cash. They have this. You have to multiply it times 1.4 to get the actual cash balance. That'd be roughly 21 billion. And then we've got total debt. So they have more cash than debt. Very good. And cash flow. So they're cash flowing 23.4 times 14 would be 2.8. So it'd be about 3 billion in free cash flow per year. And this type of business industry growth rate multiplied times 15 minimum. And that would get us to 30 billion in market cap, and they're right there. So these guys are fairly priced. I don't agree that they're 70% discount. I'm sure their earnings per share look really attractive, but I do it on cash flow for these guys. And this would be a high risk stock because it's in China. It's smaller. They're going to compete against the likes of not necessarily Baba, but there's other competitors that they're going to have in that region. So that's Baidu. And then TCE. Why? Tencent. I haven't seen Tencent in a while. Okay. These guys are like Alphabet, Google. They are much bigger. 441 billion. Now, these guys also are like, are these guys the ones that own TikTok? So Tencent's a really valuable company. They say they're headquartered in the Cayman Islands, but everybody knows they operate out of China. ByteDance, different company. Tencent has a bunch of other gaming platforms. So 441, impressive that they have that much valuation. This is the Chinese currency. Their growth. See, the growth is pretty good. They're a big company, not as big as Meta, but they're big. They're probably about a $90 billion revenue company. Okay. And cash flow wise, they do. So they're doing about 3 billion in cash flow. 30 billion, excuse me. 30 billion in cash flow. Free cash flow. You can justify this number with $30 billion of free cash flow, the power of the company, the growth rate, you can get to like 450. But you're just going to be dealing with, this is a Chinese stock. Is it ever going to go anywhere? Baba hasn't gone anywhere. I just showed you the other stock that seems to be discounted according to analysts. It's not going anywhere. It's also an over-the-counter stock, which makes it less desirable here in the U.S. So that'll be hard to sell. And the market's really discounted this puppy. So I wouldn't touch it. I got Baba. I'm good with Baba. I don't need another stock in China. And then IQ. Man, look at these stocks. Holy smokes. Man, down 93%. Whew. Another Chinese company, online entertainment, video services. Okay. And it's $2 billion market cap, $4 billion revenue company. PE is low. Forward PE is low. So this one's kind of been left for dead. I wonder why. So the revenue isn't bad. They had good growth last year, flattening this year. So is this in the Chinese currency? Yeah. So Free cash flow is going to be about 140, 280. It's about $400 million of free cash flow per year. Yeah, you can get to this number. You can exceed that number. But there's the market, just the Chinese stocks, man, they're just discounted and they're staying there. So yeah, I can give you the math and say this one's discounted by 50%, but if nobody buys the stock is not going to go anywhere. It's just going to kind of just stay sideways. And I don't want a lot of stocks like that. If Baba, I mean, I could see myself selling Baba. I don't think I need to, but if I had to sell a stock, Baba would be like one of the stocks that I would consider selling because it just doesn't go anywhere. I can prove to you that their fundamentals, if Baba was called General Motors, or better yet, if it was called General Electric, it'd be worth 4 times more from a market cap and stock price. So that's where we are. TDG. TDG. Transdigm Group. Wow, nice chart. Nice chart. So Transdigm Group incorporates, designs, produces aircraft components. So they're in the aerospace industry. Okay. And I've always found that aerospace companies carry a lot of value. You can't get there with fundamentals. Pays 2.7% dividend. And if we look at their growth rate, very good growth. Wow. Very good growth. Free cash flow is 1.7 billion. So if I multiply that times 30, I'd get to like 51 billion. So I get to 51 billion. It's like the best case valuation, and it's $20 billion more expensive. And I find that with defense contractors, it seems like a lot of investors like them because they're a good stock for recessions, because we're going to spend on defense no matter if the economy is good or bad. This one here, the earnings per share is expanding, very good, and very good growth. So looks good. Analysts say it's discounted by 10%. I rarely invest in this industry because there's other industries that have way better fundamentals and I believe will give me a greater rate of return. And these are a little more defensive stocks for the investors that want that. This one looks good. It's a really good quality company. I just think it's expensive. They're up quite a bit. I think a lot of the price matches the premiumness of their fundamentals, the very good fundamentals, but I think they're overpriced. And if anything goes wrong, boom, you just lost 30% very quickly. So, man, we covered, I would say, about 15 stocks. That's really good. All right, let's look at some scores, and I'm probably going to look to land the plane. So it looks like the Steelers are holding on to their lead. The Bills are on top. Bears are coming back. Bengals are on the board. Colts are coming back. This game's where we left it. Saints are running away with it. So whoever has their players for fantasy football is having a very good week. Vikings, ditto. Whoever has them for fantasy, like who would have this quarterback, right? Whoever picked him is very happy. 2 touchdowns, 181 yards. So good stuff. All right. So I think that was a very good session. Let's see. We got Michael Anthony Healy. Am I pronouncing it right? Healy. And then we've got Jose Pinto. What do I think about GCT? Helen of Troy. Okay, these guys do like consumer packaged goods. They do like curling irons, kind of like products that we have in our homes, hair dryers, toasters, that kind of thing. And wow, not good. Down 56%, no dividend, low PE. They're losing sales, and they're in a very old industry. See how a lot of their competition's already in China. These guys are probably getting all their products manufactured in China, but this is just a space where the competition continues to increase, and they don't have any like barriers of entry for competitors. So they're really feeling it. This is an untouchable stock to me. It's like, I don't want to invest in this company. I don't want to invest in that industry. Somebody else can. Total debt is 786. Cash, man, just 20 million. Whew. How are they operating with that little of cash? Scary. Then we got free cash of 176. That's a pretty good number. 269. Okay, 176. I mean, you can value this company. You can probably say it's fairly priced or maybe discounted. I just don't like the industry. I think this industry in 5-10 years, they're going to have more competitors. Times are going to be even tougher. So you can get there from the fundamentals, but I just don't like the company and the industry. I'd rather pick an industry that's going places, becoming more valuable year after year, and wake up 5 years later and it's much, much better. GigaCloud Technology. GigaCloud Technology provides end-to-end e-commerce solutions for large parcel merchandise in the United States and internationally. That's interesting. So, small market cap, tiny PE. So end to end. So when somebody sells a big product, these guys fulfill it. They deliver it. So a couch, I guess refrigerator, that kind of thing. The revenue is increasing nicely, very nicely. They're a small company. Their gross profit is kind of thin. They're a delivery company. Cash. 207 million, long-term debt. No debt. Very good. So 207. Cash flow. See, look at their cash flow. It's been positive. It's growing, 114. So I'd probably be like, this company is worth 1.5 billion. This is an interesting company. It's a little company. It makes sense. Their business is growing because we're buying everything online and it's harder to ship. Like these guys are a strong player in a category that's going places. So this one's getting a gold star and is going to get fully analyzed by yours truly because it looks really interesting. I think these guys are different, right? Like doing these large parcel deliveries and having all the e-commerce companies that will have to fulfill using them is a very strong situation for them. So what was their symbol? It was GCT. See, the industry, kind of was aware that these guys are going to be valuable, and then for some reason they just started this downward trend, 57%. Man, what's going on? Yeah, I'd have to look at them closely and be comfortable with them. But I like that they don't have any debt. I like their growth rate. PE is tiny. Good company. So the ones that I'm going to look at are GigaCloud, HIMS, and then PNNT looked interesting, but for sure HIMS and GCT looked really good. All right, so caught up on those comments. All right, so all right, so what I'm going to do is I'm going to take a break and come back a little later. I think we've got through all the questions you guys have been asking. Very good. Thanks for bringing it today. And I'll probably come back in about 15 minutes, maybe go for another half hour, and then we'll call it. Mike. Yeah, man, Mike, we keep going, man. We're a second half team. We're going to play even better now. So I'm going to be back in about 10, 15 minutes, guys. I will leave you with some pre-recorded investing videos. Hopefully you enjoy them. Thanks for tuning in. I will be back. I'm a value investor, and I wait for great companies to be priced at the price that I want to buy them, and then buy shares in companies like Apple. Great company. Their balance sheet is just incredible. How much cash and marketable securities they have on their balance sheet. But their stock is really popular. People really understand what Apple does because they likely own an iPhone or a MacBook. And that makes them somewhat very familiar and comfortable in buying their stock. So the stock tends to be priced quite high most of the time. This stock had an excellent 2023, being one of the stocks that rose over 40% in the Magnificent Seven stocks. Their market cap is incredible, almost $3 trillion in value. Warren Buffett owns this stock. It's just got a lot of things going for it. Now, I don't buy stocks just because they're popular. I buy stocks because they're a really good value. And Apple really provided opportunities to buy the stock in 2024. The stock has dipped, and it provided a pretty good discount recently. I'm glad I bought into Apple. I bought some shares. I didn't dive in head first, principally because Apple is not going to offer up a big discount, but it is going to offer up a value investor a price that I'm willing to pay for a great company. I'd like to take you through my analysis. I'd like to value Apple, share that analysis with you, and also share with you what my intent is with this stock. I own a few shares, and I need to make a decision whether I should buy more shares, hold, or sell my shares in Apple. Keep in mind, I'm an individual value investor, just sharing my analysis for other investors to take a look at. I hope you find it interesting. It is not financial advice, and I'm not recommending you buy or sell Apple stock. I hope you find my video interesting, and please leave comments. Now, looking at Apple for this current year, 2024, the year-to-date performance on Apple is pretty much flat. It really has gone up a bit, gone down significantly, and we're really flat for the last 4.5 months. If we look at the annual return of the stock, it's up only 8%. So this stock has not overperformed. You'd have to look at an NVIDIA or another stock to really show a stock that's just been performing really, really well. Also, if you look at the past year, you can really see a lot of volatility where the stock really came down. It was trading down as far low as $165 per share, and it's currently at $186 per share. So that is interesting. Volatility is my friend. As a stock, especially on a great company, goes up and down, I can wait for it to come down into price levels that I'm willing to buy. Now, being prepared with the right information that tells me, hey, this is a good price to buy it at, this is where it's discounted, That is where I have to do my homework, do my analysis, and I'll share that analysis with you in a few minutes. More about Apple. This is a very large company with revenues above $380 billion. Just humongous, incredible. Their net income alone is over $100 billion if you look at 2023. Their forward PE is 26.68, which is a little higher than the S&P, but this is a high quality company. They pay a really small dividend, about 0.5% as a dividend rate. A lot of analysts, as you would expect, cover Apple, and they have a buy rating. They say the stock is discounted by about 9%. Overall, this company, their revenues really grew coming out of the pandemic. They grew really nicely, especially their services, but they hit a wall on growth in 2023. The revenues actually went down by 3%. And they're beginning to really flatten out. So revenue growth is just not expected out of Apple. They don't have a big launch of a new product that's really going to just be a catapult to growing the company. So that's one reality with Apple. They do have opportunities for growth around AI. If they can put AI in the hands of people by putting it into the iPhone, I think that has a lot of upside. But other than that, I can't think of any big causal factors that are going to really push the Apple revenue higher. It's already super high. Their balance sheet is where they're super impressive. If you look at their cash and you look at investments, both on the short-term and long-term investments, they have a huge amount of cash and marketable investments, well over $100 billion. And I'm going to use that along with free cash flows to value the company. They don't have more debt than they do cash and marketable securities. Their debt is well below their net cash and marketable securities. So I consider their balance sheet really being debt-free because they can pay off all debt if they wanted to. Their free cash flows are incredible. If you look at the trailing 12 months, their free cash flow is a little over $100 billion. And I'm going to use that in my valuation model that uses free cash flows. In addition to free cash flows, I'm going to look at earnings per share. The company is very well covered by 29 plus analysts, and their earnings per share are expected to be $6.68 per share. It's expected those earnings per share are going to grow nicely by 9% in 24, 9% in 25, 8% in 26, and even better in 27. So overall, the earnings per share is really solid with the company. That's another measure that I look at to value the company. I'm going to value Apple using their free cash flows and also using their earnings per share. To get started with free cash flows, I'm going to start with their trailing 12 months of free cash flow and increase it by 4%, which is the growth rate I expect from the company in the first 4 years. They're going to grow the cash flows by 4%. I also expect the same growth rate in the future for terminal value. So across the board, it's going to grow 4%. When I look at all those free cash flows and discount those cash flows by 7.5% as a discount rate, I get the value of all those free cash flows of $2.8 trillion. The cash and marketable securities on the balance sheet amount to $162 billion. And the total debt amounts to $102 billion. So the net equity value when I add the cash and marketable securities and I take away debt is $2.9 trillion. And the current market cap is $2.86 trillion. So there's a small discount of 2% on the stock, 2% so close to zero. I'd rather just say that it's fairly priced at the current stock price. Earnings per share. It's expected they're going to do $6.68 in their current year. I'm going to use a PE at 25 just because they're not growing. It's a great company, but they're not growing. So I'm going to go with 25 versus their forward PE that you're seeing on most of the platforms for information. And I'm going to grow that earnings per share by 8%. It gives me about $180 stock price, but the current stock price is $186. So using the earnings per share actually shows that the stock is being priced at a premium of 3%. That said, when I blend the two, putting more weight on the free cash flow method, I get a 0%, no premium, no discount. Now, it's always okay to pay a reasonable price on a great company. But Apple has seen a lot of down days and a lot of downward pressure at times. And I do believe the stock market is currently priced very high. So I'm going to use those details as I make my decision whether I should buy, hold, or sell Apple stock. Looking at the balance sheet, the debt to EBITDA ratio looks great, frankly, because they have a net zero debt. They have more cash and marketable securities than debt itself. So really, you're at zero, well below the 3 that I'm looking for when I compare debt to EBITDA. They have a small dividend. It's 0.5%, which is interesting. Well, I'm going to look at the 3 areas that I really want to make sure I'm bought into. First is the company. Do I like the company, their products? Do I think the company is a leader in their space, in their industry? And do I like their management team? Overall, Apple's a great company. I really like all of the above. The only concern I have is the lack of growth. And I think a problem they have is they're so big. It's very hard to grow when you're so big. So hopefully they find ways to continue to expand the value that they have because they're so entrenched in so many users through their iPhone. But we'll see how that goes. They are doing a massive stock buyback, which is interesting. And they're going to remove shares from the marketplace. That's a good idea. So it could really have the stock price really rise, and not have the stock go down too much. Next is balance sheet. The balance sheet for Apple is excellent. As mentioned, they really have net zero debt. Their credit rating, when we look at a bond issued out by Apple, is as good as it gets. So very good balance sheet. I'm completely comfortable with their balance sheet. Now the discount. There is no discount on Apple. And that is an area that causes me to pause. I would like to see a downturn in the stock before I buy more shares. Maybe if we could see a correction in the market and a downward correction, and if we see that the Apple stock drop 5, maybe 10%, I'd be a buyer at those price levels. And not too long ago, I did buy shares using that philosophy, and I'm up 9% on the stock. It's a $7,500 investment. My investment is now worth $8,000, giving me a 9% yield on a stock that I bought less than 3 months ago. So overall, I'm glad that I follow these principles of value investing and wait for a great company to be priced at the level that I want to invest in, and then take advantage of it. I'll be doing the same going forward on Apple, waiting for the stock price to be priced at a level that I'm willing to invest in. Thank you for watching the video. I hope you found it interesting. Good luck investing in 2024. Welcome back to my channel. In this video, I'm going to cover AbbVie. This is a pharmaceutical company that's been operating really well for over a decade. They had a rough 2023 where they saw their revenue go down. But will they change things in 2024? Will they begin to grow? And this has been a really good company. This is a big cap stock with their company being worth over $290 billion. Over the past year, the stock's done okay, a 9.9% return on appreciation, and they pay a nice dividend of 3.79%. Historically, AbbVie's done much better than that. And it's really the decrease in revenues and the threat to one of their principal drugs, which is going off patent, that's created a lot of concern and fear around this stock. It might be a good time to buy as a value investor, but I got to be careful. Got to do my homework and study the most recent earnings report that they announced about a week ago. In this video, I'm going to look at the fundamentals of AbbVie. I'm going to take a look at a valuation I put together for the company, go through their earnings report, and see what I want to do with this stock. I currently own shares of AbbVie, and I have a hold on my investment of roughly $14,000. I'll make a decision at the end of this video whether I'm going to buy more shares, hold, or sell my shares in AbbVie. Before I proceed, let me just remind you that my videos are just to share my experience as an individual investor. It is not a recommendation that you buy or sell AbbVie, and I'm not providing any financial advice. Let's take a look at the fundamentals of AbbVie. The company has revenue of $54 billion. It is a big, big company. They, again, provide a nice dividend of 3.79, and that dividend is very safe. The payout ratio is in good condition. A lot of analysts cover this stock, and analysts believe the stock is discounted by about 11%. Overall, the stock hasn't been nosediving, let's say like a Pfizer, but historically, AbbVie has done really well. You can see how it marched up over the last 5 years and just went from sub $75 up to $175. So it was a really good performing company, and they just had a really bad year in 2023. Is it a good time to buy? Financials, the company was growing nicely for years. You can see that growth, especially in 2020 and 2022. You saw tremendous growth, but then in 2023, we saw revenue go down by 6.44. I think that's a source of a lot of the worries, especially around one of their principal drugs. I think it's their biggest drug. I'm going to take a closer look at that when I look at their Q1 earnings release. They have a good balance sheet. Debt is less than 3 times EBITDA. Very good. Cash flow. This is a cash generating company, and their cash from operations did dip in 2023. And I looked at the first quarter of 2024, and it is fairly flat. The CapEx for this company is not very high. Very good to see. And just a reminder, if you look at the most valuable companies on the stock market, they all produce very high free cash flow, which is why I value companies based on free cash flow. Taking a look at the forecast for this company, again, 11 analysts cover the stock and they think it's 11% discounted. The earnings per share expected in 2024 is $11.41, which is a big improvement from last year, which was way down at $2.72. It's expected to grow. The earnings per share over the next couple of years will grow at 9%, 10%, and then 8%. So nice growth over the next 3 years. The dividend is a really nice dividend of 3.79, and the payout ratio is deceiving. You really got to look at the first quarter. When I do that, the payout ratio is fine. And they have lots of cash on the balance sheet, and I'll show that in a minute. They also buy back shares to a certain extent. That's very good. So overall, this is a dividend payer, and historically, it's been a high performer stock. Looking at the first quarter of 2024 financials released on April 26th, the company actually beat on earnings per share. It came in with a higher earnings per share than the market expected, and that was favorable. Revenues increased just 0.7%, less than 1% increase on revenues. But after having a year where revenues went down, I call that one a win. If they could just stabilize their business and begin to grow. One thing that is encouraging is they announced that they're acquiring a company. And one thing AbbVie has been very good at is acquiring companies and having that revenue come into their income statement and really increasing that top line, increasing revenues and cash flows. It's a very good company that acquires other businesses. So that looked really good. It raised its guidance for the full year of 2024. Very good. And I'll use the guidance they're providing on earnings per share when I value the company based on earnings per share. In general, I think the earnings were good. And it wasn't a earnings report that really changed the whole narrative. I think there's still concerns around one of their drugs going down substantially. And I believe we're going to see that right here. Humira is their big drug. It went down 35%. Now, what's good is that they're actually growing two of their drugs, Skyrizi and Rinvoq, and I'm probably pronouncing that wrong, but those two more than overcompensated for the drop in revenue in Humira. So it's good to see that some of their other drugs in the same category of drugs has been increasing. If Skyrizi and Rinvoq continue to grow, I think they're going to begin to grow again. And then they have that new acquisition. So we need a quarter or two to see if that's going to be the trend. But if they really start growing, I think AbbVie is going to return to those glory days of the stock price going up. I'm going to do a valuation on AbbVie, and I'm going to do the first valuation based on free cash flows, and then a second valuation based on earnings per share. First, with free cash flow, I'm going to use last year's free cash flow. It's a conservative way to get started with my model. I'm not going to grow those cash flows. I'm just going to expect they're going to be flat in 2024. But in 25, 26, 27, I'm going to grow them by 4%. And in terminal value, all cash flows beyond year 4, I'm going to grow by 3%. So I get all these cash flows, and I'm going to discount them by 9%. Now, quality balance sheet, good company. I would normally give it an 8% discount rate at this time. But since they have had a threat to one of their primary business lines, I'm going to go with 9% as a discount rate and get an intrinsic value, a net present value of all those cash flows amounting to $352 billion. They have $18 billion on the balance sheet, and they have $63.8 billion of debt. So when I add the cash, take away the debt, I get to an equity value of $306.7 billion. The market cap's $290 billion. So it provides a small discount of 6%. When we look at all the cash flows that the company is expected to produce, we discount them by 9%. Earnings per share looks good. The company upgraded their earnings per share, and I'm going to use an 18 PE. I had previously put a 24, but since they are under some threat, I'm going down to 18 for now. They have a growth rate of approximately 9 to 10%, so I'm going to go with 7 of growth rate over their earnings per share to get a value per share of $214 per share based on the earnings per share projections that I'm seeing. That provides a nice discount of 31% if we look at earnings per share. I'm going to blend the two calculations and get to 14% discount on AbbVie. This is a quality company. And if they didn't have that bad year, and if they didn't have the threat of one of their main businesses, I would be a buyer all day long at 14% discount. But I have to weigh that against the risk of this business right now. And I may hold or I may buy and nibble on shares, especially if I see a dip in the stock price. I will definitely be a buyer. But those are the things that I'm thinking about as I think about AbbVie. So should I buy, hold, or sell AbbVie? I'm going to base that decision on 3 criteria. First, am I still a believer in the company, in the business, in the management team? Second, do I still like their balance sheet? Is it a quality balance sheet? And third, do I like the discount? First, on the company, I really like the company. These guys have been successful for a long time. I like how they acquire businesses and they really make them work for the overall business. They've been very successful in acquiring businesses over the last 10 years that have been a net improvement to their overall business. Management team's really good. So overall, I like the company. I like the balance sheet. They have a fair amount of cash. They have very good EBITDA, and the debt ratio, debt to EBITDA, is less than 3. So I like the balance sheet. I like the discount, but I'm not fully convinced. I still see that this business is under threat, and a modest discount is not enough for me to jump in headfirst. I'd like to buy more shares if there's a pullback, but I'd like to see one more quarter of financials, seeing that their strategy is working before I invest bigger amounts of capital in AbbVie. I've invested $14,002 into AbbVie. In my investment, the current value is $13,848. So I've lost about 1% on the investment so far. I've been owning this stock for about 4 months, and this yield obviously is not positive, but it's been a short period of time. I'm going to track the stock and see how it performs over the next 3 months, especially on dips. I'm going to buy more, especially since it's a nice dividend paying stock, and I like having it in my income portfolio. Overall,
All right, everybody, I am back. I moved myself to the family room so I can get ready for what is going to be a 1 o'clock Pacific kickoff of the Raiders against the Chargers. So looks like on the chat we had Michael Anthony came back and wanted to know about, I think it was GCT. So let's just do a quick refresher on GCT. So GigaCloud looked really good. It's one that I starred, and I'm going to do deeper analysis. In general, they just are very valuable. They have no debt. They have good growth rate of, I'm going to move myself out of the way here. Give me a second. There we go. That's going to be better. So their revenue growth is very good. And when we look at their cash flow, it's good. Balance sheet, all cash, no debt. So all those boxes are really checked. And I think they do have some staying power, because when you look at GigaCloud, they're doing large parcel deliveries. Not everybody's doing that. They probably have a level of expertise and how to get product there without it being damaged. All those good things are probably coming into play. So it's one that I'm going to go, take a look at much closer. I think the stock is being discounted really nicely. And if it keeps, what's good about a dropping market is that if the market keeps dropping, some of these companies like GigaCloud, they just keep getting better and better. Right now the market's selling them off, but at some point, what if this stock hit like $10 a share? We'd be like, I'll be an investor at that level, because you're buying so much value for such a low price. So it's good to catch these somewhat early before it begins to hit a trough and starts going up. So that was my summary of GCT, and let's move on. So the Walla Mala, what if it goes down? I'm not sure where that one. It could still go down. Stocks can go up or down. Nobody knows for sure, but in that case, I make my investments based on free cash flows and a company's ability to generate those cash flows principally. In some cases, I take into, earnings per share into account, because that should be, especially for younger companies, be considered. So that's where I'm at there. Apple is so trash. So I agree with you. I think the thing about Apple is that it's a very expensive stock, right? When you consider, man, it's a 3 trillion, 3.36 trillion dollar company. That's huge. I mean, that's massive. But if you look at their strategy, they do a smartphone. They don't really have a smartphone that's like transformative. They had one when we went from the BlackBerry to the iPhone. They did take that on. They do deserve to get a lot of credit there. But now they have a lot of competition in the smartphone market. Samsung's come out with a really good device. A lot of good things happening for their competitors. So I would say that Apple is looking more and more average, yet their valuation makes it seem like, hey, they got great ideas. Look out, they're gonna be so valuable because they're gonna grow their business. But once you look at their financials, you realize no, in fact, they are not growing their business. They're pretty darn flat. So if you're flat, not growing your business, why is the valuation so high? I mean, we're looking at a lot of growth companies that are growing their businesses. Apple's not, and they get this huge valuation. They do generate a lot of free cash, but that's going to go away, especially if somebody comes out with, phones that are really transformative, maybe for AI. And um, those are things they take into account. Apple's one of those stocks where I believe long term it's going to be worth maybe half, maybe 60% of their current stock price. It's going to take a while. I've actually shorted Apple. I've put about $6,000 at risk, and I continue to add to that position because I think they're gonna hit a wall. There'll be some competitor that comes out with a phone that the market just gets crazy about, and Apple's been wrong on their development for a while. They tried to come out with a car, if you recall the Apple car. That was a complete failure. They just wrote the whole thing off. So they don't have any new ideas. What's their next idea that's going to come out of Apple? I don't know. I don't think anybody knows. And if a company has a $3.3 trillion valuation, we should know what their forward path looks like. We know that for Microsoft. They're a $3 trillion company. We know that they're growing their cloud. They have a really good AI business, and they have their established business, which is really good. That's saying something. That's like having a direction. Apple has none of that. They just have their iPhone. It's getting pretty tired. The iPhone is a good device, but the new releases of the iPhone are not that exciting. It's just a couple features that you get, but it's not transformative. So that's my feeling on Apple. All right, so I just used $10 as a make-believe example. I don't plan to buy any of that stock. I'm gonna look at it, and then I'll look at evaluation, and then I'll begin to consider if I want to buy it, how am I going to approach it. It'd probably be a small position because it's a tiny company. I don't throw that much capital at really small companies. So that's my feeling on that. Okay, so I'm caught up on comments, and we've got no comments on stocks either. Let's check in on scores. I'm watching the Steeler Falcon game, and they'll probably flash the score soon. So this is the game I'm watching. Looks like, oh no, Steelers just picked the ball off. So that one's pretty much in the bag for the Steelers. They just picked off the pass, and they're in the red zone for the Steelers. So that one's looking good for them. Cardinals. Oh, the Bills are on top. And looks like the Cardinals have the ball with 5 minutes to go. The Bears are back. Wow, good comeback. And Patriots are still on top. Texans over the Colts. Dolphins are, making a comeback. The Saints, 47 points. Holy smokes. Let's look at some stats here. What's going on here? Some fantasy football players are pretty darn happy. I was just hoping to see some stats, but let's see stats. So passing, we want the Saints. Derek Carr, 19 for 23. What a completion percentage, huh? Only 200 yards, 3 touchdowns. Very efficient. Rushing, man, look at that. They've got about 100, collectively about 170 yards rushing. That's a very good day. Look at their average per carry. And they're receiving. He spread the wealth. Looks good. Looks like the Saints have recovered a fumble. Man, the Saints are having a really good day, man. That's the way to start the season with a lot of momentum. So, all right. So that's what's going on around the NFL. Let's take a look at the futures for tomorrow. Let's see if they already have them. So right now the futures are for the markets to open down a little bit on the NASDAQ and the S&P, and the Dow down 21%. See if there's any big news that's going to drive the market. So this is a railroad, and it looks like the CEO is being looked into, maybe an inappropriate relationship, which would could cause him to lose his job, I imagine. I'm just insinuating that. Boeing, okay. All right, I'm just going to read through these and see if there's anything that I see that's going to drive the market tomorrow. There's a stock that I forgot to cover, which was Disney. Why did I miss Disney? Yeah, there it is. Fun and Disney. Let me cover Fun and Disney. Somebody asked for those. So what is Fun? Six Flags. And we'll cover this one and Disney together. So this one's Six Flags. Man, it went up nicely at the beginning of the year. And look at that quick pop of 52%. But it's given it all back. Wow, not all of it, but most of it. Man, it's a pretty good haircut there. So for the year, it's up 5%, but at one point it was up quite a bit. And when we look at Disney, Disney has not done well for a couple of years. And they, you see Walt Disney here was up at the beginning of the year, and now it's down, and they're both kind of ending up the same place. They both started at the same place a year ago, and they're ending at the same place. Both have small returns. I believe that Six Flags pays a dividend, so did Disney. These types of businesses, they definitely have moats, because these theme parks are really expensive to build. It takes a lot of capital. You got to put a lot of work into them, and then who knows if people are going to like them. In both cases here, people like them. Customers go. They like going to these parks. Disney's more diversified, with having a studio, having ESPN, Disney Plus, the streaming service. They have a variety of businesses as well. So Disney's more diversified. But every time I value Disney, I don't get a discount on the stock. I see that the stock's being priced high. And I always thought that was because investors, they find Disney to be a stock that they understand. Of course, everybody knows Mickey Mouse, so they're very comfortable investing in Disney. They have a market cap of 159 billion, revenue of 90 billion, and a very small dividend of 1%. Analysts say it's a strong buy and it's discounted by 34%. When we look at their financials, they are growing a little bit. They grew substantially in 22. I think it's everybody going to theme parks because we were tired of being, shuttered in for 2022 or 2020, excuse me. So, so they are growing their business. It's a big entity. And when we look at their free cash flow, the trailing 12 months free cash flow is 8 billion. Very good, Disney. They've really improved that. Very good. So these numbers were lower, but now it's higher. I know that the CEO, a CEO returned from being retired because the CEO that took over, just a lot of things were going against him. And the new CEO that took over, he's doing a really nice job, it seems. So very good job. All right. And one second, I just need to take care of something. All right. I took away the banner, which was kind of annoying. All right. So free cash flow is 8 billion. That's very good. That's a tick in the right direction. Let's look at the balance sheet. Balance sheet has cash of almost 6 billion. Long-term debt, 39.5 billion. So that is a lot of debt, but they probably can afford it. Let's see what their EBITDA is. EBITDA is 16.75, so less than 3 times EBITDA. So that's very good. That's good. Now, if we look at $8 billion, multiply it times 20, it gets to 160, right on the button. So they're fairly priced, and at the rate that they're going, right, you have a declining price. This is Disney. This is a premium company. I'm going to start watching Disney, and if they dropped another 20, 25%, I'd probably buy because it's Disney. There's only one Disney in the world. It's the leader. So I like the direction it's going in. I bet you if it dropped another 20%, at some point it's going to hit a bottom and then rally up like 25% over the course of 6 months or more. So I'm going to keep looking at it, and I'm probably going to pay close attention now that they're making their business much stronger with free cash flow. When we look at Six Flags, let's see what these guys are about. Now, Six Flags is well recognized, but it's not as diversified. It's much smaller. Market cap's 4 billion. Revenue's a little less than 2 billion. Their PE is really manageable at 16, forward PE 11. And analysts say it's a really discounted stock. When we look at their free cash flow, 167 million, and they've been a good cash flow company for years. The COVID year, I give them a pass. How could you deal with a pandemic, right? So 167. What's their income growth? So they grew a little bit, flat, grew substantially because these years were so bad. So this one here, I would take their current cash flow times 15 roughly, and that gets me to 1.6. So it'd be about 2.5 billion in value, and they're at 4 billion. So I think Disney's a better horse for me to take a look at, better stock for me to look at, because it's fairly priced, but it's a great company. So I would wait for that stock to drop a little bit more. I'm going to do more homework on it, put it on my watch list, and if it hits a certain price, that'd be a good stock for me to own. So Disney looks interesting. Six Flags, not so much. I think it's a business that is not as recognizable and not as valuable. They don't produce a lot of free cash, And the stock is kind of priced high for its valuation, in my opinion. So thanks for asking about that. I'm going to note Disney. That's a good one. All right, so okay, so man, a lot of comments came in. So the important game later is Dallas against Dallas. Who's Dallas playing? Oh, Cleveland. Oh man, if you guys are playing in Cleveland, you're gonna have your hands full. Cleveland last year, Cleveland early in the season was really tough, and then they kind of faded toward the end. Still waiting to get into Google. Man, Google's been coming down. A lot of stocks have been coming down, but let's take a look at Google. See, if you look at the last couple of months, it's down quite a bit. It's down 21%. It went on a nice run starting in March. It was up 45%, and now it's given back a lot of those gains. For the year, it's up 10%. I really like Google's position. I think they have a lot of businesses that are beginning to grow. Waymo's exciting for robotaxi. Their cloud business is really growing. Their YouTube business is phenomenal. Do I need to convince you guys? You guys are watching me on YouTube. So all things considered, I actually think out of the Magnificent Seven, the one that's going to do the best over the next couple of years is going to be Google from a price appreciation perspective. That's my expectation. Now, when to get into Google? I've been buying Google shares for years, and I bought shares this past week. And if the market goes down and they Google shares trade a little lower, I'll buy more. I'll just keep buying because this is my second most valuable position in my portfolio. Let me see how much I own of Google. So Google Alphabet, I own $134,000 of Google. And I'll continue to buy shares. That's just one of those stocks that I want to own more of if the market's going to give me a discount. All right, so you're also looking back. So UPS is kind of a rough situation. When I value UPS, they don't measure up very high, and their business wasn't what it was 2 years ago. Volumes are really declined, revenues are down. United Therapeutics, I love that stock. Really good company. I continue to buy shares on pullbacks, and I'm sitting on a nice return. And then you have targets on Amazon and Nike, understood. Two quality companies there. Then Chewy. So Chewy. So let's take a look at Chewy does pet food, right? And pet stuff. So we look at the 1 year. And it's incredible how people love their pets and they buy stuff for them. This one's up 14% for the year, not bad. It held its share price fairly well, given this past week was brutal for most stocks. Okay. And is Chewy just primarily e-commerce? Yeah, it's primarily e-commerce. Very good. Okay. And company is an $11 billion market cap company. Revenue is about the same. PE is 31. When we look at their income statement growth, it's very good. They went from high growth to kind of slower growth because they're getting bigger. I mean, that's a pretty good number, 11.3 billion. Looking at the quarterly, slow growth, they're getting bigger. These guys do, I would say for pet stuff, it's pretty stable and the demand will persist. If we go into recession, pet owners are still going to take care of their pets. Pets are pretty much part of the family and they'll take care of them. And then we've got balance sheet. Let's take a look at cash and short term, 694. So 695 million of cash, and debt is, so they have more cash than the debt. That's a good sign. Good. And let's take a look at cash flow. So the cash flow is 259, and they've had good cash flow for 2 years going on 3. So 259, they're growing, small growth, multiply it times 15, gets me to about 2.6, gets me to about 4 billion in value, and these guys are valued at 11 billion. Nowhere near their valuation. Yeah, this isn't very interesting to me. I think stocks that people can understand very easily, they tend to have a very high stock price. I'm sure a lot of pet owners are like, I'm going to buy this stock because I buy my pet stuff from this site. I get that, but you know, there's some stocks that are hard to understand, like Nvidia, that are worth a lot of money. And another one would be like Google, right? Not a lot of people understand search and how powerful it is and how much money they make. I do, and I invest in it. These guys are valued by analysts to be a high growth company, but they're not growing that fast anymore. So that's the problem. They were growing at 40, 50%. Yeah, I could see them being worth that, but they're not growing that fast anymore. So I think this one's overpriced by a pretty good margin. So UPS has been hurt by small carriers and Amazon doing their own deliveries. I agree. Isn't it incredible that Amazon just continues to grow and become better and be obsessed with their customer? Really, really commendable. Bird Construction, BDT in Toronto. It's a home builder. So Bird Construction. See if we find it here. Bird Construction. All right. So these guys are a $1 billion company. So these guys do infrastructure and commercial. Okay. Revenue 3 billion. Construction companies don't carry high valuations. Seems like the market is afraid that it's feast or famine. They have a couple good years and then they have a couple bad years, and that cyclicality really rubs investors the wrong way. They have been growing. They've become a pretty good sized construction company. And when we look at their balance sheet, they have $111 million of cash, 241 of debt. So they have basically about $130 million of debt. Not too bad. Based on their revenue level, they can probably pay for that within 1 year. Now on the cash flow side, free cash flow, they didn't cash flow for the trailing 12 months in the positive. They've had, I guess, 60 million is representative, and that's not a lot of free cash flow. And for a construction company, I would only be able to value these guys like at 600 million to 800 million. So this would be a little too expensive for me. And again, construction companies, they don't get the same valuations as, you know, high growth tech stock or biotech stock. That just doesn't happen because construction is cyclical. They have a couple good years, a couple bad years, and investors want smooth and up to the right. So thanks for asking about that. All right. Bono, what's up, man? So ASTS. Oh, this is a fun one. ASTS. So these guys launched their satellites. They're going to launch their satellites. I don't think they've launched them and put them into service yet. And the reason I remember that is because we looked into it on another live stream. And look at this stock. It went from nothing to a lot very quickly in 1 year. Look at that. But the thing about it is they're probably going to be successful in launching these satellites and providing, I believe, high-speed internet to those that need it in remote places, and space-based cellular broadband network, allowing existing smartphones to connect to satellites in areas with coverage gaps. Very good. Yeah, that's a pretty good use case. Now, if it all works, yeah, they're going to be valuable. But there was another company called by the name of Viasat, and they launched their satellites, and the satellites didn't work, and it was like a complete write-off, and it was really bad. I'm sure their satellites are going to work, but there's always that chance. Travel into space is not 100%, perfected. So we'll see what happens. And this stock, I mean, if you were smart enough to buy it here, congratulations. I wouldn't touch this stock because right now I don't think they have much revenue. I take that back. They had $1.4 million of revenue in the last trailing 12 months, but they also had a operating loss of $238 million. So they're burning a lot of cash. You look how much cash they have on the balance sheet, 285. I think they probably have like 1 year of cash left. And they probably have about $90 million of cash left. So they got to get those satellites up because they're going to run out of cash. And I think they're burning free cash flow. Yep. See how much cash they're burning? So if they make those satellites to space, maybe they make it and become a really, really good business. They have any kind of hiccup, they're going to have a liquidity crunch. Maybe they don't ever make it to space, but we'll see. So I'd keep an eye on that. Their balance sheet is very, very risky. And when are they going to launch? Is it a year from now, 5 years from now? If it's 5 years from now, this is really risky. How are they going to have the cash? What's the next equity round, right? What's the next debt round? Right now, the markets are scared. Who would want to invest in these guys? So I would do my homework on this one. This one's not my kind of stock, not my kind of investment. I'm a pass on this one, but I thought it was really interesting because it's just gone up so fast. So thanks for asking about that. So I've been adding Meta, Uber, Meta. I said Meta twice. Google, and I would say that a quality stock would be. So I've been adding some Live Nation. I don't have much of it, so I've been trying to build that up. Nike, I've been adding Nike. I've been adding Solventum, Catalyst, United Therapeutics, Pfizer. I think healthcare is going to do well going forward. And I've been adding Zim. So those are the stocks I've been adding. Ready to buy more next week. All right, guys, I'm going to land the plane. It is, I don't know if they kicked off here. I think I'm on the wrong channel. Give me a second here. Yeah, here we go. I think the Raiders already committed their first foul penalty, excuse me. So I'm going to get going. I'm going to watch the Raiders take on the Chargers. I'll leave you with a couple more recordings for today. I really appreciate you joining. Everybody, enjoy the rest of your Sunday. Good luck investing next week. Let's hook up again. Every morning, I'm going to do a live stream, and I'm going to do it on YouTube as well as Stonks. Every morning at 9 a.m. Eastern, 6 a.m. Pacific. Just kind of open the market together. I invite you to attend that. And of course, next weekend, we'll do some more live streams as well. But for now, everybody, have a good afternoon. Really appreciate you attending. Take care.
Does the fact of defining myself as a value investor force me just to buy stocks? No, I buy other asset classes other than stocks. I love stocks. I love growth stocks. I love picking up stocks that are discounted and watching them rise in value. But I also invest in real estate and have done really well with real estate. I also invest in bonds, and bonds really fit a need that I'm going to have in the future. I plan to retire, and at that point, I want a source of the income that I'll have from my portfolio to be low risk, to be defined. And that's why I've set up a bond ladder for myself. I'd like to go through the creation of my bond ladder and how it fits in my portfolio to provide income and really make the next 5 years very defined in the inflows of cash that will either be used for my living expenses or be reinvested. I'd like to take you through that and share with you what I'm doing. I'll also reveal the bond that I am investing in here in the month of May. It's a good one, and I'm glad that I'm buying it. Before I go further, I just wanted to remind you that I'm an individual investor sharing my investing journey on YouTube. I am not recommending you buy any of the bonds that I cover. I'm not recommending you sell any of the bonds. And I'm not providing any financial advice. I'm just sharing my journey, my experience, my opinions. And I hope you find that all interesting. Why am I investing in bonds? Well, it's really because interest rates are so high. If you look at interest rates in the last 5 years, they're really up. Back in 2021, it was basically interest rates for the 10-year treasury, which is probably the most popular cited bond, was at 1%. It was like anemic. And I didn't invest in any bonds then. You'd have to be crazy to, lend somebody your money and just pay me 1% and I'm going to lock up my cash. No, thank you. But now it's more than 4 times the interest rate, 4 times. And you can get a yield of 5%, 7%, 11% from corporate bonds. I'm looking at stocks from these same companies, and stocks are great. Long term, I believe equities have a great return. But short term, even the likes of Meta, the likes of these great companies, you can have volatility. You can invest in a stock and be down 20% in 12 months. Where bonds are very specific. Hey, you buy this bond, you will get your money back in a year or 2 years. And in the meantime, you'll get paid 5, 7, 11%. So that's why I'm more serious about bonds, is that interest rates are much higher. So let me start off with covering the concept of a bond ladder. What is it? Well, it basically means that you're buying bonds that mature in the next 5 years, meaning you buy some bonds that'll mature in the next year. They'll mature in a year, 2 years, 3 years, 4 years, and 5. Each bond will give you a maturity date, and you can see that, hey, this is going to mature in 3 years, and they will return the face value of that bond to me. In the meantime, they're going to also pay me interest, and that's also defined in the bond. So think of a CD. You could buy a CD for 6 months, 18 months, 2 years. You have to lock in your money at that point. After the CD period, you get your money back, and that's similar to a bond. Now, the bond ladder also means that as your bonds mature and the issuer says, hey, thanks for buying that bond, letting me borrow that money, here's your money back and some interest. And then I could decide, hey, great, I think I'll put it back and put it in the 5-year bucket, because that's probably the next bucket that I'm funding, and then start all over again. Of course, if I need the money, I can also spend the money. Or if I see that the market for stocks is really good, let's say we had a huge, pullback, stocks are down 30%, kind of like 2022. Hey, I'd rather invest in stocks right now. Great. But I'll have that liquid cash for me to decide, hey, what do I do with this? So that's what a bond ladder is all about. And now let me go through and show you my bond ladder, and also show you a particular bond that I'm buying into. So here's my bond ladder. It really covers the next 5 years and then plus. I have some longer term bonds, but I'm going to focus on the next 5 years, starting with 2024. I have some bonds that will be redeeming in 2024. I have 4 of them. So that's kind of spreading the redemptions, over the next couple of months, and the final one redeeming in November. A total, when you include cash that I have, $53,000. So that's a pretty good amount, and we're not quite halfway through the year, but I would say 5 months through the year. So I'm doing fine on trying to fill $80,000 plus in this bucket. Looking at 25, I've got more than 100,000 in this bucket, and it looks good. And I've tried to spread the redemptions across, months throughout the year. Looks like for 25, the interest earned will be a little over 6,000, and the appreciation on those bonds would be about 3,000. So collectively, it'd be over $9,000 of money that I've earned both in interest and appreciation. Looking at the next bucket, which is in 26, a little over 88,000 spread across the year. The third year, 81,000. Fourth year, 83,000. Then we get to where I'm currently investing in. So in 2029, which is 5 years from now, I'm currently buying into Kroger, which pays 7.7% on their bonds. Very nice, attractive percentage rate. And this is a company I'm very familiar with. I analyze Kroger from a stock investing perspective, and I'm very comfortable with this company. It's a good company. So I'm willing to invest in there. And I've actually bought $4,000 in their bonds. And this is in the month of May. And I'm glad I did so. Might be buying a little bit of more or waiting a month before I buy more bonds. We'll see how that plays out based on how interest rates behave. So that's the bond ladder for the next 5 years, trying to cover and have, an access to a replenishment of cash in each bucket for the next 5 years. And if I get a redemption and my best option is to put more into bonds, if these interest rates stay really high, I just keep replenishing this bond ladder. If we get to a point where discounts are really rampant on stocks, we have a huge sell-off like in 2022, I could take the capital and put it into stocks, but it's up to me. It's good to have the next 5 years kind of spelled out with bonds, which are a low risk, very defined way of generating income. Investing should always be personalized based on the investor's needs, their goals, and so forth. And for me, bond investing makes a lot of sense. Now that I'm 55 and as I approach retirement, it's good to become a good fixed income investor and have some of this learned process and learned strategy, well understood and well practiced. So having a bond ladder, I think, is going to be a permanent fixture to my overall portfolio. It's been really working recently, and I expect it's going to continue to work as interest rates stay higher for longer. I really appreciate you watching, and I hope you found it interesting. Investing could be a lot of fun at times. Today, I wanted to talk about a small company that's fairly unique and has a potentially exciting future. And that company is Bit Digital. Bit Digital started as a cryptocurrency mining company, mining Bitcoin, also working within the Ethereum network. That market at times has proven to be really profitable and really goes up and down based on the price of Bitcoin as well as Ethereum. Overall, this company's been a successful Bitcoin miner and has gone up and down. Now, I wasn't overly interested in just pure play Bitcoin miners. I have been an investor in Bitcoin for some time, as well as Ethereum, and I've followed this market. I'm an investor in Coinbase as well. And at times, I was an investor in other coins just to get really familiar with this space. I do believe that the future of cryptocurrencies is pretty bright and undetermined in a lot of ways. Now, what got me really interested in this company is that Bit Digital became a high performance computing player. Why is that important? The whole AI revolution is built on high performance computing, the use of GPUs, graphical processing units, that really accelerate the building of large language models and accelerate these AI builds. It's also the original use case for GPUs was gaming. The other market that Bit Digital is going after is gaming companies that are cloud-based gaming companies that need high performance computing to power their gaming platforms. Now, Bit Digital is not a one-trick pony. It's not just a Bitcoin miner. It's really diversifying into high performance computing, which is really exciting. What's also exciting is this is a tiny market cap company. And I found it and actually found me. On our investor conference call, one of the community investors came up with this stock and we looked at it. And the more I dug into this company, the more interesting it got, to the point where I spent a few hours analyzing the company this past Sunday and invested in the stock on Monday ahead of their earnings. They announced their earnings, and I'll share what I'm seeing in their earnings and what I plan to do with this stock going forward. I'll run this stock through my valuation, which is based on free cash flows and earnings per share. I'm also going to look at their gross margins. That's really important. The desirability of a business is, are they very profitable? Is their industry very profitable? Do they create a lot of free cash? That's why the most valuable companies on the stock market are worth what they're worth, is They generate a lot of profit, they generate a lot of free cash, and they keep growing. That's no secret. It's a very simple recipe for success in being a big cap player. So I'll take a look at Bit Digital and see what I think the stock is worth and share with you what I plan to do with this stock. And before I get into my analysis, let me thank the participant, Brian, for bringing this stock up. And I hope that other community members join either the investor conference call that we have each week or get on a live stream and bring ideas on stocks you think have a really exciting future, because this one's really off to the races nicely on a Tuesday morning. This stock is up 18% at this moment after their earnings announcement. I just listened to their conference call. I really liked what I heard, and will share with you why I like this company in my desirability quadrant phase of this video. All right, so enough said. Let's take a look at this company. So Bit Digital over the past year is up 38%, and that includes a nice rise today of over 17%. And it's really been fluctuating between, I would say, 15% and 22% this morning. This is a small cap. This is normal for a small cap to be bouncing around so much. Where it's going to settle today, I don't know. Maybe a little higher, maybe a little lower. But over the past year, it's been a nice reward to investors. Over the last 5 years, you see really, really drastic volatility. A couple of years ago, Bitcoin was in the 70,000 or so price range, and Bitcoin miners were just, going through the roof. The one thing I would mention is they were a $25 stock when Bitcoin was in the 70,000 range. Now Bitcoin is nearing 60,000, and it's expected it's going to rise. But the stock price is only a fraction of what it was before. And I'm going to get into their fundamentals and their profitability, which I'll show you that they're very profitable. The margins are very good. So this, to me, seems like a misunderstood stock. Once again, I don't think the price is being, the stock price is aligned with the true value of the company. This is my first kind of suspicion that, hey, this company is misunderstood and worth a lot more analysis. So Bit Digital is only a $515 million market cap company. So it's a micro cap. They have $86 million of revenue, and they are growing very fast right now. Very good to see the company grow. They're profitable. They generate free cash flow, which I'll get to later. Their PE is nice and low at 13, and their forward PE is 10. What's interesting is small caps, especially micro caps, have been left behind. The current market is really excited about these massive cap companies, NVIDIA, Apple, Microsoft. The market can't get enough of them. And these tiny micro caps are just being left way behind, but they really have a lot of value. Analysts agree with that statement. They believe that this stock is discounted by almost 72%. So I'll take a look at their reports in a minute. When we look at their financials, and I'm going to look at their released financials so I can show you some details that I'm seeing that is really important. But their quarterly is growing at 200% plus. Okay? It's rare to find a company growing that fast. Anybody growing at 200% is going to really change their business fundamentally. If they can grow at this rate for a couple of quarters, they've tripled their revenue run rate. They've tripled their cash. They've tripled their profits. They loaded up their balance sheet with cash if they are profitable. So it's really exciting to see the company really just take off. It is still small. Their quarterly revenue is $29 million. But again, growing at this rate, they could quickly get up to about $1 billion market revenue run rate company. And I think their valuation would really take off. I'm not going to look at the cash flow using stock analysis because there's some detail that I'm going to get into that is important to consider when looking at this company. Their balance sheet as well. What I would tell you about generally accepted accounting principles are used for publicly traded companies. Generally accounting principles, generally accepted accounting principles is a concept that's been around for decades. I'm going to guesstimate for 60 to 80 years. So it's a very established, traditional methodology, and it's important. They should all follow it. But this company is in a brand spanking new industry, and a lot of things they're doing just are completely alien to GAAP, which is generally accepted accounting principles. And that's where I'm going to pick those pieces out of GAAP and put them in my valuation, because I could see it best, or better, I should say, because I do understand Bitcoin mining. I do understand cryptocurrencies, and I do understand GAAP. I was educated in accounting. I graduated in accounting. I did accounting for publicly traded companies. So I know GAAP, and I also know the cryptocurrency industry. I also know high performance computing to some extent. So I'll be able to grab some numbers that are stuck in GAAP and bring them out because they truly are cash items or balance sheet items that are misclassified from my valuation technique. So I'm looking at their financial statements and I'm jumping straight to the cash flows because I love cash, and that's the most important statement that I consider in a statement in the financial statements that a company produces. Now, traditionally, the company is shown as having negative cash from operations of $30 million, and then they have capital expense of $5.5 million. Using GAAP, which is appropriate, that's how the company would be classified. Now, I know that when they mine Bitcoin, the value of that Bitcoin is very liquid. You can take Bitcoin and turn it into US dollars immediately. 24/7, you can turn it into US digital currencies, USDCs, immediately, 24/7. But GAAP doesn't treat cryptocurrencies as a real cash event, which is, I think, behind the times to some extent. Now, GAAP isn't going to change because of the cryptocurrency industry, but I'm going to take that $37.9 million of digital assets mined and put it back into cash because I think it's appropriate. And the same thing with the staking credits that you get on Ethereum. Ethereum, you can convert to US digital currencies immediately, 24/7. So I'm putting those two numbers, which are significant, back into positive cash, which has been taken away, therefore making the cash from operations much lower than what I believe is correct from an investor's perspective, not an accountant's perspective. I'm trying to make money. And if you give me Bitcoins, I'm good with that because I can sell the Bitcoins immediately. I can convert them into something else. I could very easily transfer those coins over, no problem. And the same thing with the balance sheet. The balance sheet, if you look at GAAP, classification of cash and cash equivalents, it'll exclude digital currencies. Well, I'm including those digital currencies because those digital currencies are very valuable in my universe, and I'm the investor putting my money on the line. So that's the technique that I'm going to use in my valuation. So let me go over gross margins that Bit Digital is having. So first, their most historic business is the digital asset mining business. It has gross margins of 46%, which is very good. But what's exciting is their highest growth area is high performance computing, and their margins are even better at 62%. Very good gross margins. And staking has a 94% margin rate on that itself, but it's a tiny part of the business. I'm most excited about their high performance computing business. If they grow that part of the business, it's going to generate high profit, high cash flow. So what do I think BTBT stock is worth? Well, I'm going to look at their cash flows that I expect and value those cash flows to arrive at a per share value of those cash flows. I'm also going to look at earnings per share and arrive at a value based on earnings per share, and then blend the two forms of establishing value. Now, looking at free cash flows, I've taken their cash flows and I've added in the digital currency value that they generate because I believe that's cash, and I added it back to the positive column. Took the first half, doubled it, and then grew it by 40%. And in each year for the first 4 years, I'm growing it by 40%. This is a high growth business. You saw their margins, and I think that's a conservative cash forecast. And overall terminal value, cash flows beyond year 4, will be about $316 million. And that's based on a 5% growth rate. I'm going to discount by a high discount rate of 12% because it's a smaller company. It's more risk. I want a greater return. When I take the net present value using a 12% discount rate against those cash flows, I get to $219 million of value out of those cash flows. I add the cash equivalents, digital currencies on the balance sheet. It's $192 million. When I add those two together, because there's no debt, that's very good, no debt, I get an equity value of $411 million. Their current market cap is $515 million. So overall, there's about a 20% premium if we look at this cash flow forecast compared to the current stock price. Now, it's normal for young, small businesses not to really crank up the cash flow just yet. They're really focused on growing that top line, establishing market share. So it's not a deal stopper for me. It's not a showstopper. Let's go to earnings per share. Earnings per share is expected to be 42 cents earnings per share in the current year. I'm going to use a P of 24. I could easily go higher because it's such a high growth rate, but I'm going to go 24. I'm not expecting their earnings per share to grow. I'm actually expecting it to come down a bit. Even when I really tone down that earnings per share forecast, the stock per share value is $7.06, which is 102% above their current stock price. So it's being discounted quite drastically on the earnings per share side. Very interesting. When I blend the two and I put more weight on the free cash flow method, I get a 21% discount on this high growth company. How desirable do I think Bit Digital is? Well, I look at companies and put them into one box within a quadrant of types of companies. There are thousands of companies to pick from that one can invest in. There's companies that I believe are in the green box that are really desirable. Companies like Microsoft, great barriers of entry, a strong moat, really profitable, growing, generating tons of cash flow. There's companies in the red. These are businesses that just have too many competitors. Think of retailers like Macy's. And Macy's been around for 100 years. They're competing against retailers that are trying to sell, garments and products that are quite commoditized. They're also competing against Amazon, which is an e-commerce giant. Just so much competition that they make very little money, very little cash, and are always being threatened to go out of business. So I don't want to stay out of the red zone. And then there's companies in the gray, these gray boxes, which are good businesses, maybe not growing a ton, but they are very investable if the right discount, the right momentum is in place in those industries. Now, Bit Digital, I would say they do have competitors. They do have other cryptocurrency miners within high performance computing. They have competitors there from other hyperscalers. I totally get that. Now, I do believe that they have a lot of know-how within operating GPUs. Their Bitcoin mining and Ethereum operation is very profitable, very solid business, and they're getting off on the right foot with high performance computing. So all those things with their high growth rate, high margins, I really put them in the gray, but have some in the green, believing that they are going to have a very good growth trajectory, will be a significant size company in a couple of years. Having said that, I'm going to buy shares of Bit Digital. My investment isn't that much at this point. I see myself investing maybe about $5,000 overall over the next couple of months on pullbacks. The stock's really rallying today, so I'm probably not buying shares today, but I may buy more stock into this company. I like what they're doing. I think it's a very solid business that's operating well. I could see this stock really tripling in value over the next 5 years, if not higher. So I want to be a part of that. As time passes, maybe in a couple of quarters, I may increase my investment in this company, but it'll be with more analysis and more numbers that are being reported after a couple of quarters. So just a reminder, I'm just an investor. I'm not recommending you buy Bit Digital stock, sell it, trade it. I'm not recommending anything at all. I'm just sharing my experience with you. And I hope you found it interesting. I really appreciate you watching. Good luck investing for the remainder of 2024. One of my favorite analysts, Tom Lee, just predicted that Bitcoin, in his best case, will get up to $150,000 per coin. That's a 136% increase from where it's at today in 2024. Wow, what a bullish call. You can't believe it? Let me show you what he said.
That's right. I mean, Bitcoin's still, we think, early in an upcycle. So the idea that it could get to like 150,000 this year is still, within our base case. And
150,000 in 2024.
Yeah.
Our base case.
I own 1.4 Bitcoins right now, and I would love for Tom Lee to be right and for that value of those coins to go up 136%. We'll see how it goes. Bitcoin's had a very good couple of days. It's up almost 9% in the last few days. Let's see how things work out, and let's see if Tom Lee is right. I'm a value investor, predominantly invested in stocks. I invest in real estate. And why do I invest in Bitcoin? Well, the answer is because I think it is a part of the future. And I love learning. I love trying to invest in something that's going to be big. And Bitcoin has certainly proven that it's gotten bigger and bigger each year. My investment has more than doubled in value. I've invested $62,000 into Bitcoin and Ethereum, and my investment has gone up more than $67,000. So it's been a very good appreciating asset. And it also is a part of the future, which I'm excited about. I don't put a big part of my portfolio in Bitcoin, but I'm glad that I've invested, and more importantly, that I've learned a lot about this new asset class. Welcome back, fellow Value investors. In this video, I wanted to cover Boyd Gaming. This company doesn't have the biggest casinos you've ever heard of. They're spread out across the United States, and they operate really well. They're profitable, they generate free cash, and they grow. I thought it'd be a really good company to take a look at. I'm really liking small mid-cap stocks going into 2024. And this certainly fits that profile of a small mid-cap stock. I'm going to take a look at the financials for Boyd Gaming, put them through my process, and determine whether I want to buy or not buy their stock. I currently don't own any shares of Boyd Gaming, but it is an interesting company that I'd like to tell you about. Before I jump into the analysis, please like my video and subscribe to my channel. And I'd really like to see your comments on what you think about Boyd Gaming. To evaluate Boyd Gaming, I'm going to look at three primary areas. The first one is probably the biggest area, which is the company. Do I think the company is a good company, operated well by management in an industry I want to be in? And I'm going to take a look at that and weigh that carefully. Second, I'm going to look at the balance sheet. Make sure there isn't too much excessive debt. Make sure they're less than 3 times net debt to EBITDA and see where the balance sheet lies. Third, I need a discount. I'm a value investor. I buy stocks that are discounted. I don't buy stocks that are fairly priced, and I don't buy stocks that are sold at a premium. And based on the answers that I get, I will buy or not buy Boyd Gaming. So as mentioned in the preamble, Boyd does not own these massive casinos like a Caesar's Palace or Mandalay Bay. Instead, they own these smaller casino and hotel operations. So I think that's smart. And the other thing is they're located regionally. So the person that wants to gamble maybe on a late afternoon or maybe on a weekend that's close to home, that's where Boyd Gaming customers tend to be. So their properties, 29 properties across the country, and they serve 19 different markets. So they're not just in Las Vegas, they're scattered across the country. The other big area that they want to grow in, and their revenue growth is really high, is online gambling. They have really grown their online betting substantially. Their normal operations, the whole legacy hotel and casino operations, isn't growing very much, but the online gambling is growing quite quickly for Boyd Gambling. So looking at their income statement for the first 9 months of 2023, their overall revenues have grown about 6%. So it's good to see that. In the current quarter, they grew just a little bit. Their legacy, their traditional business is not growing very much. In fact, it contracted a slightly bit. Now, the online gambling is where the business is really taking off, and it's the right place to be. Online gambling is really growing. The whole addressable market continues to expand. So it's good to see that they have a good business in that area, both for the quarter and for the year to date. That area of the business is growing real nice. And I'm attracted to Boyd Gaming because they have a very good online gambling presence, and they don't have excessive property related assets. They have these 29 regionally located properties. They don't have massive casino properties like Caesar's Palace or the Wynn and so forth. So that's good to see. The other impressive item on their income statement is that they're profitable. So their operating income is really strong. It really supports, less than 3 times EBITDA of net debt is less than 3 times EBITDA because they produce a lot of EBITDA. So that's a strength in Boyd Gaming. Looking at the performance of Boyd Gaming based on earnings per share, they've been performing well, nice and profitable. And I'm going to use the next 4 quarters of earnings per share to value the company based on earnings per share. They have a low PE, just 10.3 if you look at forward earnings. I'm going to use 16, which is higher, but casinos can get a higher PE. And again, I really like that their online gambling business is really growing. If that continues to grow at the rate that it's growing, that's going to be a major part of this company. And I believe their multiple is really going to change if investors realize that, hey, Boyd Gaming is really in the online gambling business. I think their multiple is really going to expand. Looking at the balance sheet, the cash balance on the balance sheet looks good. It's nice and stable. It's good to see that long-term debt is going down. Very good to see it being paid off. This company has acquired other businesses, and you can see that in the intangible assets and goodwill. That usually is a sign that the company's been acquiring in the history of the company. So it's good to see that, hey, the debt is less than 3 times EBITDA. And I'll put that on the overall valuation, make sure that they do qualify to be a good investment for me because their balance sheet is in good health. The statement of cash flows, a very important statement for me because I value companies based on free cash flow as well. Cash flows from operations did go down a little bit, but it went down. It's nice to see that grow year after year, especially if revenues are growing. Looks like they had to invest more money into the business. They went from $173 million of CapEx to $279. So they probably have had to remodel some businesses, maybe invest in that online gambling business by buying technology and so forth. But it is a point that free cash flows have gone down. I'm going to use the free cash flows that I'm seeing for the first 9 months of 2023 and annualize that number and compute what I think the value is for the company using discounted free cash flows. I believe Boyd Gaming is discounted by 9%, but that's such a small discount. I would say that they're probably just fairly priced. The current value that I have on the company is $66.64, but the stock is trading at $61. So pretty close to the valuation I have on the company. Where did I get my numbers? First, I discounted their free cash flows. And as mentioned earlier, their free cash flows for 2023 annualized are going to be about $558 million. I'm going to grow those cash flows by 6%. That's been their revenue growth rate. And maybe they grow cash flows a little quicker, but that's a good conservative rate that I'm going to use. Long term, I'm going to grow 3%, cash flows by 3%. So all these cash flows I expect in the future, I'm going to discount at 9.5. This is a small company in a riskier sector. So I'm going to go with a more conservative discount rate of 9.5%. The net present value of all those cash flows is $8.6 billion. I'm going to add the cash, but take away the debt to get to an equity value of $5.9 billion. The market cap of the company is $6 billion. So you see that there's about a 5% premium currently priced in the stock for Boyd. The earnings per share look really good. Strong earning and profitable company. I like that about them. Their PE I'm going to use is 16. I believe their PE you're going to have a multiple expanded because as investors realize there's an online gaming component to this company, I think it'll expand from 10 up to 16. And based on that criteria, I use this formula to determine the value of Boyd using the earnings per share growth rate of 13%, a multiple of 16. And I get to a share value of $83.47. Company is being traded at $61.31. So there's actually a 36% discount if we use earnings per share. I blend the two, but I put more weight on free cash flows. And I get pretty much a fairly priced company with a 9% discount. Looking at where the stock for Boyd has been over the last 12 months, it's quite interesting. You had the stock really rise just coming out of the gate in 2023. It came back down and then it rose, and it rose to pretty good levels at around $72 per share. Now, more recently, it had a pretty significant drop in share price and then a rally. So it's had really good volatility, to say the least. And that's good for a value investor. I can pick places to invest in the company. And overall, the stock price is up 12.72% year to date, and they pay a small dividend of 1%, and they also buy back shares. So to finish off the evaluation of Boyd Gaming, let me go through my process and make a decision whether I should buy shares or really just hold off from buying shares of Boyd. First is the company. What do I think of the company? I think the company is excellent. I think they're doing the right things, investing in online gambling. I like that they have smaller casino properties. I like their profitability. I really like that about the business. I like their balance sheet, very good health. I like the balance sheet, but I don't like the discount. I'm a value investor. I like seeing higher discounts. And a couple of things can change that discount level. If they come out with better earnings, it'll raise the value of the company and maybe increase that discount. Having said that, I'm going to hold off from buying any shares of Boyd Gaming. It is just a hold. If I own this stock and I owned it for a long time and I was sitting on a gain, I'd probably just hold it. But since I don't own any shares, I'm going to hold off from buying any shares in Boyd Gaming. Thank you for watching my video. I hope you found it interesting. Do me a big favor and leave a comment on Boyd Gaming. I love reading comments and I'd appreciate yours. Also, like my video and subscribe to my channel. With that, thanks again for watching and happy holidays. I wanted to talk about Broadcom. They announced their earnings yesterday and the stock price is sold off. It's Friday morning, about an hour and 15 minutes before the market opens, and the stock is down 7%. What was in the earnings that caused investors to sell? Well, it's been my observation that Broadcom stock has been very high, fueled by the AI hype, that the data center is going to explode with new revenues and make semiconductor companies very, very valuable. That's certainly been the case for NVIDIA, as well as other companies that have been benefiting from the data center build out. But I'll show you in the information that Broadcom provided that Broadcom's growth is actually quite slow. It's not booming. It's just growing like you would expect them to grow. Whether you put an AI label or not, the results were just lackluster. They were just okay. And I think that's why the stock price is really down this morning. So I'll go through and update my analysis on Broadcom. It is a company that I've been an investor in for a long time, but more recently, I started to short this stock because I think that this stock price is just much too high for the value of this company. Now, Broadcom's a great company, but the company is not the stock price, and the stock price is not the company. This video is really focused on the stock price. I'm an investor, and I invest to make money. I don't invest just because I want to own a part of a company just so that I could say that. No, I own a company so that it could go up in value and I make money. In the case of Broadcom, I think the value is too high, and I think the stock price is going to drop. Over time, I think my short position is going to make money. So I'll go over my short position on Broadcom, share with you where I'm at, what my plan is to get out of the short position. I'm not going to stay in it forever, and what the guardrails are that I put on that position. So let's get into analyzing Broadcom. So the stock price has done really well. Over the last 5 years, it's up 423%, which is phenomenal. Great job, Broadcom. I've owned Broadcom for a long time and sold right around the end of 2023 at a really nice gain. I don't regret doing that because I, again, think that the stock price is too high compared to the actual value of Broadcom. But the stock price continued to rally, and over the past year, it's up well over 38%. If we look at the monthly, it hasn't fared very well. It's down quite a bit. It's down 8.88%. That doesn't include the more than 7% it's down this morning. So it's going to be down about 15% shortly after the market opens. And that's clearly in correction territory. And I sense that it's going to continue to fall. I'll share more of my analysis with you that leads me to make that statement. Broadcom has a market cap of $711 billion, which is a huge market cap for a semiconductor company. They're a $46 billion company. And if you look at some of their peers like Qualcomm, they're almost the same revenue, but their market cap is much lower. We look at PE, has a very high PE of 139. It's a strong buy according to analysts, but it's only discounted by 17%. I don't know how you could say strong, but it's only discounted by 17%. It's a strong buy and it's discounted by 70%, but that's interesting. Overall, as mentioned, the stock is really up, which is interesting, but more recently, it's really begun to drop and it's seen a lot of volatility. The whole semiconductor space is really being pressured. Now, what I'll show is that their revenue has really, if you look at it to the naked eye, the revenue looks great. They have really high growth on the revenue. But the thing that I want to call attention to is they acquired a company, VMware, and that's really led to the big percentage growth. It's not organic growth. And in my book, organic growth is the best type of growth. That shows that customers really like your product. They are buying more of it. And new customers are being attracted by your product or service. And that is also a real positive. When you acquire a company, it might be a real good thing, but it's not organic growth. And in fact, they had only 4% organic growth if you take out the VMware business. And that was reported by Broadcom themselves in the latest earnings. So it's very good that they provided that so we have a clear picture of how the company's growing. So really, I view Broadcom as a 4% growing company, which is a very different reflection on the company versus 32%. When we look at cash flow, it's a very good cash flow generating company, but my comments that I mentioned on that acquisition continue to linger here. Nonetheless, the reason I've been a Broadcom investor in the past is their cash flows have been really good and they are very attractive, but they only provide a certain valuation, which I'll show later and compare it to its current stock price. The balance sheet's gotten better. They were above 3 times EBITDA, but they've done a nice job of paying off debt and bringing down the debt level so it's below 3 times EBITDA. Good job on that, Broadcom. Now, I believe Broadcom is being priced at a premium of 43%. If I look at their stock price, and that is the stock price that I'm seeing before the market opens, that is the lowered stock price the market's pricing, and compare it to the value that I see in their cash flows and the value I see out of their earnings per share. Cash flows are very, very good. And I think I've created a fairly accurate and optimistic forecast cash flows for the first 4 years and growing those cash flows by 6%. And then terminal value growth by 4%. This is a cyclical industry, and this is an optimistic forecast. But I want to be optimistic since I'm shorting the stock. I don't want to make the numbers look better for a short seller position. I want it to look very optimistic just to make sure that I'm not shorting a stock that's going to come back and cause me a lot of losses. The discount rate's 9%. And you know what? Let's change that on the fly. Interest rates are dropping. I'm going to change it to 8.5. Broadcom's done a nice job of improving their balance sheet, and I think they deserve a lower discount rate. The intrinsic value of all those cash flows is $432 billion. And the cash on the balance sheet's a little under 10 billion. Debt's a little under 70 billion. So the equity value of the company is $372 billion, but the market cap's much higher. So when I compare the current stock price to the value per share that I calculate, based on cash flows, the stock is being priced at a premium of 43%. Earnings per share is similar. Now, analysts are going to use a very high PE. That's fine. They can do that. But when I invest my money, I'd make the decision on the PE. And I think an 18 is reasonable for a semiconductor company. Having said that, I'm going to grow the earnings per share quite aggressively. And I get to a premium being priced into the stock of 29%. So the combination is a 38% premium on the price of Broadcom stock, which is interesting and information that I'll use as I update my short position. I began to short shares of Broadcom over the last few months, and overall, I am at an unrealized gain of 12% on that short position. And you likely know when you short a stock, you're actually borrowing shares and selling them. And I did so. And I borrowed shares and sold them. And the proceeds from that sale was $5,239. Now, I owe whoever lent me those shares. I need to return those shares. Now, if I were to buy them today, they'd cost me $4,666. So I would stand to make a gain of $573 if I closed out the short position today. Now, I think this is going to continue to drop. I think the semiconductor space is certainly on its way down. And I'm going to really think about buying shares and closing out this short position if it reaches 20%. And at that point, I think I'll be satisfied with the return. Again, this is achieved over the course of a couple months. And more importantly, I was seeing that the semiconductor space was just overpriced, and it seemed obvious to me. I also have been working in technology for a long time, and I've seen these paradigms of technology get established, and get working. AI is really interesting, but it's just going to take a lot longer than the media outlets would lead you to believe. It's not going to happen overnight. It's not going to happen over a couple of years. It's going to happen over a decade. And the data center, I think we've proven that if, in fact, the data center is growing by leaps and bounds, Broadcom revenue organically should be growing maybe 25%, 50% a year. Instead, it's just growing 4% organically. So there's no boom there. I don't see it. So having said that, having a short position, I put capital out there, make this a real, investment, make this a real thought and a real position I'm taking to confirm my thesis. Or frankly, if this turns around and I lose money, maybe I get to learn a lesson out of this investment. Let's see how things work out. Broadcom is a terrific business, and I've been an investor in the company because I think that they have certain intellectual property that's really desirable by the market. They are a fabulous semiconductor, so the real value is providing the engineering, the creativity to create the right semiconductors for the market. So I think the company's great. I just think that the stock price is much too high. So I separate the two because I really do believe Broadcom's a great company, but I think the stock price is a different matter. So I put them in my desirability quadrant, put them mostly in the green. I think it's a really good company, very profitable, generates cash flow. And at some point, maybe if the Broadcom stock really goes down in price, I might start buying the stock again versus shorting it. But for the time being, I'm going to keep my short position open. I don't think I'm going to make it any larger. I think we're on our way to correcting, stock prices in the semiconductor space. I'm just going to wait to probably close out the short position in the next couple months. We'll see how quickly we get there, and we'll go from there. So that's my video on Broadcom. I hope you found it interesting, and I really appreciate you watching. Keep in mind, I'm just an individual investor, just sharing my experience on YouTube. I'm not recommending you short Broadcom. I'm not recommending you buy, hold, or sell Broadcom. Please make your investment decisions independent of this video. Thanks again for watching. semiconductor space has seen a lot of losses recently. This week, Nvidia has really been dropping, and it's bringing down the whole space. At some point, some of these semiconductor stocks are going to begin to look like really good buys. And I wanted to focus on Qualcomm. Qualcomm is a semiconductor company really focused on communications. If you go back to the origination of mobile phones, Qualcomm was a player, and they've been a player ever since. When it goes to wireless communication, Qualcomm's a leader. They also have a lot of revenues from the Defense Department because a lot of their technologies are used by the military. They're a company that is headquartered in San Diego, and I've known of this company for a long time. Looking at the company's stock, the stock has gone up over time. If you've held the stock for 5 years, you're up 109%, but it's not the really incredible rises that you've seen in Nvidia or like Broadcom, which I believe are a little too frothy at this point. It has a market cap that's quite reasonable at $184 billion, and they do pay a 2% dividend, which is nice. And Qualcomm provides opportunities to buy the stock at a reasonable price. Less than a year ago, Qualcomm could have been bought for about $100 to $120 per share, and really seen a nice increase in the stock price. I did so, and I made a fair amount of gain from the stock. I'll show those results to you a little later. But recently, the stock's really come down. It's down 23% from its high. And that's why it leads me to really analyze the company and see if it's a good buy. Let's take a closer look. So the company has revenues of $37 billion, really big company. The PE is 21 in the current year, but it's supposed to drop to 15. They're really growing their business nicely, and I'll show that in the income statement in a bit. Analysts believe that it's a good buy and it's discounted by 24%. That's interesting. When I look at their financials, and I'm going to zoom in on the quarterly, the most previously closed quarter, they're growing the revenue by 11%. That's really good growth. And you can see that it's really picked up. The growth has accelerated. And that in prior quarters, they weren't growing, which is normal in the semiconductor space. Semiconductor companies are cyclical. They have a couple of good years, maybe a bad year, or maybe a couple bad years. As companies buy those semiconductors and put them into service, they don't need to replenish for a while. Therefore, Qualcomm had a couple bad years, but now they're beginning to have a nice run up on revenue. So it's a good time to look at the company. When we look at cash flow, really impressive how this company has really grown their free cash flow. They've always been a good positive generating cash flow company, but the trailing 12 months, the cash flow has increased to $12.5 billion. That's really good. So I'll use the free cash flows as part of my evaluation of Qualcomm. Looking at what analysts believe about the company, there's 24 analysts that look at Qualcomm, and they all believe on average that it's discounted by 24%. They expect that in 2024, the company is going to produce $10.28 in earnings per share, which is a big growth from prior year. You can see that bad year in 23. Then after 24, it's going to grow at a good rate of 10% and then almost 9% in 2026. So really the next couple of years look good for Qualcomm. I'll use this information in my evaluation of Qualcomm. To dig a little deeper, I wanted to go into the financial statements and point a few things out that are important for me to look at in this semiconductor company. So the growth is excellent, which is very good. I wanted to hone in on the balance sheet. Semiconductor companies carry an inventory, and it tells you quite a bit. It went from 6.4 billion to 6 billion. So that's a decrease of 400 million. And what that tells me is that their growth has accelerated, and they've depleted their inventory, which is good. I don't like seeing semiconductor companies really swell up their inventory because it goes to show that customers aren't buying, and it's becoming risky to carry that type of inventory where it just kind of gets cash gets stuck in inventory, and potentially they have to write off that inventory. So it's good to see that inventory is decreasing. Overall, their cash flows are really good, and it's really a product of a couple of factors, one of them being a big tax benefit. It looks like they had a provision for tax that's not a non-cash item, so they were able to add it back and put it into their statement of cash flows. That was the biggest effect there. They've done other things like their accounts payables being managed well, Inventories went down again. That's a positive. I like that. So overall, the statement of cash flows looked really good for Qualcomm. To make a decision on a stock, I run my own calculations of what I think the stock is worth. And I'm going to do that for Qualcomm, looking at their free cash flows and also looking at their earnings per share. Looking at cash flows first, I'm going to be conservative and start with last year, just add 10%. And it gets me to $10.8 billion in cash flow that I would expect. They're running at a faster pace, but I want to have a forecast that's reasonable and a little bit conservative. I'm going to grow cash flows in the first 4 years by 6%, and the terminal value beyond year 4 is $298 billion, which grows at 4%. I'm going to have a discount rate of 8.5. Interest rates are dropping, so again, that's a conservative number. I could have gone with 8, which would have given us a higher valuation. The net present value of all those free cash flows is $236 billion. I'm going to add the cash on the balance sheet and take away debt. The equity value is $235 billion. The market cap of the company is only $182 billion. So there's a discount of 28% if I look at the cash flows the company produces, which is very good. The earnings per share expected are $10.28. I'll use a PE of 18 and a growth rate of 6%, which gives me a value per share of $196 per share. But shares are being sold for $165. So there's a 19% discount using earnings per share. So my blended discount, where I blend free cash flow and intrinsic value, earnings per share value, comes in at 25%, which is similar to where analysts put this stock. So I have high regard for Qualcomm. And now I'm going to tell you about the desirability of the company and then make a decision on whether I should buy shares of Qualcomm or pass. So I've put together a desirability quadrant, and just to basically establish how desirable a company is to me. And the most desirable companies are in the green. These are companies with really strong moats, barriers of entry against their competitors. These are monopoly-like companies that have high revenue growth, high profitability, and generate high free cash flows. And in the gray are companies that are good companies, but they don't quite have that monopoly-like business. In the red are companies that just have too much competition. They can't grow. Maybe their space is contracting. Their industry keeps getting smaller and smaller. Profits are pretty thin. Cash flows are non-existent. Companies in the red I try to avoid. Now, Qualcomm isn't quite completely in a monopoly-like business. They do have patents. They do have really good business especially with the government around the Department of Defense. So I really like Qualcomm, and I'm going to have them straddle between gray and green. And I put them in green because they do have some technologies that are very unique to them, especially with the military, where they've put a lot of their semiconductors into the military complex. And some of their wireless chips are quite unique. They're really making noise now in the PC market with their Snapdragon chips that are going to be good chips for AI. So overall, I like the company. They straddle both gray and green, and it's a desirable company to me. Since they are providing a nice discount on a high quality company, I'm going to be buying shares of Qualcomm. Today, the stock's trading down a bit in the pre-market hours. So if the stock is being priced at a discount, meaning less than it was priced at the close of the market yesterday, I'll buy some shares. I'll probably start with $1,000 and then dollar cost average from there. I could see myself buying $25,000 to $50,000 of Qualcomm when it's all said and done over time. Now, let me show you my prior investment in Qualcomm, because I've been in and out of the stock, and the last occasion was really successful. So I invested in Qualcomm in 2024, and I started buying shares at the very beginning of the year, and I dollar cost averaged my investment. So I bought over time, and then I decided to sell when the stock price just got way too high, well above the value that I had for Qualcomm. I invested $21,841. And when I sold the stock, I got $26,895. So there was a nice gain of $5,000. The return over the course of that 4 or 5 months was 23%. When I annualize the return, it really computes to 69%, which is a very good return. I'm really glad that I invested in Qualcomm. Now that the stock price has really come down, I think it provides an opportunity to get back into this quality company. I'll be doing so. So I hope you found my video interesting, and I really appreciate you watching. Keep in mind, I'm just an independent investor to share my experience on YouTube and other platforms. I don't recommend you buy, hold, or sell Qualcomm. Please make your decisions on your investments independent of this video. Thank you for watching. Good luck investing in 2024. So we had a nice weekend with Labor Day, nice 3-day weekend, and then we got into stock trading, and the market was terrible on the first trading day of September. The NASDAQ was down more than 3%. The semiconductor space was down more than 8%. It hadn't had such a bad day since 2020 when we were dealing with a pandemic. It was just a horrible day. And it's real horrible days like that that enable me to appreciate some of the investments that do really well during these times. I wanted to cover that on this video, talk about some investments that nobody thinks about. The best time to buy them is when stocks are doing really well, because those investments sell off, they have good prices. And now that stocks are crashing, alternative investments, non-equity investments are really going up in price, which is why I own them, to diversify and have a good portion of my portfolio in an asset class that will rise when everything else is falling. So let's talk about that. And I hope that you get a few ideas that enable you to manage your portfolio over time. Keep in mind, I wouldn't recommend anybody just jump in and change everything today. No, these are ideas that take time. As these alternative asset classes go up in price today, it's probably a bad time to buy because the prices are going up. You're kind of chasing the price up. It's best to buy them when stocks are really rallying. And I would encourage you to think about that. Just keep it as some notes that you can buy in the future. So as we look at the market has seen a really good year. Right now in 2024, we're up 16% on the NASDAQ, but it has seen some pretty good volatility. About a month ago, we went through a pretty good correction on the NASDAQ, and it really rallied back, which was quite incredible, by the way. But now we've given up a good part of that rally. This volatility, I like volatility as an investor. It enables me to buy, good prices on stocks, good prices on bonds. Volatility is my friend. But what I wanted to point out is I would not be surprised if we start developing more of a crash, which would be like a 25% reduction to the stock market. It's an expensive market to begin with. And for sure in September, it feels like we're going to have a good correction. We're going to have, stock prices probably go down more than 10% overall, especially on the NASDAQ. But is it going to be a path towards something more significant? I don't know. I'm not a fortune teller. I just wouldn't be surprised. Now, as we talk about investment types, you could just Google search alternative investment classes other than stocks, and you'll get to a good list of ideas. The first list is treasury bonds. So treasury bonds are loans from the government, and government will issue out bonds. We buy those bonds. There's bonds and bills. Bills are short-term, bonds are long-term. And they pay you an interest rate. It's almost like buying a CD, but usually bonds pay better than CDs. You could also buy corporate bonds, which I really like because I do a lot of analysis on companies, and I use that analysis to have a comfort level around a particular company. And I know that, hey, that company is a good company, profitable, they're growing. I'm okay buying their bonds. In essence, giving them a loan and being paid a good dividend. I'll show you my bond ladder in a bit. And I'll show you that some of these corporate bonds, especially some that are deemed to be a little riskier, really pay a high return. So we'll go over that. You can keep your money on money market accounts or money market funds. Now, right now that continues to work, but I would say that interest rates are really falling fast. If you track interest rates, they really fell yesterday and they're falling again today. So money markets are going to stop working. I don't know how soon, maybe within a year, they're going to stop working. Then there's gold. A lot of people like gold or precious metals. I totally get that. Gold has been a stored value asset for a long time. And other people like to go into other types of precious metals. Real estate investment trust. So real estate is a limited asset or resource. They just don't make it anymore. So real estate tends to stand tall during these corrections. And of course, there's dividend stocks. Now, dividend stocks, especially around consumer staples, they tend to hold their value well during these stock market crashes, and they pay you some income. It's really nice to have dividend paying stocks during market corrections or crashes because you do see positive return in that income. Values of really good stocks may be going down, and it's temporary. Over the long haul, those are really good companies. They're going to be worth a lot more. But over the near term, that dividend income really, really looks good when everything else is down. So that's a quick flyby on different types of investments to consider that are really good during stock market corrections and stock market crashes. Over a long period of time, I've amassed a bond portfolio as well as a crypto portfolio. And I'm going to cover my bond portfolio, which really is looking good today. It had a really nice rate of return yesterday. It really popped up in value. And bonds usually don't move a whole lot, but they really move up when stocks go down. And what I've done is I've tried to really set up bonds that will mature at different dates, because bonds are a loan and they have a maturity. Think of your home loan. You either got a 15-year term or a 30-year term, and you agree to make your mortgage payments. And at the end of that term, you own your home. A bank or some home lender lends you the money to buy that house. That's a loan. Similar to that, a bond, either a corporation or a government or a municipality will issue out a bond, and you can buy that bond and hold it. So I have different maturity dates. Some of them maturing this year in 24, and then some maturing in 25, 26. What I try to do is just cover all my living expenses. So I'll have cash flow in the form of redeeming bonds as well as interest out of this bond ladder. Now, what I'll point out is looking at 2025, it's a bond ladder where I'm going to have a little over $99,000 of bond value redeeming. And I'm going to have a nice gain on those bonds, and they pay an interest rate. The combined rate of return is going to be 9.3%, which is really nice if you consider it's a lower risk asset and it's just going to be consistent. It's going to be safer than a stock. Looking at 2 years, this will handle cash flow coming in during the year of 2026, rate of return of 9.6, year 3, year 4, year 5. And then I have some longer term bonds. Now, the longer term bonds are riskier, by the way. You want to be careful. But the shorter term are, in my opinion, it's just an opinion. I'm not recommending you buy, hold, or sell any investment I ever cover. But if you issue out a loan to the US government, it's pretty low risk. If you issue out a loan to some of these good companies, it's pretty low risk, in my opinion. So I feel comfortable with these bonds. And again, they're really showing up today. They're going up in value. It's nice to see some green in my portfolio because there's a lot of red. It's almost like Christmas has come early, if anything, in the decorations of my portfolio. So it's nice to see green on the screen with regards to bonds. And when to buy bonds, you want to buy them when nobody wants to buy them. And that's when the stock market's really going up, when everybody wants to buy stocks. And try to buy bonds when interest rates are actually going up. So bonds have a reverse or opposite effect. If interest rates go up, bond prices go down. So it's good to buy. Buy low, sell high. If interest rates go down, bond prices go up. So your asset appreciates. Yesterday, interest rates went down substantially. So my bond prices, bond values went up. So you think about that. Usually when it's good news on Wall Street, stocks are really going up. That means that it's usually a good time to buy bonds because typically during those periods, you might see interest rates creep up. So those are just some tips that I've seen in my years of investing in bonds. I've been investing for over 30 years. I've been buying into bonds for more than 30 years. It's something that I got into quite early in my investing career, principally because I'm in Southern California, Orange County, and probably the GOAT in bonds was a man by the name of Bill Gross, and he actually operated here in Orange County, and he would regularly be showcased as, a really successful guy, which he is. He's a billionaire. He's really accomplished, but he made bonds really work and actually have a rate of return that competed with rates of return on stocks. So I really appreciated that bonds can really do a lot of good things for an investor, and it gives you an opportunity to diversify. Diversification really comes into the picture and comes in on focus on days like we experienced yesterday, and it looks like we may experience today and maybe experience for a period of time, is that bonds will be looking good in the month of September. So that's my video on alternative investment types during market corrections and crashes. I hope you found the video interesting. I really appreciate you watching. As always, I'm just an investor, just sharing my experience. I don't provide any financial advice, and I don't recommend you buy any of the investments that I talked about. Good luck investing in 2024.
DocuSign stood up tall on Friday's trading. It was up almost 4%. At the same time, the NASDAQ was down 2.55% and the S&P was down 1.73%. Why did DocuSign go up while the rest of the market was going down? Well, DocuSign is underappreciated. It's a small cap. It's also a software company, and software companies have been left behind by investors going to semiconductor stocks and chasing the AI hyped stocks. And I'd like to go through my analysis of DocuSign. I'm a stockholder. And I'll share with you why I continue to buy shares in DocuSign. I think it's a good investment for me. DocuSign over year to date, it's up 3.81%, which isn't a whole lot considering that the NASDAQ and the S&P are up much higher. Over the past year, it's looking a little better at 17.88%. But I happen to think this one's going to be going up. DocuSign is underappreciated. If we look at their fundamentals look really good. First, it is a small cap at $12 billion market cap, and the revenue is almost $3 billion. It's a software company, so that's an industry I really like. The PE this year is 12.54, which is not a very high PE. And analysts say it's a hold and that it's almost barely priced. Now, when I look at their financials, the trailing 12 months, they're growing the revenue by 7.7%, which is very good. The company really grew during COVID years when their digital capture software became very, very popular. DocuSign is the leader in digital signature capture, and they are beginning to expand into other product lines within the whole contract management process. Now, their top line revenue looks great. They're very profitable. Their gross margins look great, by the way. Gross margin on this revenue, $2.8 billion, is almost $2.3 billion. So the margin is excellent. Their balance sheet is very good. They have cash and short-term securities of $938 million. And they have total debt of $135 million. So they could just write a check to pay off all debt. That's a very good balance sheet. That means the company is lower risk. That means they have a lower likelihood of going bankrupt and having issues related to how much debt they have. When we look at cash flows, the situation continues to look good. They operate really good cash flow from operations, and they don't have a whole lot of CapEx. So their free cash flow is $919 million in the trailing 12 months, which is a very good cash flow rate. I use cash flow and earnings per share to value companies, and that's what I'll do next. When I look at the cash flows that I just showed you, I'm going to use that as my starting point, but I'm going to grow it by a tiny bit, which is 5%, and just have a good conservative growth rate on the free cash flow forecast. And after year 4, I'm going to grow it by a little more conservative rate of 4%. So all the cash flows I expect from the company in the future are in this line. This is the forecast. They have a very good balance sheet. So I'm going to use a discount rate of 8.5%. And it gives me an intrinsic value, which is a net present value of all those cash flows, discounted by 8.5% of $20.7 billion. I add cash and take away debt to get to an equity value of what I think the entire company is worth. The market cap's $11.6 billion, so far lower than their intrinsic value. So it provides a very attractive 78% discount if you look at the free cash flows of DocuSign. The earnings per share, I would agree with analysts that say that their earnings per share reveals about a 6% discount. But I put more weight in the free cash flow valuation, and I get a blended discount of 54. DocuSign is an acquisition target. A larger software company can buy this company, get these cash flows, and get that revenue growth as well. So I happen to think that they continue to be a good acquisition target. They were almost taken over by a private equity group in the late 2023 timeframe, which caused the stock to really rally. So it goes to show that this is a good acquisition target for investors. I think the DocuSign business is attractive and desirable. I like companies that have strong moats, barriers of entry, and have market leadership. And DocuSign, although their products are very narrow, they are the dominant leader in digital capture. So I like that they have, I think, a commanding lead in that industry. They have very good margins. They continue to grow their business. It'd be nice to see them expand into other products and continue to be a very well appreciated company within these companies that use DocuSign. So what am I going to do with DocuSign? Well, I showed that they have a really attractive discount. It's a good business to own. I like software companies. So I'm going to continue to buy shares of DocuSign. It was good to see that the market did appreciate them on a very down day. And I think that the next couple of months, the stock may rally well because it's been recognized by some investors who decided to buy on Friday. So I'll continue to buy shares on pullbacks and expand my investment in DocuSign. So that's my video on DocuSign. Just remember, I'm an individual investor, just sharing my experience with you. I'm not recommending you buy, hold, or sell DocuSign. I'm just sharing my experience. Please make your investing decisions independent of this video. Thanks a lot for watching. Good luck with your investments in 2024.
Welcome back to my channel, Value Investors. In this video, I'm going to be covering Kroger, the big grocery company. And they announced their earnings today, March 7th, and it was well received by Wall Street. Their stock's up more than 8%. And there's reason for it. This is a really well-run company. They execute very well. They do what they said they were going to do. They really execute exceptionally well. It's also a steady stock, really good for my income portfolio. They pay a dividend. It's not the biggest dividend you've ever seen, but they really buy back shares. And I'd like to update my analysis based on their earnings release and a full year of financials that I've got to work with and see where I think the company should be valued and compare it to the current stock price to make a decision whether buy more shares of Kroger, just keep the shares that I own, or potentially sell the shares that I currently own. Let's take a close look at Kroger. Understanding the Kroger business is pretty simple. It's a supermarket, and I can't think of anybody who hasn't been to a grocery store to buy food. And they've been a grocer for a long time. The company's headquartered in Ohio. This is what they've done for 100 years, and they've done it well. They continue to grow and have all the different regions of the U.S. covered by their grocery stores. What I really like about the company is that it certainly seems, and they act in a way where they're in partnership with the stockholders. They clearly communicate to stockholders the value that they're going to provide to the shareholder. They execute their business really well. And that's really a compliment to the company. They are communicating in their investor deck that they like returning to shareholders 8 to 11%. Again, this isn't like NVIDIA where you're going to triple your money in 9, 12 months. It's a real steady stock and a really good stock for my income portfolio. So I like that about the company. It's my expectations of the company, again, are just for steady, gradual increases in the profit price and the stock price and a good dividend over time. The company's using their footprint of grocery stores to expand into fuel sales. So selling gasoline, since they already have a real estate footprint across the country, they can diversify into fuel sales. Since they have grocery stores, they can also operate pharmacies inside of the grocery store, which makes it convenient for a shopper to get their prescriptions while they're picking up some groceries as well. They are also really growing on the digital side. No big surprise. Food delivery, grocery delivery is huge now. And Kroger continues to really evolve and really adapt to the way that customers want to buy their groceries. I think 10% of their sales are done in a digital format, and it continues to really grow, which is great to see. Let me review the fundamentals of Kroger. To begin with, it's a $35 billion company, and their revenue is $147 billion. So it's a grocery store, so they don't have huge margins. That's why you see that their revenue is much higher than their market cap. Their earnings per share are good. Their forward PE is 11.7. That's phenomenal. And the S&P, as an example, is at 26 forward PE. So Kroger is well below the mean on forward PE. And I think it is a signal. That's why the stock is really going off the charts today, is that investors are realizing that this is a really well-run company and their PE is super low. If we have a recession, this is the right industry to be in. Groceries, no matter if it's a good economy, bad economy, we have to eat. So, Kroger should not have a big drop in revenues anytime soon. They'll just steadily continue to grow. Over the last year, the stock's up 16%. And again, recently, especially year to date, the stock's just really done well in my portfolio. It's great to see that the stock really rally. Kroger is trying to acquire Albertsons, which is another grocer, smaller grocer, and then it'll make them larger. I think strategically they see that, Target and Walmart, they're becoming threats to their business because both of those companies that I named were retailers. They retailed really, consumer goods, apparel, TVs, and so forth. Now they're getting into groceries, which is really coming into the industry of Kroger. So they see that they have to continue to get larger so that they can compete against those big retailers. And that's the reason for the acquisition. Now, they've had a lot of pushback from the Federal Trade Commission, who has really argued that this acquisition could be bad for the consumer, that Kroger would then have a lot of power to increase prices and price gouge and all that good stuff that they like to, probably enhance and make it a little too dramatic. Whether the acquisition happens and they acquire Albertsons or they don't, I don't think it's going to have a big effect on the Kroger stock. I would like to see the acquisition happen because I really believe in Kroger. Their management team has been executing for decades, just a really, really well-run company. And if they believe that this is the right strategy for the company, I'm completely behind it, but would totally understand if the government stands in front of them and they have to abandon the acquisition. So be it. I think we'll move on and Kroger just continue to organically grow. Kroger is providing guidance for the new fiscal year, and they're guiding for really good earnings per share, $4.30 to $4.50. Kroger tends to exceed expectations. So as I've learned with this company is if I want to be really conservative, I go on the low end. If I want to be realistic, I go with the high end. Free cash flows, same. They guided 2.5 billion to 2.7 billion free cash flow. Last year, they guided under similar numbers, and they ended up coming in close to $2.8 billion of free cash flow. So they exceeded expectations by a little bit on the upper end of that guidance. So overall, I really believe these numbers, and I'll use them for my valuation. I really like Kroger. I like their story. I like their management team. But a story without numbers, it's just a fairy tale. We got to have numbers in order to know, am I buying into a good investment? So I'd like to look at Kroger and value the company based on the cash flows they're going to produce in the future, and look at the earnings per share and value the company on earnings per share, have a blended valuation, and then see if the stock price is currently being sold at a premium or at a discount. Let's take a close look at cash flows first. So they guided cash flows to between 2.5 billion and 2.7. I'm going to take the midway point. I think that's conservative. Again, they tend to overachieve on the numbers they put out there, but let's go conservative. And I'm going to grow those cash flows by 7%. They have grown the cash flows over the last 5 years by 12%. So 7 should be a good number. After that, since it is the grocery business, I'm only going to grow future cash flows beyond year 4 by 3%. I'm going to discount all those cash flows by 8%. They have a strong balance sheet. And I get a value of all those cash flows of $54.1 billion. I'm going to add the cash on the balance sheet and take away debt to get to an equity value of $43.8 billion. is the equity value that I see for Kroger. The market cap is $36.3 billion. So overall, there's about a 13% discount available on Kroger stock. Earnings per share, I'm taking the higher end of the earnings per share, going against a 16 PE and growing those earnings by 3%, which is conservative. And I get to a value per share of $61.38. The current share price is $54. So there's about a 13% on earnings per share. So blending is easy. It's 13% discount. And this is a very fair price for a very good company. So I like that the fact that the company stock price has been rising. I think stockholders are taking notice. This is a solid company, but it starts with a really good company. So let me summarize my review of Kroger and make a decision on whether I should buy more shares, hold, or sell my shares. Starting with the company, I think very highly of the company. I like the business. It's the grocery business. It's a good diversification play in my income portfolio to have a food grocer. Very stable. I like the business. And same thing with the industry. Their management team, I would argue, in the grocery business, no management team is better than Kroger's management team. Their balance sheet is very healthy. Their debt is well below 3 times EBITDA. And they offer a discount on their stock. So I'm going to be a buyer and a holder of Kroger stock. I buy on pullbacks. The stock's really run up today. It's up about 9%. And it's great to see that. It's a pretty good size holding in my portfolio. So it's great to see that big, gain for the day, but it's not a good day to buy stock. I think it'll probably settle down and I will be buying more shares on pullbacks. Kroger is a steady company, just a solid company that isn't going to cause too many problems for my portfolio. It's rare if they ever surprise me, which is a very good thing with companies. They just do what they said they were going to do. They execute really well. And I really like that. I continue to put more money into Kroger year after year. And I've built up a really big position in Kroger, and I'm glad I did so. I hope you found my video interesting, and I really appreciate you watching. In this video, I wanted to cover Live Nation. This is the leader far and away in ticket sales for concerts and live venues. They're recognized here in the United States with their flagship website, Ticketmaster. It seems that every concert that you go to, at least 9 out of 10, if not 99 out of 100, concerts and artists have to partner with Live Nation to sell their tickets. It is a dominant company within their micro industry. The US government has pointed that out and has accused Live Nation of being a monopoly. For me, I'm looking for companies that are dominant, that have competitive barriers to keep competitors out, that they have technology or they do their business in a way that their competitors cannot keep up. They win over customers and they really grow their businesses. Live Nation may be that type of business. I'd like to take a look at the company, take a look at the fundamentals, value the company based on free cash flows and their earnings per share. Compare that valuation against their current stock price, then make a decision to see if I plan to buy shares in this company or not buy shares in this company. I owned Live Nation stock in the past and made money, and I exited the position in 2023. Might be time to reinvest depending on the results. Overall, Live Nation has been caught up in the press a few times under a bad light, where if you recall, Taylor Swift would sell out concerts very quickly. A lot of fans were left out and they blamed Live Nation. And Live Nation pretty much took the brunt of that bad press. But in reality, just the demand for certain artists is just so high that fans, as well as professional ticket resellers, really buy up the tickets very quickly. Live Nation also has a resale business where they resell tickets. Should a fan not be able to go to a concert and they need to sell their tickets, they can do it on Live Nation's resale platform. Or, frankly, the professional ticket resellers can also use the Live Nation platform. Overall, I like the company, and I'm going to look at the fundamentals to see if it's being priced at an attractive price, at a discount, see if it's a good investment. Let's take a look at the fundamentals. Live Nation is only a $21 billion market cap company. I'm a little surprised by that number because Their revenue is 23.8 billion, almost 24 billion. So the company is being priced less than their revenue. Somewhat of a surprise. The PE ratio for the current year is 83, which is really high. Forward PE is going to come down to 42 if you use next year's earnings per share and compare it to the stock price. Analysts really like Live Nation. It's a strong buy, and they think it's 28% discounted. It's a pretty strong discount. Over the last 5 years, a stockholder would not be happy with the results, only gone up 33% collectively. But you could see that coming out of COVID, there was a time to buy and hold Live Nation. It really appreciated nicely for a couple of years. But along with everybody else in 22, it really sold off. But ever since then, it's just been going somewhat sideways. Not a big appreciating stock, especially in the last 2 years. Stocks have really appreciated. What's surprising is this company has just really good revenue. And you look at 23, 36% revenue, 22, 166% revenue. And if you look at before COVID, because COVID did affect live venues, tremendously, they were an $11.5 billion revenue company. 2 years removed from COVID, they're up to 16.6 in 2022 and 22.7 in full year of 2023. And you look at their trailing 12 months, they're almost a $24 billion company. So Live Nation is growing the revenue. Probably ticket prices are going up. So their portion of the sale goes up as well. All those things look really attractive to me. Meanwhile, they do make money, which is very good. The balance sheet, they have as much cash as they do debt. Strong balance sheet. No debt problems. They generate good cash flow. For the last 2 full years and the trailing 12 months, they have positive free cash flow. So that's very good. I'm going to use free cash flow as one of the valuation methods, and I'll take the most recent information to put that into my model. As mentioned, analysts like the stock. There's 12 analysts that are saying this is a strong buy. This is a good company. They're saying it's 28% discounted. The principal method they use is earnings per share. Earnings per share is $1.46. It's a little low, and it causes the forward P to be quite high. But it's supposed to almost go up 70% next year and then continue to go up the year after that. So the growth of earnings per share is expected to really take off. So that's interesting that it's going to grow so quickly. I'll take that into account on my evaluation. Live Nation announced their earnings for the second quarter of this year on July 30th. So I have a fresh set of financials to take a look at. The growth of revenue was 7%. And quarterly, they grew over $1 billion in that quarter. That's a great run rate. Their operating income went up 21%. Operating cash flow is up to $412 million in the quarter, and free cash flow, $456 million in the quarter. That is a very good run rate. I'm not going to use that as an annualized figure. I'm going to take the first 6 months of free cash flow, double it, and annualize it that way. But overall, their earnings show a strong business, and live venues seem to be just in excessive demand. If Taylor Swift has a concert, there just isn't enough tickets. Beyonce has a concert, not enough tickets. It seems that the public just has an appetite that cannot be solved with the number of acts that are out there. It's quite interesting. I don't see the demand slowing down for the company. I valued the stock and came up with a result that the company is being discounted by 32%. If you buy a share of Live Nation stock, you'll pay $91.87. But the value of that share, based on my calculations, is $121. I get there by looking at their free cash flows, creating a value of per share using that method, then looking at earnings per share, getting a value, then blending the two. Let's go through free cash flow. I took the first 6 months of free cash flow and annualized it and then added the growth rate that I expect in free cash flows. And then I forecasted years 2, 3, and 4 to grow at 8%. Terminal value will grow at 4%, giving us an intrinsic value, a net present value of those cash flows of $35.6 billion. The cash on the balance sheet is $6.4 billion. Total debt is $6.2 billion. So the equity value is $35.8 billion. The market cap currently from Live Nation is only $21 billion. So it provides a 69% discount on the stock if we look at the free cash flow valuation method. The earnings per share is a little low, and I'm going to apply a 24 PE. I don't like going too high on PE. This is a growing company. It's great, but I don't like using high PEs unless it's a high growth company, which I don't believe Live Nation is. I am going to apply a very high growth rate because the expectations are for high growth. Having said that, I only get a $52.56 valuation using the earnings per share, and the company current stock price is $91.87. So there's actually a premium on the stock if we look at the earnings per share method of 43%. Now, when I blend the two, I put more weight in the free cash flow method because great investors like Warren Buffett, Charlie Munger, they really focus on free cash flow. You look at the top 10 most valuable companies on the stock market, they all generate free cash flow and they grow that free cash flow. Earnings per share for those companies might go up and down, but free cash flow is king. That's what sets companies apart. And that's why I give free cash flow a greater weight in my valuation. So overall, it's a 32% discount on the number one company in ticketing and live venue management. I look for businesses that are desirable, and desirable means that they have strong competitive barriers to keep competitors out of their marketplace, be able to grow their revenues, grow profitably, and generate very high free cash flows. I also like businesses that are growing, have momentum, they're profitable, they have free cash flow. And Live Nation really fits in the ideal quadrant for me because they are the dominant company in ticketing for live events. They have few competitors that rival what they can do. Their market share is dominant, showing that customers like using their service. Artists depend on partnerships with Live Nation to have their concerts. They just have a stranglehold on this marketplace. So I put them in the most desirable quadrant, making them highly desirable for me. Having said that, I really like the company. I think the company sets itself apart and can't really be replaced. It would take a lot to replace Live Nation. The balance sheet's excellent. They have more cash than they do debt. They generate free cash flow. So really like the balance sheet. And I like the discount at 32%. So I'm going to plan to buy into Live Nation and build a position. Maybe invest about $10,000, but I dollar cost average in my investment into companies. I'm not good enough to pick the exact moment when a company has hit its low. So therefore, I'll just know that I'm going to be buying into a business that I do believe is discounted and over time accumulate shares at discount levels, ideally on pullbacks. We'll see how it goes. So that's my video on Live Nation. I hope you found it interesting. Keep in mind, I'm just an investor, just sharing my experience. I'm not providing any financial advice. I'm not recommending you buy, hold, or sell Live Nation. Please make your investing decisions completely independent of this video. Thanks again for watching. Good luck investing in 2024. Mercado Libre is an e-commerce company operating down in Brazil, Mexico, Argentina, and other Spanish-speaking countries in South America. It's a successful company that's really growing their revenue. I like the growth in revenue. I also like the geographic connection to Latin America. Mexico, as an example, their economy is doing well. They're doing well. Their middle class keeps growing, and their economy is doing well. So I think selling e-commerce down in Mexico is a great idea. I'm not quite sure about Brazil or Argentina, but I have heard that Argentina's economy is improving. Having said that, I am interested in having an e-commerce retailer in my portfolio. So I wanted to analyze Mercado Libre and see if it's a good stock to buy and put into my portfolio. I'll share my analysis with you and go through my evaluation of the company, see if it's really competitive or if it's just another company. I'll value the company based on their free cash flows and their earnings per share and compare it to the current stock price. And then I'll conclude with my intent to either buy or not buy and just pass on the stock and share that with you. None of this is financial advice. It's just one investor sharing his analysis and opinion on a company. Please make your decisions independent of this video and weigh them carefully. Now let's take a look at the fundamentals of Mercado Libre. Mercado Libre is an $81 billion company, and their revenue is just a little short of $16 billion. The PE currently is 72, and they are a high growth company, so that's somewhat understandable. Their forward PE is coming down because I think their revenue line keeps getting bigger, their profit keeps expanding, which is very good. Analysts really like the company, have a strong buy, and they say, hey, it's discounted by about 20%. The stock is rallying in the pre-market. It may open about 7% higher. So that's interesting that the market really liked the earnings they announced yesterday. I'll take a look at earnings in a little bit. Looking at their revenue, this is where the company is really impressive. Just the growth year over year has just been excellent. And they already have a pretty good number, and they keep growing it, a pretty big number of revenue. and they keep growing it by really big percentages. So that's a job well done by the company. Good job, Mercado Libre. The other thing I look at is cash flow. And the cash flow for this company is positive and has also been growing. If you look at the cash flow growth, I love seeing where a company consistently grows their cash flow over time. That's a sign of a really solid business that really has the model figured out, and they're probably just going to keep expanding that free cash flow. The balance sheet. I like debt to EBITDA to be less than 3. Let's take a look at what their debt to EBITDA ratio is for Mercado Libre. And that is a 2.04. Nice. Good balance sheet, really good company in a space that is expanding. They're profitable. They generate really free cash flow, really good free cash flow. So the fundamentals look really good for the company. Let me take a look at their earnings. The earnings report came out yesterday, and the company announced they grew year over year by 42%. That is phenomenal. Very good growth. Again, their revenue number keeps getting bigger and bigger. So growing at high percentages like that is more difficult, and it shows the company has a lot of special sauce to it. The margins, 14%, which is good for an e-commerce company. And net income margin, 10%. Again, it's an e-commerce company. And if you look at Amazon, they have margins that are in that range. Other things I think the earnings were in general very good. One thing I discovered about Mercado Libre is that they have fintech. I think they're doing a lot of financial services in the form of fintech. That is interesting. It's good that they're diversifying away from e-commerce and maybe catching another industry play that can give them better margins and keep that growth going. So very nicely done that they offer fintech, which makes sense since they already have a relationship with the customer. Why not sell the customer other products and solutions? So very nicely done. I really like that about the company. Their active users of fintech has really grown. And here is the layout. I think the biggest market they have is in Brazil. Second biggest market is Mexico. And then Argentina is in third place. So those economies, I believe, are doing well, specifically Mexico. That's probably the one that I know most about. Their economy is doing quite well. My one investment in Mexico has done well because of the economy expansion. So overall, the financials on the earnings report looked really good. And that's why the market is rallying today and really supporting a good stock price for Mercado Libre. I like buying companies where possible that are really strong competitively. They almost operate like a monopoly, where they have no competitors, they can set prices, they continue to grow in an expanding market without a lot of competition. There's a few companies that are like that. Mercado Libre, I'm going to put them in the ranking, but I like companies in the green, and I like to stay away from companies in the red that have too much competition and there's too much of a price battle. Margins are being squeezed. There's very little cash being produced. I happen to think the Mercado Libre is straddling the green and the gray. Gray being, it's an okay company. A lot of old industry companies are in the gray. They're good companies. They're profitable. They just don't grow a whole lot, and they have some competition. Mercado Libre does have competition. Amazon, as an example. Alibaba continues to grow around the world, and I think they do have competition, but they have big advantages since they focus in Spanish-speaking countries. I think culturally, they probably cater to that market far better. They're probably, the customers probably feel a better connection with Mercado Libre. So that geographic advantage most certainly, I think, is an advantage. It puts part of their whole proposition in the green. So I like the company. It's not a specific monopoly, and it's an industry that's really competitive. E-commerce is super competitive, right? And the margins are not the greatest. It's not like a software company or other companies like Facebook that have just incredible margins. So that's where I rank Mercado Libre in my desirability quadrants. What do I think Mercado Libre stock is worth? I happen to think that each share is worth $2,293, but the market is selling shares today at $1,732. So it's discounted by 32%. And the way I get to that discount is I look at their cash flows and discount their cash flows that I expect they're going to produce in the future to a current value, and really work towards comparing a value per share based on free cash flows to their current stock price. I also look at their earnings per share and see the valuation based on earnings per share. And together I blend the two and I get to a discount of 32%, which is a good discount on Mercado Libre. This is a higher risk company since they are outside of my home country, which is the US. A lot of things can happen that can surprise me. So I discount them at a higher discount rate, much higher than Amazon as an example, to compensate me for the risk. So those things are taken into account. Now, overall, I think a 32% discount is a very good discount on Mercado Libre. I'll be watching this company. Now, let me arrive at the decision. Should I buy or pass on this stock? Mercado Libre has really impressed me. I think they have a really good business model, and I love their revenue growth. It's a sign that it's a strong business that keeps getting bigger and stronger. So I really like the company. They have a really solid balance sheet with debt to EBITDA at around 2. The discount of 32% is also a good discount. Therefore, I'm going to start buying into Mercado Libre. It's a little bit of a tough day to buy into them since they're up about 7%. I hate buying stocks when they pop up like that, especially since the rest of the market's pretty much selling off today. So I'm going to let things settle down, but then start dollar cost averaging my investment in Mercado Libre and build a position. The other thing that could interrupt my investment in Mercado Libre is Amazon. Its stock price is really dropping, and Amazon is the strongest player in the space. If I can get Amazon at a very good price, I would be investing in Amazon instead of Mercado Libre. Let's see how that plays out and which one I end up buying. So that's my video on Mercado Libre. I hope you found it interesting, and I appreciate you watching. Meta reported earnings yesterday after the market closed, and the earnings were really positive. The company grew their revenue, they increased their profitability, they generated really good cash, and they're investing in the business so that they can build the next big business. Meta is the social application giant, really, of the world. If you consider billions of people log into a Meta application every single day, from WhatsApp, which is a very popular international application, to Facebook, to Threads, Instagram. The company is loaded with the top applications that people like to browse on, stay current on, build communities, stay in touch with family. It's pretty incredible how many things Meta does. A hidden gem for all of this is the AI business, and I'll take a closer look later. But Meta early on was not considered a big AI company, but as I study them closely, it is a big part of their business and a big part of the future. The metaverse continues to be a part of the company. They continue to build out the metaverse, and their Ray-Ban sunglasses have been popular. And maybe that's the way that people can go into augmented reality or virtual reality and have those experiences in the future. We'll see how that plays out. I'm an investor in Meta and have been an investor for a long time. And I wanted to analyze the company now that I have fresh data. Take a look at their financials, look at their earnings, and see how the company is doing. Analyze the company and see where I put them on my desirability quadrants. Are they really desirable or just an okay company? Value the company based on free cash flows and earnings per share to arrive at what I think the company is valued per share, and then compare it to the current stock price in order to make a decision whether I should buy more shares, just hold, or even sell my shares. I'll go through that rationale with you. Now, everything that I share is just one investor sharing his analysis with YouTube. It is not investment advice. Please make your decisions carefully and do your own research. Now, let's take a look at the fundamentals of Facebook, Meta. Meta is a large cap company with over $1 trillion of market cap. It's 1.2 trillion. The market's expected to make the stock go up at the beginning of the trading day. It's before the market is open. So if we add that 9%, it's probably going to be a 1.3, $1.4 trillion company later on today. The company has $142 billion of revenue, which is excellent. If you consider their margins, it's just an incredible amount of revenue. The PE for the company is 27. The stock has been doing well this year. And the forward PE is 22.5, which I believe is a really good value considering that the company is growing. It's clearly the leader in their space, and I would expect a higher PE. The company pays a small dividend, not a dividend stock by any means. And analysts really like the company. They think it's a strong buy, and the stock is discounted by 13%, soon to be 4% if you consider it's going to rise about 9%. The company's done really well over the past year. It's up 30. In 2024, it's up 35%. In 1 year, it's up 49.5%. It's really been an excellent stock overall. Meta's really grown their business over time, and they've gone from being a $70 billion company in 19, and now they're trailing 12 months. They're nearly a $150 billion company. That's incredible. And you can see the real growth rate. They had one slight down year in 2022. I think part of it was in 2021, they just grew so darn much. They probably pulled forward a lot of the investments. So overall, just great growth for a very big company to be growing 20% plus on a big giant number is super impressive. The balance sheet's really strong for Meta, principally because they have a lot of cash on the balance sheet, 58 billion of cash on the balance sheet, and they have less debt than they do cash. It's $38 billion. So they could pay off all their debt immediately if they wanted to. The most valuable companies on the stock market all produce high amounts of free cash flow. They also are growing companies. They are also leaders in their particular industry space. In the case of Meta, they are great at producing free cash. When you look at their sales, if you recall, were roughly about $150 billion, and they are producing about $50 billion of free cash. 1/3 of its revenue ends up being free cash. That's a clear sign that margins are excellent. It's not a business that takes a lot of expense, and overall, it becomes a really valuable business. The earnings for the second quarter for Meta were really good. If we look at revenue grew 22%, which is excellent, and the overall profitability increased 71%. So just a double positive where you have expanding revenue and expanding profit at a greater percentage. That's really impressive. The number of users on Meta platforms has gone up 7% year over year. So that looked really good. Their cash flow is very good, and the company is guiding to have an excellent Q3 and overall a very good 2024. Meta is a leader in social applications by a big margin. There's no other company that's even close to Meta's size and number of users and really daily active users, monthly active users, and they keep expanding. For example, Threads continues to grow and take market share away from X. Now, one hidden business, and I don't think it's been hidden all that long now, is the AI business. And you consider a couple of things. One, Meta was investing in AI. They just didn't really make a big deal out of it. And they have great capacity to build their AI application to do a lot of things. I was offered the Meta app a couple months ago, and I played around with it, and it's very good. I've played around with ChatGPT, Gemini. I don't use them on a daily basis, but I would say a couple times a week, I jump over there and ask it to do something. The Meta AI app is really good. And you think about the advantage that Meta has. They could offer their AI to billions of people quite quickly, easily. That access to that many daily active users, monthly active users is unrivaled. No one else in the space, even the massive Google, which has so many Gmail users and users of YouTube, they don't have as many users as Meta. You look at ChatGPT. ChatGPT is a very popular name among people that are probably ahead of the curve on technology. But to the average person, you ask them if they know of ChatGPT, their answer is no, and their exposure isn't very high. I think they have something like 135 million users of ChatGPT. Well, compare that to multiple billions of users on Meta. So Meta has a huge advantage of being able to distribute their AI app. So first, it's a very good app. Second, Meta has the capital to really make this business work. And it could become just one more application amongst its portfolio that is incredibly valuable. So Meta is just clicking and has a great operational team, and the future is really bright with AI being well covered by Meta. So I've put together my desirability quadrants to really point out the companies that I want, companies that I want to stay away from. And I want companies in the green, companies that have competitive barriers of entry so their competitors can't come in and compete for the business and drive down margins, drive down the value of that business. And stay away from companies in the red, which are companies that have excessive competition, they don't have great margins, and don't produce much cash at all. And Meta is clearly the leader in their space. Their social applications are clearly ahead of everybody by such a margin that it's hard to imagine they're going to be caught at any time soon. More importantly, they continue to invest in their business to make their applications even more desirable. They expand their applications. For example, Facebook Marketplace is a really neat place where people are beginning to buy and sell. It has a lot of potential to be almost like an eBay within Facebook. So that really has a lot of potential, and just one more example of how Meta continues to expand and keep their user base really interested in their apps. So overall, Meta is an easy company to put into the highest point of the green quadrant, making it a really desirable company for me. and therefore I'll treat it that way as I go into the valuation. So I've valued Meta using their free cash flows as well as their earnings per share. As mentioned, Meta is just a high cash flow producing company. It's also a growing company that really makes them really desirable. Their last year free cash flow is 47 billion. They'll probably do a little more, but I'm going to be conservative in year one and just have a starting point of last year's number of 47.3 billion. I'm going to grow it by 8% for the first 4 years, and then terminal value I'm going to grow at 5%. I'm going to discount by 8%. I could easily go to 7.5 since interest rates are dropping. But again, let's be conservative, and I'll go with 8. Really, the net present value of all those cash flows in today's value is 1.6 trillion, dollars. I'm going to add the cash and take away debt. So the equity value of Meta for me is $1.6 trillion. The market cap, again, it's ahead of the market open, so I'm just going to use what's on public websites, is 1.2 trillion. And I'm going to compare the intrinsic value per share against a stock price that is the stock price that it should open at, $513. So when we look at the free cash flow valuation of Meta, it has about a 26% discount on the number one player in social apps. Earnings per share look great, 20.65. That might be a little bit conservative. The PE, I'm going to move it to 30. They are trading less than 30. I think they're worth 30. And their growth of that earnings per share is expected to be quite high. I'm going to go with a 10% growth rate on that earnings per share. It calculates a stock value of $681, but the current stock price, based on where it's supposed to open, it's $513. So there's about a 33% discount if we look at earnings per share. So combined, it offers a 28% discount for me for the number one player in their space, an incredibly growing company with the AI business and everything else that Meta delivers. I think that's quite an offer to buy a stock at a 28% discount for me. So I've looked at the company, really looked at their business to see if I like the business. And most definitely, I really like the Meta business. And I really like that the company just has not really stood still. They have made their company stronger and better. They've made their products better, the experiences that their users have, making them better. They've broadened their business, bringing in an AI, Facebook marketplaces. The Threads business is relatively new and is continuing to expand, the users and the engagement on that application. So the business is just a really desirable business, really a very strong business with a strong moat. And I really like the company. The balance sheet's excellent. They have more cash than they do debt. They produce high amount of free cash and high amounts of EBITDA. So the balance sheet is incredibly strong. So balance sheet's good, company's great, and a 28% discount on a high quality company. So I'm a buyer of Meta. I've been buying Meta shares on pullbacks just because I want to continue to build my position. I have a position at $198,000. That's before the open. If it opens 9% higher, it'll be 9% higher on that amount. And I continue to add shares. It's the biggest position in my portfolio. And I am comfortable with that because Meta is such a great company. Most of the appreciation that I've seen is making up that number. I'm sitting on a good gain with Meta, and I'd like to see it grow and grow in the future. So that's my video on Meta. I hope you found it interesting, and I really appreciate you watching. .3M had an excellent day today. The stock was up 22% after the company announced earnings. 3M is a company that I've followed for many years. I've known of 3M ever since I was in college. That's 30 years ago. And I've always respected the company. They're a company that has continued to innovate and really put good ideas to work for either industrial accounts or consumers. The company started in the mining business a long time ago, but realized that they should really grow into businesses that were probably more profitable and better for their company, for their employees, and really for the economy. Overall, I'm a fan of 3M. They fell on hard times recently where they did manufacture some earplugs that ended up causing hearing loss to some servicemen and women. And that's really unfortunate. I don't think the company meant to do that, obviously, but they did have to pay a big settlement. That's behind them. And I'm glad to see that they are going to proceed forward with their business. They paid off the plaintiffs, and hopefully all the plaintiffs are going to be okay. But now that the business is going ahead beyond those problems they had, the business I thought was going to be a really good rebound business. And I'm glad that I started investing in them in 2023. Overall, the return's been really good. And I wanted to analyze the company now that they've announced their earnings and see if I want to invest more money into 3M, if I should just hold my shares or if I should sell my shares. Did I already get enough return and I could sell the shares and make a good profit? I'll let you know that at the end of the video. Now let's get into the fundamentals of 3M and go through the valuation of the company first. 3M has a market cap of $70 billion. It really went up today. It went up really 23%. So it was a very good day. And revenue is $32 billion in revenue. They have a PE ratio, that forward PE of 17, which is fairly reasonable if you consider a lot of PEs on the S&P are in the mid 20s. It pays a nice dividend, and analysts had a buy rating. And now with the stock really going up, it would be sold at a premium based on the calculations they had before their earnings. The company overall, again, it's a rebound story. They had trouble in the past. Their revenue isn't going to look great, but overall, the most recent quarter, and I'll look at their financials next, it shows that their revenue did grow just a slight bit. More importantly, their profitability really went up. Taking a look at their earnings for the second quarter of the year, their sales were relatively flat. They had just slight growth, 1.2% year over year if you look at the most recent quarter. But they did surprise, and they had better earnings per share than were expected. And I think that's what the stock market got really excited about. It really does help on a day when they announced their earnings. There also was positive economic news, which was that inflation is being tamed. Inflation, the producer price index came in at 2.5, and that surprised in a favorable way. So that combined with the good earnings really helped 3M have a great day. Overall cash flow is improving, which is excellent. That's very good to see. It'd be great to see 3M return to the glory days that they once had, where they really produce high free cash flows. Looking at their balance sheet, it looks good. I'll look at the balance sheet more closely. They're in an industrial business, automotive, consumer products. For the guidance, I want to get to the guidance. They raised their guidance. They raised their guidance on the profitability that they're going to have. They're going to be more profitable than originally stated, and they're going to have better earnings per share than originally stated. So overall, it was a positive earnings. And overall, I think I'm not the only one that thinks the 3M brand is really positive. I'm sure there's other investors who think highly of the company and really expected the company to rebound like myself. I think it's becoming reality now with these types of numbers. So where do I rank 3M in the overall desirability of this business? What's really important for me is to know, what type of business am I buying? Am I buying a business that has really good competitive barriers and can keep competitors out of their market, pretty much operate close to a monopoly? Companies like Google Search, Microsoft Software, and such. And those companies would be in the green. Those are great businesses that just have really strong competitive barriers against competition. The worst companies, they have no barriers. Anybody can enter their market, compete against them, drive down prices, be overly competitive, and nobody makes any money. 3M, I think at one time was clearly in the green in their heyday. I would say that not too long ago, they were in the gray, where they were just trying to figure out how they were going to get out of these lawsuits and get ahead of these things. Now they've done that. I think they're moving towards the green. They have a lot of products that are very well liked by the market, liked by their partners. They have a very good network of customers. They have a lot of patents, a lot of good stuff there. But I wouldn't put them completely in the green. I'm going to say that they're in the gray, and an investment in the gray for me, I have to get a very good discount. And based on the discount that I was getting a year ago from 3M, it was a good investment. So that's where I put 3M. They have a medium barrier of entry against competitors. I think it's a strong, moat, but it's not very wide. It's not like an Apple that has that device that everybody wants. So that's where they sit in my desirability quadrant. It's a good company, but it's not a great company. So what is 3M worth? If I look at their cash flows that I expect the company is going to produce, as well as the earnings per share that I expect the company is going to perform. Well, let's take a look at both. First, with cash flows. I put together my own forecast. The best forecast I could put out there is, they had a good year in 2023 when it comes to cash flow. I'm just going to go with 70% of 2023, which gave me $3.5 billion. They're operating towards that number, and I think it's a good number to start a forecast of cash flows for this company. They're doing better now, so I raised the growth rate to 10% from my previous valuation. That gives me a forecast for the first 4 years represented here. And then terminal value will grow at 4%, all cash flows beyond year 4. Now, the discount rate is 8.5%, which is a reasonable discount rate for this company. When I discount all those cash flows, to today's value, it's $85.8 billion of value if you look at those cash flows. I add the cash and take away debt to get to an equity value of $75.4 billion. The current market cap is $70 billion. So the company now is being priced pretty close to their stock price. So it's fairly priced. It's a slight discount, but it's pretty close. If we look at earnings per share, I'm using toward the higher end of the earnings per share that they represented, and I'm using a PE of 18. They're not too far from that number. I'm going to grow those earnings per share by 6%. The economy keeps getting better. I think there's good times ahead for 3M. It gives me a per share value of $137. The current stock price is $127. So there's about an 8% discount available if I look at the earnings per share. Combined, when I blend the two, I get about an 8% discount on 3M. That's a small discount. It doesn't compel me to buy a ton of stock from this point. And remember, I have 3M in the gray. It's a medium desirable company. It's not like a Google or an Apple that is very desirable. So if I'm getting a small discount on a company like that, I'd probably take it. But a company in the gray, I have to know that I've got a better discount. It's still a rebound story. The rebound is looking really good, but it's not done. So I'm going to have to really think long and hard about buying more shares at this discount rate. Looking at where the 3M stock has traded over the last 5 years, boy, it's been a real roller coaster for the company. You know, I don't really consider COVID anybody's fault. It just happened, and a lot of companies' stocks went down. 3M stock really rose out of COVID, and it went up 65%. But then came the big drop from the high point to the low point. Boy, nobody wanted this stock. It went down 58%. And really buying in 2023 may have been a good idea. In fact, it's proven to be a good idea because the stock's up 75%. So it really provided one of the premium companies in the history of the United States, I would say, especially over the last 100 years, an opportunity to buy that company that put out so many great products and in my eyes has a great brand, has a lot of smart people working there at a discount. And I'm really glad that I invested in the company when the investing was good. So what should I do with my 3M stock? Well, I'm glad that I bought the shares in 2023 and then I dollar cost average my investments. I'm not smart enough to pick the very low point in a stock. I just know when a stock is discounted and I tend to buy when those prices are discounted. Overall, I'm sitting on a 49% gain on this stock in less than 1 year. So that's been great. And I'm going to hold my shares. If the stock rises anymore, I may consider selling. You know, there's nothing wrong with taking a solid gain and just banking that money. Because you never know that maybe in a year or two, you know, this stock can really go down. I could see myself holding this stock for a long time. It's just, I have to be smart with these gains. I like taking gains at times, banking them, and then seeing what else is out there to take advantage of, really doing it all over again, finding the next 3M that is unappreciated, undervalued, buying it at the right time, and then making a nice gain. So that's my video on 3M. I know that I got one comment on the community page asking for 3M, and this is for you, for that viewer that wanted it. I hope that you invested a lot of money and you had a very good return. And just one last reminder, I'm an individual investor. I'm not providing any financial advice, and I'm not recommending you buy, hold, or sell 3M stock. I hope you enjoyed the video, and I appreciate you watching. MPW is the stock that I get asked about quite a bit. This is a stock that could be a multi-bagger, and I think it lures a lot of investors to take a look at this stock. What also lures investors is a very high dividend rate. This is a very troubled real estate investment trust. Their principal tenant, Stewart, ended up in bankruptcy, and that created a big strain on the MPW business to the point where MPWs had to sell properties to drive up their cash flow and really stay as a viable concern. Overall, I'm all for seeing a rebound story, yet this one has been going on for a while. I can understand a rebound and giving a company 2 quarters to really show promising results or maybe showing that they're back on track. This one here has kind of stayed in the same cycle for over a year now, which is really, really concerning. I decided to completely sell my shares. I just thought that it was too much of a distraction. And before this past stock pullback, I wanted to drive up my cash position. So MPW is one of those stocks that I sold to create more cash. I'm glad I did, but I kind of felt like I was admitting defeat on a stock that I hoped would go up. I still hope it goes up. I still hope that the investors that hold MPW are rewarded for taking the chance on this company. I wanted to update my analysis on MPW and share with you how I feel about this company now that we've had a little over a year of the company trying to get out of this trouble. So MTW is a small cap stock. They're about $2.95 billion as a revenue cap, which in this day and age, that's a tiny cap. Their revenue has been going down. It's $320 million per year. And I'll show the income statement and show you how revenue has gone down because they've sold properties in order to create cash on their balance sheet. Their dividend is attractive. The concern there is the payout ratio. We got to look at funds from operations, and I'll do that in a few minutes. Analysts say it's a hold and that the stock is discounted by 10%. The stock over the last couple of years, it's not a very pretty picture. The stock used to trade around $20 a share, and this is a real estate investment trust that operates in healthcare. So leasing out hospitals, clinics, urgent cares, that type of thing, to me, is fairly steady. So having your primary tenant, the biggest one you have, go bankrupt just really, really put a strain on this business. They've gone from being a $20 per share stock down to bumping around, $4 or $5 per share. Now, stocks like these, if you buy them at the right time, and other stocks that I've seen really rebound off these lows, a good example would be Zim. That's done really well because it's really risen above the low that they reached. This one, MPW, you could have made some really good returns if you really knew where the bottom was, but that's really tough. Even if you just dollar cost averaged this year, you'd probably be doing okay. I know I sold at a loss because I started investing well over a year ago and probably invested a little over $5 per share, and I sold probably around $4 per share. So the company has had enough volatility to offer up some really low prices, but is it going to pay off for investors? Well, I think it's all about if they can just get this Stewart tenant off their books and out of the business and just have a clean business, then I think the answer is that the stock should rise. The other thing I would point out is I think that you got to have a little bit a changing of the guard where management that got them into this mess with Stewart, I think there needs to be some accountability and get some new people, some new blood into the business in the management team. You see how a new CEO could really do a lot of good. If you saw Starbucks decided to switch the CEO and put in a different CEO, and the stock rallied over 20% in one day. I think it really just changed the whole theme of Starbucks. They really needed that. I think if you had a new management team, investors might think differently of MPW and feel like they really have turned the page. That would just be an idea that I would throw out there. So if they make it, I think investors are really going to be rewarded. If they stay in these cycles of just bad news after bad news and can't get this Stewart bankruptcy through their system and off their balance sheet, then I think it's going to just continue to just cycle and keep this stock down for another year or so. The revenue for the company has been going down. Understandably, that you've got your biggest tenant not paying you, and that can really lower your revenue. They've also sold properties to create cash on their balance sheet. So they've seen their revenue really go down in 2023. In the trailing 12 months, it's really gone down as well. That's really concerning. I use top line revenue to tell me the health of the business. And obviously this business is not healthy when they're losing that type of revenue. The other item we have to look at is funds from operations. That's how, for a real estate investment trust, you got to make sure they can afford that dividend. It's very attractive, but in 2023, it was way over funds from operations. That's why they lowered that dividend. So is that just going to happen over and over again where they have to keep lowering the dividend rate because they just can't afford it? We'll see. A 12% dividend is very, very high. They could probably cut it to some extent, and it's just going to set a bad precedent again. But a 12% is very high. It's abnormal, and companies typically don't pay that high of a rate. It's principally because the stock price has gone down so much in value. We'll see if it gets cut again. I wouldn't be surprised if it does, because the company is in survival mode. They have to figure out how to survive, and it may be at the cost of reducing that dividend again. Most analysts think the stock is either priced fairly or priced at a 10% discount. And one analyst actually thinks the stock ought to be priced around $10 per share. So there's an optimist for you. Overall, there's 10 analysts covering the stock, which is pretty good coverage for a small cap of this type. I think it's gotten a lot of attention since it's gotten a lot of press around the Stewart bankruptcy. The earnings per share in 24 is expected to be a loss, but it's supposed to be positive in 25 and 26 as well. I would say that it's a tiny earnings per share. I don't know that it's going to drive much of a valuation at all. And that's just kind of another bad sign of the company. It might be that this company gets sold for its parts. Somebody buys it and kind of rebrands it, or a bigger real estate investment trust buys it and gets rid of the bad stuff and keeps all the good stuff and just operates those properties under their own brand. Who knows? But what I'm seeing is just fundamentals that are really bad for a business. And I hate saying that, but it's just reality. I'd prefer for the company to really show more promise in the immediate future. They've had a lot of time to kind of sort through these issues. The one item that I would say is the interest rates coming down are really helping MPW. If you have lower interest rates and these guys have to redo their debt, they could probably get lower rates as opposed to the higher rates that we were paying a year or 2 years ago on loans. So that's a bit of good news and a bit of good luck. Overall, I think MPW has a chance to make it. I certainly hope they do, but I think it's going to take a while. And I wouldn't be surprised if it's just another year or two of disappointing news. For me, I'm staying out of the stock. I think this type of stock just gets me in the wrong road. I'm looking for the next Meta. I'm looking for the next Uber. And I'd rather spend my time and take my chances and make my bets trying to find a company like that than waiting around for MPW to turn their business around. I hope they do, but I just don't want to be waiting around. I think it's more of a distraction than it is valuable to me. So I'm staying out of MPW. I hope all the investors make money on this stock because I think investors deserve a good return on this stock. So that's my review of MPW. Hope you found it interesting. Keep in mind, I'm just an individual investor, just sharing my analysis with you. And I'm not recommending you buy, hold, or sell MPW. Appreciate you watching. Good luck investing. Merck announced their earnings today, and I wanted to go through their earnings and then quickly value the company to see if this is a stock that I should be interested in. I currently don't own any Merck stock, but I've known of this company for a long time. Who hasn't? They've been a real well-known company for a long time. Now, let's take a look at their earnings. They look at their fundamentals and see if this stock presents an opportunity, a discounted stock, or maybe if it's priced fairly, or maybe it's overpriced and we expect that it might go down in the future. Let's take a closer look. Merck is a $323 billion company. That's a pretty big market cap. And part of the reason for that is over the last 5 years, the stock's done quite well. It's risen from about $70, $75 a share up to $127 a share. And likely it's because they've done well from a business. They've grown their revenues and so forth. So they probably deserve that. Their forward PE is 14, but in the current year, it's quite high at 141. They pay a dividend, and I'm sure income investors like that dividend. Analysts like the stock, and they believe that it's discounted by a little bit. Now, earnings were announced, and the stock is down 3.6%. Interesting. When we look at their revenue, the revenue historically has been good. They've grown their revenue over the last 4 years, although 2023 was a little bit slow. If we look at the quarterly, revenue is good. So the revenue has been growing nicely, which is good to see. A company that grows their revenue at this rate, I consider this a good revenue company. And you see that in 22, they had really good revenue. It really did dip. Maybe they sold forward in 23. When we look at their free cash flow, most pharmaceutical companies produce really good free cash flow, and Merck really does as well. They have historically produced really good free cash flow. And in the most recent full year, they produced $9.1 billion. I'm going to use about a $10 billion rate of cash flow so I can get a quick value for the company. When I look at Merck's revenue, it looks pretty good. The company increased their revenues by 7%, which is very good in the second quarter for their business. Overall, positive earnings per share, and the company really operated well. Their full year guidance, they raised their guidance, which is very good on their top line revenue, and they expect earnings per share had a decrease to it. So maybe that's what's causing the price decrease for their stock. So they had to set an expectation that they're going to have a negative impact from a one-time charge of approximately $1.3 billion. So that might be the reason why the stock's selling off a little bit. But again, sales did grow, which is always a good barometer of the health of the business. If you're growing your revenue, that means customers like your products, you're getting more customers, you're increasing your price. All those things are good. In general, I think their earnings were good, but as you saw from the stock price, it's been going up. So I think investors expected more, and they've been paying a premium for the stock potentially, and they expected more. So that's maybe why it's selling off a bit. How desirable is Merck as a business? Well, I like to put companies in the desirability quadrants that I've put together. The green representing companies with the strongest moats and the ability to operate almost like a monopoly, setting their own prices, really getting more demand than they can probably fill. And they're probably the most profitable companies operating out there. And then there's the worst companies in the red, which are in industries where there's just too much competition. Those competitors are constantly slashing prices, getting rid of profits, and seldom do those companies generate really good free cash flows. Merck is a pharmaceutical company, and there's a lot of desirable aspects to a pharmaceutical company. Although I'm not going to put them squarely in the green, I'm going to put them straddling the green and the gray. Gray being that there is a moat. It is strong, but Merck does have competitors. In a few drug franchises that they have, they are the sole company that provides that drug, but in many other categories, they compete in the marketplace, and that tends to drive down price and profit. So it's a really desirable company, but not the most desirable company that I see out there. Now, I don't currently own Merck, nor have I done deep analysis on it, but I like to do a quick qualifier calculation to see if I would really want to dig into this company and invest my valuable time. And I have a quick valuation calculation metric where if a company has no revenue, I have a multiplier against their free cash flow, modest, good, and high. And I think that Merck has good revenue. They've been growing nicely. They have good, consistent growth. So I'm going to take their current annual free cash flow, and I'm going to use about a $10 billion figure, multiply it times 20. I get a $20 billion value for a company like that. But their current market cap is $323 billion. So I think just very quick calculation, the stock seems to be overpriced. And I probably won't invest more of my time because I'm looking for stocks that look great and present a value proposition to me where I think the stock's going to go up over time. So this one doesn't qualify, and I'll stop my analysis at this point. Merck is a high quality company, but it's not discounted. It doesn't provide a great investment option for me. So I'm going to just pass on this company and let other investors own this stock. There's a lot of choices in the market. It's not like I have to buy a specific stock to make lots of money. I have great choices out there, and I'm looking for choices where I could buy a stock and really make good money. In this case here, again, Merck is a great company, a great business, but the price is a little high, and I'm going to go ahead and pass. I hope you found my video interesting, and I appreciate you watching. Welcome back to my channel, fellow value investors. In this video, I'm going to be covering Microsoft. Microsoft is the biggest software company in the world, and they are in just about every part of the software industry you can imagine, whether the software is being used for personal reasons at home, students, businesses that need to run their business, store big, data sets. Microsoft is in just about every industry, government, and institution. They've been around since the 1980s and were really part of the big PC build out. They were part of the, connected.com surge. And now they're part of the AI build out. Microsoft has a couple of things going for it with regards to AI. First, it has a big hyperscaler business where that hyperscaler business can help companies build their large language models for AI. And that business is going to thrive as companies use Microsoft Azure to build out AI. They also have they have a big partnership with OpenAI, so that ChatGPT is being integrated into a lot of their software products. Most definitely, Microsoft, their narrative has been really positive and gained a lot of attention, positive attention from the marketplace, and their stock price has really gone up as a result. I think their main competitor for AI is going to be Google, and Google has really been stumbling. Google is an incredible company, and I think they have a very strong AI business as well.
But Microsoft has certainly been perceived as just really doing a great job in rolling out their AI business. Their narrative tends to be very positive, and if anything, just gets a lot of positive attention. So it's interesting how that's played out. In this channel, I value companies, and I want to know what I think a fair price for Microsoft is and compare it to the current stock price. I'll share with you what I plan to do with the stock. I'm currently not a Microsoft stock holder, but I'd be a Microsoft stock holder if I can get a reasonable price on this great company. Now, let me show you more on Microsoft. The fundamentals on Microsoft are really impressive. The company has become the most valuable company traded on the stock market. Their market cap is $3.02 trillion, and that's incredible how valuable Microsoft has become. Their revenue is well over 200 billion and growing. They're growing at around 12% per year, which is really impressive since they're already so big. Their forward PE is 32, which I think is reasonable since the PE for the S&P is 26. Microsoft's a growing company that has a pretty bright future. Most analysts are real big positive proponents for the stock and they have buy ratings, but the stock has run up quite a bit over the past year. It's up 56%. And compared to NVIDIA, that's pretty rational. And it's funny to say that because 56% in any normal year is a phenomenal year, but NVIDIA and even Meta are just crushing their stock price. So Microsoft is interesting. It's interesting that in 24, they had a surge in January, but they've been trading sideways for about a month now, which is interesting. Maybe stockholders are pumping the brakes and seeing that, hey, a $3 trillion valuation is fairly large. How much higher can the Microsoft stock price go up? I'm going to value Microsoft based on the free cash flows I expect the company is going to produce in the future. And I'm also going to value the company based on earnings per share. Let me go over free cash flows first. Microsoft really generates high amounts of cash flow, and I expect for the next 12 months, they're going to generate $59.5 billion of free cash flow. And I get to that number by taking the most previous closed year and then growing that number by 8%. The first 4 years, I'm going to grow at 8%, which is a reasonable factor to grow those high cash flows. And then after year 4, in terminal value, I'm going to grow those cash flows by 4%. These are very large numbers. So growth in these numbers is very difficult. You're just consuming or taking over so much market share, and you're taking so much more of the customer's wallet that I feel that 8% growth in the first 4 years and then 4% is reasonable for Microsoft. This is a high quality balance sheet. So their discount rate that I'm going to use is very low at 7.5%. The present value of all those free cash flows is about $1.8 billion. They have a little more cash than they do debt. I'm going to add the cash and take away the debt to get to an equity value, which is $1.78 billion of value. Compared to their market cap of $3 trillion, the company is actually trading at a 40% premium when you compare the value of their cash flows compared to the stock price and the current market cap. Earnings per share tell a different story. Earnings per share look really favorable. The company's nice and profitable. And I'm using their forward earnings per share, which is expected to be 11.89. Their PE is 36 for me. I know that might be a little high in other people's books, but Microsoft has a lot of momentum. I think they have growth. I think they deserve a higher PE. And I'm going to grow those earnings by 4% per year. Based on those factors, the company is actually fairly priced on earnings per share. I weigh free cash flows. The discounting of free cash flows is a better measure of a company's value. And when I blend the two methods, I get to 27% as a premium on the Microsoft stock. Now, a 27% premium is a little too much of a premium to pay on Microsoft. If it was fairly priced, I would consider buying shares depending on, if I believed in the business in their next 5 years. I think the next 5 years for Microsoft are going to be really positive, but a 27% premium is just pretty high. In summary of Microsoft, I think their business is awesome. I would love to be an owner of Microsoft, a part owner. I think their industry is great. Software is proven to just generate lots of value for stockholders. And the company just has a great management team, just great employees. Their debt is it's zero debt because they have more cash than overall debt. So well below the metric that I really like to follow, which is having debt less than 3 times EBITDA. But there's no discount on the stock. And again, I'm willing to pay a fair price for a great company, but not a, high premium for a great company. So I will be a seller of Microsoft stock and hold until I see a correction in the stock or things change. Maybe the company does so well that their actual fundamentals, the amount of free cash flow they generate, really goes up and it changes their valuation. But I'm going to hold tight and keep looking at Microsoft in the future. It'll be interesting to see how far, how fast, and who's going to win or lose in the generative AI space. It is a new space. A lot of things need to be determined, but most definitely Microsoft has really looked good for the last year as in regards to AI. We'll see if they can keep it going and for how long. I really appreciate you watching the video. I hope you found it interesting.
In this video, I'm going to analyze Netflix and make a decision whether I should buy more shares, hold my shares, or sell my shares in the #1 streaming company in the world. Netflix has a storied history. They came out of the DVD industry. They used to rent out DVDs, mail them to you, and you'd return them in the mail. But they knew that the future was all about streaming, and they really bet the company on building a streaming business, and boy, did it pay off. They are the #1 streaming company. They're well ahead of all competitors, clearly ahead of everyone. They have the best service itself. The software functions the best. They have a great library of videos, and they have the biggest user base that is a paid user base. It's global. Here in the US, geez, I can't think of a household that doesn't have Netflix. But as you go around the world, Netflix is really growing around the world. This is a profitable company that can really turn on and turn off free cash flows as needed. They build their own content. They develop new movies. They develop new shows. Some of the best new shows are coming out on Netflix. They're even going into sports. Drive to Survive really put F1 at the forefront of the viewers' experience here in the US. It's just been a huge hit. And I think they want to continue to grow in sports. Overall, Netflix is clearly the leader. And is this company well priced currently at their stock price? Is it priced at a premium or at a discount? I want to find out. I'm going to do my own analysis and get to that decision. I'm going to go through the fundamentals of the company, show that to you. Then I'm going to go through my process of making a decision whether I'm going to buy more shares, hold, or sell my shares in Netflix. The Netflix stock is up 32.94% year to date. It's a really nice return for 2024. In 1 year, the stock is up 87%, a really nice return. If you look at the 5-year chart, you can see where the stock was really discounted in the 2023 timeframe, and it really rose 255%. And there's a correction on that. It was in the 2022 timeframe that it rose 255% if you go from the low point up to where the stock is trading today. It still hasn't reached the peak that it got to. It's down from that peak about 9.7%. But you could see where you could have picked up Netflix at a really good price not too long ago. The fundamentals of Netflix. The market cap for the company is $269.5 billion. Pretty big market cap. This is a mega cap stock. Revenue for the company is $33.7 billion. So you're paying about 9 times revenue, which is really good for the #1 streaming company that is growing. They have solid net income at $5.4 billion, and they have a forward earnings per share of 35.4, which is reasonable for a growing company. They have lots of analysts covering the stock, and they have a buy rating on the stock, and they have a price target at $578, which is below the current stock price of the company. The company has been growing the revenue really well. In 23, they grew 6.67% on a very big number. In 22, about the same amount. In 18% growth. So the company is a growth company. They're growing globally, and they can also increase their prices, which would really drive top line growth for the company. The company's really grown their cash flows. Their cash from operations went from being negative to being very positive. You can see that in 19, they were cash negative on operating cash flow. But since then, they've been positive on operating cash flow. And this past year, they had really good free cash flow because they had a lot of cash from operations and very little CapEx. So that just really looks good that the company is really profitable and beginning to generate really cash flow, similar to Alphabet, Meta, and all the other technology-based companies that make a lot of money and return a lot of cash back to shareholders. Analysts cover Netflix, and their price targets are a little dated This company, the stock price has been moving up so fast that it's moved beyond most price targets. The average price target is $578, and stock price is trading at $622. The high target is $765 per share. But you can see that analysts put these price targets maybe 3 to 6 months ago, and that the stock has been moving up so fast that it's really gone past those targets. The balance sheet looks really good for Netflix. They have a lot of cash on the balance sheet, and they have a reasonable amount of debt. Their debt to EBITDA is 0.68, and I require that it be below 3. So it's well below my benchmark. So it's doing really well with regard to its balance sheet. Earnings per share look great. The company's really growing earnings per share. The company is expected to do $17.52 per share in 2024. But as you go into the future, you can see that it's really going to grow 23%, 19% in the next couple of years. So this is just going to continue to drive that stock price higher because the earnings per share is really moving up for Netflix. I calculated the value for Netflix using their free cash flows and also using their earnings per share. And I came up with the fact that this company is currently selling its stock at 8% premium, meaning that I believe that the stock is really worth $601, but the stock price is being sold at $622. Again, this is a really well-operated company, number one in this category. A lot of investors like it, which is why the stock price is really high. So should I buy more shares in Netflix, just hold my shares, or sell my shares in Netflix? Well, let me go through my scorecard and make that decision. First, do I really like the company? Do I like the industry they're in? Absolutely. I think Netflix is in a great industry. I really like it. I like the fact that they're number one. And the company is really well operated. They really are ahead of the pack when it comes to their industry. They continue to invest in the business, making it better, making it bigger, making customers even more happy with Netflix. The debt is well below 3 times EBITDA, really looking good. All those things look great, but there's no discount on the stock, which is kind of a bummer because that's going to cause me to just hold my shares in Netflix and see how their fundamentals change, which might change the valuation of Netflix, or maybe the stock price comes down a bit and it becomes at a good price to buy additional shares. Netflix is one of those companies that actually created the industry that they're in. Streaming, it was really Netflix that really built this business. And now all other media companies are trying to catch up. You see Disney with Disney Plus, Apple with Apple Plus, and Peacock from Comcast, and all the other players are trying to catch up to Netflix. But Netflix is really a pure play streaming company that's really going to focus on the business. I like that a lot about the company. Overall, it's just a great company, and their stock price has really run up. It's not time to buy more shares for me, but I'm going to continue to own these shares and really continue to evaluate the company to see if there's a better entry point in the future. I hope you found the video interesting, and I really appreciate you watching. Nike is the dominant athletic footwear company in the world by a wide margin, and their stock price went down 20% on last week's trading at the end of the week after the company announced their earnings. Wow, 20%. Is it time to cut bait and get out of this stock? Or is it time to buy more shares and buy into this company since it's being discounted? That's what I want to answer in this video. I'm going to analyze Nike, go through my whole process of looking at the company, and then I'll make a decision whether I should sell the shares that I currently have, buy more, or just hold. Let's get into it. So first, I'm an individual investor. Nothing of what I do or say is investment advice. I don't recommend you buy Nike, don't recommend you sell it, don't recommend anything related to financial actions around Nike. I also have a sponsor, Moomoo, who sponsors my channel, and I appreciate that. They're offering new account holders a really nice offer where they'll pay you 8.1% on your cash that you hold with Moomoo. They'll also, after 3 months, that's an introductory rate, they'll pay 5.1. They'll give 15 stocks to new account holders that put in more than $1,000. And that's a pretty good offer combined with an 8.1 and then 15 free stocks. Take a look in the details of the video if you're interested in that offer. Now, Nike. So Nike clearly is the dominant company when it comes to athletic footwear. You can look at any sport, just about most of the athletes wear Nike. They have the strongest brand, and the margin between the value and power of their brand compared to Adidas, which is probably in second place, or Puma. There's some brands out there that are recognizable, but nowhere near the power of Nike, especially here in the United States. But I imagine it's the same around the world. So the company is recognized, and their shoes are held in a higher desirability, I think, category than typical shoes, let's say from Adidas, Puma, and others. So that's one recognition, is that Nike has clearly a brand like a Coca-Cola. It's very recognized, and it gives them an advantage. Retailers want to carry Nike in their stores. Online companies want to carry Nikes on their websites. Athletes, they want to be endorsed by Nike. Their whole network effect is quite powerful compared to the other brands. And they had a movie come out recently. Matt Damon and Ben Affleck were the actors in that movie. And I really liked the story they told. At one point, Nike was small, and they really had to fight hard to be relevant in that case, basketball. And they certainly became relevant because they signed Michael Jordan and they created the Air Jordan line of shoes, which have become just a huge, huge success for the company as well as Michael Jordan. So the company really got to where they're at by having great shoes, a great product, and having great partnerships, and really just being more creative and probably just hungrier, harder working than their rivals. So the advantages that Nike has as a business are really desirable to me. I think it's a company with a strong, wide, competitive moat. Companies cannot compare against Nike. If Nike were to falter for 5-10 years and another company really performed really well, maybe at that point you could see that their moat would be threatened. But as so long as Nike continues to do what they do, which is really dominate the professional sports endorsement game, dominate, the retail shelf space that they command, dominate online sales, dominate direct sales to their consumers, I don't think their moat is going to be threatened. So I really like the company, and I really like their competitive moat. Their balance sheet. Their balance sheet's excellent. They have almost as much cash. Actually, they have more cash than they do debt. So they can pay off debt immediately. And EBITDA, they make almost as much EBITDA as they have of debt. So they could pay off debt in almost 1 year. So that's a very strong balance sheet. On their earnings, they announced that they reduced their inventory. So that's just one more element of making their balance sheet even stronger. Because the lower the inventory a company has, the lower the risk of that company having a write-off of their inventory for inventory that's become stale and less desirable. So all things are good with the balance sheet. So really good company, good balance sheet. Now let's talk about the discount of the stock. And I value Nike using two methods. One is using the free cash flow method, meaning look at the free cash flows that I expect the company is going to produce in the future, discount those free cash flows, get to a value of what that company is worth. The other is to look at earnings per share, value the company based on the earnings per share that I expect the company is going to provide. Free cash flow looks really good. Their trailing 12 months of free cash flow is $6.9 billion. And I'm going to grow that by 10% because they have been just performing really well. They are putting more cash on the balance sheet every quarter, very profitable. They have certain products that are very mature and they generate a lot of cash. So next 4 years, I expect they're going to grow free cash flows by 10%. And then after year 4, grow at 4%. It's a really strong company. So I'm going to discount all those free cash flows that I expect by only 8%. I get to a value of all those free cash flows of nearly $190 billion. I'm going to add the cash on the balance sheet, which is $11.6 billion, and take away debt, which is $8.9 billion. I get to an equity value of the company of $192.5 billion. The current market cap of the company is $113.7 billion. So there's a 69% discount if we look at the company based on free cash flows. So that's a really strong discount. The earnings per share. First, a lot of analysts cover Nike, and it is a stock that they believe is discounted. I'm going to use the forecasted earnings per share for the current year, which is $3.79. I'm going to give them a PE of 24 and a growth rate of 4%. It gives us a value per share of $94.60, and the current stock price is $75. The discount using the earnings per share method is 26%. So both methods provide a discount, and the free cash flow method provides a greater discount. Now, I put more weight in free cash flows because I believe that's the truest measure of the value of a company. I put 2/3 weight on free cash flow method, 1/3 on earnings per share. When I combine those two valuations, I get a 55% discount on Nike. It's a very attractive discount on this company. Let me add a few more fundamentals that I like to track. First, momentum. The momentum is not with Nike. Their stock is down 20% in the last month. Part of it is this past week. It was really a bad week. So momentum is against Nike. I think the stock may continue to drop. The business risk for the company is low. The return on invested capital looks really good, 19%. That's exceptional. The earnings yield is very good, 5%. The free cash flow yield is very good at 6.1%. Now, as I look at Nike, I like owning premium companies, and you get them at a discount when times are tough. And times have gotten tough for Nike. This past week, a drop of 20% is really substantial. I read through the earnings, and yes, the company did not grow much. They grew a tiny bit in this most recently closed year. They just closed their fiscal year that closed at the end of May. So having said that, it's a premium company. I love the company. I love the strong competitive moat. I love their balance sheet, and I love the discount. So I'm going to continue to buy Nike shares, and I'm going to buy in good quantities. I could see investing $50,000 to $100,000 in Nike because it is one of those companies where this may be the time when it's discounted, and we may not see it discounted again for another 5 years. So I want to take advantage of the current times and really load up on Nike. So that's my video on Nike. I hope you found it interesting, and I really appreciate you watching. I wanted to provide an update on my NVIDIA short position. As you might recall, if you watched any of my other videos, I started shorting NVIDIA 3 months ago and have provided a video updating where the stock's moving and the status of my short position at the end of each month. And we are at the end of August, so I wanted to provide a new update. This past week, the biggest story out there was the NVIDIA earnings. There was actually some watch parties that people got together and watched. I know why. I certainly got together with a group of people on Stonks, and it was really fun. It took a lot of energy, by the way. It seemed like the predictions and the analysis really hit a peak. Now, the company, I'd like to go through it, evaluate it, value the company, and then share with you what I plan to do with my short position, plan to do with this stock. And as always, this is not financial advice. I don't recommend you short NVIDIA. I don't recommend you buy, hold, or sell NVIDIA. Now, the company is still a very large cap company. It's $2.93 trillion of value. That's a lot of value. Looking at their revenue, they're a $96 billion revenue company. Now, I happen to believe that semiconductor is cyclical. I think a lot of people would agree. Some people would argue that NVIDIA is not going to be that way, that they're going to keep growing because they're going to build out the AI universe. And that might be the case, but it would be a rarity. And I think it's beginning to show up that their growth is really going to plateau and I believe decline. And I'm going to show that a little later. They are very profitable. This is a very a likable company, very valuable company because they are growing, they're profitable, and they generate free cash. That is most definitely the case. Their P is a little high this year at 55. Next year, it's supposed to come down to 35, which is still quite high. But since they're growing, I think they deserve it. There's strong buy by analysts, but it's a little bit of a group think that's going on out there. It just seems like, especially 6 months ago, 3 months ago, the whole kind of media universe was so in love with this stock. But the stories are changing. What I've heard over the last few business days is, media personalities like Jim Cramer really pump the brakes on NVIDIA. He's already saying that the stock's overpriced, which is really incredible because he was one of the biggest cheerleaders of NVIDIA. But if you go through other media personalities, I think the NVIDIA is incredible and we think it's going to be worth 3 or 5 times more story has really faded. We'll see how the media treats this company over the next few weeks. I happen to think that as we go through the next 2 to 3 weeks, how the stock behaves is going to determine the next year. Because if some large investors leave the stock, it's really going to open up the floodgates. If a few large investors enter the stock, I think the stock could really rally. So the next couple of weeks would be really interesting. We'll see how it goes. When we look at them financially, they're just an excellent company at the moment. They have really grown their revenue. Their growth has just been incredible. But it's not about where you're growing now, or I should say for the past 12 months. It's what are you going to do over the next 12 months? So I'm going to address that. I have got a forecast of the revenue that I'm going to show a little later. And their balance sheet's excellent. They have more cash than debt, a lot more cash than debt. They're going to buy back shares, which is a positive thing. Now on the buyback, it's always positive for companies to buy back shares, but they tend to do it when it's getting later in their product cycle, their innovation cycles. And here's my point is if you had another great idea coming, you would keep that cash because you're going to need it to build that idea. But once your current idea is pretty much kind of playing out, you start returning that capital back to investors in the form of buybacks. A great example is Apple. Apple hasn't created a new product in a long time. I think the Apple stock is undesirable to me for that reason. That what's next? You're going to keep making the iPhone a little prettier, change the colors, have new commercials, and that's it. It seems that that's the case with that company. And a signal is that they buy back shares to prop up their stock price. NVIDIA buying back shares, I think, is actually a sign for me that no, that's not what you should be doing if you're an incredibly high growth company. You should keep that cash and keep the growth going. So that was interesting to me. Cash flow is excellent. As we look at cash flow, the margins on their product are really high, and I put that into my evaluation. Analysts have been in love with NVIDIA. 38 analysts cover it. Who doesn't cover NVIDIA? And they say that the stock is discounted by 21%. The market disagrees, and the market has marked down the stock recently. But there was, over the last, I would say, 2 to 3 weeks, there was an upward run that has since faded. It faded a little bit this week, actually a lot this week. But for a couple of weeks, I saw the stock really rally. The current year, it's expected that they have earnings per share of $2.79. It really grew from last year. And if you look at previous years, this is what I talk about in the cyclical nature of this industry is not too long ago, they weren't making a whole lot of money, and they may return to negative growth, which is the case in 2019. It's a cyclical industry. It wouldn't be a surprise that a lot of these hyperscalers bought too many GPUs and they say, hey, we're not going to buy for a while. And you see a negative growth year, maybe in 25 or in 26, and it really changes its valuation. I'm expecting that. I can't tell you if it's going to be 25, 26, or 27. One of those years is going to have negative growth, maybe 2 consecutive years since there were so many GPUs bought from NVIDIA. We'll see, but I'm going to take this into account into my valuation. At the current stock price, I believe that NVIDIA is still priced 37% too high. It's being priced at a premium of 37%. And I get to that conclusion by setting up a cash forecast that I expect from NVIDIA and then getting a net present value of those cash flows to today's value. I also look at earnings per share, do my own calculation there. I primarily use free cash flows as the valuation method, but earnings per share is a strong influence. Now, when we look at cash flows, I wanted to point out that I'm starting with their first half of 2024, and I'm multiplying that times 2, and then I'm growing it by 25%. I still think that they're going to have growth in free cash flows in the next 6 to 12 months. And I'm setting up a favorable forecast. I want this to be as positive, favorable for NVIDIA because I'm shorting. I don't want to start with the expectation that it's super overpriced and my numbers give me a number that proves that. No, I actually want to try to prove the other, which is, hey, could this stock really be worth what it's worth and maybe worth even more? So I'm growing year 1, year 2 aggressively by 25%, which is a very high free cash flow growth rate. But I'm expecting the company's going to plateau their revenue and actually have competition with alternatives, especially as the hyperscalers have bought many of the GPUs they need. And at that point, they don't have to buy anymore. So maybe they're buying for other use cases that could use AMD technology. It could use competitive technologies, even from the likes of Intel. So I'm expecting competition to enter the picture, sales to plateau, and I actually expect for cash flows to come down in years 3 and 4 by 15%. Again, they're going to reach a very high watermark of free cash flows in year 2 in my forecast. All these cash flows look great. The amount and terminal value is going to be pretty high. I'm going to grow terminal value by 4%, which is a high growth rate because, again, I believe that semiconductors are cyclical, but I'm still going to be as optimistic as I can be in this forecast. I'm going to discount by 8%, which is very reasonable, quality balance sheet. And the current net present value of all those cash flows is $1.387 trillion. I'm going to add the cash on the balance sheet, take away debt. I only get to $1.4 trillion of value, but the market cap is $2.9 trillion. So based on cash flows, this stock is priced at a premium of 52%. Earnings per share get us to a 7% premium on the stock. If I base it on a PE of 36 and a growth rate of 10%. Again, those are optimistic numbers. I could easily say the PE should be 25 or 24 because I'm going to show you that their growth rate is actually going to decelerate and it's going to plateau, and eventually you'll see some negative growth. In the next 2 to 3 years, I expect negative growth. When that happens, holy smokes, look out. The stock's going to drop. So having a combination of the two, I put more weight in free cash flow. I think that free cash flow always yields the true value of a company, and earnings per share is a strong influencer at 1/3 of the weight. I get to a 30% premium on the stock. How did I get to that cash forecast that I just showed you? And what is my expectation for NVIDIA's revenue going forward? Those are really the pieces of information, or I guess the projections that are really going to dictate where the stock price is going to go. What I've taken is the historical information data that NVIDIA has provided. The most recent quarter is Q2 of their fiscal year 2025. They have a fiscal year, I believe, that ends January 31st. So this is the quarter that just ended is in their fiscal 2025. And they reported that they had $30 billion of top line revenue, which was, if you compare that same quarter to the same quarter the year prior, 122% growth, phenomenal. But it's a sequential growth from the previous quarter was only 15. When you compare those numbers to where they were at previously, when they really just caught fire a year ago, the numbers were quite drastically different. The sequential was 88%, 100% moving to 200%. And you see how sequential growth is really coming down. Now, the company guided, this is a number from NVIDIA, 32.5 billion is going to be their Q3 revenue number. So when we put that number into this little spreadsheet, we see that year-over-year growth is going to drop down to 79% from 122%. And that drop may be psychologically difficult for a lot of investors. Whoa, what happened to growth? How come it's dropping so quickly? Sequential growth is only 8%. Again, this is NVIDIA's number. So as investors get their heads around, they're sequentially growing only 8%. I expect that Q4 of their current fiscal year is going to be in the neighborhood of 34 billion. And that's probably a little optimistic. Again, their year-over-year growth would drop to 54, sequential growth 5%. Q1 of 25, which would start on February 1st of 25, I think their revenue is going to be around 35 billion. And again, the growth rate keeps dropping, sequential growth 5%. And I believe that in the middle of 25, they're going to plateau. They're going to stop growing. Sequentially, they'll still be able to show a growth rate in that quarter compared to the prior year. But I think by this point, investors will see that, hey, this is just going to be a normal, high, large technology, moderate growth stock. And a lot of I would say the fantasy valuations will leave the room. It'll now be based on, okay, cash flows are probably not going to grow anymore. And maybe the cyclical nature of this industry will begin to show up. So that's what I'm looking at from an information perspective. This section of the spreadsheet is completely my expectation, but this section of the spreadsheet is provided by NVIDIA. So these are numbers that are real. These are the numbers that I've estimated based on my best prediction. And this is a realistic prediction. I think it's very realistic to see them plateau. And I think it's realistic to see that they're going to have negative growth in 12 to 24 months. And psychologically, that's going to be really tough on investors. We'll see how the stock behaves at that point. The desirability of the NVIDIA business is really high, and that's never been in question. NVIDIA most definitely is a company that has very strong barriers of entry. They have the best accelerated computing technology in the marketplace, and they're in high demand. That's most definitely the case. I've been a semiconductor investor for a long time. I think it's a very desirable industry. Semiconductor companies have their technology patented, and then it prevents other competitors from duplicating what they do. And that's the case for NVIDIA. They're definitely a very desirable company. It's never been about that. The company is not the stock price, and the stock price is not the company. Those are two different things. And the company most definitely is a great company. If you value a company above $1 trillion, it's a great company. There's no ifs and buts about that. My only point that I made with my shorting is the stock price is unrealistic. It's just completely unrealistic, which is why I shorted. And I also shorted the stock so that I could put capital at risk and really put myself in a position to learn something. If I lose money, I paid a price for that lesson. If I make money, I gained and I got a lesson out of it, which is, I'm seeing the analysis, I'm seeing my best estimate, and I'm going to trust it. And I'm probably going to be able to calibrate and sharpen my skills as an investor as a result. So let me go over where I'm at with my short position. I started the short position at the very end of May, and it's roughly around this point that you're seeing on the graph. And this is the stock price. It's currently trading at $119 per share. My average cost base is $115 per share. So the current the stock price since I shorted the stock has really moved. When I first shorted, I thought, whoa, I really nailed it. It went down a little bit, but then it rallied up. So I was like, oh boy, here we go. I've got that 30% maximum, right? So if it goes up more than 30%, I'm going to get out of the position. It's just something that it was a wrong thesis that I had. Get out of it. Tip my hat to the stock market. Thank you for the lesson. And I'll make another video and share that with you and say, hey, this is how I was wrong. This is how much money I lost. But at a certain point, it really went to the downside. And I think the next couple of weeks are going to tell us what is it going to do. The last earnings call was a little ahead of this number or this point where I shorted the stock. So they actually announced their earnings like a week prior to that. And I think over the next 2 to 3 weeks, we'll see where the stock goes, if it goes up or if it goes down. Right now, I'm sitting at a 3% loss on my short position. I actually chickened out going into their earnings. I was hearing a lot of, I think, optimistic, bullish comments. And I took a few shares and I closed them out. And I took about $1,200 of capital off the table, and actually about $2,000 of capital off the table, and lowered the amount of capital at risk. So it's kind of funny, but hey, I'm still got a short position out there. Maybe I'll add some shares going forward. I don't know. I'm not ready to make a decision just yet. But I think the story on NVIDIA is still the same to me. It's a stock that is incredibly exciting. But if you study the fundamentals, it's overpriced. The stock price is overpriced. The company is great, exciting. Stock price is a different thing. It's overpriced. The last time that we saw this scenario was with Cisco. Cisco most definitely had the best technology in the time when we were building out the internet. And the market just got carried away. It was just so in love with Cisco. And the stock price, it became the most valuable company in the stock market. And it rose from not really being anywhere near the top of the stack not too long before. Does that sound like a familiar story we've heard recently of NVIDIA adding pretty much at this point 2.6 trillion dollars of market cap? Now, Cisco continued to grow, continued to operate really successfully for years. For years, it kept growing. But the stock price collapsed. Stock price is separate from the company. The company continued to operate. It was a very good company. Their technology was the best. It was clearly different than the rest of the marketplace. The world had to build out the internet. So revenues kept growing, but the valuation had gotten too high and the stock price collapsed below its value. But investors, once bitten, twice shy, they didn't want to touch the stock because it had caused so many losses that I'm sure these big hedge fund managers just didn't want to touch it because they had to explain to their investors how much money they had lost on Cisco. So for a long time, Cisco just was undesirable, untouchable from many investors, and it just didn't go anywhere. Eventually, it did rise, but it's never gotten to the stock price that it originally attained. What's NVIDIA going to do? I don't know. For all I know, it's going to keep going up. That would be incredible, but the stock's already been incredible. So they're in the incredible zone. But if they do fall off a cliff, it will become a falling knife because especially the big investors, once they start leaving, they are not going to return. And big investors pour big capital into these stocks. You don't get to $3 trillion of valuation with just retail investors. That's just not the case. You get there with big institutional investors putting big bets on these stocks. They certainly have been doing that with NVIDIA. As soon as those start leaving, I think a large number of them will leave and the stock price will really have a hard time staying at $119 per share. These are all things that we'll have to let time tell us which is going to happen. Is it going to go down or is it going to go up? I'm going to keep my position open on NVIDIA. I think the story that I was seeing 3 months ago, I just feel more comfortable, confident. that's the story that I was seeing, and that's the story that I see today. And I think there's more evidence that this stock price is going to have to get corrected at some point. I think more and more experts in the media space are beginning to cite that, hey, this stock price has gotten carried away. And we'll see how the next 2-3 weeks play out. This is my update on my NVIDIA short position. I hope you found it interesting, and I'll record another one in a month's time. We'll see what happens in the next month. For all I know, it'll go up 30% and I'll sell, or it'll go down substantially. And maybe I'll sell because I just want to take the gain and move forward. My last 2 shorts have gone really well. I made 52% on Super Microcomputer, and that stock's really, really hurting. It's a falling knife. And I saw similarities there as NVIDIA, but it's different. They're a different industry. They're not as profitable as NVIDIA. They don't control IP like NVIDIA. And the other one was CrowdStrike, which I thought was priced for perfection. If they would have one error, the stock price would go down. And boy, did they commit one error. They created the biggest computer outage in the history of computing. So they got the championship belt for making the biggest blunder in the security space by providing a very poor update. And that ended up being a 42% gain over the course of 10 days, which was great. We'll see where I end up with NVIDIA. I may end up with a loss. I may end up with a gain. But it's certainly been a really interesting play on NVIDIA. For the most part, I'm a long-term investor. I like buying great companies and holding them for a long time. I like to see those investments double in value every 5 years or less. No problem with a stock doubling in 6 months. But I'm a long-term investor. But I analyze companies, and I'm putting the analysis that I had on NVIDIA, and I've tracked NVIDIA for a long time. I was an investor in NVIDIA years ago. So I'm putting that analysis to work, and I'm putting capital at risk just to make sure that, I guess I know that my analysis is going to either produce a gain or a loss, and it's going to give me an opportunity to learn something. So that's a part of why I'm shorting this stock, and I've shorted other stocks. Shorting stocks is not the principal investing idea or discipline that I follow. It's really long-term investing. So I hope you enjoyed the video, and I really appreciate you watching. I'd appreciate comments on NVIDIA and see where you're at with the stock, what you think is going to happen. I'd really appreciate if you could provide a comment there. Good luck investing in 2024. Okay, so the market went down substantially last week. The S&P was down like 1.7 or so on Friday, and it was down like 4%. And I don't expect it to stay on this particular, pitch. I think it's going to have some kind of rally in the coming weeks. Now, I'm not focused on next week. I'm more interested in, what's this market going to do over the next quarter and into 2025? And I think the whole story around recession is real. I think there is enough there to expect a recession, but I don't think it's going to be all that bad. It's not led by some big giant problem like the subprime mortgage meltdown or anything like that. But I think there is going to be a slowdown. And I would point in large part to the issues of, it's not an issue, it's just reality that in 2021 and 2022, the government in the US really stimulated the economy. And you see the market just really go up because companies were literally not having to pay their employees because there was certain stimulus that companies were receiving as long as they keep their employees employed full time. They had no payback grants, given to them. You have individuals that received checks, stimulus checks, and they went out and spent, on new things, new discretionary things. So now that all that money is gone, because it was kind of stimulation time was 21, 22, the economy had to kind of fend for itself, and it hasn't been as good since then. Now, as we go into the now, which is 2024, you do have a little bit of, okay, we're having a hard time growing, especially as we compare over the last 2-3 years. And the consumer is beginning to be tapped out, and that's 70% of our economy. So I think that has something to do with it. And we'll see how things sort out. But I'm glad that I did put more cash, in my portfolio, and I'm actively buying into companies that I want to own. The good news about having bonds is that as they mature, I'm probably going to take those proceeds if the market keeps going down and putting it into equities. And then when equities rally a lot, I'll put more money back into bonds. So that's my general plan of what I'm going to be doing. How about you?
Oh, I guess I'm the only one here, right? So
Yeah.
yeah, so I definitely, even though I do have some experience in the markets, as an intelligent investor, like let's say someone who kind of has a grasp on what they're doing, I'm fairly new. So I am learning about bonds now, right? And I personally am trying to buy into treasuries and bonds now, but that's because for treasuries are always safe, right? So my philosophy with that is that's always safe, but now is the kind of the last minute to get the good rates on the T-bills, right? T-bills and T-notes, because rate cuts are coming. Look, the yield curve says it all. It's not super steep, but it is uninverted. As I'll send it to you now. It
went from being inverted. Let's kind of see this together here. So
sure. Yeah, it's the one. Well, the one I look at is the 10-2 spread.
Yeah, that is what they compare. So this one, we'll compare it to the 10-year.
Also, with investing, it's always good to know your time horizon, right?
Yeah.
How far out you're looking.
So as we look at, is this going to show it to us? Yeah. So the 2 years represented in the dark green, and then the 10 years represented in the green, and it's been inverted, meaning it naturally should be above the 2 year because an investor is taking a higher risk. I'm going to commit to a loan to the government for 10 years versus just 2 years. So how is a 2 year promissory note, a bond, priced to pay me more money? So it was inverted. It started to get inverted back here, and now it's not inverted. So changing it to the 5-day is, let me try this graphing tool here. So you can see on the tail end of this is when it became not inverted. You see that? So the long and the short of it is that I'm glad I've got the next really 4 years completely bought in bonds in my bond ladder. I was buying into my 5th year. I think I'm up to 66,000 or so, and I want to have at least 80,000 out there. But now it's going to be about looking at that 10-year treasury or quality bonds from corporations, because that's going to have a higher yield. And, it's going to be money that I don't need. It's just out there collecting income. And I don't want all my money, all my liquid assets to be in stocks, because this past week is an example of why you don't want to go all in on one asset class. Not at my age. It becomes a very uncomfortable scenario if we get into like 2022, where we had a very good correction in the S&P and the NASDAQ. I think the NASDAQ has a more dramatic drop. So in 22, it dropped about 29%. That's a significant drop. So tech stocks and the like just really went down. So
could I ask, what was the story in 2022? Was it, inflation became an issue in 2022, but that's not it, right? There are others.
I think part of it is you had this go-go period, right? You had the market over 2 years went up 133%. Yeah. That's phenomenal, right? That was great. But it's like, okay, that isn't sustainable. So the market, stocks gave back a lot of those gains, and I thought it was necessary, because if you really look at the last, call it, after the subprime meltdown, the market's been doing great. Nobody should be complaining. We should all be like, great, I'm glad I own stocks. Look at this rate of return. You see the steepness of this? It just was getting too steep and needed to be corrected, and it corrected. And now it's back. It's doing it again. But what really has carried the market to very high highs is, in a way, the AI hype has made semiconductors very vulnerable to being corrected. If not, I guess, I don't know if the Broadcom investors could call last week a crash, but it certainly was really bad for Broadcom. If you look at their 5-day, it went down 15%. And let's look at year to date. From the top to where they're at now, it's down 25% over the course of 3 months. So things are really correcting in the semiconductor industry. And for good reason, I think it should, because you have stocks that have been run up too high. These stock prices are not sustainable. So that's happening. At the same time, like when Broadcom goes down, like Qualcomm didn't participate in the big run up. They began to a little bit, but when you look at here's Broadcom, here's Qualcomm, and look, Qualcomm's actually a better investment over the maximum. But let's look at the year. Actually, they kind of matched each other. Having to take back what I was just saying. I guess recently it didn't keep up with Broadcom. But I'm beginning to buy into Qualcomm because I like Qualcomm. I like their fundamentals. And whenever the market corrects like this, it kind of gives everybody a haircut, whether you need it or not. And I think Qualcomm's a pretty good buy. So that's where the opportunity starts, is if you know of good companies that you want and it's being discounted, hey, great, thank you. I'll buy, load up during a time where a stock like, in my case here, Amazon and Qualcomm are being discounted. Because if we look at the 6 month, you see that Qualcomm is down from 30% from its high. And I think it's discounted. So I'm going to start buying in dollar cost average in my investment. That's the kind of stuff that I want to do, because I know it's going to make me a lot of money over the next 3 years. It may feel awkward for the next 6 months. It may feel, as long as we're in this bear market or this correction, it won't feel warm and fuzzy, but it's the right thing to do. And it's proven itself over and over again at every correction that I've been a part of.
I have one question, if you don't mind. And it's just going back to the bond question for a second. Mm-hmm. Something I don't think I've ever heard you mention are junk bonds.
Yeah.
You mentioned quality corporate bonds.
Yep.
What is your opinion on junk bonds? I mean, first of all, we should cover what they are, right? Because not every corporate bond is automatically a junk bond, right? It depends on the rating. Is that right?
Yeah. And I don't know how quite to define.
It's like high yield, basically.
Yeah, I know what it does, but what is kind of like that threshold? At what point? So a junk bond is a corporate bond that has a low credit rating, considered high risk investment. Okay, so let's talk about what I would think is a junk bond, right? So I'm an investor in, I'm going to first define what I think a good corporate bond is. And this isn't opening. So I'm going to say Qualcomm, right? Qualcomm is a good company. I've analyzed it. I think they're a company that's going to do well. So if they issued out bonds and let's say they had a BBB rating, I'd be very comfortable. That's not a junk bond. Okay. If they had a term of 5 years, I'd be okay with that. Now, let's say you have a CCC rated company, which is a big rung lower. And this company has a significant amount of debt. Debt's like 5 times EBITDA. They've struggled over the last 5 years. That's a junk bond. Now, the yield on that, nobody wants to buy that debt. So the yield on it's 12, 14, 16%. But you're taking a really high risk. If I'm going to take that kind of risk, I'd rather buy a good stock in a quality company versus trying to get there through junk bonds. If you know of a company that is like just misunderstood and they're on the road to recovery and you really feel conviction around that, maybe you do buy those junk bonds if they are classified as junk. But that's how I don't have any junk bonds right now. I have one bond that you could say is riskier. It's with the oil company down in Mexico, Pemex. And my yield on it's 12% and it's locked in for the next 7 years. So that's awesome. To me, the oil complex in Mexico is, I think, a reasonable risk. The Mexican economy is doing well. There's a lot of things there that I'm comfortable with, but it is outside the US. So there is more risk, but I am making 12%, which is a very good return. So that's as close as I get to the classification of junk is an international bond with a Mexican entity. Pemex is a nationalized oil company. It's not like Chevron or Exxon. It's nationalized. So that's as far as I'm willing to go. I'm familiar with Mexico.
That bond is paid in US dollar, correct?
Yes.
Which is good.
It's issued, it's issued on Wall Street. It's US dollars. It's, all those things make me feel warm and fuzzy. Now, if you said, hey, I've got one in Thailand, I'd be like, yeah, I can't. Step one. The answer is no. Like, that's outside my wheelhouse. I don't have enough familiarity, knowledge, comfort level to make that investment. So
how about Switzerland?
I would be,
interest rates here are quite low.
I'd be comfortable with like Switzerland, Germany, United Kingdom, probably France. To some extent, Japan. Yeah, I'd be comfortable with Japan. Talked about Mexico. I have invested in Brazil in stocks, but not bonds. I don't know about bonds in Brazil. I think I'd be careful with that because I think bonds serve, and hi, Sia, thanks for joining. I think bonds serve my portfolio to be a low risk asset. Turning them into a higher risk asset, it kind of, that defeats the purpose. You want them there. So like weeks like last week, the value of all my bonds went up. Now it didn't go up substantially like my stocks dropped to the equivalent of the drop in stocks, but you see it work. You're like, okay, great. My bonds are worth almost across the board 1% more at the end of the week than when we started at the beginning of the week. And my yields hold steady. So that's why I have bonds. Bonds are meant to cover my living expenses for the next 5 years. I want to always have my next 5 years taken care of. That way, no matter what comes our way, I'll figure it out in 5 years.
And if I can just mention something that I think you brought up, I think when you were talking with the Yield Nerd, you were talking about credit ratings, which is a kind of a canonical, if you want to say, way of differentiating a junk bond versus a quote-unquote investment grade bond. And you mentioned that, yeah, you do look at the rating, but that's you don't just go on that. You make your own analysis.
Right. So ratings could be, so for example, like, I don't know what, let's look at Qualcomm again. And I think it'll help me prove my point. So BBB, okay?
Yeah.
I'm very comfortable with Qualcomm. Now, AAA rating would be like Apple or Johnson & Johnson. And let's kind of look at that for a second. Johnson & Johnson had legal issues that were huge. The whole baby powder class action lawsuits, that is huge. So I'm actually more comfortable in Qualcomm versus Johnson & Johnson. So those ratings are a little cloudy to me, a little gray. Like, well, what does triple B mean? What does triple A mean? So I'd rather look at the company, get familiar with it, and some of them I already have familiarity with, and make my own decision based on what's their balance sheet look like from a debt perspective, and then I'll make my decision. So I know that, like, the yield nerd, he was purely, it's almost like he was a technical trader on the bond side. He only looks at technicals. He was like trying to make short-term gains, and the gains were really small. I was thinking to myself, if you're going to put that much effort, why wouldn't you want like a 30% return versus he's just trying to get a 0.25% better return on bond yields? And it's like, you're like fighting to get a 0.25% better yield. That's not enough for me to fight. I want, like, I'm going to fight to get a 20% greater return on a stock. That's what I'm fighting for.
Yeah, it's a question of risk, I guess. But,
Yeah, it's comfort level. You know, one of the, I'll try to bring it up, but one of the realities is that when you're in equities over a 10-year horizon, you're going to make more money. You're going to have a greater yield than bonds. That's a reality. It's just the path is going to be smoother with bonds. You're going to get from now to 10 years and just have subtle moves up and down, and you're going to have a consistent yield. Okay. Bingo. That's what you get with bonds. Now, with stocks, you may have weeks like last week or years like 2022, but at the end of 10 years, you're going to outperform bonds. That's proven. That's data driven. There was one exception in the 80s, but that was just completely different. And is it going to repeat itself? I don't think so. Not at least in the next 10 years.
okay. One quick note, and I don't know if you've seen this, but just for personal experience, I have seen companies that have multiple credit ratings. You know what I mean? So
No, I've never seen that. Tell me
I
more.
think it's more common with banks, like UBS. So I live in Switzerland, right? So I was looking at UBS, and so they're a global bank, so they have different branches, right? They have a branch in the US, they have a branch here, and I think that the different, like the bonds from the different branches could have different ratings. So like, for example, the London branch might have a different one than the one in Switzerland. But then also there's different categories. They have their own kind of junk bonds.
Interesting.
They have their own almost like portfolio that you can choose from. So I don't know if you've come across this, but I think certainly in the financial sector you come across it more. So it can be more complicated, just so people know.
Yeah, that's very interesting.
So
I
like if
didn't
you
know that.
pick a rating, don't assume that that's the rating for the whole company. They may have other bonds with different rating.
Super interesting. All right. Very good. So let me get back to the. So let's see. Let me look at the chat. Hi, Sia. Very nice for you to join. Thanks for joining. If you have any questions, feel free to put them in the chat or ask away. So going into next week, I've got my process remains intact. I continue to, if the market discounts, you know, the companies I want to own, I'm going to buy. I think I have enough cash to, you know, keep buying until the end of the year. If it really melts down, then I'll have to figure out where to get the next, you know, load of cash to continue to buy equities if it gets to the end of the year and we're still in this downturn. But I don't know what's going to happen, but I'm optimistic that it's not going to be as bad as, you know, what we had in 22 and not as bad as like the 2007, 2008, 2009 market. That was a really bad market. All right. So any other topics or so we talked about bonds. The bond rates have now uninverted, which is good. We're back to normal. But every time this happens, there's a recession. Every single time, by the way, without exception. So that's why it's like, oh, okay, the data may be difficult to interpret, but it usually does not lie. It tells you what's going on, and we'll see what happens. How are you, like, mentally? You know, you good? Or is it like, you know what? I'm going to get through this, and yeah, it's not fun to see losses on my portfolio, or is it like, and I hate seeing this, I'm just going to put it away and not look at it for 6 months?
I think it's like, you can kind of think of it like, once you've learned how to take a punch, you've learned how to take it. I learned how to take it a month ago, let's say.
Good.
That numbed me up personally pretty good. Now, it doesn't mean I'm going to completely check out. If I was going to do that, then I would just put it all in the S&P, right? If I was going to do that, I would do some bond. I would, the 90-10 Buffett portfolio, which is 90% S&P, 10% short-term bonds. If I was going to check out, I would do that. But I'm not going to completely check out. I'm going to keep an eye on it. And if it keeps dropping, then maybe I will start moving more into bonds.
Got it.
But otherwise, I'm just going to let it ride personally.
Good. Very good.
I don't know. What about you? Do you move to more defensive industries?
No. Here's my opinion on that is when we look at, sectors so there's 11 sectors, and consumer staples is a defensive stock, a defensive sector, right? So these are companies that we need no matter what. You're going to buy food, you're going to buy the necessities for home and so forth. But when you look at the long-term return, and let me see if I can add the long-term return here. So when you look at the long-term return of consumer staples, it underperforms most every other sector. It's down here. Energy is down here. Real estate's down here, and utilities are the worst. The best being technology, but that may give up some of its gains. So temporarily, it's going to be potentially a hard it's going to be hard for some industries within that sector. Consumer discretionary, healthcare. Healthcare can be a defensive stock, and meanwhile, it gives you a greater return than staples. So I don't move from, hey, over the next 5 years, I'm going to give up on this type of return, and so that way I can just protect my portfolio. I'd rather just move to cash, which I did, 3-4 months ago, leading up to some of these corrections. I sold some of my stocks, some of like completely out of Ford, completely out of a couple of different names, and it created more cash, which is good. I'd rather do that than move to a stock where it's like temporarily I'm going to earn 5%, maybe 7%. At that rate, I'd rather just park it in a good short-term bond, make 4 or 5%. It's defined, it's set it and forget it, and I'm good to go. And then wait for the market to, give me good prices on stocks, buy those stocks, and then it's going to rise at some point. So that's how I view it, and that's what I'm going to do.
Yeah, makes sense. I mean, you could even look into municipal bonds depending on your situation. Yield Nerd has videos on that, and I had a bond fund actually, and I'm considering buying into it again. I think I told you it's I only just mentioned it's MQY because it's look at your personal situation, right? But generally speaking, I think it is it can reduce your taxes, and the yield is like between 5 and 6%. So again, but this is actually something that I wanted to mention. My personal philosophy: if you are going to invest in higher yield bonds, that is one thing where I would maybe suggest thinking of an ETF of some kind of fund, just because the risk is higher of default. Right?
Yeah.
So, just a thought.
Yeah, I think, we all get to pick the lane of investing we're going to do, the type of investing, and then, how far we want to go with investments. And I go back to, if I have to put that much effort to go from 4% yield to 5% yield, I'd rather not. I make a lot more money long-term on real estate and stocks. That's where I should be putting my time and energy. That's where I make, the difference between a 10% rate of return and 20% rate of return is doing your homework, finding the right companies, picking the right stocks. And 10%, yield differential is far better than going from 4 to 5. So that's my preference. That's what I think to do.
Can I ask you one other thing? This is leading to a lot of interesting questions, I think. We talked about annuities a little bit. And this is related, right? Now, I didn't know what an annuity was until I had to deal with my dad's estate, and he had one. And I realized what it is in the US, I just wasn't thinking about it. And then here, where I'm getting a little bit older, and do think about it, it's just not a thing. Like, even though there's plenty of insurance here, I mean, Swiss people love their insurance, annuity is not a thing. But you know why? It's because typically people here have pension funds. And if you have a pension, you don't really need an annuity, I think, right? Maybe you could correct me on that. But it seems that if you live in a society where people tend to have pension funds, you don't need an annuity. But anyway, the reason I bring that up is my personal situation. I actually can buy in because I came here in my 30s. They will allow me to buy in more into my work pension fund. And that's basically a guaranteed fund. And it's in the Swiss franc, which is a pretty strong currency. I mean, literally, what is it now? It's like 18% above the dollar, I think. So that may not stay that way, but it never really goes much below. So anyway, I threw out a couple things for you, but I guess if I did a question coming out of that, it was, if you see where I'm coming from, that pension is kind of a similar idea to an annuity. Is that correct?
Yeah. Annuities, I think to the average person, annuities can bring value because, the fact that a person's saving their money for a rainy day or for their retirement or for their future, that's a very positive action. So I think it's great that people do that, whether they're putting it in a CD, and an annuity, a bond, or a stock. If you're saving, if you're putting away a part of your income, you're way ahead of the pack. Now, for me, like my mom is 88 years old, and she goes to the bank, and they're always trying to pitch her on it. Well, not always, but they've pitched her on an annuity. And then I read through the details, right? And there's just a lot of fees involved, and it's a black box. It's like, and it's also locks in the money. And so my mom on the surface, she's like, well, they're guaranteed this rate of return, and it seems like a good idea. And then we dissect it, and I explain it to her, and we always end up with her funds are in CDs and very low risk investments. And because she doesn't give up her flexibility and liquidity. If you go into an annuity, you kind of do. And you can't, if something comes up, you can't go to your annuity and say, hey, I'm going to need $25,000. Maybe there is an annuity of that type, but life happens. The air conditioner in my home, it's very hot in Southern California. We're above 100 degrees Fahrenheit. And on Wednesday, the air conditioner, it's a 20-year-old unit. It just blew up. It was not salvageable. So on Thursday, it was completely replaced. It was an $8,000 issue. Things happen in life, right? So if you're in an annuity and you need $8,000, where are you going to get it, right? If you have it in your savings account, wonderful. But if you had it in a bond, you can redeem or sell the bond. If you sell it through your brokerage. So anyway, so things like that. For some people, I think annuities are probably a good recipe because they just want defined benefits, and they don't want to touch a mathematical equation to figure out what's better. It's just not for me because it's too much of a black box, but for some other people it's probably a beneficial.
Yeah, it sounds like a pension might be better than annuity because you actually, at least here, you can take a loan or you can actually really withdraw in certain situations. Like I think if you're going to buy a home, you can actually withdraw some money from your pension towards the down payment here.
It's interesting here in the US, right? We have Social Security benefits. So when we reach a certain age, and if you paid into the system, you get to draw out what really is a pension, right? It's Social Security payments based on how much you contributed. There's a maximum. If you're a high income person, you get maxed out. You put more into the system than, I guess, from a ratio perspective, than you're going to get back. That's just the way it is. And so that's a part of my plan. I have this spreadsheet that, is many rows and many columns, and I project out, how much money I will have and how much money I can leave to my kids. And I put the Social Security benefit in there, and I put it in at the age when I expect I'm going to start drawing those benefits, when my wife's going to do that, and put it into our overall cash flow for the next 40-year spreadsheet.
Yeah, now this is getting into another very interesting topic, which is very deep: retirement planning, right? And actually, I'm going to send you a website. Just check it out. Have you heard of FICALC? FICALC?
No.
It's something I got from another channel. I remember there's this like more passive investing, retirement focused channel. So check it out. It's like a calculator that helps you check failure rates. So depending on the amount of money you have and it's kind of like a stress test.
Yeah.
For retirement. And it's about, the 4% rule and stuff like that.
Right.
Anyway,
Right.
I just put it in the chat.
Yeah. Thank you. And let's talk about retirement and kind of the things that, and I can't share my model because it just has too much private information in it. See, I'm looking at the website that you sent. So I've probably looked at 2 retirement softwares models, and my complaint about them is that they're not tailored to the individual. They use kind of some general, buckets, and that's good for the average person. Now, I personalized my model, like very precisely around my wife and I, and that's what you miss if you use a software versus you create your own. Creating your own is more difficult. You gotta have the knowledge and know what to do. But the way that I've created it, I know every number, and I could clearly see how much money we're going to have. The percentages of growth, I mean, those are all formulas. Those are all calculations. You can put them into a spreadsheet. The models that, come in a software package, they're very useful. They're good to put your information in there and have a very good understanding of where you're at. And it'll probably get you there within 80 to 90% accuracy. For me, I just thought, I'll build my own, because I looked at 2 very closely. And I actually used to have I had extensive conversations with a YouTuber out there who's very good, and he does retirement planning. And we went over his model. I showed him mine, and he said, yeah, you're good to go. And what I understood is, their intent is to manage your money, and they want to charge you, in that case, it was 1% of managing your money. That's a big expense.
1% is a lot.
Yeah.
Even think about that, right? Like, I have an ETF, which is 0.25%. And I know that's not that bad, but even that's, I'm kind of like, for me, that's kind of the limit.
Yeah. So I think a good retirement planner, there's been some coaches that I've had, like for fitness. There was one coach who's excellent, right? And it was really affordable, and he was really good. And I've had other, kind of areas of improvement where I've had coaches, and they're excellent. Very, how should I say this? They provided enough, but it wasn't like, hey, I want to talk to you every day, and FYI, I'm going to charge you this amount every week and every month. Now, there should be like a financial planning category of, a financial coach. And it's really just to bounce ideas and approaches. And then that person identifies blind spots or identifies potential areas that you should look into further, and maybe agrees with a few things you have, right? But they don't like find a problem, then try to solve the problem for you. They're more like, hey, I get what you're trying to do, but you may want to consider, just as an example, more fixed income. And these are the reasons for it. And at your age, you really got to start getting good at that, because it's just going to become more and more important over time. I could see that being a pretty good little blind spot for somebody. And then they're off to do their learning around fixed income, and they become a better fixed income investor. So I think I don't know if the market has that. I mean, the actual financial advisor doesn't make as much money, so maybe they don't like it. They're like, no, don't offer that, because we just cut our fees, by 80%. But I think we're in an age where there's so much good information. There's so much to work with. If you hire a money manager, a financial planner, I believe they get in my way. They prevent me from really getting high returns. They prevent me from really getting into great investments, because it's just one more, it's so much like bureaucracy. It's one more person that has to be involved in a decision. And they're accustomed to dealing with people that are like, oh yeah, what 5 ETF should I be in? Okay, perfect. All right, great. That was a 10-minute meeting. We're done. All right, see you later. That's not me. I'm very active, very informed, and there's very little value add that a financial planner can provide. But I would really like a coach, and I've actually sought out other investing, kind of YouTubers, and said, hey, I would really like you to look at my portfolio and say, hey, I get it. I would say that this piece doesn't make sense to me, and I think this piece has too much risk, or this. And then I may not do anything with the information. I may research it and say, well, that's what I want to do. Or I might say, they have a good point. That's a blind spot that I should get stronger in.
Yeah, you mean someone who to just review the plan that you already have. Right?
Yeah, and do a checkpoint once every 6 months kind of approach, and just talk about, what's new and what's the topic? What do you want to accomplish over the next 6 months? Oh, okay. Well, we're in a down market, this, that, and the other. So I think there is room now for that type of coaching, because again, investing is so fun and exciting now, where we have information at our fingertips. At some point, I would think that the stock market is going to become a 24/7 exchange, like crypto. I don't understand why we have to follow business hours. Everything runs on computers. It's nice that they give the computers time off so they can go on vacation and spend time with their family. I don't get why they don't have 24.
They do
What's
need
that?
maintenance, to be fair, as you know, right?
Yeah, but I know technology well enough that there's a lot of industries that are 24/7 operations, and you can do maintenance by having distributed workloads. You just put it simply as you have 5 servers handling a workload. You take one server down, you update it, and then you put it back into service, and then one at a time. You never take all 5 down at the same time.
I'm right there with you. Cloud computing, all that. Exactly. That's exactly the point.
I just scratch my head and I go, we have Wall Street hours that we had 100 years ago. It's like, why? If anything, give us 12-hour trading. Why is it on the West Coast trading stops at 1? It's always been I don't get it. Why is it, and then you have what I think is greater volatility, because like on an open, stocks will run up. Why? Because we haven't been trading from 4 p.m. Eastern until 6:30 Eastern. So what is that? 14 and a half hours. So there's all that pent up trading volume for 14 and a half hours. Well, that creates more volatility. And if you like volatility, keep doing what you're doing. But if you had a 24/7 market, as soon as the news hits, let's say in the middle of the night, Chevron, which is one of my stocks, has a big oil spill, then that stock's going to be hit right in the middle of the night. And traders could get on that move, sell their stock or buy their stock, whatever they need, 24/7. I think that's in the future because it makes too much sense. I mean, we're already in the cusp of artificial intelligence. Why are we still dealing with a stock exchange that's on the old paradigm of business hours, when people used to go into work, and people still do, but they have a trading floor where they used to deal with paper and these very old school trading boards where they would, put up physical numbers to represent the stock. So it's just an exchange. I think they could really modernize, if anything, just the paradigm of, hey, we can do 24/7 now. The computers can handle it.
Yeah, to your point, I think NYSE is actually doing a study now to see what would be needed and to see the ramifications for 24/7 trading, or at least certainly to extend the hours.
I think, thinking of that retail investor, right? If you live in California in the US and you work all day, let's say you're a nurse and your shift is from 6 a.m. to 6 p.m. Tuesday through Thursday. And so for those 3 days, you really can't trade. You'd have to do all put in your orders in advance, and it gets harder for the investor. Now you have to say, okay, I'll specify a price and this, that, and the other. And, 24/7, that nurse can get home at 7 p.m., have dinner, get their bearings straight and look at the market. Okay, it's 8:30, watching Netflix. I wanted to buy some more Amazon. I'm going to go ahead and put an order right now, and it's going to process and transact right now at 8:30 p.m. versus, the market closed 7.5 hours ago. I'm going to have to put in my buy order. It's not going to be executed till the next day, next trading day. If it's a Friday, it's even worse. All that stuff is like, why are we still dealing with that? We should go to a 24/7 market.
Yeah.
Anyway, so
All right. Just wanted to mention something, because you were talking about the idea of a financial advisor. There are advisors and planners who will just coach you and review the plan that you have. Actually, the other channel I watched, he had a list somewhere, because this question has come up on his live streams, but I can't find it at the moment. But yeah, there are people that will do that for you. They will give you advice. Also, there are people that go on a flat fee. It doesn't always have to be a percentage. And now if it's a huge flat fee, okay, but there are people that will just do 100 or 200 a year, something like that. So if I find a list, I'll send it to you, because
thank you.
It's useful.
Great. And if any financial planners listen to this video and you provide that service, send me a message. We'll highlight you. Maybe we'll bring you on one of the podcasts and you can answer questions for everybody.
Fun fact, CFP is actually a global certification. Now, someone in my family is a CFP in the US, but I looked into it here. There's actually training here in Europe to be a CFP, same certification, just in your local language. So
very good. All right, so let's kind of land the plane on this call. I wanted to have the call just because it was such a down week, but you know, it comes with the territory. Equities, this is part of it. I thought it was a good opportunity week. We'll see what happens next week. But I really appreciate both of you tuning in and doing the podcast with me. I wish you a very pleasant Sunday and a very nice week coming up. Thank you.
Same to you.
we're on a nice rising market with the stock market in a rally where shares have gone up in general. The S&P has gone up for about 7 days, and it's really climbed quickly. We had a pretty good pullback about a month ago, and we've almost come back to the highs on the S&P. It's been pretty incredible. Every market will provide opportunity. We just have to know, which way the market's going and what we can do as investors to really monetize that opportunity. I'm going to talk about selling put options and how I'm using them to get extra income in my portfolio on stocks that I would love to own, and I'd love to own more shares of. The 3 stocks I'm going to talk about are Amazon, Allstate, and Live Nation. These 3 stocks are really good companies. I've made videos on all 3 and believe that they're all discounted. I'd love to own more shares of these stocks, and they have been going up in price. Now, selling a put option gives me the opportunity to buy shares at a lower price if they were to go down in price. I sell put options roughly a month into the future. I feel comfortable with that term. I try to stay away from some of the pitfalls like not having a dividend event or an earnings call, because you never know what's going to happen with earnings. For example, today I had one stock go up 18%. I'd hate to be in a put option when a stock either goes up or goes down that much. Having said that, let me go through 3 examples and show you how I'm generating $495 more income in 1 month by selling put option contracts to buy shares at a discounted price compared to what they're selling today. Let's start with Amazon. I don't think I need to convince anybody that Amazon is a great company, and I would love to own more shares of Amazon. I've been buying into the company ever since they had a pretty good dip after their earnings. Not sure why the market sold them off so much, but the stock is really rising. I've bought into the stock as fast as I could during that low point. But what I also did is I sold a put option to buy 100 shares of Amazon on September 13th if the stock goes down to $160 or less. Right now it's $178.22. Now, whoever bought that contract paid me $178. So I get that cash. If the stock stays above $160 per share, I get to keep that $178. And if it falls below $160, I get to buy Amazon shares. I win either way. Heads, I win. Tails, I win. Thank you very much, stock market. So I was glad to sell that put option on Amazon and see if it's going to go ahead and trigger and get to the strike price and enable me to buy more shares of Amazon, or if I'm just going to keep the $178. Overall, the way I calculate it, that $178 really gives me a yield of 13%. How do I calculate that? Is I have to put up the collateral, which is the money that would buy 100 shares, and that money's locked up, can't go anywhere. So I'm taking that as being the basis of my investment, and the yield is $178. So if it stays above $160 per share, I'm going to get a yield of 13% on this put option. Not a bad month's work, considering that I do have a good amount of cash right now, and it's earning 4 to 5%. So this is a better yield on that cash. The next company that I want to accumulate shares in is an Allstate. And this company is in insurance. It's been doing really well over the past year. It's up 71%. So I'm very glad that I own this stock. I've done really well in appreciation. I'd love to own more shares. The stock has been going up recently, and I sold a put option contract to buy 100 shares of Allstate if the price comes down to $170 per share or lower. And the person who bought that contract paid me $168 for the right to buy those or to sell me those shares at the price, which is fine. If the stock price stays above $170 per share, I get to keep the $168. If it comes down in price, I get to buy Allstate stock. I win either way. Heads, I win. Tails, I win. Thank you very much, stock market. If I calculate the yield on that put option, I'm making 12% on the money that I have to put up as collateral for those 100 shares of Allstate stock that's going to be locked up for a little over a month. So that's the second stock that I've put a put option in place, that I've sold it and created some income. And the third and final stock that I've sold a put option contract on is Live Nation. This is a company that I think has a lot of value compared to its stock price. And I've completed a video recently. You can see it on my channel if you like. You can see that the stock's been very volatile. And I've been buying into this stock, but I also sold this put option contract. Basically, if the stock comes down to $90 per share or lower, I get to buy the stock at that price. And if it stays above $90, I get to keep a premium of $149 that I got from selling this contract. In either case, in all three scenarios, I get to keep that premium. But you would hate to see a stock like this one really come down. Let's say so there was some really bad news and the stock, crashed down to $60 per share. I would have to buy the stock at $90. That's the risk. But the benefit right now in a rising stock market, I think, is pretty clear. I get to generate income, in this case here, $149 from a stock that I would like to buy. All things being the same, I would love to buy Live Nation at $90 a share if somebody would want to sell that to me. And we'll see how it plays out. All three contracts have a duration of roughly about a month. That's the time duration that I'm comfortable with. And again, I try to stay away from earnings calls, dividend events, because those could really move a stock one way or another. In all three scenarios, generated some income, $495. I just started doing this since we have a rising stock market. I feel like the market is probably going to go up from this point. Chances are, right? Nobody can predict it. But we had a pretty good correction about a month ago. And I think that's kind of given the market the medicine it needed to kind of bring down some prices. I wouldn't be surprised if we go up a little higher from this point through the end of the year. So I might double up on the put option contracts that I sell and create a little more income. Maybe get that income stream up to about $1,000 a month. We'll see. So that's my video on selling put option contracts to get additional yield and additional income in my portfolio. Hope you found it interesting. Thank you for watching. Welcome back to my channel, fellow investors. In this video, I'm going to cover a small ocean logistics company by the name of Pangaea. You probably have never heard of this company. They're tiny, small cap, under $1 billion in value, but they've had a really nice return in the last 5 years. I'll show that later. I've been a long-term shareholder of Pangaea, and I wanted to update my analysis since the company announced their earnings today. Pangaea, they specialize in shipping particular types of aggregates, loose materials like cements, sand, gravel. They also do things like grains, beans, and ship them from one continent to another. They also specialize in the northern route above North America. In certain parts of the year, the ice breaks up, or they're able to break through the ice and cut the shipping route considerably between Europe and China, which becomes much more affordable for companies to take that route versus having to go down to the Panama Canal, which costs money, or even go down further around the tip of South America, which would really be a long voyage. The company announced their earnings today. So with their new financials, I'm able to update my analysis and value the company. I'm a current stockholder. I've been a stockholder for some time, and I'll need to decide whether I'm going to hold my shares, sell my shares, or buy more shares. And it'll be based on the valuation as well as how the company is doing. Let me tell you more about the company. Let me go over the fundamentals of Pangaea. The market cap is small. $382 million is their market cap, and it should be down because, again, after their earnings, the stock went down quite a bit. We'll see where it opens tomorrow, where it trades. The company has a forward PE of just 7.5, very low PE company. Historically, they pay a really nice dividend. Right now, it's at 4.8%, and historically, they paid up to 8%, 10% dividend, while their stock has been appreciating. If you look at the 5-year chart, especially from 2020 up until now, it's really gone up. It's gone up 143% over the last 5 years. And more recently, if you look at the last 5 months, it's up 55%. So it's been a really nice stock to hold. Overall, it's only covered by one more analyst, and he has a hold rating. This is a tiny company, so I don't expect many analysts to cover it. And there's been really good investors that buy these small companies, hold them for a long time when there's really good value. And I think I may have found a company. It certainly paid me back. I probably have already sold enough shares to recover my full investment in Pangaea since I started buying in the year 2020. I'm going to value the company by first discounting the cash flows that I expect the company is going to produce in the future and getting a current value of those cash flows, and then value it a different way, which is looking at the earnings per share and trying to get to a stock price based on earnings per share. Let me start with free cash flows. So they had positive free cash flows in the full year 2023 that just closed. I'm going to have that as my starting point of $27 million. I'm going to grow those cash flows by 4%, which is very reasonable since the economy should be picking up soon. And this company tends to really get more premium shipping rates and do better than most other shipping companies. In terminal value, I'm going to grow those cash flows by 4% as well. And that should give me a nice conservative forecast of the free cash flows I expect from the company. Keep in mind, over the last 5 years, they've grown free cash much faster than that, but I want to be conservative. I'm also going to be conservative with my discount rate at 11%. And I'm going to use that to discount all those free cash flows to get to a current value of $350 million. The company has $87 million of cash, $121 million of debt. So the equity value of the company is $316 million, but their market cap is $383 million, which means the company is trading at a 12% premium. And in my book, that's pretty close to fair value. If I really like the company, I'd be willing to hold and maybe even buy shares on dips, because if I really like a company, I just think they're going to continue to grow their earnings per share and grow their free cash flows. So that's within reason of a valuation. Earnings per share value, I'm going to take their expected earnings per share for 2024, which is $1.10 per share, go times a 12 PE. It's expected the company is going to start growing now. They command a good shipping rates, and they should grow in 2024. I'm going to grow their earnings per share by 4%. And I'm going to use this formula here to determine the value based on earnings per share. And the value based on earnings per share is $11.27. Current stock price is $7.74. So you have a discount of 46%. I combined the two, and it has about a 7% discount on Pangea, which I think is more fairly priced versus any big discount offered. So should I buy more shares, hold my shares, or sell my shares in this company? Well, let's take a look. Let's start with the company. Do I want to be a part owner in the business? Yes. I think it's a really well-run company that I like their specialization. They differentiate in the market. And it's an industry that has really high highs and really low lows. We're getting through one of the lows, and I think the best is yet to come for this industry. The balance sheet is in good shape. Debt is less than 3 times EBITDA. So the balance sheet's in good shape for this company. And they don't offer a discount. I think it's fairly priced. So I'm going to hold my shares of Pangea, see the company operate for a quarter or two. And if the valuation changes, then I can decide whether I want to buy more or sell my shares. I hope you found my video on this really small company interesting. I really appreciate you watching. Good luck investing in 2024. Pfizer announced their earnings this morning, and the earnings were positive. This company has been a rebound story, and it's hard to believe because this is traditionally a very strong pharmaceutical company. They were the company that stepped up and found a vaccine for COVID, and they did really well for a few years. They generated upwards of over $60 billion of free cash flow in those 2 years when they generated vaccines to help the world get over COVID. But since then, the revenues really dropped, and so did their stock price, and it became a rebound story. Pfizer's always been a high dividend paying company, and it's certainly the case now with the stock. I wanted to take a look at their earnings and see what's going on, see if we're headed in the right direction or if this stock's going to continue to really struggle. I'll take a look at their earnings, and then I'll look at their financials. I'll run a valuation and then determine if I should continue to buy shares of Pfizer, just hold my shares, or sell my shares in Pfizer. Now, none of what I am sharing is financial advice. I'm not recommending you buy Pfizer. I'm not recommending you sell it. I'm just sharing my analysis, and I hope you find it interesting. So overall, Pfizer is a very well-known pharmaceutical company. And what's good about the company is they haven't stood still. They've continued to create new drugs and treatments. They're going to help a lot of people, which is good. It's also going to refresh their portfolio, which is very good. I really like their long-term vision of reinvesting in the business. They took all that cash as well as some debt they took on and acquired some businesses to make their portfolio even stronger. And I think the next 5 to 10 years, the company should be growing. Now let's take a look at their earnings. So it's July 30th, 2024, and Pfizer announced their earnings. The really good news is for the quarter, they've begun to grow their revenue. That's really good. And the reason why the revenue has been going down is they had a temporary sale of COVID vaccines. And that temporary event was really good to build cash, but it was not going to stick around forever. But now they're beginning to have compares where they can start growing. I think that's really going to change the perception and psychology around this stock if you see the stock grow. Again, I really like their forward opportunity with all the different drugs that they're going to come out with and the companies they've acquired. So I think that's a really, really good milestone for the company. Overall, they continue to drive really good free cash flow. They pay a really nice dividend, and I'll get to that in a few minutes. Overall, they improved their guidance. They increased the revenue guidance by $1 billion, and their earnings per share, they improved as well. So they beat and raised their guidance, which is a very good sign. After announcing their earnings, the stock in the pre-market has gone up 0.75%. So a modest little rise to the stock. The stock overall is $174 billion in market cap. They do about $55 billion in revenue. Their forward PE is really low at 12.15%, 12.15. And I like that. If I look at the fact that if they can start to grow, that PE should double. It really should be an opportunity for this stock to really go up. The company pays a 5.47% dividend, which is a really high dividend rate. Analysts believe that it's a buy and that it's discounted by 12.3%. So that looks good. Historically, when we look at the stock price is traded close to $60 per share, and now it's down to 30. So back to my comment on the PE. If the PE can double, the stock price can double, in my opinion. But as you can see from 2021, when it was deemed that, hey, COVID isn't going to be around forever, we're not going to need vaccines forever, the stock really sold off, and it never hasn't really had a long-term rally for a while. Another thing I would point out is this company is bigger and has more cash, is just stronger than before 2020, before COVID. But in those days, the stock was trading upwards of $37 a share. Now you're getting a bigger company 4 or 5 years later at a discount. So I think it's an opportunity to look at Pfizer. When we look at their financials, you can see where the COVID years really pretty much doubled the size of the company if you compare it to 2019. And now the company still is bigger. If you look at 2023, they're much bigger than they were in 2020 and 2019. But those COVID years are what throw their financials off and probably throw investors off. The piece that I'll point out that is really interesting is I really look at free cash flow. In this company, when you look at the cash flow they were producing before COVID, they were producing about 10 billion, 12 billion in free cash flow. Once COVID came around, they developed the vaccine, they produced a lot of free cash flow. They produced a whopping $56 billion of free cash flow. And they did good things with that. They took it and invested in the business, which is really good to see. They acquired a big business that is going to help with certain cancers. And I think that's going to generate really good cash flow, future cash flow, and really good revenues for Pfizer. 12 analysts cover Pfizer, and they believe it's a buy and that it's discounted by 12.3%. I'm willing to bet that they're going to probably increase their price targets because the company beat on earnings, raised their guidance. So that should raise the price predictions of these 12 analysts. But at this point, before they've had a chance to update their information, they're showing that it's probably discounted by 12%. And as we look at their earnings per share, their projection this year was 2.37. And I believe Pfizer raised their guidance, so it's going to be above that. And then next year, it's supposed to grow 16%, 6%, and then 4%. This guidance looks okay. I think it's going to be better than that because Pfizer has a really strong portfolio of drugs that are just now becoming sellable. And they're going to have additional drugs and treatments approved by the FDA in the next couple of years. So overall, they're going to have a really nice growth trajectory in the next couple of years. So I think they're probably going to surprise to the upside on earnings per share going forward. I like to look at a company and determine how desirable is that company? Do they operate in an industry where they operate like a really strong monopoly and can command their own price, have very high profits, and have free cash flows? Or are they subject to excessive competition and therefore revenues go down over time, profits go down? It's just really tough to really make free cash flow in those industries. So let me make that decision around Pfizer. Pfizer is a pharmaceutical company. And what I like about pharmaceutical companies is that they do the science to then discover a drug that's going to help people, and they earn a patent. They also have to go through FDA approval, and that takes a long time. So both the patent and the FDA approval, and then really becoming mainstream, that has a network effect. So pharmaceutical companies become really, really valuable. That's why Pfizer has a big market cap. And you have other companies like Eli Lilly with even a larger market cap. So Pfizer, I don't put them on the upper part of the green quadrant, which is the most desirable. I would put them kind of like straddling both the gray and the green. And the reason that I give them a combination is that in certain markets for pharmaceuticals, Pfizer definitely has a lot of power, and they have new drugs where they're the only ones selling that drug. So people that have an illness or a condition will have to buy it from Pfizer. That's really strong. But in other markets, they have a lot of competition. For example, they're getting into the weight loss drug market. And that part of the market, there's already a couple of competitors. So when they enter into that market, they'll probably just have a drug that competes with others. It'll probably make some money, but not as much as where they're the single drug that really helps patients with a particular disease. So I'm going to put them there. It's still a desirable company for me. They have, I would say, a moderate to wide moat, and the strength is really strong. I like that Pfizer's been putting a lot of capital into their R&D to develop and discover better drugs, new drugs to help people and really grow the products that Pfizer has to sell to the marketplace. Now I'm going to value Pfizer by looking at their free cash flows and getting a net present value, all the cash flows they're going to produce in the future. I'm also going to look at earnings per share and value the company by using earnings per share. To start with free cash flows, I think that a good starting point for this company based on their historical information is to start at $9 billion and then grow by 10% for the first 4 years. Terminal value, I'm going to grow by 4%. Those are all cash flows beyond year 4. I'm going to use a discount rate of 8%. And the intrinsic value of all those free cash flows based on that data is $246 billion. I'm going to add cash on the balance sheet and take away debt to get to an equity value of $188.6 billion. And the market cap currently is $174 billion. So there's about an 8% discount on Pfizer if you look at free cash flows. Now, this is a conservative forecast. If the drugs that they've taken to market work out, you could see 50% more free cash flows, and that's really going to change the valuation. But I think it's good to be conservative and have a good starting point. Looking at earnings per share, the company just guided up. They just moved their guidance up. So using the lower end of their guidance, which is $2.45. I'm going to raise their PE to 18 since they're beginning to grow. I think they deserve an 18. Eventually, I think they're going to get to 24. The growth rate is going to be 15%. And I get to a estimated stock based on earnings per share, $50.72. But their current stock price is $30.72. So there's about a 65% discount using earnings per share. When I combine the two, put more weight on free cash flow, there's a discount available on Pfizer of 27%. I think this is a conservative valuation and a good one. And I think that it really gives me a reasonable discount on what I think is a very good company. So should I buy more shares of Pfizer, just hold my shares, or even sell my shares? Well, I think I'm getting a very reasonable price on a very good company that has a lot of upside potential. So I'm going to buy more shares of Pfizer. I really do consider them a very good company to own long term. I think it's been misunderstood. I really like that the stock sold off so much and the price has really come down. I think it really presents a very good proposition for me as an investor. So I'm going to keep buying shares in Pfizer. I hope you found my video interesting, and I appreciate you watching. Welcome back to my channel, fellow investors. In this video, I'm going to be reviewing Palantir. This is a software company that deals in big data. They try to find patterns in that big data, which will then give their clients the ability to pick up on that intelligence and act on it. One of their big customers is the military. They use big data sets and try to pick up on patterns that help them keep the country safe. They're trying to move over to the commercial space and sell their solution to businesses who could also use their software. Of course, they're a software company, so every software company now says they're an AI company, and Palantir is doing the same. They are claiming that through AI, they're able to work with large language models and bring value to that customer as well. I'm going to take a look at Palantir. I'm currently not a stockholder of Palantir, and I'm going to value the company, and I'm going to decide whether I should start buying shares in Palantir or hold off from doing so. Let me show you more on Palantir. Let me go over the fundamentals on Palantir. To begin with, this is a $55 billion company, and they're a new company. They've been around publicly traded since 2020, 2021. And if you followed the company, they IPO'd at around $10 per share. and then they really went up in value, up around the $35 range, but really went down. And you could have picked up shares of Palantir under $10 in 2023, at the beginning of 2023, and at the end of 2022. If you had picked it up at the very low point of the stock, you'd be up 300% from that stock price up to where it trades today. So stockholders, especially the ones that bought in late 2022, early 2023, are likely really happy with that return. Overall, this is a high growth company. They're growing at about top line revenue, about 20% per year, but their cash flows are growing much faster, which is really impressive for a company to have free cash flows this early in their young history. Forward PE is 73, which is a little high, and I think they'll need to grow into that PE. But I'll value the company using free cash flows as well as earnings per share. I'm not going to use a 73 PE. I'll use something lower and tell you what I think the company is worth. Most analysts are saying to hold on Palantir. I think the stock price has gotten pretty high and pretty expensive, but I'll see where I value the company, and I'll let you know what I'm going to do with this stock. I'm going to value Palantir by discounting the free cash flows I expect the company is going to produce in the future. And I'm also going to value the company looking at their earnings per share and determining what the stock price ought to be based on their earnings per share projections. To begin with, on the free cash flow side, the company produced really impressive free cash flows. And I'm going to have a beginning point of the 2023 year, and then I'm going to grow that by 25%, which is a pretty fast growth rate, but they did grow their free cash flows over the last 3 years by 47%. The first 4 years, I'm going to grow at 25, and then years after that, I'm going to grow at 5%. It gives me this particular forecast of free cash flows that I expect in the future. Now I'm going to discount those free cash flows by 10% as a weighted average cost of capital. This is higher than what I would use for like a Microsoft, but this is a small company. They are new. A lot of things can happen. A big competitor can come into their space and take them out of business or really limit their growth. That said, with a 10% discount rate, the net present value of all those free cash flows is $31.2 billion. I'm going to add the cash, $3.6 billion, and they don't have debt. So it increases the overall value to an equity value of $34.9 billion. The market cap is $55 billion. So the company is trading with a 34% premium. That's a pretty good premium on this company. Looking at earnings per share, the earnings per share is a little small. It's 34 cents per share, and their growth rate isn't going to be all that great, but I think they can really improve on it. I'm going to grow their earnings per share by 10% and give them a PE of 60, since they are a pretty exciting company. They are saying the right things with AI, and I think a 60 could be something I could substantiate. Based on those factors, I get a value of $17.39. Current stock price is $25 a share, so there's about a 30% premium if I value the company based on earnings per share. If I combine the two valuations, I get to a blended 33% discount on Palantir. That's pretty high premium that I'm paying on Palantir. And, it causes me to pause. If it was closer to fair value, I might consider it. And definitely if it was a discount, especially with the execution of their business and the profitability and the free cash flows, I'd definitely be interested in Palantir. Now it's time to decide whether I should buy shares of Palantir or not buy shares. And I'm going to base it on 3 factors: the company, the balance sheet, and the discount. To begin with, I think the company is really exciting, and I'd be happy to be an owner in Palantir. I think they're an industry that I have invested in for a long time and have done really well in. And the company's operated really well. There's no debt, so it's well below 3 times EBITDA, and the balance sheet's in very good shape, but there's no discount on the stock. So you saw where the volatility of this stock has gone. And I think at the right points, this stock may come down to a better valuation and a better entry point. Therefore, I will not be buying Palantir. I would be a seller of this stock. Palantir is an exciting company. They're in a space where they're really doing well. They've grown very quickly, which is impressive. And we'll see if they can keep that growth rate up, especially on the top line. That's been growing at 20%. If they begin to slow down, then it's really going to affect their valuation. We'll also see if they can keep growing that free cash flow at the rate that they've been growing. It'd be impressive if they do. And their valuation will go down if they don't. I hope you enjoyed the video. I hope you found it interesting. And I really appreciate you watching. Welcome back, fellow value investors. In this video, I'm going to analyze Perdoceo. This is a small cap company that focuses on higher education. What makes them different is they do a lot of distance learning for their students. For people that have full-time jobs and have to go to school part-time, or maybe make it convenient. They have to educate themselves without leaving their homes. Produccio's been really offering a lot of curriculum for that student and giving people a way to get educated, earn degrees, and improve their lives. It's a company that's also making money and generating a lot of free cash flow, and that really caught my attention. I'm going to evaluate Producio, let you know what I think the company is worth. I'll also let you know if I'm going to intend on buying more shares, if I'm just going to hold the shares that I own, or if I'm going to sell the shares in this company. Do me a favor and like my video and subscribe to my channel. And also please leave a comment on this company. I'd love to hear what you think. I'm going to evaluate this company looking at 3 principal areas. Most importantly is the company. I don't want to invest in a company that I don't believe in. I have to like the business. I want to be a part owner in the business, and I want to know that I like the management team and I like the industry. So a lot of attention to the company, its industry, its management team. I want to look at the balance sheet, make sure the debt's under control and less than 3 times EBITDA. And I want to discount the stock. I'm a value investor. I buy stocks when they're discounted. And based on the answers that I get, I will buy, hold, or sell this company. A lot of industries have to really change. They have to innovate. They have to adapt to the modern times. And I would say that higher education might be a little slow to adapt, especially these big universities, big state universities. These are really big institutions. And don't get me wrong, I think they're great. I think they educate a lot of people. And I was educated here in California by the Cal State system. So I'm very fortunate and grateful that they educated me. But there's a lot of people that would rather go online and earn their degree. There's also people that have to work, and it makes it very hard for them maybe to drive across a city or maybe drive an hour to get to school and then go home, do their homework, and then go to work the next day. So it'd be far easier if they can do it at home or somewhere where they have a high-speed internet connection. And Producio has been really focused on distance learning. So it makes it very modern to the student that wants to do it over the internet. It also makes it less expensive, more profitable for the company that's actually providing the education. So all those factors, I think, benefit this company and make them, I think, more competitive than their rival institutions that are very big and really serve predominantly on-campus students. The company has 2 big divisions, Colorado Technical University Division, and then the American Intercontinental University System. The bigger of the 2 is the Colorado Technical University System. It has brands like Colorado Technical University, Hippo Education, and Coding Dojo. This is really focused on technology-based education and getting people to take jobs in technology. Very good. It's the bigger of the 2 different divisions. They have 25,900 total enrolled students. They have 2 on-site campuses, but most of the education is done online. So it makes it convenient for the student, less expensive for the university. The other university division is the Intercontinental American University System, and they have 4 different schools within that division. This is the smaller of the 2. They have 12,100 students. And again, primarily online. This particular company likes to educate people and get them ready for a particular job. So most of what you get educated in this system prepares you to be a nurse, to be an IT professional, to be able to code and work somewhere developing software, or maybe even AI. So I like their curriculum. I like that they do primarily online, which fits the modern times. And I like that they really focus on what is being demanded by the workforce, by students, and that's what they focus on educating students in. So let's take a look at the type of student that attends their college typically. Students tend to be a little older. 68% of them are over 30 years old. And then there's a category of 21 to 30. So a majority of students are adult students. It's not people that are just graduating high school and going straight to college. Most of them are earning a bachelor's degree, 68%, and some are earning an associate's degree. The types of degrees that are being earned: business studies and information technology, as well as health education, so nursing and so forth. So these are very occupational related degrees. So people are going to better their earning potential. Maybe students are using their employers' continuing education benefits that a lot of employers provide, and you use those resources to attend one of their colleges here and earn a degree online. So I think they're really tapping into a population within the United States that wants to be educated, but they just need it done a little differently, done online, done at their pace. And this is a more an older audience that is going to their colleges. So I think this company is different. It's not just like any other university. They are different. They really want to be primarily an online learning university. They want to be flexible. So mostly their students are adults. So they have families, they have jobs. They use a lot of technology. Now that's probably similar to most universities, but these guys go that extra step doing online education. And now they're going to bring in artificial intelligence. And they really focus on what's marketable. Let's educate these students so when they get done with their degree, they have a job waiting for them in business, in IT, or in healthcare. Let's look at their investment thesis. First, they want to establish a growing online platform. So they really want this online business, this online education business to really thrive. That's their principal goal. I like that. They're going to be using AI to really enhance the education process. That makes a lot of sense. I think if they provide AI to students so they can ask a lot of questions around particular topics, that student can learn much faster if they get the answers that much quicker. And if the company builds a large language model around the subjects that students need help with. They have a strong balance sheet and really focus on the return of invested capital. Very good. And no debt. They carry no debt on the balance sheet. That's very good. They also want to partner with the stockholder by buying back shares and paying a dividend. Now, one item of concern is they had to basically bring back their previous CEO because the existing CEO resigned. I don't think the person was working out. And that's a concern because they had a change of the guard. That person didn't work out. The CEO that was previously in the role came back, but he's probably not going to be there permanently. They're probably going to need to find another CEO to take over. So we'll see how that sorts itself out. But it is an item that concerns me. Producio has been growing their revenue. I'm looking at the trailing 12 months, and you can see that their revenue is growing. Not a ton, but it continues to grow. I like that. The other thing I like is they're profitable. Profitable with some growth is excellent. I'd like to look at earnings per share. That's another metric that I use for valuing the company. And one website, stock analysis website, stockanalysis.com, has their earnings per share next year at $2.14. And CNBC has it effectively at $2.06, not too far apart. So I'm going to take the middle point of the two. I'm also going to look at the forward PE for Producio. I'm not going to take the forward PC that's listed on CNBC. That's too high, but I'm going to go way above the 8 that they have done for the trailing 12 months. I think they deserve a higher PE. They're growing, they're profitable, and they generate free cash flow. And their cash flow is really good. They generate really good cash flow. Free cash flow, trailing 12 months, 131 million. So that's very good for a company their size and their market cap. So I'm going to use that free cash flow in the valuation of the company. I take two techniques, free cash flow and earnings per share, to value this company. Looking at some of their ratios, they have a very low PE. It's 8.22, and I think that they deserve a higher PE. I'm going to use a higher price to earnings ratio. I think they deserve a higher price to earnings ratio. It is a small, mid-sized cap company. Their debt to EBITDA is really low. They have low debt and they produce good EBITDA. So that's very good. Their return on assets is good, 14.8%. Return on equity is 18.8%. I believe Producio is heavily discounted and it offers a discount of 83%. I get there because I value the company based on the earnings per share that they're going to produce, seeing how much the company is worth based on that factor. And I also look at the free cash flows that I expect they're going to produce and then valuing those free cash flows and determining a net present value. The free cash flows for the trailing 12 months is 131 million. So that's going to be my starting point. And I'm going to grow these cash flows by 4%. And then terminal value, I'm going to grow more modestly by 2%. These are really low growth rates. I think they could do better than that, but I'm going to be conservative. The weighted average cost of capital is 9%. Interest rates are down. This is a small company, so I'm going to use a higher rate than normal. I'm going to add the cash, but there's no debt to take away. So the equity value ends up being $2.4 billion for the company. The market cap for the company is 1.1 billion. So the free cash flows just look fantastic. 113% discount if you look at how much cash this company produces. The earnings per share, I took the midway point between the two websites I visited. So it's $2.08. I'm going to use a PE of 12. It's a growing company, profitable, generating free cash. So they deserve a 12, if not higher. And then just a conservative growth rate of 3% on those earnings per share. When I take those factors and put them through my calculation to determine a value of a company using their earnings per share, I get to a value of $21.29. Current stock price is $17.45. So just using earnings per share provides a 22% discount on the stock. I blend the two, but I believe in free cash flows more than earnings per share and use 2/3 of that as a weight and 1/3 from earnings per share to get to the blended 83% discount. The debt to EBITDA is super low, so it's well below the 3, and I'm very comfortable with this company's balance sheet. Looking at where the company is traded, year to date, they're doing well, 25.63% return year to date. It's had a really nice run up at the end of the summer. Their earnings came out and investors recognize, hey, this company is valuable. It has been trading sideways, which offers an opportunity for an investor like me to come in and take a look at these shares. They pay a dividend of 2.5%. And overall, they offer a nice discount between where they're currently priced and where I value the company. So let me determine if I should buy, hold, or sell this stock. First, let's take a look at the company. Do I like the company? Do I think it's well run? Do I like the industry? And the short answer is absolutely. I really like that they're primarily online. They really focus on what types of careers are people getting jobs for, and really making the education process valuable for the student that graduates. So that's all things are good. The one small thing about management, they did replace the CEO. Now, that's not totally bad news, but it is a concerning item that I'm going to keep an eye on. The balance sheet, very low debt, well below 3 times EBITDA, and they offer a nice discount on the stock. So I'm going to be buying shares of Producio. Hey, thanks for watching the video. I really appreciate it. I'd love if you could leave a comment. I'd love to read your comments on the company. I'd love to hear what you think of the company. And please like my video and subscribe to my channel. I'd really appreciate that. Good luck investing and happy holidays. Now, I need to update my stock price on Prudential before I could give you a full review of Prudential. So $109.46. Over the last 30 days, it's pulled back 8%. Year to date, it's up 5%. 1 year, 14%. Pays a nice dividend of 4.75. So one thing that Prudential has going for it is it produces a lot of free cash flow. When you look at their cash flow, it continues to expand, and the insurance industry, there's a reason why, like, Warren Buffett loves insurance companies, is you sell policies and you sell them at a policy rate. Your policyholder pays you in advance. You have actuarians that are trying to calculate, hey, for that type of insurance product, this is what we want to price it at. This is where we want to sell it. Therefore, our payouts will only be 80%, 90% of what we're selling the policies for. So you're somewhat mathematically expecting to make money on the policy, and better yet, you get to take that cash and invest it and make money on it. With the higher interest rates, they were certainly making a very good return. As interest rates come down, I think it's going to erode some of that profit, but it's still a pretty good dividend environment. It's not like we're going back to, the days when, interest rates were near zero. So it's still going to be a decent area. I had Prudential discounted very, very well. And as we look at, the path forward for Prudential, I don't see anything being a threat to the company where, well, as we have declining interest rates, what will that do to Prudential? Well, I think it's going to be okay because it's not going to be a zero interest rate environment. So they're still going to make that cash. I think insurance continues to be, and have good, strong demand because people want to insure their life. They want to buy into annuities because they're intimidated by investing in, stocks or bonds directly. They just want somebody to tell them, hey, you buy into this either life insurance policy or this annuity, and then you'll get this type of cash flow in the future. People can get their heads around that. So those products, and I think the basket of products that they have, are going to put this company in a good place. So I think Prudential is a good stock, and they pay that really nice dividend. Market's been going up really nicely as of late, and overall over the last 2 years we've seen really good gains. Makes it a little harder to find valuable companies that are discounted, that are set to go up in price over time. I may have found a nice idea in ProPetro, which is a company that provides services to oil companies that are looking to set up wells, especially in the Permian Basin, to do fracturing and extracting the oil that exists in that region. This company is a small cap. They're under $1 billion in market cap. And overall, the fundamentals look good. I'd like to go through and show you the fundamentals. I'm going to value the company and share with you what I plan to do with this small cap stock. The oil business has its ups and downs. And right now, oil is down. The oil price is down, which is a good time to buy, because when oil prices rally, which they often do, companies that are in the oil complex go up in value. So it's not a bad time to take a look at it and buy into this little company. Let me take a closer look. ProPetro is a small cap at $843 million of market cap. Over the last year, their stock price has been coming down. It's probably because oil prices have been going down as well. I looked at oil prices and I looked at this stock price, and they seem to pretty much align with each other. I should say follow each other. So no big surprise. If you have our higher oil prices, the oil companies are going to want to extract more oil. Low oil prices are not really motivated. That totally makes sense. The company has revenue of $1.5 billion. They have PE in the current year of 26 and forward PE of 26 as well. Analysts really like this stock. They think it's 45% discounted and they have a buy rating. When we look at their financials, even though oil has been going down recently, this company has been doing a good job in maintaining their revenue and actually growing it over the last 3 years. That shows that companies want to use ProPetro. They probably provide really good services. So all that's real positive in my mind. A company that grows their revenue shows that they have products and services the customers want. It shows that the business is strong and growing. Overall, their cash flow looks real good. The company is young, but it's producing free cash flow now, which is really good. The trailing 12 months, they're produced $148 million of free cash flow. Let me remind you, these guys are less than $1 billion of market cap. So their yield to free cash flow on that revenue is up around 16, 17%, which is very, very good. So I like that about this company. When we look at the balance sheet looks good. Their debt's really low. They provide really good EBITDA. So the balance sheet checks out. The forecast, 4 analysts cover the stock. They all think the stock is discounted. That's a rarity. Sometimes you have some analysts that are just really bearish on a stock. They're basing it on a earnings per share of 49 cents in 2024, but really good growth in 25 and 26 to keep in mind. So I'll use these figures as well as the free cash flow I shared a minute ago, put that into my valuation to see what I think the company is worth. I value companies by looking at their free cash flows that I expect they're going to produce in the future, discounting those free cash flows to today's value using a discount rate. I also value companies by looking at their earnings per share. I blend the two valuations to arrive at what I think a fair price would be for a company, and then compare it to its current stock price to see if it's discounted or if it's being sold at a premium. Starting with cash flows, ProPetro has provided really nice cash flows over the last 12 months. So I'll use that as a starting point. I'll grow the free cash flows by 5%, and after year 4, they'll grow by 3%. I'm going to use a very high discount rate of 12% since it's a small business. It's also a cyclical business. And when I use that high discount rate, all those free cash flows I expect the company to produce have a value of $1.6 billion. I'm going to add the cash on the balance sheet, but take away debt to get to an equity value of $1.5 billion. The market cap's only $844 million. So if you look at cash flows and the value of those cash flows, I think that they're being discounted by 82%. Earnings per share gives us a different number. I'm going to be really conservative with this figure. It's 49 cents per share in the current year. I'm going to go with a PE of 12 and grow it by 10%, even though they expect that earnings per share are going to grow much faster. I'm just going to be really, really conservative. Using those conservative figures, I have a premium slightly of 20%. But when I blend the two and I put more weight in the free cash flow method, still yields a 48% discount, even though I'm using a 12% rate of return discount rate. So overall, this is a very discounted stock at a time when oil prices are down, but they're not going to stay down forever. If oil prices go up, I expect this stock's also going to go up. How desirable do I think the ProPetro business is? Well, let me take a look at it. I really like businesses that are very desirable, that have great moats, which are competitive barriers to keep competitors out. And they are in industries that are growing and expanding. They have plenty of room to grow. They're very profitable and provide free cash flow. Now, ProPetro is not exactly in the green. They are mostly in the gray, with a slight amount of their company in the green, and I'll explain why. So ProPetro does have plenty of competitors in the marketplace that will do the fracking services that they perform. This company is growing. As oil prices come down, they continue to grow. And that exhibits that oil companies really like this company, the services they provide. So it shows that they have some type of competitiveness, value add, some unique secrets of doing business and extracting oil better than their competitors, which is why they're growing. So I'm going to give them a little bit of an advantage there, but most of the business is in the gray. Considering that they are in the gray, there's a really good discount available on this company of 48%, and that's using a very high rate of return of 12%. So I'm going to be a buyer of ProPetro going forward and build up a position maybe of $5,000. There's a couple of reasons. One is oil is down, but it's not going to stay down forever. If oil goes up, this stock's going to rally. Two, I think small caps have been left behind. And as you can see, fundamentals look pretty good for small caps. They look really good for ProPetro. So I'd like to buy more small caps. I'm going to keep all my large caps. I'm going to keep all my stocks that have been performing great. But I have capital where I can put in $5,000 into this company, and it'll be a nice starting position in this small cap. So that's my video on ProPetro. Hope you found it interesting. Let me just remind you, I'm just an individual investor, just providing my experience, and I hope you found it interesting. I'm not recommending you buy, hold, or sell ProPetro. I'm not providing any financial advice. Thanks again for watching. Good luck investing in 2024. PayPal is back. They had a very good earnings call today. Their report looked really good. PayPal is growing their top line revenue. It's growing the number of transactions that are going through its network. Overall, it was a very good report. I'll also point out that PayPal has had consistent growth in the last several earnings releases. The market just didn't like PayPal for some reason. And the market really realized today that maybe PayPal is undervalued and should be appreciated more. The stock has really gone up today on a day when the NASDAQ is down about 1.5% overall. A lot of technology stocks are down big today, but PayPal is standing tall with a really good stock price and a very good stock rise today. I'm an investor in PayPal. I've been an investor in and out of PayPal for, the last 6-7 years. And it's been overall a very good, profitable experience. On this occasion, it's taken a while for the stock to even do anything, but it's really having a good day. And I'm hopeful that it's going to continue to rise over time. Now that more investors realize that PayPal is doing a lot of things right, like growing their business, generating more free cash, buying back shares. It's bought back a lot of shares in the last 2 years. And it's really set to continue to grow in a profitable way. So all those things are good. I'm going to go through and take a look at their earnings, look at their fundamentals. I'll do a valuation of the company, and then I'll let you know what I plan to do with this stock, whether I'm going to buy more shares, hold my shares, or sell my shares in PayPal. Let's take a look at the company earnings. So for the second quarter of 2024, PayPal grew its revenue by 8%. So that's good. And again, they've had consistent growth for the past 2 years. They've been doing quite well. Their expenses have been a little out of control, but they really reeled them in. You can see that their operating income increased quite a bit, 17%. So that's really good. Earnings per share increased 17%. Great job. Total payments that they took through their network went up 11%. So that looks really good. The free cash flow is much higher than I expected. In the quarter, they did $1.4 billion of free cash flow. In the first half, they're well ahead of the cash flow I had expected from PayPal. So from a cash flow perspective, they just generate cash like you wouldn't believe. So I'm going to look at their cash closely and put it into my forecast as I value the company later. Overall, their balance sheet's in great shape. They have a lot of cash, $18.3 billion on the balance sheet, and they have more cash than they do debt. So they can pay off their debt immediately if they'd like to. The statement of cash flows was far better than I expected. If we look at the first 6 months of the year, the company produced $3.4 billion of cash from operations. And a part of that was the buy now, pay later business that they have. For a short while, about a year ago, they were having to carry that debt and really roll out a lot of cash for that business. But they have now arranged a partnership where they're selling off that debt and getting that cash back quite quickly. So that's really balanced out their statement of cash flows. If you look at the prior year, they had a negative outflow of cash for these loans and they weren't getting much back. But now they have that partnership and the cash should be fairly good going forward. The business doesn't require a whole lot of capital to be reinvested and keep it going. So the CapEx expense is only $311 million, while their cash from operations is $3.4 billion. So it gives them more than $3 billion of free cash flow in the first half. If I double that, that's going to be the run rate that I'm going to use in my valuation of PayPal is having a good day today. The stock is up 8%. The market cap of the company has risen to $67 billion. and the revenue for the company is 30 billion. Considering that they're a good growing company, I think that's a pretty good ratio. The PE is 16 in the current year, and it's going to drop down to about 15 if you look at forward PE. Analysts think it's discounted by almost 14%, and several analysts cover it, which I'll get to. When you look at the 5-year, you can see that it really sold off. It was really a valuable company back in 2021, but it's now worth about 1/5 its value. It's down big. But if we look at the year to date, you've seen a lot of choppiness, a lot of volatility, especially with today's rise. Where will it go next? When we look at growth, this is what I was talking about earlier. This is consistent growth year over year over year over year. And I just don't understand why the market hates PayPal so much. The company keeps growing their revenue. That's a very good sign of a strong business. In addition to that, I've already commented on the cash flow, but this is historically a very good cash generating company that I expect is going to continue to do so for many, many years. When we look at the forecast that other analysts have, 30 analysts cover it. And it's almost like a group think, hey, let's all hate PayPal. But if things are turning around, it's now a buy rating for PayPal, and analysts believe it's discounted. So that might help the company really rally, or the stock rally to higher levels, especially when you look at their earnings per share. They guided up on their earnings that they're going to do better than expected. And you look at the growth that they expected at earnings per share, and it's exceptional. So I'm really liking what I'm seeing with earnings per share, cash flow, revenue growth from the company. They have more cash than they do debt. Just a lot to be like about the business. And they delivered a nice growth number, a nice profitable P&L. So all those things look good to me on PayPal. So how desirable is the PayPal business? Is it a really strong business that is almost a monopoly and has a broad moat that's very strong, where it has few competitors, if any? Well, let's take a look at that, and I'll make a decision on how strong their moat is and how wide it is. Overall payment processing, PayPal does have competition. There's a lot of payment processors out there. Now, PayPal has been around for a long time. The brand is pretty strong. They have a strong network. They also are very creative, and they've made good acquisitions. For example, they have Venmo, which is a very popular payment app. They're into buy now, pay later. So these things look really good. They're also creating their own cryptocurrency, which is really interesting. So although I think that they're not clearly a dominant monopoly in their market, I'm going to put them in the gray and partially in the green. I think it's a good business. It has certain areas where it operates like a monopoly, let's say the Venmo business, but it does have a fair amount of competition in the US as well as around the world. It's one of the bigger brands. I really like their network. It's a desirable business, but I need to be able to buy a business like this at a discount. And that way I'm looking to get a really nice return over time as this business really gets priced more fairly to its intrinsic value of cash flows and earnings per share. So I believe PayPal is discounted in a big way. In fact, 88% discount on their stock. I think when you look at their earnings per share, it's discounted by 27%. But when you look at their cash flows, just really high free cash flows, I think it's discounted by 118%. Now, cash is king. Most good investors look at cash flow. That way we can determine the value of a company. Similar to the most valuable companies like Apple, Microsoft, Google, you look at their cash flows, they're very high and they continue to grow them. PayPal continues to grow their cash flow, and they look really good from an intrinsic value of all those cash flows that they're going to produce in the future. The earnings per share in my forecast is quite conservative. They represent a really nice discount. Analysts believe that it's a buy. So overall, this has been a discounted stock for some time, and it's good to see it rise. What should I do with my shares? Should I buy, hold, or sell? So let me look at the different aspects of PayPal and make the decision whether I should buy more shares, hold, or sell my shares. So first, the business. Do I like the business? Do I think it's worth having? And the answer is yes. I think PayPal is a company that has a few really good competitive advantages, and it's really solidly in the gray, which is an area where I could buy a company at a discount and see it rise in value. With regards to the balance sheet, excellent balance sheet. It has more cash than it has debt. Very comfortable with the balance sheet. And it has a tremendous discount. So I'm going to keep buying shares of PayPal. I already have a good size position, and I'm going to be adding shares in hopes that the stock continues to rally. I think it was a wake-up call today for a lot of investors that want in on PayPal. So I hope you found my video interesting, and I really appreciate you watching. Qualcomm stock has gone up 71% in 1 year. Can it keep rising? Does it have the right fundamentals? Are the financials good after their first quarter earnings? Well, I'm going to look into that and answer that question in this video and come to the conclusion of either buying more shares, just holding my shares, or selling my shares in Qualcomm. Qualcomm is a large semiconductor company. They do the best in communications devices like smartphones that Apple sells. They're also putting their chips in cars, and they're putting their chips in Internet of Things, meaning devices that are out in the field, in places, and communicating with some type of central command center, some central server reporting what that device is seeing. Overall, it's been a very successful company. It has a large market cap of $203 billion. As I look at the financials and share with you my opinions, keep in mind, I'm an individual investor. I'm just sharing my analysis as an opinion, sharing my journey as an investor as I continue to grow my portfolio. I am not providing any financial advice, nor am I recommending that you buy Qualcomm stock or sell Qualcomm stock. Please make your decisions on your investments very carefully. Now let's take a look at the fundamentals of Qualcomm. So the revenue of the company is $36 billion. This is a large company, and their forward PE is just 17.8% or 17.8. The dividend has dropped down to 1.87%, and the reason for it is that the company stock has gone up so much, it's really brought down the dividend rate. It's kind of good news is bad news on the dividend. Analysts really like the stock. They have a buy rating, but it's really fairly priced at this point. The financials look good. The company has been growing, but this is a cyclical industry. They've been growing in 21, 22. They didn't have growth in 23. But as we look at their Q1 earnings, we'll see if they grew in the first quarter. They are a high cash flow producing company. Their cash flow from operations is a nice $11.2 billion, and their CapEx is only $1.3 billion. So it's a really high net free cash flow that I'll use in my valuation of the company based on free cash flows. The most valuable companies on the stock market all produce high free cash flow. And the reason why this has a big market cap is that free cash flow. The balance sheet looks good. They have $11.3 billion of short-term investments in cash. Their debt is $14.4 billion. And when you add current debt, it's another billion. So it's about $15.5 billion. So not too much debt, considering that they're producing about $11 billion of free cash each year. Balance sheet looks really good, well below 3 times net to EBITDA. So very good balance sheet. Cash flow is just looking fabulous, and the income statement looks okay. Looking at their forecast for earnings per share, the earnings per share for the company is expected this year to be $9.98. I'll use that in my valuation and then grow nicely, 10.5% next year, another 3.7% in 26, and then 27 will grow about 7%. So good earnings per share and good growth rate on that earnings per share. There are 22 analysts covering the stock, so it's a very well covered stock. They don't expect the stocks are going to rise a whole lot, but they do have a favorable opinion on the company. Year to date, Qualcomm is up 29.8%, and they announced their earnings on May 1st. And you can see that from May 1st to this point, it's up almost 11%. So investors really like their earnings. They saw a lot of good things in it. I'm going to jump to the earnings in a minute to take a look at, what was in that earnings report that really drove the stock. Just taking a look at the stock over the past year, it's up, almost 75% if you measure from 1 year ago. So it's been a really positive stock. Over the last 5 years, it's had a really very high stock price in the latter part of 2021, and then it dropped, and it had a really nice low point in 2023, as well as recent as October 27th, 2023. So from that point to now, just over the course of like 6 months, it's up 71%. Wow, what a rise. So the stocks really offered up value investors really good prices to buy into Qualcomm. Let's take a look at their Q1 earnings and see how that looks. So overall, investors really like the report. The revenue really went up about 1%, not a big rise, but profit really changed. It went up 11%. So really good to see that net income is up 14%. And that, I think, was the big positive, as well as the guidance that the CEO provided is that they're going to have a very good year. I think they're through the negative cycle they were in with regards to the markets they serve. And for the rest of 2024, Qualcomm is very optimistic that they're going to do really, really well. I completed a valuation on Qualcomm using 2 different approaches. The first one is looking at all their free cash flows and looking at a forecast of those free cash flows and getting a net present value of those cash flows in today's dollars. The other is to look at their earnings per share and try to get a value per share using earnings per share. Let's start with cash flows. So I'm using last year's cash flows, but increasing them by about 7%, which is conservative. They're really off to a great start with regards to free cash flows. And I took a look at their Q1 numbers, and they are already reporting that they're well ahead of last year. So 7% is a good rise. For year 2, 3, 4, I'm going to rise those cash flows by 6%, and then terminal value by 4%. All cash flows after year 4. I'm going to use a discount of 8.5% and get to an intrinsic value, a net present value of those cash flows are $230.4 billion. The cash on the balance sheet is $13.8 billion, and the debt is only $15.4 billion. So the equity value of the company is $228.8 billion, but the market cap's only $203 billion. So it offers a 12% discount. If we look at the free cash flows the company is going to produce, earnings per share, some analysts expect it's going to be higher, but I'm going with a conservative number of $9.55, a PE of 23. And I believe they're going to grow those earnings per share by 8% going forward. So based on those metrics, I get a value per share of $237.22. Current stock price is $182. So there's actually about a 30% discount if we look at the earnings per share method. When I blend the two, I get to an 18% discount. I put more weight on the free cash flow method. And that's a nice discount on a high quality company. So should I buy, hold, or sell Qualcomm? Well, I'm going to look at the company, I'm going to look at the balance sheet, and I'm going to look at the discount available on the stock before I make that decision. That's my process. First, with the company, I think it's a very good quality company in an industry that I want to be invested in, semiconductor. I've done really well in semiconductor, have bought companies, owned them, and then sold them with really good gains. And they also pay really nice dividends. This company is really operated well. They focus on their end markets very well. They come with very good innovations, and they're set to really grow. So overall, I like their management team. I like the company. So I really am bought into the company. The balance sheet's in excellent shape. They have almost as much cash as they do debt to begin with, and then they produce really high free cash flow. So I'm very comfortable that their balance sheet is very high quality. Discount. An 18% discount is reasonable on a really good company like this. It's just a high quality company. I'm still going to be holding. Why? Because the stock has really had an upward trajectory, and it's really, really great to see the company do this well, going up, just almost 74% from latter parts of 2023. I'm going to wait for a nice pullback. We had a good one here very recently in April. The stock went down upwards of 10%. So I think the market's a little expensive right now, and I'm willing to bet that there will be a pullback on Qualcomm. I'll be prepared to buy more shares when there's a pullback on Qualcomm. But for now, I'm just going to hold my shares in this really good company. As a value investor, I wait for a company, a high quality company like Qualcomm, to be discounted. And this is a perfect example of a company that has been priced at $180 in price, and they've been priced at $110, all within the last year and a half. And really being patient, doing my homework, and then finding the right acquisition price is the goal with a stock like Qualcomm. Buying when it's discounted, and knowing that this high quality company will rise in value overall over time. So that's my technique. That's my strategy on value investing with really good companies like Qualcomm. Thanks for watching the video. I hope you found it interesting. Is Roblox 22% worse than it was a day ago? Well, the stock price went down 22% on Thursday's trading. Why is that? Did the revenue go down significantly? Did profitability go down? Did free cash flows go down? I need to answer that question. I'm a small investor in Roblox. I really like the company. I think it's a really neat platform where people that play video games, mostly younger people, can go on the Roblox platform and play games. The Roblox model is a lot like YouTube. Roblox partners with developers of video games who put their games on Roblox, and then game enthusiasts can come on the site and play their favorite game, mostly on their phones. It's a model where Roblox provides the platform, owns the relationship with the end customer, the user. The developers of games have a marketplace to take their games. They also have a partner in Roblox who provides the platform. So it's a symbiotic relationship between video game developer and the platform owner, which is Roblox. I like companies like these. It reminds me of YouTube in a lot of ways, and it really becomes a very valuable company. That's the reason why I invested in Roblox. I really like the company. Their fundamentals are a little immature because it's a young company. I'm going to go through and analyze the fundamentals, analyze the first quarter earnings report, and update my valuation of Roblox and update my plan with Roblox. I own a small amount of shares, and I'll update my plan whether I'm going to buy more shares, just hold my shares, or sell my shares of Roblox. Before I jump into that, just a quick reminder, I'm an individual investor. Just sharing my journey, sharing my experience as I evaluate companies, analyze them, and it is just my opinion. It is not a recommendation to buy Roblox or to sell Roblox, and I provide no financial advice. Now let's take a look at Roblox financials and fundamentals. The company IPO'd a few years ago, and it was received with a lot of fanfare. The stock price was really high. It was well above $80 per share, got up to above $120 per share. But now the stock's down to $31 a share, so it really settled down. This year to date, the stock is down by about 29%. Most of that is that one-day drop that happened on this week on Thursday. Now, if we look at the company's market cap, they're a $19.8 billion company. Their revenue is about $3 billion, which makes the ratio of revenue to market cap, you're paying about 6 times revenue for the company. A lot of analysts cover this company and they have a buy rating, and they say that the stock price is discounted by 33%. That's interesting. Looking at the growth of their revenue, it's been really good. If you look at the last 5 years, they've grown every year, and they grew 25% last year. They keep getting bigger as a company. Their total revenue in 2023 was $2.8 billion. What makes this company unique and valuable, in my opinion, is they produce free cash flow. And the cash flow they've been producing is quite high for a young company. They provided guidance, and I'm going to use the guidance on free cash flow for the valuation. The balance sheet's in really good health because they have more cash than they do debt. That makes their balance sheet very high quality. And obviously, if you don't have net debt, you're in a very good position from a balance sheet perspective. Analysts cover the stock. A total of 24 analysts voice an opinion on the stock, and they believe it's discounted by 33%. They're not profitable yet. It's expected they're going to be profitable in 2027. So for now, I'm going to work off of their free cash flows to value the company. Now let me cover the Q1 earnings report that caused this big sell-off in the stock. First off, in the first quarter of this year, their revenue went up by 22%. That's a good thing. Their bookings went up 19%. Good thing. The amount of shares they did issue out did go up. That's a bad thing. Their net liquidity went up, meaning they have more cash. That is a good thing. Their average daily users went up 17%. Very good. So there was some good news in their Q1 earnings. Where investors, and I would say the market really was disappointed, is in their guidance. And we've seen this as a theme here in 2024, where really good companies like Meta, as an example, they announce their guidance and then the market sells off. They completely ignore that they just had a really good quarter, and they're just so disturbed with potentially having an okay quarter to follow. In the case of Roblox, their revenue is going to show growth in the second quarter. That's a positive. Overall, their free cash flows that they project for the year is going to be at least $350 million. That's a real positive. I don't see a big problem with that. So overall, I think that the sell-off from Q1 may have been overdone. But, Mr. Market, it does what it does. Certain momentum stocks either go up or down. And Roblox is one of those stocks where it's a little unknown if they are going to be a big company or if they're going to continue to really play with the small cap stocks. I think this company is ripe for being acquired by one of these bigger companies, whether it be a Microsoft, Amazon, Alphabet, Meta, one of these big media companies like a Disney. Disney would totally do a lot with Roblox. So don't be surprised if in the next year or so, Roblox gets acquired by one of the big companies. I completed my own valuation of Roblox using their free cash flows. I started with their initial cash flow for this year is going to be $350 million. And that's because they guided that would be the worst case scenario for free cash flows. It might be better than that. I'm going to grow cash flows by 25% in years 2, 3, 4, which is very reasonable. It's a high growth company doing really well. And terminal value, I'm going to grow cash flows after year 4 by 6%. I'm going to use a higher than typical discount rate just because Roblox is not yet profitable. They are a small company and they could surprise me. So I'm going to have a higher discount rate. When I use those factors, I get an intrinsic value and net present value of all those cash flows equating to $14.7 billion. I'm going to add the cash of $2.4 billion and take away debt, which is roughly $1 billion, to get what I think is the equity value of the company is $16 billion. But their market cap is currently $19.8 billion. So they are currently trading at a premium of 18%. So maybe all the people that sold the stock on Thursday were right, that the company is overpriced. We'll see. As the company operates and they change their fundamentals, the valuation can go up or down. As mentioned, my decision to buy Roblox was primarily based on how much I like the company, and I still like the company. I think they're very different than other businesses out there. Video games and the development of video games by the legacy players like Activision, which is now part of Microsoft, or Electronic Arts, that's old school. The new school is what Roblox is doing, which is creating a platform and then having developers develop their games and then sell their games on the Roblox platform. I really like the whole model. And I think that a player like Apple would love to own Roblox, or Disney, or somebody else. So I continue to really like the company. The balance sheet's in great health. If you have zero debt and you have a really nice balance of cash, you're doing great. In the case of Roblox, they continue to generate free cash flow. So the balance sheet is in great shape, very comfortable around that. The discount is not there for Roblox. And right now at an 18% premium, that's just too high for me to pay to continue to accumulate shares of Roblox. I'm going to hold on the stock, just hold the shares until the fundamentals change, the valuation changes for the better, or if it changes for the worse, I may have to sell my shares in this company. Thank you for watching the video. I hope you found it interesting. I'd love to hear what you think of Roblox, what you think of their business, and what you think of the earnings for Q1. Did you think it was overdone that it sold off so much? Or do you think it was right? I'd love to hear your opinion on that. Thanks again for watching. Good luck investing in 2024. How can you retire and have a lifestyle and the experiences you're looking for in that next phase of your life? If it's after you stopped working, sold off a business, or maybe got an inheritance, or something happened to give you enough money to take that next step in life. It's the principal reason why people invest in many cases, if not the majority. That's one of the reasons I started to invest as a young man and continuing to invest and become a better investor, is to really be in a power position once I retire, to retire comfortably, do the things that I want to do, help the people that I love. In this video, I'm going to be covering the overall plan to retire. In this case, to retire early. And early, you get to define. I have a friend that retired at 42, and he's been really happy. And he retired a while back. He's a little older than I am. He retired a while back. And I have friends that have retired recently. So when the time is right, I will do the same. And I wanted to share with you some of the thoughts I have as I've taken the journey of saving up, investing, and setting up my retirement on the horizon. Allow me to introduce one of my sponsors, Moomoo. They're offering a special offer to new account holders of Moomoo that's pretty good. They'll pay account holders 8.1% for 3 months as an introductory rate, and then pay 5.1% after that. They'll also provide 15 free stocks if you deposit $1,000 or more. Those 15 stocks could be quite valuable. Their typical value per share is between $2 and $2,000. I signed up and I'm looking forward to receiving my free stocks. If it's something you want to take advantage of, please look at the description of this video. There's a link there and you can get signed up. Thanks. The first topic of retiring is earning money to have a very good balance going into retirement. No matter what age, whether you're just starting your career or you're in the middle of your career or you're towards the end, finding ways to make more money is one of the keys that I would recommend. Early on, I had that as an ambition. I knew that I wanted to make more money so I could save up more money. And I did so. I always took on more responsibility at work. I educated myself a little further. I got a master's and continued to just take on challenging roles that ended up being more financially rewarding. So overall, that's one of the keys, is making money so you can save money and then set up a really good balance going into retirement. After you've earned the money, which is the hardest part, is it's key as you go is always save 10% or more of what you earn. If you do that, a couple of things are going to happen. First, you're saving up, which is a good discipline. And second, you're living within your means. You're buying things that you could afford with 90% or less of your take home. That's a very good discipline for life. Oftentimes, people really get caught up in debt, and debt is terrible. Debt can really take away one's flexibility and freedom. So I encourage you to really live within your means. And if you can save 10% or more of your take home, you'll be in great shape. That's advice that I received when I was in college. And I received it from a pretty wise person who was maybe 15 years older than I was. And he's done really well. I really appreciate that piece of advice. And I wanted to pass it along to you as well. So I'm sure that whatever occupation or business you run, there was a learning curve involved. And it may be a pretty long learning curve. For example, if you're a doctor, it took many years of education. Then you had residency. Then you went out and practiced. And maybe you've been a doctor for a while and you're doing really well. It just took a long time to be a successful doctor. Or if you're running a business, maybe the first couple of years of the business were really tough, and then followed by a couple of mediocre years. And hopefully you're doing really well now. There's always a learning curve. Investing is the same discipline or the same body of work. You just don't roll out of bed, become a good investor. You've got to learn. And YouTube and the internet make learning just so much faster and better. 30 years ago, I had to really read books and get magazines and newspapers. I read the Wall Street Journal, and it really set me up to really concentrate and focus on investing. And I learned as much as I could. I would say that learning today is far faster because no matter what topic, you can search it on YouTube or on Google, and you'll have plenty of information to learn. So learning is a very important phase of building that great retirement. Now, learning by doing is very important. You can't just, keep studying and never get into the game. You have to begin to invest and begin in a comfortable zone, but continue to just grow, continue to take on a new type of investment. You don't have to jump in head first. Maybe if you've never bought an individual bond, study it up and then buy an individual bond. What if you've never bought a ETF or an individual stock that was a growth stock? So really challenge yourself to continue to grow and become a better, more well-rounded investor. For example, we're in a market where stocks are a little expensive, and I'm most comfortable when I can find a good value stock that I believe in their business and I see that stock go up over time. That's pretty much the most typical stock that most investors want to invest in. But what if I can invest in another alternative asset? Let's say a cryptocurrency. Well, I've been learning quite a bit about crypto, and I started learning about crypto about 8 years ago. It was really early in the game, and I really studied it up, understood, which coins are what and how they tend to behave. And I've been a successful cryptocurrency investor. The returns have been great. And that's an example of really growing into a space that I didn't know before. I encourage you to make a big investment in yourself by learning online, reading books, and then putting that into practice and setting up a pretty good learning plan for yourself and try just to become better and a bigger investor, investing into different asset classes that really put you in a place where you diversify really well. You really empower yourself with knowledge in ways that you can make money, because the better you grow your investments, the more you're going to have. And then setting up your retirement years, if you're really knowledgeable on a variety of investment types, when you do retire, you're going to be able to get better performance out of your portfolio and probably live more comfortably, probably do extra travel, probably support the people you love a little bit more. So learning should be one of the biggest investments you make as you take the journey to retirement. The more learning, the more hands-on trial and error that you complete, the better off you're going to be. You're going to be empowered with great skills, great intuition about investing, especially when you do retire and you stop earning income and you start depending on those investments. I recommend that you create a retirement model, and it's available through just about every typical broker provides a retirement model. Speak with your advisor. They probably have one. And some of them are rather simple. You could also hire an advisor that could help you prepare a retirement plan. They oftentimes call it a plan. I'm more mathematically minded, and I call it a model. It basically says, hey, this is my age, and I'm thinking I probably want to retire around this forward age, and I have 10 years, 20 years, however many years before that date. Show me a forecast, show me a projection of how I can get to that point and live comfortably. That's really important. So you understand the numbers, the math, how much you're saving, and really set that up. I've met with professionals, and I'm a pretty advanced investor. I'm very advanced with modeling, computer, software, and all that good stuff. But I really appreciate getting another pair of eyes and advice from some of these advisors. And these advisors may be provided to you for free. I know my brokerage provides free advisement services, and they tend to be pretty good. They don't get into the nooks and cranny of my plan, but they do have some pretty sensible ideas and suggestions that I listen to. I create a model and I review it once a year with that advisor. I've also paid professionals in the past, and that was productive, but it was expensive and I didn't do it for very long. So creating a retirement plan and a model is key so you can see the numbers and see how you're going to get to that final state. As you think about retirement, think about the retirement you want to have, the experiences you want to have, and really define that lifestyle that you want to have. We really get, you know, overwhelmed with the images of people retiring and they're sitting on a beach in a luxury resort 365 days a year. Now, I would say that it's fun to travel to resorts like that, maybe for a week or two, but I would really get bored. I'm more of a, hey, I like hiking in the wilderness. I like experiences that range from, you know, beautiful, pristine, you know, forest to riding the subway in New York. I'd like to do a bunch of that stuff when I retire. And I want to define the experiences that I'm going to have in retirement and the lifestyle that I want. You know, some of the best meals that I have are at pretty affordable establishments, but it's really the company that I have with me that make the big difference. If I get my two sons and my wife out to dinner and we eat tacos for a pretty good price, I'm as happy as I can be. It doesn't take, you know, a really expensive restaurant to make that experience really, really fun. So really, I encourage you to define, you know, the retirement that you want to have. Really be clear about what's important to you and how you want to take care of the people that are important to you, and maybe disregard a lot of the images that we get about retirement. I'm not a golfer, as an example. Some people are. I think they have a lot of fun with it. Great. But I'm not going to pick up golf when I retire. I'd rather go for, again, a nice hike or a mountain bike ride in the wilderness, or go volunteer, you know, somewhere helping, you know, the community. Those are the things that I aspire when I retire. So earlier on, I talked about investing in learning to become a better investor, become better at making money from your investments, and just really empower yourself to find ways to really generate that income that you're going to want in retirement. The next thing that I really think you ought to invest in, which is outside of buying stocks, bonds, and all kinds of investments, is your health. Investing in your health, it may be the best return on investment that you can get. Let me give you an example. If you lived another 5 years and you worked for another 5 years, you ran your business for another 5 years, or you were just a better investment for 5 more years, those 5 years are probably worth a pretty penny. I know, looking at my life, 5 years is a lot of earnings. It's a lot of money. And I can get there if I exercise, eat right, sleep right, live right. And oftentimes, you know, people abandon health to really pursue economic goals. And I'm not discouraging anybody from, you know, trying to get to economic goals, but I would say that if your health is always there, you're gonna probably live longer, live better, work better, and be able to do it longer. And that in itself has great ROI. And let's face it, what's the sense in saving up, investing right, retiring, and then, you know, dying shortly after? Well, that would stink. I'd rather retire and live another 30, 40 years. That's my plan. But I'm not going to get those 30, 40 years unless I exercise, eat right, sleep right, live right. So investing in your health, you're going to get a great return on investment. And that's one thing that I would say should be a part of the retirement plan. So I hope that you found my video on retirement interesting, and I appreciate you watching. I'd love to hear from you and see what other topics you'd like me to cover that relate to retirement. It's something that I have on my horizon and something that I've been working on for 30 years. So as I go to the next phase of my life, I'm really excited and I feel like I'm prepared. And, you know, I wanted to share just some of the things that I picked up along the way in my journey. And again, I hope you found it interesting. Starbucks is a stock that's been sold off in 2024. It's down 22%. This is the number one premium coffee restaurant in the country. I like coffee with regards to profitability. If you think about the complexity of making a good cup of coffee, it involves grinding beans, using hot water, and then yielding a really good cup of coffee. Starbucks does much more than that. They sell a variety of premium drinks. They'll mix up a delicious beverage and charge you $8, $9 for it at the same time. They also sell food in their restaurants as well, but it's usually somewhat prepared food that is then served in the restaurant. So their cost model, I really like. If you compare Starbucks to a McDonald's or something else, I think the Starbucks model is far more profitable. So I really like that about them. I also like that they are the dominant brand. Something about the top player in an industry says a lot about a company. First, they got to be number one because they did something right. They probably did a lot of things right. They also got there because customers like them. They want to go back and buy more of their product or services. And that's certainly the case for Starbucks. Now, I began to get interested in this stock when it sold off. When a great company gets sold off, it might be an opportunity to come in and buy some shares and see those shares go up in value. I'd like to analyze Starbucks. They announced their earnings last week. I have a fresh set of financials, and I can go through my process and see if I think Starbucks is discounted, fairly priced, or being sold at a premium. That'll affect my decision with the stock. I'm currently a stockholder of Starbucks. I own shares. So I have to decide whether to hold my shares or sell my shares. So I'll share that conclusion with you at the end of this video. So Starbucks is a pretty big restaurant, $83 billion in market cap. They have $36 billion in sales, which makes them a pretty big operation. They pay a nice dividend at 3%. So income investors are probably liking Starbucks. A variety of analysts cover them. They're saying, hey, Starbucks is a buy, and they're discounted by 23%. Let's see what I end up calculating for this stock. Financials for the company, historically, they've just been a great growing company, growing year after year. The COVID year, I'll give them a pass. We had COVID, social distancing, and all that good stuff. But years since, they've been growing nicely. This is a big operation. So when they grow 2-3%, that's huge sales growth compared to a small restaurant company. Overall, they produce really good free cash flow, and they did not disappoint in the trailing 12 months, producing really good free cash flow for the company. The most valuable companies on the stock market produce free cash flow, and Starbucks produces really good free cash flow. So that looks good. I'll use free cash flow for my valuation. I also use the earnings per share. Looking at a forecast for Starbucks, 20 analysts cover the stock, so plenty of exposure for the Starbucks stock, and their average price target is 23.5% above the current average price. Very good to know. Their earnings per share for this year, 2024, is expected to be $3.67. It's also expected to keep growing in the future. Very nice, very good forecast. So I'll use those numbers in my valuation because I value based on free cash flow and based on earnings per share. Starbucks is another American success story. Somebody who really liked coffee, had an experience in Italy that he wanted to replicate here in the US, started Starbucks a long time ago and really grew the company. Their stock has really risen. If you bought the stock way back when, you'd be a happy camper. You would have really multiplied your money times a particular factor. But recently, in the past year, you've seen the stock really come down, and you've seen the stock sell off. In fact, just in the last 9 months or so, stock's down 31%. This is a really good company. So when I see a discount like that, I get really interested. Is this a good buying opportunity? How desirable do I think the Starbucks business is? Well, I like buying companies in this green quadrant. They have strong, wide moats, almost a monopoly. They get to control the amount of revenue they sell. They have lots of demand for their product or their service, and they get to control their margins and produce really high free cash flow. Those companies that fit into that green typically are the most valuable companies, or will be one of the most valuable companies on the stock market. Starbucks has a lot of advantages to it. I really like that the brand is recognized pretty much ubiquitously in the US and even internationally. They have a really good network model and network strength. Their brand is awesome. I also like their profitability. And I think it's hard. Other businesses have tried to compete against Starbucks, like McDonald's, Dunkin' Donuts, but no one's really come close. So I'm going to put Starbucks somewhat between the gray, which is a business that competes with other restaurants, and the green, which says, hey, they are like other restaurants, but different and better. And they have certain characteristics that are very, very competitive and will keep competitors away. Let's face it, for a premium cup of coffee, Starbucks is the place to go versus the other companies. I also like their model. I also like, one thing I didn't mention is the member program where people have an app on the Starbucks, they download the Starbucks app on their phones, they load it with credits, and they buy their Starbucks and have a very good loyalty program. That is awesome. If you look at their balance sheet, you see how much cash they hold for those customers. Most customers have that app downloaded. I certainly do, and so does my wife. I ran a valuation on Starbucks to arrive at a stock price that I think the company is worth based on free cash flows as well as earnings per share. Based on free cash flows, if I use their first 3 quarters of their current year, then annualize it, I get an 18% discount on the stock. That's a good discount on a very good company. And if I use earnings per share, coincidentally, I get the same discount level using their earnings per share that I expect, the PE of 22 and a growth rate of 8%. So the discount average and blended discount is 18%. On a quality company, one shouldn't expect to get an outrageous discount. You're getting a quality company. Even paying a fair price for a company you want to be a part of is a good idea. An 18% discount is respectable, and I'll consider that as I make my decision to buy more shares, hold, or just sell my shares of Starbucks. So should I buy, hold, or sell Starbucks? Let's take a look. So first, the company. Do I like the company? Do I want to be a part owner? Do I think this company really is going to have longevity and be worth a lot more money in the future? The answer is yes. I really like the business. I think selling premium coffee is very profitable. I like their brand. I like that Starbucks is recognized pretty much everywhere. I also like their membership program, their loyalty and rewards program. That's really good. I bet you they can do a lot of marketing and programs to really generate more income and really keep that loyalty up for Starbucks. The balance sheet's in great shape. Their debt to EBITDA is really low. I believe it's 1. It's very low. I want it to be less than 3. And the discount's very respectable at 18%. I also like that dividend. I'm not a big income investor, but I like that they're paying out a nice dividend. It makes it an attractive stock. Overall, I like the discount. I love the company. So I'm going to keep buying shares of Starbucks, really build up a nice position. I like having really top companies, and Starbucks is clearly the #1 player in premium coffee restaurants. I'd love to have them be a nice, sizable position in my portfolio. So that's my video on Starbucks. I hope you found it interesting. Keep in mind, I'm an individual investor. I'm just sharing my experience. I'm not recommending you buy, hold, or sell Starbucks. Please make your decisions independent of this video. Thanks again for watching. Good luck investing in 2024. Healthcare, I think, is a fertile market. I think healthcare has the ability to sustain recessions, right? You're going to go to the doctor whether the economy is good or bad. It's not a discretionary spend. It's oh no, I have this illness. I have to go get treated. Then I have to buy the pharmaceuticals that they recommend. I have to take care of myself, maybe buy some healthcare related devices that are going to help me with this condition should one get ill. So healthcare, I think, is a place where I continue to buy into. I think it's somewhat early in what I think is going to be a good trend in healthcare. So I'm going to keep investing in companies that are healthcare related. Eli Lilly's just been a phenomenal success. And I did not understand how powerful the weight loss drug was going to be. And I kind of missed that stock, but whoever was in that stock, man, congratulations. That was a big winner.
It's hard to bet against it, but there is precedent.
Todd, this doesn't seem right to me.
What's
The
that?
semiconductors are now the largest industry group in the S&P 500.
Oh yeah, this is index evolution, right?
And
So
it's
NVIDIA,
it's Broadcom, Qualcomm, AMD. These are big stocks.
No, but within all the other tech giants, what industry groups are they in?
So there's software, which is Microsoft and Salesforce, Oracle, Adobe, and then Apple's in hardware, along with like Hewlett Packard and Dell.
Tiny
It's
companies.
just Apple, yeah.
Yeah, okay.
But so semis, 10 years ago, semiconductors were 2% of the S&P 500.
What are they now?
2%, 13, 12.
So it's the largest industry group.
Yeah.
That seems a
So
little
the
crazy.
second, the level below sectors, if you want to get more granular.
I actually would bet that could mean revert more than overall.
Semis are super cyclical.
You can see semi.
Yeah,
you could see that the semi. What is it? 13. What do you say? It's 13%.
Yeah.
You could see that easily coming down to 8. Like why not?
Oh, totally.
Yeah, I agree with that.
Especially if Nvidia goes through a hard period.
Or if some other sector. So you need two things to happen. You also need some other sector to rise up and take the place of the.
Yeah. Wait, what is it?
Again, we've seen Chevron and Exxon outweigh everything else in the market. We've seen financials.
I was about to say financials.
Yeah,
Look,
but-
how about this? Over the next year, financials will flip semis.
Oof.
Uh,
Interesting bet.
wait a minute. So
It's hard to see, but
where was the peak? Oh, look, do you see where Exxon and Chevron are in
Yeah,
2008? Like I'm telling you, that those were the stocks that everyone was
no, I
talking
believe
about.
it. I just don't
Yeah.
think that Chesapeake Energy was traded by common folk the way that they trade out.
You have no idea.
Okay.
I'm telling you that this
Very-
was. I'm telling you, this is
I
the case.
would disagree to disagree.
Oil prices are up substantially, and that is going to create big profits for big oil companies and big energy producers. Let's face it, we need energy for just about everything. We need energy to run YouTube. We need energy to run our computers. We need energy to run the stock market. The big AI push, you can't do that without energy. You need energy to run cars, to run infrastructure, you name it. We need oil. And I know that oil could be a political topic. I'm not going to go there. I'm just going to be with the reality. People on Earth use oil to power just about everything. The increase in oil prices creates a very profitable scenario for oil companies. And it's nothing new. The richest man on Earth for a while was a big oil baron. And he created his wealth by having a monopoly on oil. Now we have what I would call an oligopoly of big oil companies like Chevron, Exxon, and others that become very profitable. They pay very high dividends. Now, in early 2024, this sector is performing great, paying very good dividends. Yet it's not getting the airplay that you see with AI or technology and other topics that are quite interesting. But at the end of the day, not only do I want interesting investments, more importantly, I want to make money in 2024. And I think I can make good money from the energy sector in 2024. I want to talk about this sector, share with you what I'm seeing in the sector, and how I plan to profit from big oil companies in 2024. My first job out of college was to go work as an accountant for a big oil company. And it was a really interesting experience. Back then, per barrel, the oil price was $16, and we're up to $86 per barrel. So much higher than way back when. And more recently, over the last 4 months, we've seen that oil has really gone up 26% just in the last 4 months. And when you see the price per barrel go up, that means that an oil company, their top line revenue is going to go up by 26%. That means their profits are going to expand. That means cash flow immediately increases. So it makes oil companies that much more valuable. Oil is really looked at because it has a big effect on the economy. If you have very high oil prices, it really shrinks the profits of companies that need a lot of oil. And just about every company needs oil. You think about UPS, they need gasoline and diesel to power their infrastructure, to get packages to their customers. You look at Uber drivers, they need gasoline to drive passengers. I mean, just think of just about every industry, they need energy, they need oil. That said, if it's too high, it really affects the economy. Right now at $86 per barrel, it's beginning to affect the economy. Now, buying an oil company can have a good hedge against high oil prices. The reason for it is if you own an oil company and we have a condition of high oil prices, then you have an automatic hedge. Yeah, the economy is going to slow down because companies are having to deal with a high oil price, but your oil company stock is flying up in value. They're also paying you really good dividends because they're making lots of money. So it's a natural hedge. One of the reasons why I hold a pretty good position in one oil company that I'll talk about later. The big rise in oil prices has really made the energy sector the top performing sector against all other sectors in the past month, even better than communication services that has Alphabet, Meta, Netflix in it. It pretty much doubled the performance in the last month if you look at the last month performance. And you think about an appreciation of 14%, that's phenomenal. Most of these companies also pay a very high dividend rate. In the case of Chevron, they pay more than a 4% dividend. So add 4% on top of a 14% yield over the last month. That's a phenomenal return. And if you look at year to date, it's not much higher than the 14%. So this is more recent. This is a recent push on oil prices. Over the last 10 years, the return hasn't been all that great. I think a good part of that is the COVID year, which really sank oil prices. This is a market that as oil prices go up or down, so does the value of an oil company. So it is a volatile industry, but right now it is top of the stack if you look at the last month. Let me take a closer look at 4 companies within this sector: Chevron, Exxon, Shell, and Occidental. I own Chevron. I've owned it for a long time. The oil company that I went to work for, went straight out of college, was acquired by Chevron and is now part of the overall Chevron company. So I've owned my shares for a long time. I also owned Exxon in the past. So just to put that out there. For the past month, Chevron is up 8%. Nice return for 1 month. Exxon is really doing great at 13%. Shell is up 11%. And then Occidental, which is Warren Buffett's one of his favorite stocks, is up 13%. Year to date, the companies are doing well. Chevron's up 8%. Exxon is up a whopping 18.5%. Shell's up 8%. And then Occidental is up 15%. Keep in mind, Chevron, Exxon, and Shell pay a really high dividend rate. So appreciation and income, really good recipe for having this type of company in my income portfolio. I'm glad I have Chevron. Occidental doesn't pay as high of a dividend, but it's certainly showing great appreciation. Warren Buffett continued to buy into Occidental in 2023, and he's looking again like a genius, which he is in investing once again. I try to have good diversification in my portfolio, and having a solid energy company like Chevron, which is a big position in my portfolio, has always been a good idea for me. It does a couple of things for me. One, it creates really good income because Chevron pays a nice dividend. 2, in case oil prices rise, which would affect the economy, it's a really nice hedge to have an oil company that's going to benefit from that rise in oil and appreciate. So that's a double reason why I like having Chevron in my portfolio. I hope you found my video interesting, and I really appreciate you watching. Welcome back, value investors. Semiconductor stock prices are really high. I thought they were really high 6 months ago, and now they're even higher, to the point where I think it's just way too overpriced. And I'm expecting that this space is going to repeat history and really punish investors that bought into companies that were overpriced or maybe stayed in a stock too long. And I'd like to share with you some information, some historical examples, and some conclusions that I think are going to occur in the semiconductor industry. Now, this video is not meant to badmouth any of the companies I'm covering. I think all the companies that I cover are exceptional companies. I'm just a value investor, and I love covering companies and getting a fair price on a great company or a discounted price on a company that is on the rebound. And in this case here, I just believe that the semiconductor industry, the prices have gotten way too high. You cannot substantiate the prices that these stocks are being sold at. And I substantiate it by doing a discounted free cash flow analysis, earnings per share. And I'd like to share a few examples of that. I'd also like to share historical information that leads me to believe that in the semiconductor industry, this has happened before. And the fall was very painful. And I'd like to show that example to you. I'd love to hear what you think. Please provide your comments. Please keep it positive and productive. I'm a value investor. I'm sharing my analysis with you. I'm not recommending you buy or sell any of the stocks I cover. I'm just sharing my journey as an investor. And hopefully it's helpful to you to hear one more investor's opinion on an industry and how I go about investing in companies. I'd love to learn from you, and I would really appreciate comments on this video. Now let's get into the semiconductor industry. Over the past year, the S&P index has done really well. It's up 27%. And a good part of that rise is because the catalyst has been information technology. Information technology has been the number one sector within the S&P, especially those large cap stocks. Within this sector are certain industries, and I wanted to go deeper into what industries make up technology and the performance that I'm seeing in those particular industries. So information technology as a sector is up 56% in 1 year. Year to date, it's up 13%, 3 months, 19%, over the last month, almost 6%. But if you look at the semiconductor industry, which is part of the sector, over 1 year, it's up 131%. Incredible. And year to date, it's up 44%. In 3 months, up 64%. Why is it going parabolic? First question is 131%. And again, the compare is between early March of 24 to early March of 23.
we were already out of the trough period in 22, maybe by about 5 months. So it's not comparing to a low point. And my logic would tell me that the semiconductor industry, it didn't automatically start selling twice as much revenue and generating twice as much profit and twice as much cash flow. Nowhere near that. One company is doing that, and that's NVIDIA. And I'll cover that example independently. But in general, this just looks really out of whack. Why is the semiconductor industry, the prices on stocks for this industry so darn high? I wanted to take a close look at one of the biggest ETFs for semiconductor companies. And I looked at the semiconductor ETF that had the most history. This ETF goes back into the heydays of the dot-com bubble. And it shows that back in the day, the semiconductor companies really did see a very big rise in stock prices that was followed by a 78% drop in this ETF price. 78%. Recently as 2022, the semiconductor industry had a drop of 44%. This industry is cyclical. There are boom periods and then bust periods. This shows two bust periods clearly. The other thing I'll point out is in the dot-com bubble era, that 78% correction, it would have taken an investor that bought at the high basically 17 years to get back to even. That's how far down it went down. Now we're seeing this parabolic move in this ETF. And it looks to me, I'm suspicious that this is just, a lot of this is artificial. It's not based on revenue growth, profitability growth, free cash flow growth. It's really speculation that the AI craze is going to be something big. Not sure how big, but it's going to be big. Well, I can't put a number on big. I could just put a number on, cash flow projections and so forth. And this, again, is evidence that a move that we're seeing in this ETF very recently, this parabolic move, is evidence that, hey, we are probably seeing a pretty good bubble within this industry, and it's likely going to either pop or the air is going to be let out of this bubble at some point. One company that's been there for a long time is Intel. They've been a semiconductor company for a long time, and they rode the dot-com boom. And think about the demand on Intel during that period. A lot of people were buying PCs for the first time in their lifetime. Businesses were buying PCs, pretty much across the board to make their employees more productive. Students went from learning strictly out of books and paper, to using computers to write their term papers, to do all the different arithmetic and mathematics and sciences. So the build of PCs, to put PCs in the hands of all the different users, the variety of users, was massive. And you look at Intel's rise, it was parabolic. And the fall of Intel was painful. From the high that they experienced around the year 2000, and really over a couple of years, the stock dropped 77%. And Intel's never regained the price that it was trading at. So that's really incredible to see that if you're an investor in Intel at the peak, you're still losing money. And that was 23 years ago. That's pretty incredible. And as I look at the rise in, for example, NVIDIA, it's taking on this type of curve. How far will it drop? I don't know. But there's no stock in the history of the stock market that stays on a rise of this steep angle. It's impossible. At that rate, an NVIDIA-like stock would probably represent half, if not 3/4 of the value of the stock market, which would be not beyond ridiculous. It's unimaginable. So I wanted to show how Intel, historically, what happened when the stock got really pumped up for good reason. PCs were being sold. The main CPU that was being used by computers was made by Intel. There was humongous demand. There was real demand for Intel, but the stock just got ahead of itself by a big margin. Here's a list of the individual companies that make up the semiconductor industry. And these, starting with NVIDIA, this company was worth 1/4 of what it's worth today 16 months ago. It's up 300% in 1 year. Incredible. I've done a video on NVIDIA recently. It's on my channel. And I believe that there's a premium on NVIDIA of 30%. My determination of value in NVIDIA takes a very optimistic outlook on what they're going to do with their revenues, free cash flows, and earnings per share. So it's not like I'm intending on making them look, less desirable than anything. I think my video was clear that I'm taking an optimistic position on NVIDIA, but even with an optimistic position, I just think the price is way too high. TSM, I've owned TSM for years. I made money on TSM. I tripled my money on TSM and then sold my position. They are the second biggest semiconductor company in this industry. And I've done a TSM video on my channel as well. I believe they're overpriced by 40%. Broadcom is a stock I owned up until the October timeframe of 2023. Good company. I thought that they had a very good proposition for an investor, good dividend, good free cash flows. And their stock is up 130%. I exited Broadcom with a very good gain. And I've seen the stock rise even further, which is good for all the stockholders of Broadcom that stayed. Congratulations. But I just think that stock's just really run up. I don't understand how Broadcom has a direct connection to the AI business plans. I understand how NVIDIA GPUs have a direct path with the AI build out. I think Broadcom will benefit from it, but Broadcom has a variety of businesses. They built their business with the wireless, smartphone industry. So that was another unexplainable reasoning of why the stock price was just flourishing in the AI craze. So I exited Broadcom, and although it's interesting and a bitter pill to swallow, frankly, that I didn't participate in the latest, 5 months of the upside on Broadcom, I believe that the stock is overpriced by 22% at this time. And they just announced their earnings. And when they announced their earnings, I took their financials and I updated my analysis. I also used a very optimistic point of view so that I would see, can I get, what valuation do I get if I think that Broadcom will execute on their business the way they intend to? Now, Broadcom's guidance for the rest of the year was not good enough, and the stock dropped almost 7%. It also brought all the other semiconductor companies. This is Friday's trading. It just closed. And, one day doesn't give you a trend, but it's interesting to see how, they exceeded expectations on their earnings, meaning they had more profit, better cash flow than expected, but their forecast wasn't good enough, because I believe the price that people are putting on Broadcom expects phenomenal growth, and all they can do is deliver good growth. So we'll see how things play out, and we'll see how the Broadcom stock goes. The last company that I have done a valuation on is Intel. I believe Intel is overpriced by about 10%, and Intel is up 83%, but that's a different, kind of bag of worms. Reason for it is Intel has had their fair share of business problems, and I think they were recovering from a very low price point. And I think they're going to participate in some of this AI build out. I think they'll benefit from it. But that's where I stand there. Just pointing out some more examples. AMD is up 157%. I haven't analyzed AMD, but I would imagine their revenues didn't go up by 157%. Their profitability didn't go up by 157%. It's not expected their free cash flows are going to go up by 150%. So what substantiates a move on the price of 157% on an Intel? So there are other examples here just showing just the humongous move of these stock prices within this industry. So it leads me to believe that there's just the AI hype has gotten out of control in the semiconductor space. And this is troubled waters that I'm going to be careful as I look at companies that are in this industry. So I took the 5 biggest companies, and I'm going to look at the charts of these companies. The one-day chart, as mentioned, Broadcom exceeded expectations on their earnings, but their forecast wasn't as good as investors wanted. The stock dropped 7%. So it's not my imagination that there is concern that prices are too high. When a company exceeds expectations, but the forecast is just not good enough. It was a good forecast, but they didn't restate it and say, oh, we're going to grow even more. So investors were pulling out of Broadcom, and that brought the whole space down. So I don't think I'm the only one thinking along these lines that this space is overpriced. Looking at the same companies year to date, year to date, NVIDIA's up 81%. That's just incredible. It's incredible to see a stock just take off like that. But again, price is what you pay, value is what you get. I wonder if the stock is worth 600 per share. Hell, it might be worth $1,000 per share, but we will see. Father Time will tell us what NVIDIA is worth over the next year to 2 years. Broadcom, as mentioned, it's up 20% after that 7% drop. AMD is up 50%. Incredible. And these other companies are up a significant amount as well, just year to date. Looking at the 1 year chart for the same companies, NVIDIA's up 273%, which is incredible. And they really separated themselves from the rest of the semiconductor industry. And I can understand that, their GPUs are different. Their GPUs are the top performing GPUs, and they're going to be in high demand. So I don't have a problem with them separating themselves from the others, but just the parabolic move that we've seen since January to this point is really, really overdone. The rise in the semiconductor industry has been super incredible, and we'll see how this ends. It'll be interesting to see if it trades sideways for a while and maybe even goes up even higher. That'll be incredible. But I'm not the only one out there really pointing this out. I was watching a respected channel, YouTube channel, one of the big analysts, big respected person. He pointed out that the semiconductor industry, or the stocks in the semiconductor space, now represent 10% of the S&P, 10%. And that's a big portion of the S&P when you consider how many different industries are included in the S&P. So the concern that this space is going to drop is, I'm not the only one out there saying it. I'd love to get your comments on it and understand what you think is going to happen, and would be really interested in reading those. I hope you found the video interesting, and I really appreciate you watching. Welcome back to my channel, Value Investors. In this video, I'm going to be covering the healthcare sector. This sector underperformed the S&P index, but historically, it's been a really good sector. I think it's really going to bounce back this year and probably outperform other sectors, especially the ones that did really well in 2023. The reason I believe that is that stocks in this sector are really discounted, and they're really set to perform in 2024. I'd like to share with you why I'm thinking that and what stocks I'm looking to invest in the new year. Before I jump into the video, do me a favor and like my video, subscribe to my channel, and please leave a comment. Let me know what you think is the best sector for 2024, and please give me feedback on this video. Looking at the performance for 2023, the companies that did the best were communication services, information technology, consumer discretionary. Those sectors did better than the S&P index, and they did really well. Now, all the other stocks underperformed the S&P, which was interesting. And one that underperformed is healthcare. But historically, it's been one of the better sectors to invest in. It's done really well. So I believe that it was sold off in 23, probably far more than it should have. There's really good companies there. And I believe it's going to have a bounce back year, just looking at the data of how it's done over the last 5 years and in the last 10 years. Keep in mind, over the last 5 years, it's done 64%, and that's including the year we just had. So it's really a number that if they had just kept up with the S&P, it'd be far better. So that's one of the reasons why I think the healthcare sector may be the best sector to invest in right now to achieve the best performance for 2024. As a value investor, it's not a matter of looking behind or in the rearview mirror to see what worked and, hey, let's do that all over again. It's really about trying to understand where the market's going, where certain companies are highly discounted unfairly for whatever reason, and buying companies that are discounted. So that's exactly what I'm trying to do with the healthcare sector. Is this sector was discounted,
and there aren't really good reasons for it. There's a lot of good reasons to believe that this sector overall is going to perform better just based on its historical returns. I'm trying to achieve the return in 2024 by doing something to prepare to buy stocks, own stocks that are going to do really well in healthcare in 2024. The healthcare sector has a variety of industries. The biggest one is drug manufacturers. This is companies, pharmaceutical companies. So you think of Novartis, Pfizer, and so forth. Eli Lilly, which is the biggest company in that particular industry. Biotech is a really exciting industry. It resembles technology, which is high growth. These companies make drugs and cures to certain illnesses, and they just explode in value, which is really interesting. And health plan providers, right? So this is United Healthcare, and they pay for all the different services that people get. So this particular sector has a variety of companies. Some of them are incredibly valuable. Some of them are a little more like a manufacturing company. So it's interesting to look at the variety of industries for this sector. In order to find the best companies to look at in this sector, I ran a stock screener, and I wanted to focus on a couple of variables. First, I wanted to look at free cash flow growth over 5%. So show me companies that have growth over 5%, and I don't want the forward price to earnings to be over 25. And last, I want the debt to EBITDA to be under 3. That way the balance sheet's in good condition. And then one more item is free cash flow yield of 7% or higher. I value companies based on free cash flow, and I don't want them to have too much debt. And I want their price to earnings to be reasonable. And based on that search, it came back with a list of 10 companies, and they all look pretty interesting. I did some homework on each one of them, kind of reviewed their fundamentals, put them all through my scorecard in my model, and anything with a check mark, they are potentially a good investment for me. So I'm going to do more information gathering, some more decisions, and then make a decision whether I'm going to buy shares in these companies. There is one company, Catalyst, that I'm already an owner in, so it just showed up on the list, and that one I'm already an owner in. Everything with a check mark, I'm going to show you additional information in this video. Anything with an X means that I disqualified it. It's not an investment that it belongs in my portfolio for one reason or another. Now let's take a look at each company with the green check mark and share with you what I like, what I'm seeing as part of my review of each company. The company that was ranked number 1 on my stock screener was McKesson Corporation. And by the looks of it, it's a really good quality company. Overall, the stock has been rising. If you look at the last 12 months, the company has a market cap of $60 billion. It has a forward PE of 15.77, which is really reasonable. What does McKesson do? In a simple manner, they're a distributor of all things to a hospital, whether they need surgical equipment, drugs, items like gloves, everything a hospital would need. McKesson is their source. They also distribute pharmaceuticals and drugs. So all the things that a hospital, a doctor's office, a large healthcare provider would need. And they've been really consistent. The 1-year chart looks this way. The 5-year chart looks pretty much the same way. Just consistently, the stock price has been going up over 5 years. The other items that I like about the company is they generate free cash flow. That's a qualifier for an investment for me, and they generate really good free cash flow. The revenue has been growing over time, so that looks really good. The earnings per share next year is expected to rise to $31.11. Very good. I also believe that they can have a multiple expansion here where you see, instead of them trading at 15.9 forward PE, they could trade at 20 or so, and that could really raise the stock price. Their debt to EBITDA is very good, high quality company. It's 1.37. I want less than 3, so most definitely it qualifies. The company is a profitable company, generating a good level of EBITDA, which is very good. And overall, it just has a very good profitability ratio. This company has been very consistent for the last 5 years, if not more. So this is a high quality company worth considering to add to my portfolio. and I'm going to do more analysis on this company. The next company I'm going to review is United Therapeutics Corporation, and this company is really interesting. They have pharmaceuticals, they have certain franchises of drugs that are doing really well, and that's their cash cow, a lot of profit. They're also going into xenotransplants, meaning that they are growing organs, and those organs would be grown and then transplanted to a person. As you may know, there's a long list of people looking for a vital organ, and some people die because they're on the wait list and never get an organ. And the prospects of potentially in the future, United Therapeutics being able to provide more organs to these people that need them is really interesting. They're not quite to a commercial state of doing that. It's just this company, that's where they're headed. And it seems really interesting and very futuristic. The company has been trading quite down in the current year. It's down 21%. My comment earlier that high interest rates are discounting biotech companies, and I believe that's the case here, is this is a riskier company that has a very adventurous and optimistic growth strategy, and this company's been discounted quite a bit. They have a market cap of 10.29 billion, which makes them a mid-cap stock, nice small mid-cap stock. Their forward PE is really low, under 10. I really like that about the company. They generate really good free cash flow. Love that. And their revenue has been growing here recently, which looks really good. Next year, their earnings per share is expected to rise to $22.36. And if you look at where they're categorized in the pharmaceutical industry, which is correct, but they also have that biotech component to them. So I think they can have a multiple expansion period beginning 24 and potentially into 25, where you could see their price multiple really double, and that would really cause the stock to really rise. Their debt to EBITDA, really low. Great job, really keeping down that debt. And they're a real profitable company. Their existing drugs do really well. They really bring a lot of good to the people that take them. So they've been very successful with those drugs. This company, I've done more homework on than the companies you're going to see, with the exception of Catalyst, which I'm already an owner in. And this is likely a company that I'm going to buy shares in. And we'll be creating a video on this company individually to show my analysis and why I intend on buying shares in United Therapeutics. The next company is Molina Healthcare. And this company is a little different than the ones I just showed. These guys are managing a lot of the Medicare, Medi-Cal programs. So they're somewhat of a healthcare payer-like company. They have a market cap of a little over 20 billion, so it makes them a mid-cap stock. Their forward PE is nice and low, below 16, which looks good, better than United Healthcare as an example. And for the past year, the stock's done okay, up 7%. But that's my point on the healthcare being discounted. This is a growing company, low PE, and their stock price really didn't keep up with the S&P in 23. So to me, that's an opportunity. Their growth rate on revenue has been phenomenal. Look at that growth rate. Awesome. And if you look at their free cash flow, they generate a lot of free cash. So very good to see high cash flow generating companies. Their PE is going to grow, their earnings per share is going to grow in 2024. It's expected to be $23.87. Now, they have a PE multiple of 15.8 times forward earnings. The industry is at 17. So I think they could see a little bump on that multiple in 2024. Their debt's under control and less than 3 times EBITDA. Molina is likely going to be a stock that I add to my portfolio. And because they're just a really solid company, I like that they're a mid-cap stock. I owned United Healthcare for a long time, did really well with it. It just got so darn expensive and big that I begin to think that someday there's going to be a reckoning with United Healthcare. I like little companies, or I should say smaller companies, that are set to grow and really kind of grow into a pretty significant market cap. Molina may just be the company that does that, growing from a $20 billion market cap up to like a $50 billion market cap. I could see that happening for this company. And I'll be doing more analysis on Molina, likely in buying shares of this company. And you'll see a video of this company in the next 30 days or so on my channel. Sensora is a distributor of healthcare products, so everything a hospital would need and so forth. Similar to McKenna that I showed earlier in the video. And this is just a smaller version of that, but they're a good company. They're about a $40 billion company. Their forward PE is going to be 15.59%. This year, their stock's done okay. It's up 20%, not keeping up with the S&P, but far better than other companies in this particular sector. Their growth in revenue is really good, really nice growth in revenue. Their cash generation is very good at $3.45 billion per year. Their earnings per share next year is expected to be $14.18, and it's growing from this current year. Their multiple is 15.8, and I think it could keep that multiple, potentially grow it, because they are a growing company. And their debt is under control, less than 3 times EBITDA at 1.7. This is definitely a company I'm going to put on my watch list. I'm not ready to buy shares in this company. I tend to like companies that are creating intellectual property and not necessarily just being a distribution company. This is a stable company. It's a good company. I'm going to put it on my watch list. I'd probably wait for a nice pullback to buy Sensora, and because they don't have any IP. If you have IP like a pharmaceutical company or biotech, that intellectual property becomes really valuable and you can make lots of money. In a distribution business, it's much harder. The next company up is Harmony Biosciences. This is more of a biotech company. And you can see that in 23, this company was heavily discounted, even though it has a forward PE of 10.79. It's a small cap company at 1.88 billion, and they've been growing their revenues. They have a focus on some neurological diseases that they really have a positive impact on with their biotech pharmaceuticals. They produce free cash flow already, which is excellent. And their earnings per share next year is expected to be $3.57. Their multiple is really low, and I think it should really be around that 25. They're a growing company, and they should have a multiple expansion year in 24 and 25. The reason why I think the stock's being held back is the high interest rates, and this is a smaller company. So I think investors are a little afraid of investing in a small company. Their debt to EBITDA is really low at 0.92. Harmony is likely going to be a company I buy shares in, and there will be a video on this company in my channel. Catalyst is a company I already have been an investor in. I bought in 2023 because I saw that this stock was really discounted, and I'm doing really well in my investment. It's up really nicely, especially more recently. You've seen some really nice rises in the stock, but over the last year, you can see it's down 14.97%. Again, I believe this sector is discounted for no reason. This company is a good example of it. Their forward P is 13.66%. They have drugs that are really helping the people that are taking them, and really helping people that have these chronic illnesses and rare illnesses that they help with their drugs. The company has really good free cash flow, and their next year earnings per share is expected to be at $1.27, a big increase in their earnings per share. Their multiple should be higher, around 25, and their debt to EBITDA, they pretty much have no debt, which is excellent. So overall, Catalyst has been a good investment for me, and I'm going to continue to buy shares in this small biotech company. So that covers the stocks that I found that were worthy of like additional analysis from the stock screener. Some really interesting companies, especially those biotech companies that I think are really discounted. I'm going to really look closely at those. I'm also going to consider the medical distribution companies that I think are really solid investments long term. I hope you found that list interesting. Let me know what you think of the companies that were listed in this screener. And one last note is I never recommend you buy any stock that I cover. Everything that I do is just one investor sharing his investing journey on YouTube. It is really just from an educational purpose or entertainment purposes only. The healthcare sector, I think, is going to do really well in 2024. And I'll bring you back to decisions I made in 22 that really worked out, principally investments in Meta, Alphabet. They were heavily discounted. Technology was heavily discounted in 2022, and look what it did in 2023. It just blew it out. It just did so well. And I feel the same way, that these high quality companies in the healthcare stock are really discounted. These are really good companies. So for a value investor, this is a really good opportunity. And that's why I'm going to be buying into these companies so that I can really get a nice return in 2024 and 2025. I hope you found the video interesting that I produced. I'd love to hear comments from you. Let me know what you think of the healthcare sector. And please, if you think otherwise, please share that. I'd love to learn from your experiences and understand what you're seeing out there in the marketplace. Do me a favor and like my video and subscribe to my channel. Happy holidays and good luck investing in 2024. How can an investor use short selling to make money, especially in stocks that you feel are way overpriced? That's what I hope to answer in this video. We've seen the stock market really go up for about a year and a half, and it's been great to see stock prices go up. But in the process of finding companies that are good investments, companies that are growing, generating free cash, and overall are discounted, you oftentimes find companies that are the opposite. They are seeing their fundamentals get worse, maybe revenues dropping. Maybe their products are just not becoming desirable. And those stocks still are trading really high. Maybe a lot of investors find them popular. Those are the types of stocks that I often consider shorting, which is to set up a position where you sell the shares of a particular stock through your broker, and then you wait for the stock price to go down. If it goes down, you make money. If it goes up, you lose money. So it's the opposite to buying a stock. And I'll go through the process of setting up a short position later. Before I jump into looking at short selling closely, let me share a new partnership I have with Moomoo. Moomoo is sponsoring my channel, and I appreciate that. They're offering subscribers an offer to earn 8.1% on cash balances if you open up an account. That's a really good rate for 3 months, and then after that, it turns to 5.1%. They also will give you 15 free shares of stock if you open an account with $1,000 or more. And each share could be worth $2. It could be worth $2,000. So it's interesting. I've set up my account and I'm still waiting for those 15 shares. I'm curious to see how much they're going to be worth. If it's the right type of broker that you want to open up an account with, I'd appreciate you using the link that I'm providing in the description of this video. Short selling often creates a lot of attention, and movies have been written about short selling. The Big Short, most recently, was Michael Burry's shorting of the subprime market, and it really worked out for him. The thing I'll point out is mortgages tend to be really stable, so he shorted a very stable investment, and he made a lot of money. The other one I'll point out is George Soros. It's been a while since he did it, but he shorted the British pound, another very stable investment. He made about $1 billion on that short trade. Both conditions, they felt, were really good for shorting. And in both positions, they were really the only ones thinking along those lines. It really proved to be a winning recipe for them. Another short that is very recent is a whole GameStop short squeeze. And a couple movies have been made about that already. Roaring Kitty has made an appearance again, and that stock's often flying again. And the short squeeze did happen, and it became really risky for short sellers. And in the short term, short sellers lost a lot of money. Melvin Capital, I don't know if they operate still, but they lost hundreds of millions of dollars. It was a big loss for them. The thing I'll point out is that the smaller stocks and the stocks that are priced really low, that have a lot of short sellers in them, a lot of attention, those are the ones that I sense are the riskiest to a short seller. The reason being is that if you have a very low price on the stock and it's a popular title like a GameStop, I think retail investors and other investors can think about a short squeeze. And if they squeeze the shorts, it could really cost short sellers a lot of money. So the 3 examples I showed is examples where Michael Burry somewhat snuck up on the market and shorted the subprime mortgage market without many people thinking that at all. I think people didn't pay attention, and he just let the markets do what they did, and he made a lot of money. The same thing with George Soros. He shorted the British pound, and people thought he was crazy. But once it started to work, he made a lot of money. In the case of GameStop, in the short term, short sellers lost a lot of money. But I'll point out, over the long haul, the short sellers were right. And I think most people, rational minds, would agree that the GameStop business is really not a part of the future. It's really part of the past. and that stock price is really artificially too high. But overall, short sellers made money on GameStop over the long haul. I'm recording this video on June 5th, 2024. And the market conditions that I'm observing is the market's been up for about a year and a half. And if you look at the S&P, the stocks are about 50% higher than they were about 18 months ago. And in some sectors, in some industries, the increases in stock prices have just been incredible. If you look at semiconductor and other technology stocks, it's pretty incredible. And how about utilities? Boring utility companies have doubled in stock price in less than a year. Incredible. Well, incredible means it's really hard to understand. It's really hard to imagine. I think there's an opportunity there to look at some of those companies and establish a long-term short position. Just a quick reminder, I'm an individual value investor, and I am not recommending that you short any stock. I'm not recommending you buy or sell any stock I ever talk about. I'm not providing any financial advice. I'm sharing with you my experience as an individual value investor and my experience in analyzing and setting up short sales on stocks. Let me look at an individual company as an example, Tesla. Tesla year to date is down 29%. I've done 2 videos on Tesla in the last year. I created one video 9 months ago. I created a video in March of 2024. On both occasions, I felt that Tesla was highly overpriced, and I shared that on the videos. If I had shorted Tesla on January 1st, I would have made 29% return year to date. In a little over 5 months, that's a great return on a stock that I felt was overpriced. That's an example of a stock that I'm finding that is overpriced and really an idea to short. Not a lot of people are shorting Tesla. I think it's a really popular stock. And when the CEO talks, the stock tends to jump up. But what weighs down on the stock price is the true fundamentals of the business. And if you look at their car business, it's beginning to suffer. It has a lot of competition. Cash flows have really gone down. Tesla has become a car company. A lot of people felt they were a technology company, but they're now beginning to see the headaches and the limitations of the car industry. Other rival car companies have come out with great EVs. The Chinese are coming out with great EVs at a really low price. The competition is fierce. And we'll see if Tesla can operate well in the new environment they find themselves in. Setting up a short position, you would work with your broker. In my case, I've been with my broker for some time. And at this time, since I think the market is rather expensive, I've really built up a good cash balance. And I say that because when you set up a short sale, you set it up in a margin account. You have to set up margin in your account, and you actually execute using your margin account. Once you set up a margin account, if you have the cash balance to cover all the shares that you're shorting at the stock price that they're trading at, you don't have to pay any interest. That's one thing that I cleared up with my broker, and that might be an area that there's a misconception on. If you don't have the cash, you would have to pay interest because you're borrowing the money. But if you have the cash in your balance, I think you would avoid paying interest rates. But check with your broker for specifics on how they operate. That's how my broker operates. So I've set up short sales on 2 companies, and so far, so good. I'm in the green on both, and I plan to set up a couple of more. I'm a believer that through diversification, I could lower my risk, and I think overall have long-term success. So I intend on having maybe about 5 short positions, and I'm not going to be in a hurry to set them up. I'm going to be finding and selecting companies carefully, then managing those investments very closely. Now, the upside risk of a short sale is that a stock price goes up. In the example that I talked about earlier, GameStop really went up. It went parabolic, and that really caused a lot of losses for the short sellers. So what I do to limit risk is I put a stop loss order on my short sales. And that way, if a stock begins to rise and rises very quickly, I just sell out of the position. I am not selecting stocks that are going to follow a very erratic forward price. Instead, I'm trying to select stocks that I feel are probably slower moving and I could expect a particular price action on. A little bit like George Soros or Michael Burry. They selected 2 investments that were rather boring, if you ask me. Currencies are really boring. I rarely ever look at them. And then the mortgage business is really boring. I rarely look at that either. But both of them made a lot of money shorting a very stable investment. And that's a pattern that I'd like to follow, is go to investments that I really understand, that I feel I could have a good accuracy in predicting what's going to happen. I'm never going to get everything right. Probably going to be wrong a couple of times, but I have to operate in an area where I feel I'm going to have a good success rate overall. So short selling is one more tool in the investment toolbox to help an investor make money. And as I mentioned, I believe that the stock market is priced rather high, and finding stocks that are discounted continues to become a little harder as we go month to month, week to week. But finding stocks that I feel are way overpriced is becoming more typical now. I'm finding companies that I think there's just no way they're going to have this stock price in a year or maybe two. So I'm going to execute short sales and I believe increase my return overall. Now, I'd like to remind everybody watching that short sales are incredibly risky, and you should really operate carefully and limit the amount you're investing to an amount that you can take a complete loss, and it really wouldn't affect your overall portfolio value and or your lifestyle. If you're a big gambler, I can understand that. I'm not. I'd like to increase my return, but I also want to manage my portfolio risk. I'm only putting a fraction of my portfolio into short sales so I can increase my performance. Most importantly, I like to really exercise the whole art of investing, which is finding companies that I really like, valuing those companies, and trying to determine what those companies are worth. And when I find a company that I believe is worth half of their current stock price or less than that, I'd like to exercise the execution of that conclusion and seeing how right or wrong I was. There's a lot of learning that I could receive out of that event. And that to me is also a big return on investment. I hope you found my video interesting, and I really appreciate you watching. Small caps have really captured investor interest this past week. As interest rates have come down, it's made small caps more attractive to investors. And you're seeing a rotation out of big cap stocks into small caps. It's been something that hasn't happened for a while. Small cap stocks have really underperformed the rest of the market for some time. The way I count it, about 20 months, small caps have not done well. It's probably because in the last 20 months, interest rates were quite high. As small cap companies need to borrow money, they don't have the history, the credit rating to borrow money at a reasonable amount. It puts big cap stocks at a big advantage where they could have borrowed the money far lower rates. That said, now that interest rates are coming down, it makes these small cap stocks more interesting. It makes the finding of stocks that are really growing their revenues. They have very good profitable businesses in industries that are going to have really long lasting success. It becomes a far better idea. I look for small caps that have all the same characteristics as they always do. First, I want to really buy into the business. I want to believe in the company. I want to make sure that company has competitive advantages that will keep their competitors out of their industry, out of their market. The reason for it, the stronger the company is at fending off competitors, the better revenues they'll have, the better profitability, because they don't have to cut their price and cut their margins to compete for business. The fewer competitors, the better the margins. Also look at balance sheets. Small caps that have too much debt are a bad idea. Too much debt can cause a good company to go bankrupt. And you may have a good idea that never worked because the business went bankrupt. Valuations. I still value small caps using the same process and discipline, looking at free cash flows and making sure those cash flows are really good and that they more than cover the stock price. If I look at a net present value of those free cash flows that I expect the company is going to produce in the future. I look at earnings per share. Now, small caps may not be profitable yet. So some small caps may not have earnings per share. And I'm willing to accept that as long as they're producing free cash flow. Some businesses like Uber, they were generating free cash flow before they were profitable. Airbnb generated free cash flows before they were profitable. Those are great businesses that are now well above the small cap level, but show that those businesses were really valuable based on the free cash flows. So it's the same process that I use with big caps. A couple of things that I'll point out that I want to make sure small caps have. First, I expect a higher discount when I do a valuation. The reason for it is a small cap stock comes with higher risk. We all know Microsoft. We all understand it. It's a very good credit worthy company. So the amount of risk I take should I buy a share of Microsoft is much lower than if I buy shares in a small cap company that no one's ever heard of, that doesn't have a great credit rating. So my discount on the stock price has to be much higher. I'm really aiming to have great appreciation out of small caps. I don't buy small caps just to play in a particular industry. There needs to be a purpose, a high yield, high appreciation purpose. Some of these small caps will not make it. That's the reality. But if you have a nice basket of small caps and a couple of those companies really do make it, it could really make the investing in those companies worthwhile. I have a few examples of companies that I currently own or I have on my watch list that are in the small cap basket. The first one is USB, US Bank. Now this one, we could argue that it's not a small cap, might be a small medium cap stock, but this is a regional bank, a little bit bigger than a regional bank. And their fundamentals look excellent. They also pay a really good dividend. I've owned USB in the past, and I think it's a really good idea to consider for my portfolio going forward. DocuSign. This is a clear leader in the digital capture process. Just about everybody's heard of DocuSign. They are the clear leader, and they have market share advantages against all their competitors in that space. Now, this company, the drawbacks are their addressable market and their opportunity to grow into other products may be limited, but they have great revenue growth, great profitability. They generate tremendous cash. Overall, their valuation is really good. I believe the stock price is currently discounted. And I believe that DocuSign is a prime target for an acquisition. So this would be an interesting stock to hold, and potentially in the future, they get acquired and that acquirer pays a really handsome premium on the stock price. United Therapeutics is a small cap that is a life sciences company, a pharmaceutical company. They're doing some really interesting things at that company. First, they have a very successful franchise of drugs that help people with rare diseases. And they generate very good free cash flow, very good revenue growth. But long term, this company is trying to grow organs in a laboratory that would at some point be transplanted to a person that really needs that organ. And they're on the organ donation list. If United Therapeutics is successful, they're going to help a lot of people extend their lives with these organs. If they're successful, just imagine the revenues, the good that this company could do. So I'm excited about that small cap stock. I'm glad that I own it. Catalyst Pharmaceutical is really successful. They're not the biggest pharmaceutical company in the world. They're a small cap, but they certainly are growing their revenue. They're profitable, generate free cash flow. I really like them in my portfolio. For some reason, that stock price, it goes up and down. Although their revenues are consistent, it seems that it's a small stock, so investors forget about it or it gets discounted. Well, now that interest rates are dropping, I think they're going to get more attention. I'm glad that I own Catalyst Pharmaceutical. Zim is a ocean freight company. They're known for moving freight around the world, from China to the US, from China to Europe, all over the world. Zim ships carry cargo and get cargo from wherever it's manufactured over to its end market. They had a great period of revenue and success during the supply chain constrained years, which were a few years ago. And shipping rates were really high. Shipping rates have settled down, and now Zim is at a big advantage because their ships are newer. They bought new ships with all the money they made 3-4 years ago and have a competitive advantage against their rivals by having more efficient ships. Shipping rates have risen due to global factors, and Zim is producing very good free cash flows. They're paying a dividend, and I think they're set to really impress and surprise to the upside on earnings calls. The stock is really doing well. If you look at the 1 year return or the year to date, I think there's much more to go. Small caps don't get the attention and respect. And companies like Zim, when they surprise to the upside, their stocks really fly up. And the last stock I'm going to cover is Chegg. This is an online company that helps students with tutorial services, educational services, so they could learn really difficult subjects. Being a father of 2 sons, I just think that the education process is really challenging for kids. They learn so much. I always think that my kids are learning far more than I had learned at their age. And that type of stress on those kids causes a big need to have a company like Chegg. Chegg has really led in the providing of services to students, both in high school and college levels. And they have kind of a social economy where educators and people that have the right knowledge could actually provide content. And that content is then reviewed by users, and certain ratings are given to the content. A little bit like YouTube, which you're watching this video on. And I think that's really exciting. I think that type of sharing economy, sharing of knowledge, and where the users of that knowledge could then vote and review and acknowledge, hey, this is really good content, or this is a really good content provider. I think all those things have a lot of upside. Chegg has been beaten down. Their stock price is really low. And the reasons for it is that AI could replace them. But Chegg is really working hard to make AI an opportunity and make it a product versus it just being a competitive threat. Chegg stock has really rallied since the small cap rally started. Their stock went up 30% in just a couple of days. It's settled back down, but it really shows that not all investors have forgotten about Chegg, and there is a lot of potential with that company. I really like that Chegg does produce free cash flows. And if you do a valuation on free cash flows for Chegg, I think it really shows that it's a highly discounted stock. If they can show growth in the future, look out. This is going to be a very valuable small cap stock. So that's 6 examples of small cap companies that have potential. Again, small caps will have more risk, and one should expect a higher return than big caps. And that's all reasonable, and it should be taken into account. As always, I make no investing recommendations. I offer no financial advice. I'm just sharing with you my analysis, my observation, and my experience. And I hope you found it interesting. Let me tell you about a couple of sponsors I have. I do all my analysis now on Seeking Alpha. It's a great platform for investors. If you'd like to try it out, there's a free trial available. You can find details on that free trial in the details of this video. I'm also sponsored by Moomoo, who provide really nice offers to new account holders, where they'll pay you 8.1% on cash. They'll also give you 15 free stocks if you open an account with $1,000 or more. Take a look at those 2 sponsors if it's something you're interested in. Thank you for watching, and good luck investing in 2024. Super Micro Computer announced their earnings today, and in after hours trading, the stock is down 13%. This is a stock that's really benefited from the whole AI hype, the big data center build out. And it's undeniable that their revenue really did go up. But what went up in greater proportion was their stock price. Their stock price got much too high. I'm showing a graph of how high their stock price got and how quickly the stock is beginning to contract. This is not the first time a stock's done this. If you look at the dot-com bubble, when it began to burst, you saw companies like Cisco and Intel have similar charts. And unfortunately, in those cases, the stockholders really lost a lot of their value, and it took a long time to ever get back to a portion of the previous stock price. I don't know what's going to happen with Supermicro, but I could just say that the company is not the stock price, and the stock price is not the company. Supermicro has great employees. They've built a really good business, and they're providing computers to the marketplace that the industry really needs. But the stock price just got too high, and it's beginning to come down. I'm here to talk about the stock price. I'm not here to badmouth the company in any way. So let's continue to talk about the stock price. The company has a market cap currently at $36 billion. And after today, it'll be probably around $32 billion once we have any adjustment for the lower stock price. The company has a current P of 34, forward P of 18. Now, what's probably scaring investors is Supermicro Computer is experiencing really good sales, but it's a build out. And once the build out is over, I think the revenue is really going to fall off. And I think that's what investors are beginning to really get their heads around. Analysts are way behind. They think the stock's discounted by 70%. I think they need to update their analysis because it's way off. As we look at that 1-year return, the company is up 79%, even though they're down substantially over the last month by 32%. So this stock really saw a high, and now it's beginning to really come down. Revenues have been going really well year after year. Now they're a smaller company from a hardware perspective, but in 2023, they grew at 37%, then 109% in the most previous year, which just ended, by the way, on June 30th. So that's phenomenal growth. But again, the market believes that it's going to be a build out, somewhat of a one-time event, and then revenues are really going to come down. We'll see if that happens. Cash flow was negative in 2024. Now that's a big deal to me because they're building out inventory, and they're in a marketplace where if demand stops and they're stuck with inventory, cash is going to be stuck in inventory, and that's risky. So that is a concern with the company, that they haven't been a consistent free cash flow generator. And that is a liability with this company, in my opinion. Supermicro provided earnings and their financials accompanying those earnings. And part of the presentation they provided, I wanted to point out a few things. First, in the most recent quarter, their margins went down. Now that's a problem. And you can see that it's a low margin business. Hardware, computer hardware is a low margin business. I guess competition's entering the picture, or cost is going up, but that's a significant drop in margins. That could be part of why the stock is selling off so much. Operating margins much lower than before. So the company is just not a big profitable entity. Hardware companies are not big profitable entities. Net cash. In the most recent quarter, they actually burned through $504 million of cash. And cash from operations has been in the negative for 3 consecutive quarters. That is not good because they're building up inventory, I imagine, and that could really become a liability in the future. So investors are getting out of the stock in the after hours trading and really putting pressure on this stock. Again, it's the stock price that's probably way too high, and it needs to come down to a level that aligns better with these fundamentals and the overall value of the company. Using the updated financial information provided in their earnings, I was able to update the valuation on Supermicro. In conclusion, the stock is 39% too high. The stock price is being sold at a premium of 39%. I get to that conclusion by looking at their free cash flows, trying to get to a forecast that I can believe in of cash flows, and also looking at earnings per share and valuing the company based on earnings per share. Let's go over cash flow first. And what I'm doing is I'm taking 2023 numbers and growing them by 25%. That's an ambitious forecast. And even with those ambitious numbers, which they may not attain, the company would create these cash flows over the next 4 years. After that term, we have terminal value of all cash flows beyond year 4 amounting to $20 billion. I'm going to discount those cash flows. They are a riskier company. You see that they're producing negative cash in some quarters. It's hardware, computer hardware, so that could be very volatile. So I'm going to go with 11%. And when I discount the free cash flows by that rate, I get $14.8 billion. I add cash and take away debt, and I get to an equity value of $14.3 billion. The market cap of the company is $36.5 billion. So when I compare the value per share versus the stock price that they're trading after hours, it's a premium of 54%. The stock price is too high by 54% if we look at cash flows. Earnings per share values the company a little closer to its end stock price, $24.34 per share. I gave them a very favorable 18% PE. Hardware companies usually, trade at around 12, but I'll give them an 18. We get to a growth rate of 10%. Based on those factors, we get a stock value of $481.92. That's lower than the current stock price by 10%. So blended, I believe the stock price is being sold at a premium of 39% or more. Now that's a pretty steep price to pay on a company who's seen its stock price really come down. I'll use that information to make decisions on this investment. I've been evaluating Supermicro for some time, and I've recorded multiple videos. A few months ago, I started a short position on Supermicro, meaning that I sold short shares of the company and have continued to sell more shares over time. At this point, I'm sitting on a 32% gain in roughly 2 months. It's a very good gain. at this point, should I short more shares? Should I just close out the position and take the gain, or should I leave it open? Overall, I think the company could continue to drop in price, and I can continue to accumulate more in the gain column for this short position. I'm going to weigh my decision tomorrow as the stock market trades on August 7th. It's likely that I may close the position and just exit out of this stock. A win's a win, and I had put an exit strategy of 30% on my short position. Whether the stock rose 30% and I lost money to the amount of 30%, or the stock went down and I made money. At this point, I've made 32%. So I'm going to go ahead and close out my short position tomorrow. That's likely what I'm going to do. I'll make the final decision tomorrow. So that's my video on Supermicro. Just a quick reminder, I'm an individual investor. I don't recommend that you buy, hold, or sell Supermicro. I don't recommend you short Supermicro or short any stock. Short sales are very risky. Also, the stock price is not the company, and the company is not the stock price. Supermicro is a good company, and to all the employees, I think they did an excellent job building a hardware company, and I wish you continued success. With that, I appreciate you watching the video, and I appreciate you watching. Solventum real quick, and I could probably tell you about this company by showing what they do. First, they were a spinoff from 3M. 3M is a high quality company. I certainly believe that. I think most people that have been in the business world really respect 3M. They've had their issues. They released some earplugs. They sold earplugs that caused hearing loss for some servicemen and women, which is really bad. But I don't think they meant to do that. And they've resolved that through the legal courts and have paid the money that they should have paid. So that being behind them, they decided to really focus their business, which was a good idea. And they spun off Solventum. Solventum focuses on providing products for healthcare, for surgeries, for hospitals to use. They also have systems that hospitals use to manage the operation and maybe the billing. They also do dental products. So your dentist, when your dentist is working on your teeth and so forth, they might be using Solventum products, which were previously branded with 3M. Now, the company was a spinoff, and it's coming from a quality company, in my opinion, and it's being spun off. Now, some spinoffs have been really, really good. Some spinoffs, not so good. Now, my biggest concern with the company was I didn't have enough data. Everything was being communicated as this is what we think we're going to do. So I wanted to give it a quarter or two because I was given shares because I'm a 3M stockholder, and I sold my shares and said, I need to see some data before I make a decision to buy more shares and even hold these shares. So what I'm going to do is we have the financials from the quarter that just ended. It was reported about a week ago. So let's put this guy on half a screen. Let's get the valuation model. This is for Solventum, and it'll also tell you kind of like how I think about it, right? Solventum is new. It's not as well known, so I'm going to increase the discount rate. I want a higher rate of return because it's an unknown company to this point. It's really unknown how much they're going to grow, but it's going to be modest growth. I'm going to leave these factors here alone. The growth rate in cash flow, this is healthcare, right? Healthcare is steady. Healthcare is really nice and steady. I'm going to play it safe, 5%. I'm going to leave it at 4% for long-term growth of my cash flows. Now we're dealing with a key input into my model. I value companies on cash flow, and I value companies on earnings per share. Real quick, I value companies on cash flow because the top most valuable companies, if you look at them, they produce high cash flow, and they've shown a track record of growing their free cash flows. That's why Apple's worth $3.4 trillion. And the second player, Microsoft, look at their cash flow. That's why they're worth more than $1 trillion. So I use cash flow. So let's take a look at Solventum's cash flow. I'm going to reduce this guy to a smaller position. So this is cash flow for the first 6 months of their current year. And it's cash flow is cash from operations minus plant, property, equipment, which is CapEx. And the reason there's logic in that is the business produced all this cash that the owners get to use. They can use it for dividends. They can put it on the balance sheet. They can acquire other businesses. They can buy back shares. But CapEx represents how much money they have to put back into the business. So it'd be like owning, a business, let's say a pizza shop. Now, at the end of the month, your pizza business, or at the end of the quarter, your pizza business gives you $2,000 or $5,000 in free cash. But every end of the quarter, you got to buy a new oven. And then the next time you got to buy this, you got to buy the other. It's almost like you're recreating the business every year. That's a bad business. But if you have very little CapEx, that's a very good business. If you have high cash flow, low CapEx, that is Google Alphabet. That's Microsoft. That's Apple. So that's why we want that ratio to be high operating cash flow, low CapEx. In this case here, it's 797 minus 160 for the first 6 months. So that's for the first 6 months. So I'm going to do the formula here with you. Hopefully you guys could see it. And I'm sorry if it's a little bit hard to see, but I'll talk you through it. So we got $797 million minus $160 million. That's for 6 months. So I'm going to multiply it times 2. So that's for the year. For the year, I'm expecting they're probably going to do about $1.2 billion in free cash flow for the current year. I'm going to leave it there. I'm not going to increase it just to play it safe. And these numbers are going to be growing at 5%. So the forecast is they're going to do $1.2 billion for the first year. Then it's going to grow by 5% for the years 2, 3, 4. Terminal values, all cash flows beyond year 4. And those are going to grow at 4%. I'm going to discount. This is like saying they're going to deliver all this cash to you. And let's say you were the sole stockholder of the company. You'd get all that cash. The net present value of all that future cash is going to be determined by discounting it based on the rate of return that you want on this stock. In this case here, I want 9%. And based on a 9% discount factor, we get an intrinsic value of $24.3 billion. That's what the company is worth based on the free cash flows I expect the company is going to produce. Now we need to know how much cash do they have on hand. Well, they gave us a financial statement. So we got the balance sheet. That's where we know how much cash they got. Cash and cash equivalents, $897 million. All right, we can pop that in there. How much debt? Debt's important. Long-term debt, $8.3 billion. And then they have any in the current. Nope. So we got just $8,306 million. That's how much debt. So the present value of all the cash flows I expect plus the cash minus the debt is the equity value of this company. That's what that company is worth to me. Now, when I look at Solventum and I look at their current market cap, they are a $10,160 million company. All right. Shares outstanding is they've got 172.71 million shares outstanding. So the intrinsic value per share is $98. Their current stock price is $58.84. So there's a 67% discount on this stock. If we look at the cash flows that they're going to produce and we want a rate of return of 9%, it gives us a discount of 67%. Cash flows. Cash flows, number one method that most investors use, Warren Buffett, Charlie Munger. You look at those types of Pat Dorsey, read his book, Cash Flows King. Now, I also like to look at earnings per share, and I weigh that with free cash flow method because sometimes a company has tremendous growth in earnings per share, and temporarily their cash flows are low, but eventually they'll be high. With this company, it's expected they're going to do $6.36 in the current year. All right, so let's put that in this formula here, $6.36. I'm not going to give them a PE of 24. They're too young and unproven. They are growing. They showed growth in their financials. They grew slightly. So I'm going to go with like 16. I like their industry. I like the fact that they are in healthcare, which I believe is going to do well going forward. I like a lot of attributes with Solventum. And the current stock price is 58. So there's actually a big discount if we look at earnings per share. We can even lower the earnings per share to 12, which is really, if you read Benjamin Graham's book, is if you have a company that's profitable, producing cash flow, growing, it deserves at least a 12. Sometimes the market just discounts a stock beyond reason. But in this case here, we are looking at a stock that is discounted, blended at 55. My blend is this way. I take two parts. 2/3 of the valuation is free cash flow. 1/3 is earnings per share valuation, 55% discount on Solventum. All right. So we know it's discounted, but do we want this business? Do we think this business is good? Right. So let's talk about Solventum. So Solventum are they highly desirable, okay company, or not desirable? Highly desirable is, hey, these guys, they got competitive advantages. They can keep competitors out, therefore grow really well, be profitable, and generate a lot of free cash. Okay, that'd be the green. That'd be like Microsoft. That'd be Google, Alphabet, Amazon. Those guys are super strong, great barriers. Or are they just kind of middle of the road? They do have some advantages, but overall, just not tremendous advantages. Or are they on the red? Hey, it's a donut shop. Anybody can open it. You got competition everywhere. Prices are really low. Profits are really low. No cash flow to really speak of. I think that Solventum is probably clearly in the gray. And you could argue, yeah, they're in the gray, but you could also say that they're probably crossing over into the green because they do have some patents on some of the med devices that they have for surgeries, dental practices. The other thing that you can argue that, they belong partially in the green is that their relationships with dentists, the kind of like the network effect, the relationship with hospitals, doctors and hospitals are accustomed to using Solventum products for surgeries, and they don't like changing that stuff all that often. So they have stickiness in their business. So if they can start growing, I could definitely see them. Hey, it's going to be very hard to replace Solventum. They got established relationships, that focus in the company of, hey, they're a spinoff from 3M. That real focus on med device is going to really help this business. So I like Solventum. I like the discount at 55%. I like the pedigree of the company that they came from 3M. So I'm going to be buying Solventum stock going forward. I'm going to put a nice buy order in on this company and just start building a position. Back to how much I'm willing to invest in Solventum. For now, I'm willing to bet $5,000 to $10,000. I'll build the position up. I like starting with about $1,000 investment and then building it up from there. I'm going to put Solventum in my portfolio. There's mostly income-based stocks because this stock will eventually pay a dividend and it'll be the right place for it. So that's how we got to a valuation on a company. The company hasn't existed that long. They were issued out as spun off less than a year ago. So far, down 35%. I think people are waiting to see what the heck the company's about. The last month, man, they're rocking. Look at them go. Last 5 days, down a bit. Man, you know what? I'm going to buy probably tomorrow. Unless the market, if I wake up and they're like, oh yeah, Solventum's up 10%, then I'll be like, man, I'm going to have to wait a little bit. So that's where I'm at with Solventum. I like the company. I've been tracking it for some time. I knew the spinoff was coming a year ago. It happened. I've got enough data to be comfortable. I think a 55% discount is going to be potentially rewarding enough for me to take the chance and buy stock in this company. StoneCo announced their earnings today after the market closed, and the stock is down more than 9%. What happened? Why is the stock tanking? I've owned StoneCo for several years, and it's overall a winner for me. I'm up on the stock, but I wanted to take a look at the stock, look at the earnings report, and try to figure out, why is the stock down so much? Did they have bad guidance? Did they perform poorly? I'd like to find that out. At the end of this video, what I'll do is I'll make a decision whether I'm going to buy more shares of StoneCo, I'm going to hold my shares, or I'm going to sell my shares in this high growth company. If you haven't run into StoneCo yet, they are a lot like PayPal down in Brazil. Brazil is a high population country that needs services from a company like StoneCo to do credit card processing, banking, digital banking. All kinds of digital financial services are provided by StoneCo. They've been a high growth company and have recently grown 27% on top line revenue, which is very good. Overall, they've been a profitable company and they generate free cash flow. I'm a value investor and I love growth companies, but growth companies that make money and growth companies that generate cash. And StoneCo has certainly been both. Let's take a close look at StoneCo. The fundamentals of StoneCo look good. The company is located in Brazil. Their market cap is $5.44 billion. So that's a small cap financial services company. Revenue is $2.3 billion. So you're paying about, a little over 2 times revenue for a high growth financial technology company. They have good net income, generate good free cash flow. Their forward P is 12.5, which is really low. And it's just a really low PE for a growth company. Several analysts cover it. They all have a buy rating and they have a price target of $18.38. As of tonight, the stock was down to $15.79. So it really, offers up what looks to be a discount high level. I'm going to do my own analysis and determine a value for StoneCo and then compare it to the stock price. Looking at year to date, the stock is down just a little bit. But if you look at the 1 year chart, it's up 92%. So it's done really well, especially in the October timeframe. From the late October timeframe to the end of 2023, it just went on a tear. It just took off. And over 5 years, the stock is down. This is a stock that Warren Buffett was an owner in. So as you can imagine, when Warren Buffett enters a stock, it creates a buzz and a lot of people go into it. So the stock traded as high as $90 per share, but it's now down to $15.79. So value investors, we want a good deal on a stock, on a great company that is growing. And StoneCo has offered that to investors over the last couple of years. Looking at the growth of StoneCo, boy, they've grown so fast. If you see in 2016, there are 439 million Brazilian coins, up to 9.5 billion, which is a just dramatic rise in growth. And you can see the growth per year on the revenue growth just been really, really impressive. So high growth, high top line, and they're profitable and generate free cash. I'm going to value StoneCo stock by looking at the free cash flows I expect the company is going to produce in the future, discounting those free cash flows to today's value. I'm also going to look at earnings per share and value the stock using earnings per share. To start, I'm going to use free cash flows in the first model, and I'm using the numbers that I got for 2023 of free cash flow. I'm growing it by 20%. The company is growing at 26% on revenue top line, and I'm using a 20% growth factor on free cash flow for the first 4 years. And then the fifth year, I'm going to use a 5% growth rate to establish terminal value. I'm going to use a high weighted average cost of capital because this is an international company located in Brazil, and they are a small company. So I want to be compensated for the additional risk that I'm taking. When I discount all these free cash flows by 13%, I get a net present value of 3.5 billion. I'm going to add the cash, which is 1.1 billion, take away debt, which is 1 billion, and I get to an equity value of 3.6 billion. The market cap is higher at 4.7 billion. So it shows that the stock is currently sold at a premium if you look at the free cash flows of StoneCo. If you look at earnings per share, they look favorable. It's going to be about $1.26 per share. I'm going to have a PE of 24. They are a growth company in a growing part of the world. So I like that. So I'm going to go with a 24. And it gives me a earnings per share value of 24.7. And the current share price is 15.70. So there's actually, if you look at earnings per share, I believe there's about a 57% discount. I put more weight in free cash flows. It's a 2/3 weight of free cash flow calculation versus 1/3 earnings per share. So it gets me to about a 3% discount on StoneCo. In other words, it's fairly priced. I think StoneCo at the new lower price after falling more than 9% at $15.70 seems to be fairly priced on a good company. If they keep growing, all bets are off. I think this could be a huge company that could be worth a lot. So should I buy more shares of StoneCo, hold my shares, or sell my shares? Well, let's take a close look. I first want to be completely bought into the company. I like the company, the business, the industry, the management team. In the case of StoneCo, that's definitely in the cards. I like their business. I like that they're in a growing country, that really the adoption rate and the penetration rate of digital payment systems isn't that high compared to the US. So I like those aspects of the company. They have an excellent balance sheet. They have more cash than they do debt. There's no discount on the company currently. So I'm just going to be a holder of the StoneCo stock. I'm going to wait till the fundamentals change, maybe showing a discount. And if things get worse, then I would be a seller of the stock. I've held StoneCo stock for some time, and it's been a really interesting ride. I've tried to buy it on really low points and really ride up when the stock would run up. So I'm protected with a nice gain on the stock currently, and I'm glad that that's the case. It'd be a different story if I was underwater and I was losing money on this stock and we had a bit of bad news, which is what we got with this earnings. I think that investors are a little nervous that the growth isn't going to be there in this stock, which may be the case, but it may be the case that they're just reading too much into it. I think that the company is very well run. And again, they're in a growth country with very little penetration on digital payments. So I think they have a very large market that they can sell into. And the total addressable market for StoneCo is very big. Those are the things that I really like. I hope you found my video interesting, and I really appreciate you watching. In this video, I wanted to cover super investors. It's the time of the quarter where super investors are revealing what they own, what they're buying, what they're selling. And the information could be quite useful. I like looking at it and getting a few ideas, maybe validating that I'm seeing a few trends and they validate it. I also can draw out that maybe some particular trends are beginning to take shape and I can get into a positive trade early. I wanted to go through super investor data. The primary source of this video is going to be datarama.com. It's a really good website, and I'm going to put the details of that website on the details of this video, but big props to this website. They really provide a lot of useful information. Now, as it is the case in investing, there's too much information available. You can spend 24 hours a day analyzing information, reading, and so forth, trying to interpret, understand information. So it's really important that you really isolate and be very picky on what information you're going to use, what information is helpful to you in your portfolio and the objectives you have in your portfolio. For me, I have particular objectives. I'm 55, heading toward retirement, taking care of my family, having fun trading, taking some chances just to make sure that I really enjoy investing. the positives, the ups and the downs. Now, I isolate down to a couple pieces on this website. I'm going to go through those pieces and share with you what I'm seeing, what trends I'm picking up, and what ideas I'm walking away with after reviewing this website. So as we go into the website, one thing I'll put out there, word of caution, is I just don't look at one super investor and just replicate what they're doing. I don't think that's a wise idea. I think that's a bit risky. Super investors, for example, Warren Buffett, probably the most famous one. He made his Coca-Cola investment decades ago, back when Coca-Cola and the environment, I mean, technology stocks weren't really that popular. It was very different. Well, I'm not going to buy Coca-Cola just because Warren Buffett owns it. I'm going to really analyze companies and make sure that companies that I'm picking really fit my portfolio and are aligned with the objectives that I have for my portfolio. But nothing bad about Warren Buffett. He's awesome. So I'm going to isolate a couple of things. First, I'm going to go over the stats that are provided on the website, the super investor stats, because I think it really aggregates data well. And I'm drawing a few really good pearls of value from that data. And then I'm going to look at Pat Dorsey's portfolio, because I read Pat Dorsey's book. I mean, the guy is just super sharp, understandable. I understand him. I get what he's trying to do. I really like his portfolio. So I'm going to look at his portfolio. All right. So let's look at the super investor stats. First, the top most owned stocks on the stock market. And this is kind of like the usual suspects of really valuable companies. No big surprises here. United Healthcare is showing up. FYI, I think healthcare is going to do really well going forward. We're in a part, or I should say, the economy is not headed toward a bad recession, but it's not growing, tremendously. It's kind of like just the in between. And healthcare should do quite well because it hasn't done great over the last couple of years. And I think it's really setting up to do well. So I'm drawing that, hey, this healthcare payer, United Healthcare, is a real positive one. I happen to own Elevance. I think Elevance has better fundamentals. I used to own United Healthcare, and I switched from United Healthcare to Elevance, and I'm glad I did so. I'm very happy with my return on Elevance. So I noticed that. Now, when I look at big bets, Carvana is out there. That's certainly been a real winner. I've looked at it. It's not the right one for me. But this one here, Alpha Metallurgical Resources, these guys are in the area of coal, and their coal ends up in steel. But I've looked at a couple of coal companies. In fact, one of them came up in a live stream that I was hosting, and coal companies are looking really good. So I'm going to take a deeper dive into Alpha and see what's going on there. Fair Isaac is showing up. Occidental Petroleum, of course, Warren Buffett's a big investor there. Energy, oil, and gas is really beginning to catch a little bit of fire. I think higher oil prices are beginning to make those stocks really work. Of course, you got Apple in there, and I don't understand why they would label Apple as a big bet. They're already a massive market cap. I consider a big bet where you have a small cap company that can double, triple in value in a short period of time. I don't know that Apple's going to double anytime soon. But you got things like Green Brick Partners. And again, CRM, I don't know that I would put them in the big bet category, a little too big. But things that I think are big bet category items are like Carvana, Alpha, Oxy, because Oxy isn't that big compared to Exxon or Chevron. So interesting. So I'm going to draw AMR. We'll take a deeper dive at that one. But if we go down further, the top buys in the last quarter, United Healthcare is showing up again. So again, United Healthcare, Elevance, those type of healthcare payers, it's getting a lot of attention by these really good investors. Of course, Microsoft is there. They're a top 2, market cap company. Uber, awesome. So I'm an Uber stockholder. I really believed in this company, and it looks like super investors are believing too. Apple, of course, I think it's the most valuable company on the stock market. MSCI, and I took a quick peek at this one. These guys provide data within the financial markets space. It looked interesting, but not a deep dive stock for me. CVS, I've been buying into CVS, believe there's a lot of value there. Solventum, this is a spinoff from 3M. They do medical devices and so forth. They're accumulating this stock, which is interesting. Humana, which is a healthcare payer. So again, back to healthcare, we got 1, 2, 3, 4 out of the top 10 stocks that are being accumulated by super investors are in healthcare. I've been sharing with my community on live streams and on videos that I think healthcare has a really good forward 12 to 24 months. And I'm glad to see super investors are agreeing with that observation that I have and the plan that I'm making, which is buying into healthcare companies. I've already got good healthcare companies in my portfolio, and I'm going to continue to do that. Let me take a deeper dive into Solventum. I have a full CVS video on my channel if you want to take a look at that. I have a full Uber video on my channel if you want to look at that. I've got Microsoft on there. And I've got Apple on my channel. So if you want to look at that, Adobe, that's another big bet that I've been making because Adobe is such a quality company and they've been discounted lately. So I'll gladly buy a great company like Adobe. They're number one in their space. Nobody comes close to them. And I'm glad to see super investors are also buying into Adobe. These things help me calibrate what I'm doing right and what I'm doing wrong. I saw Adobe was discounted. I felt like this is a really worthy investment. I jumped into that stock. I've been buying into Adobe. And it's a little vote of confidence from super investors that, hey, I'm doing the right thing. I'm seeing that Adobe's discounted. I'm seeing a good company and buying into it. So that's good to see. And I've got a full Adobe video on my channel as well, if you want to take a look. The last 2 quarters, a little more United Healthcare, Microsoft, Apple, Google Alphabet. I'm buying big into Google Alphabet. Charter, that one's a little bit of a surprise. I feel like Charter Communications is a little bit too much in legacy cable channels, which is just getting depleted by the streaming companies. So that one's a surprise. We got Adobe again, Starbucks is having a great week. And it looks like super investors saw that there was value there. That's been kind of one of the bets that I made recently, put it on my channel that I believed in Starbucks. And it was really, really great to see that the new CEO really created a really big rise in Starbucks. And of course, we got Uber and then Google again, because Google trades on 2 symbols. And but Google is one of my biggest stocks. I believe it's the second biggest position on my portfolio. And I continue to buy into it just because their business is so darn strong. They just keep getting better. And I believe that it's a very good proposition for me. So I've got full videos on Google if you want to take a look at that on my channel. So the one super investor portfolio I'm going to take a closer look at is Pat Dorsey's portfolio. I read his book and I really liked it. In fact, I kind of feel like Pat Dorsey is the newer generation investor that I really looked for ideas on how to really manage my own fund. So I encourage you to read the Pat Dorsey books. He's really sharp. He really is accomplished, and I really like his books. So overall, his holdings include Meta. That's my number 1 position. But the stock that stuck out is Smartsheet. That's interesting. It's a smaller software company, a tiny software company. I want to take a closer look at that. And then the other one was SPT, Sprout Social. And these guys are somewhat of a platform slash software company that helps companies really manage their social advertising, like on social platforms and so forth. That looks interesting. Let's take a closer look at that one. So what did Pat Dorsey buy in the second quarter? He bought some AutoZone and Sprout Social. Interesting. Now, I've looked at AutoZone. That's not the right stock for me. It's a little too much of it's probably going to go sideways, maybe appreciate a little bit. I'm looking for some big winners, and Sprout Social looks interesting. I'll take a closer look at that. What did he sell? Some Smartsheet. He does have a giant position there. He sold some PayPal. Interesting. Upwork. He sold some Meta. That's his biggest position. And he sold some Google. Okay. But I got some good ideas to go with. Let's get into it. So Smartsheet is a small company, $6.7 billion market cap, and they have revenue of $1 billion. This is a newer company that has been around. Their 5-year doesn't look great. Their 1 year, the stock has gone up 22%. Year to date, it's only up 3%. So that's interesting. Maybe there's an opportunity here. Looking at their forward P, it's going to be 37, which is good to see. This is a newer company and they're already profitable. Analysts think it's a buy, but it's not heavily discounted. When I look at their revenue growth, very good revenue growth. So they are already a $1 billion run rate company. They're growing at 22%. That's very good. Software of this type, this is kind of a new category within software. This might be a really good acquisition target for a bigger software company to acquire Smartsheet and then have this capability available to their customers.